jobs. I think that we are certainly going to live through a massive transition about how people learn to work alongside these tools. I mean, the reality is I do think there'll be some number of jobs that are displaced. I think it is a smaller number maybe than some anticipate. We estimate it's around 7%. And I think what's important is that we have programs that help those 7% transition into new fields of work. I think what is more likely is that most of us are going to learn to work alongside these tools. So we estimate about 2/3 of us. If you think about the tasks you do in your daily life, when you look at every industry, there are administrative tasks that are happening everywhere, and that's what AI is most helpful in improving.
From the world of politics to the world of business, Joe Matthew and Kaylee Lines deliver news, insight, and analysis live 2 times a day, every trading day. Balance of Power at 1 and 5 Eastern, only on Bloomberg.
Bringing you up-to-the-minute geopolitical news whenever and wherever it happens. I'm Stephen Engel at Japan's Akasaka Palace in Tokyo, and this is Bloomberg.
Welcome back. This is the opening trade. Just 9 minutes until the start of equity market trading. Perfect time to speak to our Markets Live executive editor, Mark Cudmore. Mark, European futures pointing higher. US futures, though, don't look quite so pretty, pointing a little bit lower. Is the benefit, the risk on from the shutdown, is that limited? Is that shutdown disappearing, I should say? Is that limited and done?
I think, Anna, that the price action is quite worrying despite the gains. And what I mean by that is that we seem to be very jittery and moving very rapidly on relatively low volumes. The shutdown resolution, which we expect this week, will obviously be good news. The 2 reasons I'm a little bit kind of qualify that positivity is that we rallied much further than expected yesterday. We kind of gave back a lot of those gains very quickly on almost no news today, which just shows these markets are jittery. And then when you go into that shutdown resolution, I think there's an assumption that the House passes it first time around. That's not necessarily so clear. There might be a little bit of a, buy the rumor, sell the fact episode around it. So I find the price action not very encouraging. The structural story is the AI theme is still strong. I still expect fresh records for stocks in the coming months. But I'm not convinced that the pullback that started 2 weeks ago is fully exhausted yet, and curious about that for the next couple of weeks.
Mark, you seem to be spending an alarming amount of time looking at crypto at the moment. This is a whole new Mark Cudmore, and I'm fascinated to kind of get your take on what you see happening there.
Yeah, and probably too much time. It's a great kind of call out because half my team think that I'm probably looking for a signal where there might not be one. Having spent too much time analyzing it, I think that the conclusion is the direct pass-through from crypto to the rest of the macro world is pretty minimal. But the indirect pass-through is definitely relevant. I think that the impact on the retail sector, on the wealth fact, is quite large. And I think that if you're going to have a deepening correction in the crypto sector and digital asset treasury companies and all the related kind of crypto sector, digital asset sector overall, then I think that will hurt some of the key retail names in tech as well, and therefore impact the broader stock market, even though the direct wealth transition is not the same. The main investor base does not overlap too much, but it still matters. And the reason I then look at crypto, even though it's less relevant, is that it seems to be the leading indicator. It seems to be the most high beta, so it might give a slight lead when sentiment is turning.
Mark, I want to circle back and end the conversation with the shutdown question. If we do start to get more data prints come out, how many data prints do we need for a clean read?
I think the data is going to be clouded for months, and it's one of these classic cases that every data print is going to be interpreted through the bias of the beholder, of the reader of the data. I think it's going to be that opportunity to spin it either way. The fact is the private sector data we've seen in the economy shows that the economy is doing okay. Sure, it's a K-shaped economy, but it's not collapsing in recession anytime soon.
Yeah. All right, Bloomberg's Markets Live's Mark Cudmore, we thank you so much. We are a few minutes away from the opening trade. Futures are in the green. This is Bloomberg.
your fixed income fix. Watch Bloomberg Real Yield around the world right here on Bloomberg. Context changes everything.
What is going to be the consequence for U.S. markets?
We are basically deep in the European earnings season.
Take a look at how we're faring when it comes to Asian markets.
It's the world's second largest economy with a growing influence in global affairs. Bloomberg The China Show brings you the unmatched expertise you need to keep track of breaking news, in-depth market analysis, and the most influential newsmakers in and around China.
We need to do more to engage the market more.
We are risk on. I think we caught a little sweet spot.
Massive savings right now.
It's already a different game.
Bloomberg The China Show. Weekdays around the world, right here on Bloomberg. Context changes everything. Why do the biggest names in business choose Bloomberg Television?
That's a great question.
It's a very good question.
Interesting question. Good question. Great question.
I so appreciate that question.
You certainly ask interesting questions.
Bloomberg Television. Top experts, great questions.
The Middle East and Africa regions are home to some of the biggest deals and fastest growth in the world. Vibrant resources and high-yield investment opportunities abound. I'm Jumana Versace. Join me on Bloomberg Horizon's Middle East and Africa for the stories, newsmakers, and insights shaping the decisions of traders across this exciting region.
You had heightened levels of volatility.
There's still room to maneuver.
We do see opportunities.
That allows you to increase significantly your net income.
Every trading day, only on Bloomberg.
Bringing you up-to-the-minute news whenever and wherever it happens. I'm Haslinda Amin in Bangkok. This is Bloomberg.
Technology is embedded in every aspect of our lives.
And laying the foundation for the future.
From finance to defense, AI to entertainment.
And from the road to the stars. Bloomberg brings you the latest stories of the people and companies pushing the tech sector to new frontiers.
And the politics that shape global tech markets.
I'm Caroline Hyde in New York.
And I'm Ed Ludlow in San Francisco.
Watch Bloomberg Tech every weekday.
Only on Bloomberg Television.
Tuesday the 11th, good morning. You want to know why European futures are higher? Let me give you Exhibit A. This is the session yesterday on the S&P. Europe went out there at session lows. We then rallied into the close. You had Palantir up 8%. You had Nvidia up 6%. It was quite the rally. People clearly wanted to buy the dip. A little bit of context this morning, though. US futures are lower and going nowhere in a hurry this morning. So how long can Europe hang on to the gains for, I think, is now an open question. That's the story I think you want to watch for the rest of the day. But this morning at the get-go, Critty, things are looking good.
Yeah, a catch-up trade that we're seeing across the board. And I think this one's interesting, though, because you are starting to see some divisions underneath the surface. Euro Stoxx 50 futures higher by 0.3%, but your outperformer this morning is actually right here in the UK, higher by 0.9%. There's some data questions here that we got. There's potential easing that is priced into this market potentially this morning, not to mention some very sector-specific places as well. The DAX, on the other hand, Anna, virtually unchanged at the moment. I think this divergence that you're seeing is really crucial.
Yeah, absolutely. So we'll certainly keep an eye on UK assets, Critty, and that leans into one of the sectors and individual stocks that we're watching this morning. So we'll start there in the middle of that board, UK house builders. I mean, to be honest, watch anything that's related to the UK domestic consumer. We've had weakness in the labour market data, which has prompted markets to price in more cuts from the Bank of England. Is the data not bad enough that throws people off thinking that could be a good thing for UK house builders? Maybe that's the case. So we'll watch to see if they go higher at the start of trade. LVMH in focus. We've had some excellent reporting around LVMH nearing a China store opening, or some China store openings. Luxury demand rebounding seems to be a bit of a theme as we've gone through this year. And Swiss Stock Sky in focus as we get closer, it seems, to a reduced tariff rate for Swiss exports.
How do we price that in? What's it going to look like? It'll take a while to get the Swiss market open this morning. We'll bring you those numbers when they get there. Let's talk about how this open is looking at the start of trade. London, I suspect, is going to be influenced by the data this morning, which is driving the pound lower, which will drive the FTSE higher because of the translated earnings story. So that is one factor why you may see some outperformance. Keep an eye on what's happening with Vodafone as well. The Spanish market is up by 0.3%. The Stock 600 is up by 0.2%. There is a catch-up trade here that we need to factor into our thinking. So where do we go from here, I think, is the more interesting question. US futures are currently negative, so just bear that in mind when you look at the numbers out of Europe. You're basically looking at yesterday's session over in the United States, here in Europe this morning. The CAC is up by 0.3%. I'm going to assume that the DAX and the SMI take a little while to get going, but I think there's some interesting stories buried within them. We'll come back to those in just a moment, Chrissy.
Absolutely. Well, one of the key characteristics of yesterday's trade was this idea of technology, of course, driving the biggest moves. But you had other defensive moves in there as well. The idea you had healthcare, you had gold stocks as well that were moving higher. It's a similar story in today's trade as well. You're seeing green across the screen, but the outperformers are really the defensive ones. I think that's why I'm quite keen, Anna, to wait for the Swiss index to open, because not only are you going to get the healthcare read through, the Swiss stocks tariffs read through as well, but also perhaps some consumer plays like Nestle in there.
Yes, I mean, we are getting maybe a little bit of the Swiss story playing in already, because just opening up the consumer products and services sector, some luxury names in there, of course, and I see Richemont's up by 2%, Swatch is up by just shy of 2%. Also, rather bizarrely, in the same sector, we see Barratt, Holmes, Taylor Wimpey, so some of the UK house builders also benefiting, so from those two separate stories entirely, but rate cut expectations in the UK on the rise. Lower tariffs expectation around Switzerland, both of those stories then coming together to push up stocks in consumer products and services. Telecoms is also higher, up by 0.8%, and Vodafone is the standout gainer. It popped up 5% at the start of trade. It's now up by just 2.8%, but this is a business that has reported numbers this morning, returning to growth in Germany on wholesale revenue. Seems to be the top line from our reporting team about what it is that's going well over at Vodafone.
Maybe appropriately on a day like today, we do see the defence stocks down. Rheinmetall is the biggest weight on the market this morning in terms of the stock 600, but Leonardo is soft. You've got Thales soft as well. Saab is down. BAE Systems, all of those. If I'm looking at a sector that is moving us lower this morning, it's probably actually the defence stocks that are under pressure.
It's a fascinating one. Do valuations... Does the weight of valuations matter from sector to sector? Let's get a little bit more expertise on this and bring in Helen Jewell, Chief Investment Officer for Fundamental Equities EMEA over at BlackRock, joins us around the table. Earlier this morning, Helen, we saw SoftBank come out and talk about that they are actually had sold their stake in NVIDIA back in October. And I think it brought up the question of, is this a kind of tell? Are they ahead of the game of some sort of bubble, pop, pullback, you name it? But then you see a session like yesterday where technology is outpacing everyone else. This morning you're seeing defense, which is also on very lofty valuations, pull back. How do you think about how much weight investors should be putting on the topic of valuation?
Yeah, great to be here. And valuation is always top of mind for everything that we look at. It is really important. And at the moment, what you're seeing, particularly in those AI names, is that they are priced for a certain level of growth to come through. That they're not crazily expensive if you assume the growth is coming through. But anything that brings in any kind of nervousness that growth isn't going to be delivered, you see some big rotations out of those names. But then, as we saw yesterday, quite quickly we see them rebounding. So the valuations don't look crazy, but they do if there's nervousness on the growth story. And that's why I think the AI story, of which we do remain bullish, and we do think that there is a lot further to go, it is likely to be a volatile ride. I mean, someone said to me, I think it's a famous saying, volatility is the price of entry to the market. Maybe when the ride is a little bit higher and you can get double-digit returns almost everywhere globally, the cost of entry is that bit higher. Defence maybe is slightly different. On the defence side of things, although we do remain still positive on the defence story, there perhaps is less in terms of the upside as there is to AI. And I think what you're seeing there is always the case that you have to rotate capital from somewhere. Now, if you are going to reinvest in perhaps other parts of a portfolio, where we're seeing a lot of that capital come is stocks that have done very, very well year to date, and defence is certainly in that group.
Last week, on that same topic, last week we saw the S&P 500 drop 4%. It was the start of a new month, so perhaps just flushing out some of these positions as well. But I think it brought up again another question of if a pullback, if a retracement in the stock market is the equivalent of a pop. How can you tell the difference?
So I think a pop is certainly something which has a much more persistence to it, and more something we're all looking at a huge amount this time versus previous times is the impact of the retail investor around it. Now, that is going to be absolutely key. If you start to see the retail investor really losing that confidence, the nervousness is that you will start to see a bit of a vicious circle in terms of downplays. For fundamental investors, however, Kriti, that can be a real positive because you can buy things at that much, much lower valuation. If we think, to Anna's point, like talking about some of the luxury names that we've seen, where you saw a real pullback earlier this year, a significant pullback, if you stuck by the fundamentals, those are the names that are actually starting to do well in Q4. So that will be actually key. I still wouldn't see that it would be a pop. I still think this is something which has got a multi-year duration, of which it's more a case of how bad might those pullbacks be at any point in time. If you'd have said on Liberation Day, we would be where we are now in terms of the market, I think we would have all been quite surprised at the outcome of the market. Let's not forget, we've just had an earnings season that has seen a real resilience. Fourth consecutive double-digit in the US, beats by 2.5% in Europe. That is what is key for the market. So we're not nervous about a pop. It might just be that the pullbacks feel a little bit scarier than they've done historically.
But your sense is that you should still buy dips?
Very much so. In the AI space in particular, which I think is obviously a key area that we're talking about now. The key thing about that AI story is the level of capex and the level of cash flow that these companies have. It is also about this circularity around the more chips that you need, the more the chips can do, the more chips that you need, and that circularity around it. And I think also the political nature of this. AI is not just about making our work lives easier. There is much, much more to this. So very much so. Being selective within the names, that's also very, very important. This isn't just a kind of all-in on everything. And I think the non-profit tech names is still an area that we would be particularly kind of nervous about really wanting to understand.
So you're still in capital appreciation mode rather than capital preservation mode?
Yes, yes.
What would change? What would need to change for you to kind of think about altering that? Are your clients still as confident? Are they beginning to? They've made decent gains, as you say. You've had double-digit gains everywhere. Are they confident that that is going to continue, or are they like looking at their portfolios going, that's been great, I want to protect that now?
Yeah, so there's two things going on. It is the single biggest question I think anybody in our space is getting is, has this gone too far? Is this a bubble? And we're very much saying absolutely no. It is a building block of any portfolio at the moment. And in terms of what might we be looking at, I think one of the key things is if in terms of what the chips can actually do, that starts to fade. Because at the moment, what is very different to what we saw in, for example, the dot-com rally, is it needs this continual reinvestment of capex. It isn't just a one and done in the way that line pipeline is. So that, I think, would be key in terms of things that we're watching for. In terms of the portfolio, though, and I know this is such a kind of cliche thing to say, it's a thing we talk about everywhere, the diversification of that portfolio remains absolutely critical. In any portfolio, you can't just, if you wanted the portfolio that was going to perform best, you'd have been 100% in on a couple of AI names.
So I've got to accept underperformance in my portfolio to play the game, because
risk-adjusted returns is probably a better way I'd like to put it than underperformance.
But it is going to be underperformance. You've got to accept that because the risk around the sort of that volatility around the AI trade is going to be enormous.
Yeah.
So I have to have things that are going to do less well in order to protect my portfolio.
To ballast against it. When you've got markets that are this narrow, when you've got markets where the index itself is 10th percentile, if you want to have some balance in portfolios, if you want to avoid weeks like last week,
and you're confident that diversification is going to protect me, that correlations are not going to be extreme if we do see a rollover?
I mean, we are seeing this kind of big AI mega theme, and even gold at the moment seems to be correlated to a certain extent. But there are places that you are able to protect against it. So at any point in time, there is a part of the market that if you were underweight, you would have seen yourself be hurt. The Japan, UK house builders, just to take a one-day example, luxury goods. The other part in Europe that we're watching very closely is those, we call them the sleeping giants, that haven't done that well year to date, in part because of where the dollar has been. That has now stabilised. And what you're seeing in those names is the valuations actually looking really interesting. So in a short way, yes, there is diversification within the market, albeit a lot of it is being sucked into those AI names.
And Helen, we talked in the past about the link between the AI theme and some of the clean energy plays in Europe, and I know that's a theme that you're leaning into still. I read a Bloomberg opinion piece which reminded me 3/4 of electricity in Europe and the UK year to date has come from clean power sources, which the writer says, 15 years ago that would have been considered science fiction. So it just shows the pace at which some of this is changing. Is that a theme that you still play from here, or has it just come so far it needs to pause?
No, that is probably the key thing at the moment. The one other thing that could stop the big AI story, I should have mentioned this one to Guy, is that there's not enough power to literally power it. And so the investment into keeping the power, there are so many great stats that you can use around it. The amount of renewable energy is equal to China in the EU renewable coming on board between 2030. So many great stats that really put the amount of power into context. So anything that helps that is going to be super supportive. We need more energy. And the energy from whatever sources it needs to be is absolutely key. I think the other thing we're looking at very closely as well is that making sure that we're not just always throwing the baby out with the bathwater. There's been a lot of negativity on software names, but actually what you often see is that you can have persistence and progress running alongside each other. The two things aren't mutually exclusive, and we're seeing this big K-shape in terms of stock performance and earnings performance. But actually really understanding those stocks that are maybe like categorized in a particular group, whether it's software, whether it is the wrong part of energy, because it's not deemed to be kind of like part of the solution. Those names can actually be trading at a very interesting, an interesting multiple. And the earnings, Anna, have been actually much, much better than we thought. Q3 earnings have been decent. They've been okay.
Yeah, so you're suggesting that some of those software names that maybe people have worried about AI competition could still have a role.
Exactly right.
And I mean, is that part of the sleeping giants narrative maybe around Europe?
Exactly. So all of these names, and again, for us as fundamental investors, this is where it's really interesting, really sifting through those. Where has everything just been categorized? We're seeing big sector, everything that's linked to a particular sector just seems to go up or down in the same way. So for us, really sifting through that is a really, really interesting opportunity, and that's something that we're looking at. That's something we're looking at as well.
Great stuff, Helen. Nice to see you.
Great to see you. Thanks for having me.
A lot going on. Helen Jewell, CIO for Fundamental Equities EMEA at BlackRock. Let's talk about some of those equities. Let's take a look at the Core 6. This is what we are looking at this morning in terms of some of the narratives that we're watching. Maybe some of the Swiss stocks are doing a little bit better. We're up by 0.6% on Nestle, but it's interesting to see some of the outperformance coming through in luxury names this morning. Appropriately, maybe, the defence stocks are soft. Let's talk to Chloe Melly about what we are watching.
Good morning, guys. So Vodafone is up quite strongly this morning. We're up 5% for Vodafone after it said that it targets the upper end of its guidance, and it also returned to growth in Germany, which is its biggest market. So it seems that the turnaround that we've been seeing for the last couple of years under the new CEO has been starting to pay off, and it is being rewarded this morning with the shares up 5.6% now. Moving over to Munich Reinsurance, Munich Re is down this morning. It is down almost 2% after cutting its insurance revenue guidance. The profit actually did rise, but this guidance cut is really now weighing on the shares for Munich Re. Moving on, but staying in Germany, we've got Hensoldt in the defense space, which is also down 5.5%. It said to investors at a Capital Markets Day that it was targeting 10% revenue growth in 2026, which might seem like a good number, but that is a number that disappointed investors, and we are down quite a lot this morning. It has dragged down as well the shares of other defense companies in Europe this morning. And finally, let's move over to the chemicals sector, and Jefferies analysts have done a bunch of ratings across the sector, but we're focusing here on Evonik and Croda. They are the ones that are facing the biggest challenges, and analysts have said that trying to find earnings support within that sector in 2026 is like trying to find a mirage in the desert. So that is quite strong words, and that is dragging down those shares in those two names in particular this morning.
Okay, Chloe, thank you. Chloe Melly from our equities team. Coming up, we'll focus in on another stock, LVMH in focus this morning. The luxury group nears major store openings in China in a bet on the luxury rebound holding. We'll get into that conversation next. This is Bloomberg.
From our studios in New York and San Francisco, our expert hosts have the data and analysis from the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action. Live every weekday, only on Bloomberg Television. Context changes everything. U.S. jobs numbers are released. Bloomberg has the report under surveillance with crucial data and expert analysis at terminal speed. Nobody covers Jobs Day like Bloomberg.
Key investors, top executives, global innovators. Join me for in-depth conversations with the biggest newsmakers on the day's top stories. Insight with Haslinda Amin, only on Bloomberg. We're coming to you live from Kuala Lumpur. The whole world is here.
The APEC Leaders Summit bringing together heads of states of 21 APEC economies.
The White House is trying to use the stops to gain additional leverage.
This big deal with a number of the biggest companies in South Korea.
That's a big number.
Deals can't be done.
Trust Bloomberg for on-the-ground coverage.
Korea is not Japan.
Up-to-the-minute reporting.
In this latest salvo of this trade war.
What a visual.
And the analysis you need.
China's not going anywhere, nor are we.
At a time when policy in Washington is driving Wall Street, we draw a distinction between the rhetoric and the action, bringing you market-moving guests and original reporting. This is Bloomberg Surveillance.
Good morning, this is Bloomberg Daybreak Europe. I'm Tom McKenzie in London. These are the stories that set your agenda.
Taking you from the U.S. market's close to the overnight session in Asia, we'll walk you through what you need to know to kickstart Europe's trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in to Daybreak Europe, only on Bloomberg Television. Context changes everything. It's a multi-trillion-dollar industry. We'll show you what's happening in ETFs like no one else. ETF IQ, only on Bloomberg.
Tuesday, good morning. Welcome back. Futures are pretty positive. We are still dealing with yesterday's session in the United States, which was very positive, and we've got to price a little bit of that in terms of the narrative we're watching here in Europe. The FTSE 100, though, is definitely outperforming. Some of that's to do with single stocks that we are watching. Some of that is to do with the fact that we have had the pound under pressure. But elsewhere, we're still pretty good as well. One of the stocks that is up this morning is LVMH. The luxury sector is having a good day. And Bloomberg has learned that the company is set to open major stores in China as high-end brands see early signs of sales rebounding in the world's second largest economy. For more on this, we're joined by our Shanghai Bureau Chief, Charlie Zhu. Charlie, talk us through the significance. We've been waiting for these stores to open in China. Kind of felt like it's been delayed a little bit as we've wondered what is happening with the Chinese consumer. Now we're on. What does that tell us about A, the Chinese economy, and B, what is happening with LVMH's strategy?
Yeah, what we're hearing is 4 labels of LVMH, including Dior, Louis Vuitton, are opening multi-story stores in Beijing, and at the same time, Louis Vuitton is said to be, close to opening a new store in Shanghai for Christian Dior. And this, is being read as a sign that China's luxury spending is bottoming out, showing signs of recovery. If you still remember, Louis Vuitton, LVMH, and Kering, which owns Gucci, just reported better than expected sales number for the third quarter, and that all is being read by analysts as a sign that the consumer spending, luxury consumer spending in the world's in one of the world's largest luxury market is stabilizing, and at the same time, some global retail sellers have also voiced cautious optimism about the prospect and recovery in one of the world's largest economies, second largest actually.
Well, Charlie, you use the word stabilizing, of course, in the Chinese economy. We know that there is a broader slowdown that has a lot of investors worried. How much of this recovery is sustainable? How much of it has legs?
That's a good question. Actually, there's still a lot of concerns about the prospect of the Chinese economy. The slowdown is continuing. Consumer spending, consumer sentiment remains very weak. The 1.2% jump in China's core CPI for last month, was a bit misleading because based on what we heard from analysts, half of that gain was, coming from the sharp price increases in gold jewelries, and the rest of the items in the basket, from energy to housing to food, remains in negative territory. That shows how weak Chinese consumer sentiment it remains. It remains very weak, and one of the main reasons is the property market. Property prices are still is declining, and the property accounts for household. Vast majority of households are relying on property as for income or for wealth. 80% of the wealth come from from property. And the decline has been going on for 5 years, and there's still no sign of bottoming out. So that really hurt consumer sentiment. People are not willing to spend because of the wealth keeps shrinking.
Yes. Now, when we speak about gold prices on this program, we're often talking about the role of the central bank in China buying up gold. That's been a theme for a while. But here, of course, there's a link into the luxury sector. Weave in the gold story for us, Charlie.
Yeah, both gold is different compared to, if people are buying gold in China because, that's considered a safe haven asset, right? And the bond market, was performing very poorly this year, and the stock market just, started to rebound. For a long period of time, gold, has been offering, more returns to investors. So there is and people are just following the herd mentality. Who knows, how long this is gonna last.
All right. Bloomberg Shanghai Bureau Chief Charlie Zhu walking us through the story when it comes to luxury and, of course, how China's role plays, how China's economy plays a role in it. We thank you so much. Let's go to another Bloomberg scoop. We understand that Switzerland is close to securing a 15% tariff on its exports to the United States. The deal, which may be concluded within the next 2 weeks, would be a relief after Switzerland was hit with a punishing 39% levy over in August. Elsewhere, President Donald Trump says the United States was getting, quote, pretty close to a trade deal with India.
We're making a deal with India, a much different deal than we had in the past. So right now they don't love me, but they'll love us again. We're getting a fair deal, just a fair trade deal. We had pretty unfair trade deals. They're very good negotiators, sir. Just you have to take a look at that, if you would, please. But we're getting close, Scott. I think we're pretty close to doing a deal that's good for everybody, right?
For more on this, Bloomberg's trade czar Brendan Murray joins us around the table. Brendan, let's start with Switzerland, then we'll get to India. What do we know about this deal that takes a tariff rate from 39% to 15%?
Well, we've been talking about a Swiss deal being close for several months now. Switzerland has been to the altar and gotten disappointed before, so I think we have to sort of put that into context. What we do know is that both sides are coming closer together. We heard U.S. Treasury Secretary, U.S. Trade Representative Jameson Greer say last week that Switzerland's pharmaceutical companies were offering to produce drugs in the U.S., that things like high-tech, high-value manufactured goods like aircraft parts that are made in Switzerland could be produced in the U.S., and that he even said gold could be smelted. Switzerland has a lot of gold trade with the U.S., and that gold could be smelted in the U.S. So the U.S. Administration sees Switzerland moving more and more in their direction toward producing the goods that are produced in Switzerland in the U.S. How that deal comes together and whether Switzerland can get from 39% down to the rest of the European Union that has 15% is still the big question. India, we have also been talking about being close since March. Yep. They were initially a front runner for one of these Trump trade deals, and talks have dragged on and on. It's important for India to lower that rate because their rival economies in the region have negotiated lower rates in the interim. So India has a lot of trade with Russia. Trump wants to reduce its reliance on Russian oil, Russian military hardware, and wants to see some of that business come to the U.S.
Great to see you. Thanks for stopping by to see us. You're going to be a busy man. We're going to watch the central bank story evolve. President Trump, certainly a lot on that subject over the last 24, 48 hours. I want to turn our attention, Brendan, to what is happening with UK assets and figure out what is happening there. We've got a big move in the pound this morning. You've got a big move in the UK 2-year as well, which is kind of coming up against, I guess, the top of its recent range, so it's going to be interesting to see what happens there. So yields are moving lower on the fact that we've basically got UK unemployment at the highest levels since COVID. The jobs market is beginning to weaken. Is this enough, really, to tip the governor over into the cutting camp? We didn't see that last time, but people are now increasingly pricing in December as an almost certain move now. But we've got to get through the budget.
And it seems as if that, you know, the data, the excuse this morning is the data and the weakness in the labour market story. And what's interesting, diving into the Deutsche Bank research on this subject, if you don't trust the overall headline unemployment data, and there has been a lot of issues with it, they're pointing towards redundancy data, pointing toward HMRC payroll data, payrolled employees data. All of that is pointing towards something softer. And interesting in terms of sectors, pulling payrolls down, it was a combination of weaker hiring in retail, but also in information and communications sectors. So this is tech.
The problem is we're about to have a budget that is going to be anti-growth. Is going to raise taxes, is going to make it harder to employ people in this country.
And the last budget was deemed to be anti-new employment, at least, wasn't it? Because it provided a disincentive to employ more people with the higher national insurance charges.
So how do we get out of it? What is it that delivers us from this? Is it going to be a series of aggressive rate cuts that are now going to be required, maybe from the Bank of England, in order to kind of stabilise and offset the situation?
And that's what got priced in immediately after we saw the data, right? More 28 basis points worth of cuts showing up into that market.
And that had an impact on stocks. So we see anything exposed to the UK consumer going a little bit higher. So some of the builders in the UK up by more than 1.5% in this morning's session as a result of that weaker rate story. Coming up on the programme, we're going to be speaking to Federico Gonzalez, the CEO of Radisson Hotel Group. Lots to talk about in terms of the travel and tourism sector. Is there anything K-shaped about the UK tourism market, US tourism market right now? We'll talk about that. Where's that next hot place to go to? The next really in-demand place for global travel? We'll talk about all of that. That's coming up next. This is Bloomberg.
Crises, two essential crises, and for both it's now or never: democracy and climate, and they are absolutely interlinked, and we have to solve them together. We're losing the democratic infrastructure and norms to deal with the climate, and we're losing the climate stability that is essential for a democracy. We have to solve them together. We've never faced a threat like this to our democracy at a time when it's a perfect storm, at a time when we're being told by climate scientists, some of you may be in this room, that we have to cut our emissions, fossil fuel emissions, in half in 5 years now. You know, when I started to realize what was happening, it was 12 years, and we haven't done it.
Tune in to Bloomberg Business Week Daily.
We got to talk crypto.
From the magazine that helps global leaders stay ahead.
What's the conversation around your company?
Bringing you insight on the people, companies, and trends shaping today's complex economy.
Planning very big things.
A new level of premium.
Plus global business, finance, and tech news as it happens.
The floodgates of innovation are going to open up.
You can't fake passion. You either are or you aren't.
Bloomberg Business Week Daily, only on Bloomberg.
Asia is at the forefront of some of the world's biggest stories. I'm Chevrian in Tokyo.
And I'm Heidi Stroud-Watts here in Sydney, where the trading day begins. We're here in the center of all the action to get you set up with the numbers, news, and knowledge you need for the day ahead.
The demand is indeed recovering. We've been waiting for this moment.
The opportunity of a century.
Join us on Bloomberg The Asia Trade. Weekdays only on Bloomberg TV. Context changes everything.
Good morning. This is Bloomberg Surveillance.
Welcome back to the opening trade.
Watch Bloomberg Tech.
This is the Asia Trade.
This is Wall Street Week. Welcome to Balance of Power.
This is Bloomberg Television.
Welcome back to the opening trade. About 30 minutes into today's session, green on the screen across the board, but the real outperformer is right here in the FTSE 100. It feels like today is a little bit of a catch-up trade kind of day, but when you look at the movers of the FTSE 100, a lot of this is tech-driven, a little bit of healthcare in there as well, Guy.
Okay, let's talk about what is happening with the market internals and figure out what is going on here. Look, there's a couple of things you want to note, one of which is you're seeing a definite outperformance to the upside, 419 up versus 151 down. However, and this is a big however, and Mark Carbon was pointing this out a little bit earlier on, what we are seeing at the moment is moves on low volume. This is an unconvinced market. This is not a convinced market about where we go, which direction, up or down. I think the kind of the intraday story kind of speaks to that a little bit. In terms of where we are seeing some gains today, tech is on the front foot. Unsurprising. Did you see what happened yesterday? Palantir up 8%, Nvidia up 6% in yesterday's session. That's feeding through here in Europe this morning to an ASML move, which is up by 1.8%. You're also seeing gains in some of the pharma stocks this morning, up by 2.35 for AstraZeneca, and the luxury names are on the front foot as well, LVMH. It is the 11th, and I keep making this point that maybe it is appropriate the defense stocks are down, but they are definitely down today. You're seeing rotation out of names like Rheinmetall, Leonardo in the defense space. Saab is down. BAE Systems is also tracking a little bit lower as well. Rheinmetall in Germany down by 1.7%. Leonardo down by 1.46%, making also comments about UK defense spending and helicopters this morning as well. The other stock I want to mention is Munich Re, which is down as well. A little bit of a disappointment. We spoke to the CFO a little bit earlier on in the session to talk about what they see in their numbers and maybe a little bit of a miss in some areas to the downside, Anna.
Let's talk about some of the other big picture stories that we have in focus this morning then, guys. SoftBank has sold its entire stake in Nvidia, pocketing nearly $6 billion. The sale comes ahead of a rash of planned investments by founder Masayoshi Son, including an upcoming $30 billion investment in OpenAI and a $1 trillion AI manufacturing hub in Arizona. UK unemployment has risen more than expected, further evidence of a cooling labour market that prompted several BOE officials to call for an interest rate cut last week. The jobless rate climbed to 5% in the 3 months through September, up from 4.8% the month before, and the highest since early 2021. And the record-setting 41-day U.S. government shutdown may end as soon as Wednesday after the Senate passed a temporary funding measure backed by a group of 8 centrist Democrats. The Republican-controlled House must still approve the spending package, which keeps most of the government open until the end of January and some agencies out to the end of September. But Speaker Mike Johnson said he expects it will pass quickly. Guy.
Anna, if that happens, are we about to get a deluge of data which is going to tell us about what is happening in the US economy? What is happening in the world's biggest economy is a key question that a lot of people are trying to answer right now. In my view, if you want to know the answer to that question, what's going on economically, you ask an airline CEO or the CEO of one of the world's biggest hotel groups. Fortunately, we have one of those with us right now. Federica Gonzalez is the CEO of the hotel giant Radisson and author of the new book, Working and Living Abroad.
Good morning.
Nice to see you.
Thank you.
What's going on? We're trying to figure out what's happening with the global economy. We're trying to figure out what's happening with the US economy. There's a lot of talk about K-shaped economies at the moment. Yes. It's good at the top, bad at the bottom. Yes. What are you seeing?
Okay, I think we are seeing, as you say, economy worldwide is doing differently by region, okay, very, very different trends. I think if you look to EMEA, for example, consumer is back into travel after COVID. I think we are seeing business recovering, business travel and leisure also travel growing significantly. I think if you inside EMEA, you see countries like Italy, Spain, Southern Europe is doing particularly well. Germany is struggling a bit. The growth is not coming in line with the economy, and I think very strong growth in Middle East, in Africa, in some of the destinations, and very strong growth in Asia. China is not yet back to the growth levels that we had in the past, but actually is slightly recovering. And I think in the US, after a year where both inbound and outbound has not been growing significantly, we are seeing a slow recovery for around 1-2%.
What do you think about this kind of idea of the K-shaped recovery? You got upper end doing very well, bottom end of the market doing less well. Are you seeing that in your business as well?
We are. I think when you look across segments and you get, for example, countries like France, for example, where actually the 4 and 5 star segment is recovering. Meanwhile, the 1, 2, 3 stars is not growing as much. Now, that is also linked to public spending many times. Many times the 1 to 3 stars are more linked to public spending, workers moving around the country.
Is that true in the US as well?
It's also true in the US, yes. I think you see 4 and 5 more linked to higher-end travelers and more leisure growth. Meanwhile, the lower segment is more on the normal business economy.
Well, sticking with the theme of the K-shaped recovery, talk to us about the labor market here. Are you finding it hard to hire right now?
Yes.
Or are you hiring at all?
Well, actually, we are, but actually it's extremely difficult. I have to say, and always say, and this I give an open invitation to any administration of the world to help us do it better. I think nearly in any country in Europe, for example, we know, and actually we could help to say how many people we need every year. We would get all the hoteliers and the food and drinks business of the country. We could tell any government how many people we need any simple year to fill up the jobs. And we could get organized to train them. I think, unfortunately, what we are lacking is lack of political decision to make sure that we get the right people in the right place. I recall years ago, we would be training people all over Europe. Okay, we would get people in Germany, people in the UK, or people in Spain, where we would be bringing people from wherever the government would say that we could bring them, and we could train them. And actually, I think that is something that I think is lacking more in Europe. I was 2 weeks ago in India, where actually the government is establishing themselves programs like this, where the hoteliers can go to training and recruitment centers, where actually you go there and you say, I need 500. You will train them, you will get them, and they will work. And I think I always say that actually hotel business is a business where in many countries of the world has been always an entry point to people into the industry and into society. Because usually, I mean, when you start, you don't need to use or master the language, but you can learn the language, you can learn the skills. So I think it's an open opportunity for whoever in the administration of any country is watching this.
Are you offering me a job, Federico?
Yes. So I'm happy. We are happy, I think, all the hoteliers to help them understand what we need. And I don't think it's that complex, to do it.
In the face of those challenges that you're seeing, really, you named India as one of the countries to address. What do you do in the absence of that? With the people that you do have, does that mean that the cost of labor goes up, that wages go higher, the benefits go higher? How do you keep the people you have?
Yes, I think actually the two trends you're mentioning are right. Costs are increasing, not only cost of the labor we employ, but also cost of energy has been increasing significantly. Obviously, we are trying, I think, all over to try to optimize any function in the back office, to try to reduce the amount of labor we need. But actually, you still need the people in front of the consumer, to do a good job and to train. So we are trying to cope with those costs and trying to absorb them, from within, to make sure that we still deliver the profitability we have to.
You talked about the different areas of your business that are growing, Federico, and you said Asia is really growing. Where are the biggest opportunities for you as a business?
Well, I think opportunities. I think we are very happy because I think beyond Asia growing very well, I think we have opportunities all over the world. I think even, for example, in more mature markets like Europe, I mean, we are growing significantly well in Italy. We are growing very well in France. We are growing very well in Spain. Also in the UK. So I think even if Europe is growing less, I think big opportunities. I think in Asia, I mean, all Asian economies are growing, and in terms of hotels, but I think there are two sectors. One is resorts are growing significantly. We are happy to have more than 170 resorts in the world, and actually we see all over Asia the resorts business growing nearly exponentially, so that's good. I think second is India, possibly one of the markets where the largest growth opportunity exists. We are the number 2 company in India, but actually we see you have 1.5 billion people. The middle class is growing, and actually that after the middle class growth, you have the travel, both in leisure and business. So I think India is a huge business opportunity.
Federico, you've talked about the labour story, you've talked about the absence of labour, the labour you need. One of the things that this industry looks kind of vulnerable to or has an opportunity to do is to bring in AI.
Yes.
How much are you spending on AI right now? How much do you think it's going to change your business? How does it change your business?
I think what we know for certain is that it's going to change the business.
Yes.
How, we are not yet.
That bit you haven't figured out yet.
No, I think there are obvious areas. I was actually last week, Monday and Tuesday, I was with the Google team in New York, reviewing actually everything Google is doing, everything that is happening, and how it would affect, and what are the solutions they are building. Actually, there is an obvious area where you look to all the back office, all the administration, all the repetitive tasks we have that will be reduced, what will help eventually, some of that labor scarcity that we have. But I think the biggest one is, I think is going to enable us to step change the level of personalization.
Right.
Well, when you think about what AI can bring, is identify in a much better way who is the different targets, what is the sweet spot that you need to do to step change their experience.
So how's that going to change? I'm checking into a hotel. I'm staying at one of your hotels. How's my experience going to change?
I should be knowing much better what you need and what you are looking for, and be able to offer that automatically. Today, and I like it, I have to say, it's one of the things I like of hospitality, so we need to see how we balance. I like also to have the intuition in the person in the reception when they look to your eyes and they say, okay, what is this person willing to do? That intuition is worth a lot of money, okay? And I don't want to lose it. But I think maybe in 50%, 60% of the occasions, you will have that nearly automatized, so we can add a bit more sugar.
So AI is a mind reader, basically.
Yeah,
that's
basically.
Right.
So you have
It's
intuition.
a mind guessing.
Intuition plus data equals better service.
That's right. I think so. So far, it has been more intuition.
Yes.
If you apply some data, but you keep the intuition.
Yes.
What I want to avoid is machines.
Right, yes. So no automated check-in then just yet. Federico, you mentioned that the hotel sector can be an entry point for people in new cultures, new environments. And there are a lot of people living abroad in the hotel sector, working in the hotel sector. And you've written about this some 10 years ago. You wrote about this, about working abroad. You've got a new edition of your book out. And I'm interested that you've added a chapter on working with China and working in China. And I wonder what it is that you've learned over the intervening period that you thought was important to say.
Well, I think you're right. I mean, actually, when I wrote the first edition 10 years ago, I had been acting more with US. I had worked for Disney, I had worked for Procter, and then I had been working obviously more in Europe, a bit less in Asia. And I had never worked with Chinese. Then when I came into Radisson, I decided to spend time with Chinese and in China. And I think it's a culture that we know less. Okay? I think obviously when we have been trading and we have been, having discussions, dinners and lunches with American people, with countries from all over Europe. But I think with Chinese is less common. Okay? So I think it was worth to share some thoughts. I think the obvious one is just communication. Okay, I mean, I think when you work with a Chinese culture, communication is never direct. Okay, it's indirect communication versus Europe and the US, where the communication is much more direct, and that leads to a huge amount of confusion. Okay, because obviously it's less easy to get a yes or a no. Okay, you may get the yes and the no, but you don't know really how. Okay, and on the contrary, when you say yes or no in a very direct way, it may create some confusion. So I think there is a big part on communication, and I think there's also something that I think, from a European mind point of view, for me was mind blowing. Is if I think China, or I mean, it's a very generic statement, but I think the Chinese as a population, they have a collective idea about China that is bigger than what we usually have as our own country. Okay, they think of China as something, a collective mission, I don't know if I can say, that is different to what actually is more individualistic in the case of Western Europe or the US.
It's interesting in terms of just the relationship between the US and China at the moment.
Yeah.
When you hear a yes, maybe it's not a yes. Maybe it's
and if you say no, you don't know really what's the reaction.
Yeah, precisely.
Maybe they'll host their summit at a Radisson. Federico Gonzalez, Radisson Hotel Group CEO, joining us around the table this morning. We thank you so much. Coming up on the program, we speak to Benjamin Haddad, French Minister Delegate for Europe, as the government's budget talks continue. He's also, I should say, the French Foreign Minister. Lots to discuss with him. Stick with us. This is Bloomberg.
Nobu-san, would you say, when you look at your career, that the pivotal moment was actually that meeting with Robert De Niro? It took him 4 years to convince you to open a restaurant near him. You eventually did, and that started a partnership that has lasted through the decade.
You know, I met him 1988 after my first restaurant opened. He asked me to come to open the restaurant in New York. And beginning, I didn't know what he did.
You didn't know he was an actor?
No, I don't know what he doing because I never watched the movies. You know, I was traveling the business. But of course, after people, hey, Nobu, so you must know him, and then I understand.
How is he as a partner?
He's for me, and a great partner. He understands to my concept. He support me 100%. But he's a very smart people. Sometimes so strange idea, but it's good idea. So, example, Nobu Hotels idea come from him. He say, hey Nobu, so we have a lot of new restaurants coming in somebody's hotel. For him, doesn't make any sense. Then we start Nobu Hotel in Las Vegas 11 years ago. Now it's a big success. So next step is the residence.
Astonishing day for US technology.
It's shaping the region's technology ecosystem.
Asia's biggest tech news and innovation.
Join me each week on Wall Street Week for stories of capitalism from business, markets, economics, tech, and climate. More than what you need to know, it's what you need to think about.
Welcome back to the opening trade. About 47 minutes into today's session. Green on the screen across the board. A little bit of a catch-up trade from what we saw in yesterday's session in the United States. We are seeing a FTSE 100 that is slightly outperforming higher by about 1%. I should take that back. It is outperforming in a big way by about 1%. There's lots going on there. And a lot going on in the day ahead as well. Let's go through what's on the agenda. We have China Singles Day. So, of course, some of that check on the consumer sentiment over in that part of the world. The Treasury market, however, is closed in the United States. So when it comes to a market read-through, perhaps reaction around this government shutdown that we are waiting to get updates on, you're not going to see it today because, again, the bond market is closed. We do have French budget talks happening in the background. We're going to discuss that in just a moment as well. Plus a G7 foreign ministers meeting in Ontario, a little bit of European data sprinkled across the day as well.
We'll come back to that story in just a moment and figure out what is going to be happening with some of those key meetings that we are watching. Let's talk about what is on Valerie Teitel's mind and where we go from here. She's getting excited. My question is, what happens with that? If the House passes on Wednesday, we then get an agenda for kind of what the next few days looks like. What are the key pieces that we need to figure out of the puzzle at this point in terms of telling us what the data, what's real and what's not?
Well, when it comes to least the BLS, we're very interested to know when they're going to be back to work. Will it be this week? And then does that perhaps entail that we do get a non-farm payroll print on Friday? The other key thing that we're really wanting to hear from the BLS is what they plan on doing with the October CPI report that they have not been putting together since they've been out of the office.
They've got no inputs into that.
So they do have some because they do scrape some from online. However, a majority of them are done face-to-face when it comes to data collection. So there is going to be some gaps in the data. And, I think this is going to be key for a few reasons. We've already talked about worsening data quality, not just in the U.S., even here in the U.K., it's had worsening data quality. And some of these components in the CPI aren't collected every month. So if you skip a month and you have to interpolate, you essentially are guessing over a 4-month period where something has gone. And that can have ramifications for the data set for months to come. I mean, even well into May of next year. And that is especially important because we know how influential the CPI report is for markets and for the Fed on their path forward for rates.
Okay, Valerie, thank you very much. Valerie Teitel with her thoughts on how quickly we can get back to the data that markets want in order to work out where the US economy goes from here. Let's talk about another economy closer to home, the French one. French Prime Minister Sébastien Lecornu is still seeking a compromise to close-door talks to salvage the 2026 budget. Lecornu must secure a deal to avoid having to resign like his predecessors had to. For more, we're pleased we're joined by Benjamin Haddad, who is the French Minister of European Affairs. Minister, thank you so much for joining us. How confident are you that a budget is passed? What is the last sticking point here? What issue needs to be addressed?
This is a very important moment for the country. You know, the Prime Minister Le Cornu and the government has proposed a budget to parliamentarians and decided to make the brave choice to tell parliamentarians, now it's up to you to debate, to amend, and to go all the way to the vote. You know, in France, historically, we have a tradition of having absolute majorities in parliament. And today, now, we look like our European neighbors, which is that we have a fragmented parliament, and so we need to find compromise. We need to build coalitions. We need to let parliamentarians decide and vote and debate. And this is what's going on right now. We had an important first part of the budget for Social Security that was voted this weekend by a majority of parliamentarians, and the debate is going through. The country needs a budget. We need to cut public spending. We need to cut our deficit. This is obviously the priority for the government. And I think right now we're seeing a spirit of compromise that's taking over among parliamentarians to move forward. And once again, you know, in a parliament where you have no absolute majority, I think it's really important now that we just make a step towards one another for the country and also for Europe.
Okay, so you sound quite positive. We'll watch those developments and see how they come to pass. Something that I know that you're perhaps reaching out to European colleagues about, Minister, is Shein, the Chinese fashion retailer, and I know that it's attracted a lot of political attention, a lot of attention generally over in the French market, and now there seems to be a call to try and get other European countries on side. What do you want from Europe or from other European partners around Shein?
You know, let's be clear. We in Europe should not be naive. We have rules. We have a rule of law, and it needs to be respected by every company, by every actor that decides to invest in Europe. We have a company, Shein, where you see that you can order pedopornographic dolls, you can order weapons. All of this is illegal in France. It's illegal in Europe. And so we've suspended this in France, and we've told the European Commission that it needs to implement its rules. We have in Europe, we've adopted a few years ago, the Digital Service Act, with a very clear basic principle, which is that what is illegal and impossible in the real world should be illegal in the virtual world, whether that's hate speech, whether that's interference in disinformation, whether that's manipulation of algorithm. And here in this case, once again, when you see a company that's throwing products like pedopornographic dolls on European market, it should be investigated. And if this behavior is shown to be illegal, it should be fined and heavily fined. So what we're asking is just for the European Commission to implement its rule and to defend and enforce its rule of law.
Minister, is that a Shein-specific concern, or is there a national security element here? I ask this in the context of the fact that in the last couple of days we've heard from the Dutch government that is starting to resume some of their relationship with China when it comes to exports of chips deliveries that are coming into the country. Let's broaden out the conversation. In terms of the relationship between France and China, do we see some of the tensions being abated, or are there still sticking points?
You know, ever since 2017, in the speech that President Macron gave at Sorbonne University, our guiding principle has been the sovereignty of Europe, and the idea that Europe should be open, should have allies and partners, but it should reduce its dependencies on technology, dependencies on the military, dependencies on energy. And right now, as you see Europe under pressure, trade pressure from the United States, the war of Russian aggression against Ukraine, and the threat from Russia on our continent, and of course the economic pressure from China with overcapacities in certain products. I'm thinking, for example, of steel, of electric vehicles that are being sent to Europe. Europeans should not be naive and give themselves the ability to defend their interests. So when it comes to the relationship with China, we have trade relations with China, and it's important, but we should also be able to safeguard our own interests and protect our key strategic industries. This is why the European Commission last year adopted tariffs against electric vehicles coming from China that were heavily subsidized. This is why the Commission also is proposing a safeguard clause on steel to protect our steel industry when you have overcapacities that are coming to destabilize our markets and our companies in the European markets. And this is once again, you know, we need to defend our rule of law and our principles when it comes to Shein and when it comes to implementing the Digital Service Act and the rules that we've set up in the virtual world. It's always the same principle. It's about not being naive and reducing our dependencies on foreign actors. You mentioned, you know, rare earths. It's a very good example where We need to be able to secure critical materials in Europe, raw materials in Europe, whether that's the transformation, extraction, push and defend our industry, while at the same time continuing these talks and negotiations with other partners.
Minister, 30 seconds. I'm going to put you on the spot. You talk about strategic interests. Let's talk about the Mercosur deal as well. It looks like France is more likely to accept it when previously France has been very concerned about the agricultural impact domestically. Why the change of heart? 30 seconds.
But it's always the same thing. We've always said that we wanted to protect our farmers and we wanted to protect all of our industries and protect the level playing field. So it's about, you can trade, but you want trade to be on reciprocal ground. We've asked a safeguard clause from the Commission to protect agricultural markets. We've got mirror clauses with the very simple idea that you can't import products that are created with pesticide, with standards and norms that don't respect European standards and norms. So we are ready to open to other markets. We're ready to trade, but not to do it on an unfair playing field. And so this is exactly what we've said about the Mercosur. Same idea that what I told you about other partners.
Yeah. All right, Benjamin Haddad, French Minister of European Affairs, we thank you so much for your time this morning. We look forward, of course, to seeing you again on the program. In the meantime, these markets, green on the screen across the board, the FTSE 100, the outperformer.
For Europe at least.
Yeah, not in the States.
Yes, not in the States. Yes, Europe is doing well. FTSE up by 1%, and there's the domestic data there. Nasdaq futures, though, down by 0.3%.
Nasdaq futures, Bitcoin's also a little bit lower as well. The Pulse is up next. We're live from the UBS event. Hope you enjoy it. This is Bloomberg.
It's the world's second largest economy with a growing influence in global affairs. Bloomberg The China Show brings you the unmatched expertise you need to keep track of breaking news, in-depth market analysis, and the most influential newsmakers in and around China.
We need to do more to engage the market more. We're risk on. I think we caught a little sweet spot.
Massive savings right now.
It's already a different game.
Bloomberg The China Show. Weekdays around the world, right here on Bloomberg. Context changes everything.
Bringing you up-to-the-minute global economic news whenever and wherever it happens. I'm Lizzie Burden in Florence, Italy, and this is Bloomberg.
The countdown is on. Everything you need to get the edge at the end of the market day. Get ahead of tomorrow's trading with The Close. Weekdays on Bloomberg. Context changes everything.
The Middle East and Africa regions are home to some of the biggest deals and fastest growth in the world. Vibrant resources and high-yield investment opportunities abound. I'm Jumana Versace. Join me on Bloomberg Horizon's Middle East and Africa for the stories, newsmakers, and insights shaping the decisions of traders across this exciting region.
You had heightened levels of volatility.
There's still room to maneuver.
We do see opportunities.
It allows you to increase significantly your net income.
Every trading day, only on Bloomberg.
From the world of politics to the world of business, Joe Matthew and Kaylee Lines deliver news, insight, and analysis live 2 times a day, every trading day. Balance of Power at 1 and 5 Eastern, only on Bloomberg.
Technology is embedded in every aspect of our lives.
And laying the foundation for the future.
From finance to defense, AI to entertainment.
And from the road to the stars. Bloomberg brings you the latest stories of the people and companies pushing the tech sector to new frontiers.
And the politics that shape global tech markets.
I'm Caroline Hyde in New York.
And I'm Ed Ludlow in San Francisco.
Watch Bloomberg Tech every weekday.
Only on Bloomberg Television.
makers and market movers. This is The Pulse with Francine Lacqua.
Well, good morning, everyone, and welcome to The Pulse. I'm Francine Lacqua here live from UBS's European Conference in London. Our studio looks a little bit different today. These are our top stories. The U.S. government shutdown could end as soon as Wednesday when the House votes on a temporary funding bill that's been passed by the Senate. UK unemployment hits the highest since COVID, prompting traders to raise bets on a December rate cut by the Bank of England. Plus, SoftBank reveals that it's sold its entire stake in NVIDIA as it reported second quarter earnings that came in 3.5 times above estimates. Now, we have some great guests joining us here at the UBS conference, including the bank's EMEA president, Beatrice Martin, Simon Gass, of course, former chair of the UK's Joint Intelligence Committee, and we'll talk about defense and always the markets never far behind. Now, this is a picture across the board for what we're seeing in stocks. Now, it's very clear that the rally in stocks seems to have faded somewhat amid renewed caution over some of these lofty valuations in AI. Also, Japan's SoftBank selling his stake in NVIDIA maybe sends a little bit of question marks across the board. Now, the other thing is actually dollar. I'm looking at dollar heading for its first gain in five days. The pound leading some of the losses amongst major currencies as unemployment in the UK is rising more than expected. Look, if we have the end of a government shutdown, it means we're going to have a lot of data coming in. It could be fast and furious, and that could also reprice expectations for the Fed. In terms of the European markets, there is a little bit of a divergence amongst the main indices. If you look at European stocks, look, they're bucking the risk-off trend in general. So let's see if we have the European markets. Otherwise, I can tell you they're actually rising a touch. Now, the record-setting 41-day U.S. government shutdown may end as soon as Wednesday. This is after the Senate passed a temporary funding measure backed by a group of 8 centrist Democrats. Well, Bloomberg's Hong Kong news editor Balash Pence joins us now. Balash, thank you for joining us. Look, there's quite a lot going on. How quickly can this be resolved?
Well, Francine, it looks like the record shutdown might be over in what feels like record speed. Just yesterday, we found out that 8 Democrats broke rank and made an agreement with the Republican majority in the Senate. Today, the Senate already passed the resolution, and the House scheduled a vote for Wednesday. And it does seem like the razor-thin Republican majority in the House will hold together and be able to pass this resolution, which can then go to the president's desk. And President Trump already said he is behind this deal. He backs it, so we can expect him to sign it very quickly. So that shutdown would end then, potentially as soon as Wednesday, U.S. time. Now, it will take a few days until air travel is restored fully. It will take a little bit of time until people can start receiving their federal payments that have been held back, but the end is certainly in sight.
Balash, how much damage could this do actually to the Democrats long term?
Well, Francine, I think we have to look no further than the reaction of the Democratic leadership. Both in Congress and across the country, including Democratic governors like Gavin Newsom and J.B. Pritzker, have sounded furious about the deal. Just a week ago, the Democrats were riding high off their off-year election victory, part of the reason for which was, they said, that the American people were behind them in this shutdown battle. And now that's not the picture that they're projecting. They are projecting the picture of a fractured party with a lot of dissent inside, and again struggling to present a united front, again struggling to present a united message, while the Republicans on the other side held firm and got everything they wanted while giving the Democrats none of what they were trying to get.
Balash, thank you so much. Bloomberg's news desk editor, Balash Pence. Now to a Bloomberg scoop, and we understand that Switzerland close to securing a 15% tariff on its exports to the U.S. The deal, which may be concluded within the next 2 weeks, would be a relief after Switzerland was hit with a punishing 39% levy in August. Elsewhere, President Donald Trump says the U.S. was getting pretty close to a trade deal with India. For more, we're joined by Bloomberg's Brendan Murray, who, of course, is in charge of our global trade coverage. Brendan, what do we actually know about these potential deals?
Well, these have been two of the toughest deals that the administration in the U.S. has tried to get over the goal line. India has been negotiated for several months, 6 or 7 months, and they've been saying all along that it was close. So the fact that they're optimistic now suggests that they've gotten through some of the more difficult issues that they're close to announcing something of a framework sort of trade deal that similar to some of the others that have been announced across Southeast Asia. The Swiss deal has also been imminent for several months now, but it seems like the mood music from both sides, the Swiss and from Washington, is that they have got some sort of outline of a deal and that it could come together, as Bloomberg News is reporting, over the next couple of weeks.
The Wall Street Journal, Brendan, also reporting that China is designing a validated end-user system for rare earths. So what can you tell us about this?
Yeah, so this sounds like some sort of easy pass lane for the rare earth permits that China is issuing. China is trying to distinguish between commercial uses of rare earth materials like magnets and military uses, and it sounds like China is setting up a system that will help speed the commercial use and prevent the military use that their permitting system, which is mirrored on the U.S. export control system, is trying to accomplish.
Brendan, thank you so much. Brendan Murray there with the very latest on some of these possible trade deals. Now, to look closer at the financial impact of the Swiss trade deal in the U.S., we're joined by Beatrice Martin, EMEA president at UBS. Bea, thank you so much for joining us. Actually, we'll get on to Switzerland in a second, but I want to get a take on what your clients are asking of you right now. I mean, the sand is shifting. There's a lot of things that they can worry about. What's like your best piece of advice to them?
Thank you. Great to be here. Thank you, Francine. So our clients this quarter and throughout the year have been really very interesting in having investment advice. I think these markets are difficult to navigate. I think when you see all the movements that we're seeing in the different asset classes, we've seen really strong net inflows this third quarter for us, and I think clients are still very supportive of the markets. I think they feel that the need and for investment is still there, and they see robust markets holding on, so they want to participate on them, and they are open to take advice.
What are the big four? I mean, the big force driving is, of course, AI and AI valuation. Are you expecting some kind of market correction, either in that or in credit?
Oh, wow, that's a very...
It's a big question.
It's a big question, yeah. I mean, there's no doubt that we've seen valuations, very strong in both credit and AI. I think, I'm not an expert in, equity valuations, of course, but I feel like, we're still seeing very strong cash flow generation from some of those firms, and I think that supports the valuation as long as, we see CapEx still at levels that are, being funded through cash flow. I think that's going to be something that will continue going on.
Bea, when you look at Europe, where do you see the biggest opportunities? So is UBS hiring? I don't know whether AI means that there are job losses, and how you see actually all of that world adapting.
Well, I mean, we are quite a strong European bank. Obviously, as you know, we have a very strong position in wealth management. We're the biggest wealth manager in Europe. Europe is really our backyard. I mean, we have been here for a very long time, and we are present in 22 countries. We have almost 30,000 people in Europe, so we have a very strong business across the board: wealth management, asset management, and the investment bank. For us, Europe continues to be a very important market. We make around a third of the total PBT for the bank here, and so we still see quite a lot of growth. There's no doubt that the bank is focused on growing the APAC and the US franchises, but Europe is still quite an important one. We are very global, so we are very global reach with a local presence that is very strong. We've been very focused on growing our presence in the Middle East, post the acquisition of Credit Suisse, of course. And the acquisition of Credit Suisse has given us, critical mass in a lot of other countries in Europe. I think there's huge expectations on Germany, if I'm honest, with all the investments that are yet to come, but definitely quite a lot of interest for investors to be part of those opportunities.
But, I mean, the integration of Credit Suisse has been, one of the biggest things that almost any bank in Europe has done. How is that going in terms of data migration?
It's going well. I mean, we're coming to, the end of it. I think Sergio commented on his interview as well. We have done 2/3 of the clients in Switzerland. We still have the end to do. And of course, as you mentioned, data migration and storage is going to be one of the biggest things we do. We need to bring that to a completion by the end of 26. But I feel like we've done, great progress so far.
So you also have a new role. Congratulations.
Thank you.
A big new global role that starts in January. How will actually your job change?
Well, I mean, I'm going to keep doing what I'm doing, and I'm going to add that role to my set of roles. And I think for me, the COO role is one that will be focused on bringing the bank closer together, I think, for clients and also front to back, looking at what are the efficiencies that we can achieve when it comes to infrastructure, to IT investments, for example, but also in the way we serve clients, the products we cover, and how can we really integrate, continue integrating the bank.
What will your priorities be? I don't know whether there's, you've thought about freeing up capital, for example, for the U.S. business, or is it, Middle East and Asia?
Yeah, I mean, for me as the head of EMEA is to continue to be, EMEA, and when it comes to clients and the clients we cover here, continue to grow in the franchise in EMEA, I think will be quite important. And, we have great opportunities because I think the expectations for 2026 for EMEA are really, really strong.
This is what, in terms of IPOs, are there enough things in the pipeline in terms of deals that will come up? And is it because it starts from a very low base, or do you actually think that the animal spirits are back?
I think valuations in Europe are somehow more palatable than, in the US for sure. But in general, I think the interest in investing in good, firms and corporates in Europe is there. I think the conviction in the boardroom to actually go into M&A in particular, I think is stronger than it has ever been before. The pipeline is very healthy, and therefore I expect, good deal flow as we go into 2026, yeah.
But do you think there's been a shift in clients' minds? I mean, we're just covering, 2 potential deals with the U.S. One of them is Switzerland. I don't know whether clients in general have just become much more used to these changing flows, the trade, the tariffs and the trade, and so it's part and parcel of what they just need to deal with.
Yeah, I think the uncertainty in the markets have been phenomenal over the last year or so. And I think clients are getting used to selectively looking at news and trying to understand what it means for them. And of course, for us, again, as a global bank, I think it's more than ever is important to be really close to what clients are thinking with, solutions and opportunities and alternatives for investment.
When you look at the ultra-high net worth individuals that you've also, I guess, gotten from Credit Suisse, how are they behaving differently from some of, the other clients?
No, they're not. I think ultra-high net worth individuals are very sophisticated investors that are close to, the things that perhaps other more institutional investors are doing. But thanks to, our global reach and the seamless, coverage that we have for clients, showing up as one bank, I think we are able to provide, with the needs that they have.
Are they asking a lot about the UK? There are many question marks about the UK and where the UK economy goes because of taxes.
Yeah, I mean, look, the UK, I think we are expecting, or all waiting to see what the budget is going to give us at the end of the month. I mean, Rachel Reeves has already been commenting on some of the things she's thinking about. I don't think, we can speculate at this point on what those are going to be. It's a very difficult situation. It's a very difficult budget. And, we just need to see what those measures are going to be at the end of the month.
But where do your clients want to deploy cash? Is there a pattern from some of them on where they want to be invested, or are they still a little bit in the corridors?
No, I said we got net new inflows this quarter. I think clients are still, looking for opportunities to invest in different sectors. AI, definitely one of them, healthcare, energy transition, and many others. And I think, the ability to be able to advise those clients on the opportunities globally and also locally where they are located is really important and one of the strengths of a bank like UBS.
Yeah, you singled out Germany. Is Germany really a sea change because of how much they're spending on defense?
Yeah, I think there is a big expectation that Merz is going to, open the taps at some point and go on with all the investments, particularly in infrastructure and defense that have been already announced. And there is, I think from all sorts of clients, not only, wealth management clients, but also some of the sponsor clients, for example, how to position to be, able to take part on those investments is something that we are definitely helping them with.
And so what is the right way? Is it, public-private partnerships? I mean, there's going to be a lot of infrastructure, certainly if the Draghi reports gets implemented.
I think
big question mark.
I think we don't know yet, to be honest. I mean, we've been very close to the government, if I'm honest, and trying to, advise them and get them some feedback from clients on things that they could consider. But at the moment, I don't think anybody knows exactly how that is going to pan out.
But, I mean, there's so much conversation, of course, about the capital requirements in Switzerland. I mean, does that kind of dominate, in general, some of the conversations you're having internally?
Well, look, I mean, I think Sergio covered that in the interview after results. I think for us, we just have to wait to see how that process is gonna continue. This is not a negotiation. We've said that many times, and we just need to wait and see how that is going to come out.
Beatrice, thank you so much for joining us. That was, of course, Beatrice Martin, EMEA President at UBS. Now, as the Trump administration looks to speed up weapons procurement, we'll be speaking with the co-founder of Dauntless Ventures about the next generation of America's defense industry. That's next, and this is Bloomberg.
Bringing you up-to-the-minute geoeconomic news whenever and wherever it happens. I'm Bonnie Quinn in Sao Paulo, Brazil, and this is Bloomberg.
From our studios in New York and San Francisco, our expert hosts have the data and analysis from the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action. Live every weekday, only on Bloomberg Television. Context changes everything.
We're coming to you live from Kuala Lumpur. The whole world is here.
The APEC Leaders Summit bringing together heads of states of 21 APEC economies.
The White House is trying to use the stops to gain additional leverage.
This big deal with a number of the biggest companies in South Korea.
That's a big number.
Deals can be done.
Trust Bloomberg for on-the-ground coverage.
Korea is not Japan.
Up-to-the-minute reporting.
In this latest salvo of this trade war.
What a visual.
And the analysis you need.
China's not going anywhere, nor are we.
What is going to be the consequence for U.S. markets?
We are basically deep in the European earnings season.
Take a look at how we're faring when it comes to Asian markets.
Earnings season is here.
It is a busy, busy week for earnings.
More buybacks, more dividends, margin compression.
Bloomberg is first to break the numbers.
We have some earnings crossing.
We'll bring you Deutsche Bank, UBS smashes Santander, beats on net income. Investors brace for more earnings.
Let's get the reaction and context.
With the smartest insights.
Maybe this German fiscal stimulus is going to start to hit the economy and come through in corporate earnings.
Continuing coverage on Bloomberg.
The conversations that matter, the insights you need. This is The Pulse, and I'm Francine Lacroix, live from UBS's European Conference here in London. Now, U.S. Defense Secretary Pete Hegseth has challenged major U.S. defense contractors to speed up weapon developments or fade away. The Trump administration is moving to overhaul America's slow defense procurement process in a shift that could benefit tech companies and startups. Now, Dauntless Ventures is a firm backing early-stage companies in the defense sector, and it's been selected by the Department of Defense for its new venture capital program. Well, joining us now is Pete Koziol, co-founder of Dauntless Ventures. Pete, thank you so much for joining us. Look, you're in the space that everyone either wants a part of or is really trying to understand. Like, what do investors don't get about how difficult it is actually to I guess, back early stage, because you don't really know what makes a success in like 5-10 years.
Yeah, well, appreciate you having me, Francine, and very glad to be here on Veterans Day in the States. Waitlist is a U.S.-focused investment firm that backs daring entrepreneurs building the next generation of the U.S. defense and industrial base. Our view, though, is that though we're U.S.-focused, we're extremely ally-aware. And the reason we're here in Europe today is because we see an enormous opportunity for U.S. defense technology companies and young entrepreneurs building the next piece of innovation for the warfighter to also sell that into Europe, into Japan, into places like Korea, because in our view, alliances will be strengthened, and there's a new global security common that's being built around this idea of shared defense technology.
Pete, what are you looking at in terms of technology? So is it, there's a bit of everything. It could be robotics, it could be like anti-drones, it could be missiles. Like, what's the next generation of defense that you're looking at?
I think the experience in Ukraine and obviously the fight that's being sort of trained for in the Pacific is heavily indexed to drones and autonomous, really AI-enabled autonomy. And so those are areas we're focused on. I think also in the States, the issues around rare earths is really one of many sort of issues in the supply chain that as Waitlist we're focused on not just defense technology but also defense adjacent technologies. And so the scope is wide, and the breadth is it's really just kind of 21st century writ large is our focus.
How do you look at actually rare earths? So is it recycling them, which is we're hearing that from many parts actually of policymakers, that the quickest way to get enough of this stuff is to make sure that we reuse?
Recycling is absolutely one piece of it. I mean, we've spent a lot of time on the rare earth supply chain. I think what you'll find is it's less about finding the rare earths, which aren't as rare as people sometimes like to believe. It's really about refinement and then magnet manufacturing. And so what we've really focused on is trying to find young companies with potential IP that's formulating magnet manufacturing in a different way.
How does cybersecurity look like differently? If there was a big war in 5 years, does it look materially different to anything that we've ever experienced?
Yeah, I think cyber permeates everything from the manufacturing base to current operations abroad. Cyber is an area that we're aware of. We're not super focused on it from an investment perspective, but again, it's similar to AI. It's sort of an enabling technology that sort of spans all categories.
What are you most, I guess, excited or worried about now?
It's a great question. We're really focused on sort of the undersea domain right now. Our belief is that so much of the future of warfare is going to be moving to space and then subsea, and so we're trying to find autonomous solutions and sensor solutions that can effectively give both the warfighter awareness, but where we also see there being massive opportunities in the commercial sector via port security, undersea cable security, needs for the insurance sector, et cetera. And so again, we're not necessarily defense exclusive, but we're looking for companies that have both defense use cases but also commercial markets.
But because you're an early stage investor, what do you look for actually in a company that will be successful? And is the goal that then they get bought out by someone bigger, or is it standalone and IPO?
Yeah, that's a great question. At an early stage, you're really backing a founder, and so you're looking for founder market fit, a founder that's either operated in that environment before or has some very unique, piece of insider knowledge around a product or a platform that they want to build that they think doesn't exist in the world. I think the market structure of defense is an interesting one, right? Because it really requires scale, and I think the Secretary of War last week laid it out really well that we need to move faster, we need to innovate, but I don't think it necessarily means that defense primes around the world are sort of dead. Like, I think they're going to play a very large role in sort of the future of defense spend, and so naturally, I think it's the defense industry is one that is ripe for consolidation and ripe for scale. And so our belief is many of our companies will end up being capabilities that get bought by larger defense primes.
But how much consolidation? Because I know in Europe there's, if you're almost like a national defense company, it might be difficult for a country to let it go. I know in the US it's different, but can you actually see like cross-border consolidation?
Yeah, that's an interesting point. I'm not an expert on the European defense team, what I will say is there are very different. I think one of the things is, as an investor that's European aware and that we think a lot about is how that situation evolves specifically between France and Germany and the UK, and how those primes in each country. How that all kind of shakes out from a sovereign capability perspective.
I mean, as allies and allyships change, does that actually change where you can sell the technology to?
So the Secretary of War on Friday laid out I think, a very ambitious plan for opening up the U.S. Defense innovation space to foreign military sales. I think that's a huge piece of where we see our company's opportunity. And if you think about, how do our companies grow revenue pool and, and potentially increase their multiple, it's by diversifying their buyer base. And we think that the allied buyer base, specifically NATO, Korea and Japan, is a huge opportunity for U.S. defense exporters as sort of markets to enter.
How will AI robotics change in the next 5 years? This is the most difficult question of the day.
Yeah, I mean, it's going to permeate everything, and it's to the point that we're including it in our investment process at Dauntless today. So I think the world is going to change so much, but at the end of the day, it's still going to require great young founders to sort of conceive of new things that don't exist and then build them.
I mean, Pete, one of the ethical questions, the big questions, is actually how to use technology for good and not bad. Like, do you have like an ethical line of what you'll be investing in?
Absolutely. I mean, I think our firm is deeply rooted in the moral belief that defense is a sovereign and individual right, and heavy subscribers to just war theory. And we think about that a lot in the investments we make. We want to make sure that we're backing founders building technology which will make people safer and make the world more secure.
Pete, thanks so much for joining us. Pete Koziol there, co-founder of Dauntless Ventures. Now we'll have plenty more throughout the day here at UBS. UBS warning the contagion risk from private to public credit markets is real and actually underappreciated. So we discuss all of this with Matthew Mish, head of credit strategy at UBS. This is Bloomberg.
Rodriguez. And I'm Jason Kelly. And we're back with another season of The Deal. With athletes and entrepreneurs who are changing the game on and off the field. Jerry Jones.
Some good-looking trophies. 1 and 1 is 3 in sports, not 2. And it's because that 3 is imagination. That 3 is putting yourself in a way, having yourself hit the home run.
Erica Ayers-Badon.
I'm a high-energy board member. I'm very passionate. I have a lot of opinions.
Robin Arzone.
I want to light fires in people's lives, and that is still one of my core mandates for all of my businesses.
Justin Tuck.
I tell all of my friends that play in leagues now, make these relationships now while you're hot. Don't wait till you're your 12th year in and you're just hanging on.
Stay tuned. You won't want to miss it.
Morning. This is Bloomberg Daybreak Europe. I'm Tom McKenzie in London. These are the stories that set your agenda.
Taking you from the U.S. market's close to the overnight session in Asia, we'll walk you through what you need to know to kickstart Europe's trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in to Daybreak Europe, only on Bloomberg Television. Context changes everything. Why do the biggest names in business choose Bloomberg Television?
That's a great question.
It's a very good question.
Interesting question.
Good question. Great question.
I so appreciate that question.
You certainly ask interesting questions.
Bloomberg Television. Top experts, great questions.
Bringing you up-to-the-minute geopolitical news whenever and wherever it happens. I'm Stephen Engel at Japan's Akasaka Palace in Tokyo, and this is Bloomberg.
Good morning, everyone, and welcome to The Pulse. I'm Francine Lacqua at UBS's European Conference here in London, and these are your top stories. The U.S. government shutdown could end as soon as Wednesday when the House votes on a temporary funding bill that's been passed by the Senate. While UK unemployment hits the highest since COVID, prompting traders to raise bets on a December rate cut by the Bank of England. Plus, SoftBank reveals that it's sold its entire stake in NVIDIA as it reported second quarter earnings that came in 3.5 times above estimates. Now, Wall Street has been shaken in recent weeks by the collapse of the auto parts supplier First Brands, which filed for bankruptcy with more than $10 billion in debt. Major financial institutions like UBS had significant lending exposure to the company. Now, in its new report, UBS is also warning that contagion risk from private to public credit is real and underappreciated. So let's discuss all of this with Matthew Mish, Head of Credit Strategy at UBS Investment Bank. Matthew, thank you so much for joining us. And there's quite a lot of people trying to understand where credit goes. So when you say that the risk is underappreciated, what do you mean?
I mean, our view is essentially that you now have private credit that has permeated public credit. But the two are essentially interconnected. And you see that on the issuer side, we see that on the investor and the borrower side. And ultimately, we believe that it is a key risk for 2026 and beyond. It's probably the key risk. But we generally, at this point, see a steady increase in defaults and credit losses. We're not alarmist. We don't think that this cycle is yet over. We feel like it's late. And we'll be watching it closely. But I think the real threat is if you get a sector like tech or like business service where you see a specific surge in defaults. Aside from that, it's something we're monitoring, but at this point we're relatively comfortable with the near to medium term outlook.
But Matthew, when you say biggest risk in 2026, could it be a systemic risk? Because this is growing. A lot of, what's being offered is also to retail investors.
Yeah, if you take a longer term view, right, I think the public and the private market vehicles are now essentially being marketed together, right? So it increases the connectivity between institutional and retail clients. And as you go through 2026, we've had a massive amount of issuance, right, so far this year. So even just in the last month, we've had over 60 to 70 billion in issuance from the hyperscalers in just the U.S. investment-grade unsecured market. And so our expectation is that that will continue because the hyperscale CapEx plans look like they're going to be up, call it another 30 to 50% next year. And so if debt becomes more and more of a key pillar to finance that capital spending, then I'm not so much worried about into the end of the year and into early or the first half of 2026, but I do get more concerned about the overall aggregate amount of debt that could be in the system toward the end of 2026 or going into early 2027.
But do you think today that the credit markets are overvalued?
We think modestly. I mean, we are looking for widening, but the order of magnitude is important to highlight. So in the U.S., we have high grade and high yield spreads that we think should be trading essentially closer to 90 to 95 and 325 to 350 basis points. So that's a moderate widening of about 10 bips and about 40 to 50 basis points. Obviously, high yield, as an example, has historically traded as tight as 260 and as wide as 700, 800, 900 basis points. So we do think it's overvalued, but the margin of overvaluation is fairly narrow.
Matthew, what makes European investment grade more attractive than the U.S.?
We like Europe a lot for a few reasons, right? One is obviously the overall exposure to private markets, but also to AI and tech is much lower, right? It really is very much a U.S. story or a U.S. and a China story. The second thing is we do like the fiscal impulse coming through in a positive derivative perspective for Europe. And the last thing, to be honest, is as credit investors at this point in the cycle, you want carry that you can trust and earn and sleep at night. And really, Europe, we think, is in this place where it's not too hot and it's not too cold. So Euro IG, we expect to outperform quite notably, not just in the baseline, but in a number of up and downside scenarios relative to US IG.
But I mean, most insurers piling into private credit basically worry about ratings or chasing ratings. How much of a problem is this?
So I think it's an isolated problem, but it is a problem. So if you look at various research out of the IMF, the BIS, and some of our own work, the insurance industry, for example, has increasingly relied on private letter ratings, but it is not, I would argue, a widespread phenomenon. And in fact, in the essay that you're alluding to that we wrote earlier in the week, I think that it's more a concern in terms of systemic risk or risk back to the financial sector at the actual company, the company level. So I believe that for PE-linked insurers, it is a material concern in terms of their use not only of private letter ratings, but also their increase in exposure to securitized products. But you could look at P&C companies, right, and certain life companies in the U.S. where they've been much more conservative. And I think the balance sheets and the overall investment underwriting has been much more conservative, much better.
You've written some really engaging notes that were like right on point, but it feels like a lot of market, or actually investors, maybe miss some of the downfalls. Do you think there's little understanding of the space?
I think that the honest answer is that if you know where to look, almost like an investigator, and you build a mosaic of what's going on, which is what we've done in our research, I do think there's a lot of information about private markets. And I would make it clear that I don't think the transparency is as poor or it's as unknown as the way some in the media classify it. And I think that's part of what we're trying to do, is cut through the fluff, or quote unquote the smoke, and really make sure that clients understand on a real-time basis what's going on in the market. Defaults are a great example. There's been, as you say, 2 to 3 very large credit events over the last 4 to 5 weeks. We're out in the market making the case that we're not seeing the next first brands right now. We're not seeing large evidence that that's a trend or a phenomenon that is accelerating. And that's important. So I think we're trying to show the downside and the upside risks in that market. But the current view that we have is kind of for steady and moderate deterioration. But at this point, to us, it looks like late cycle, not the end of the cycle.
Matthew, thank you so much for joining us. Matthew Mish there, Head of Credit Strategy at UBS Investment Bank. Now, more signs that the UK jobs market is cooling, with unemployment hitting 5% in the 3 months to September, the highest since the pandemic. While headline wage growth also unexpectedly fell. Let's get straight to Dan Hansen, Chief UK Economist at Bloomberg Economics, who joins us. Dan, always great to speak to you. Tell us a little bit more about the data and what does that mean for the Bank of England?
Yeah, morning, Fran. Great to see you. So a few things from me. I think the first is, obviously, as you mentioned, there's the unemployment rate. That was the surprise this morning. A little bit higher than we expected, a little bit higher than consensus and the Bank of England expected. And the other thing, the big bit of news is on wage growth. Now, that was in line with expectations, but what we've had over the course of this year now is this relatively gradual fall, but marked fall in wage growth, particularly in the private sector. And those two things taken together, I think, are obviously music to the ears of the doves on the Bank of England. I think, to answer your question directly about how it might affect the Bank of England's thinking, the person we really need to watch is Andrew Bailey, and where he thinks this data, what this data means for the likely path of rates. He is what I would call the swing voter on the committee now. It was a 5-4 vote in November, and he was the one that voted for a hold, asking and waiting for more information. But there's no doubt this again pushes the bank, I think, probably towards a December cut. It's not our baseline just yet. We want to see the inflation data. We also want to see the budget as well. That's a big event, obviously, coming up. But there's no doubt, taking out the margin, this data puts a December rate cut, increases the chances of a December rate cut.
Yeah, and Dan, I mean, again, first of all, the data we had today from the UK is not good news for the Chancellor. I know there's been a huge repricing of what the market is expecting the Bank of England to do in December, but how difficult is it going to be for the Bank of England to make an informed judgment? I know there's like 2 data points, but it's not going to be materially different.
Well, and I think that's a really interesting point, because what we had in August was a story from the Bank of England where they were very worried about inflation, the persistence of inflation. Fast forward 3 months, we're now in a place where they're a lot less worried about the persistence of inflation, and that isn't a huge number of data points, and we almost get a similar number of data points between now and December. So I think having real conviction in where the bank is heading is difficult. All of that said, I think the signal was relatively clear in the November minutes, and for us it's a toss-up between February and December. We're still in February at the moment, but all you need, I think, is a downside data surprise on inflation and obviously a budget that is disinflationary. And I think that will probably tip the balance towards a December cut. I think the key thing here, though, is that we're not talking about a series of rate cuts. I think the bank just wants to get to a neutral policy stance. So that might mean 1, maybe 2 more rate cuts. And I think they'll be happy to sit on their hands, because remember, inflation in the UK is still high, and it's up at 3.8% at the moment. It's going to fall back, we think, over the course of 2026, but there's still quite a way to go till we get back to that 2% target.
Dan, thank you so much, as ever, and of course, great projections. Bloomberg Economics Chief UK Economist Dan Hansen. Now, on to big corporate news. SoftBank selling its entire stake in NVIDIA, pocketing $5.8 billion ahead of a rash of planned investments. Now, that sale and windfall at the Vision Fund Startup Investment Unit helped SoftBank report net income of $16.2 billion in its fiscal second quarter, far ahead of estimates. For more, we're now joined by Peter Elstrom, Bloomberg's executive editor for global technology. So first of all, Peter, just a very simple question. As everyone's talking about AI valuations and they worry, is it a bad sign that SoftBank are actually selling off their NVIDIA stake?
That's a big question here. Yeah, Masayoshi Son decided that he's going to sell off all of his shareholdings in NVIDIA at this point and take the $5.8 billion that he made from that stake. Now, we just got the conference call from the company in Tokyo just a few minutes ago, and there the CFO said that that's actually not the case. It's not because they have any questions about NVIDIA or NVIDIA's growth prospects. Instead, what they really need is they need that money to be able to make their own investments. They want to invest in AI in a number of different areas. They're partners with OpenAI, of course, in the United States, with this Stargate venture where they plan on investing $100 billion, maybe $500 billion. We've also heard plans about an Arizona manufacturing facility where they want to invest hundreds more billion dollars. So really, Masayoshi Son and SoftBank are trying to collect that money to be able to make their own investments from here. It's not supposed to be seen as a sign of an AI bubble. In fact, Yoshimitsu Goto, the CFO, got that question, are we in a bubble? And he said, we can't really tell from here. So he's not quite as definitive as maybe a Jensen Huang at NVIDIA or Sam Altman. They're just saying we can't see it from here, but they are continuing to make these investments.
So, Peter, how did SoftBank do so well? How were they able to have these incredible profits?
Yeah, it's worth breaking down the numbers. SoftBank has an enormous portfolio of companies, and so they mark up and down the market value of those companies each quarter. Their earnings can be very, very volatile. But what we saw is they made $16 billion in the most recent quarter. That's about 6 times as much as analysts had been expecting on average. A lot of that money came from their private company holdings, the ones that they hold through the Vision Fund, their Latin American Investment Fund. And the biggest part of that was really OpenAI. They said about $13 billion out of $19 billion in gains came from marking up the valuation of OpenAI. You'll recall that that company just last year was worth about $150 billion pre-money valuation. It went up to $260 billion, and now it's at $500 billion. So that's been a very sharp increase, and they've been able to cash in some of that money. But they have other holdings too. They have Perplexity AI in their portfolio. They have Runway AI, which is actually a pretty hot company too. So there's a lot of companies in that portfolio where they're getting some gains at this point.
Peter, thank you so much, as ever. Peter Elstrom, there, Bloomberg's executive editor for global technology. Now, coming up, we'll be discussing all things security with the former chair of the UK's Joint Intelligence Committee, including the EU's potential ban on Huawei from its mobile networks. That's next, and this is Bloomberg.
To Bloomberg Business Week Daily.
We got to talk crypto.
From the magazine that helps global leaders stay ahead.
What's the conversation around your company?
Bringing you insight on the people, companies, and trends shaping today's complex economy.
Planning very big things.
A new level of premium.
Plus global business, finance, and tech news as it happens.
The floodgates of innovation are going to open up.
You can't fake passion. You either are or you aren't.
Bloomberg Business Week Daily, only on Bloomberg.
Investors, top executives, global innovators. Join me for in-depth conversations with the biggest newsmakers on the day's top stories. Insight with Haslinda Ahmed, only on Bloomberg.
Asia is at the forefront of some of the world's biggest stories. I'm Sherrian in Tokyo.
And I'm Heidi Stroud-Watts here in Sydney, where the trading day begins. We're here in the center of all the action to get you set up with the numbers, news, and knowledge you need for the day ahead.
The demand is indeed recovering.
We've been waiting for this moment.
The opportunity of a century.
Join us on Bloomberg The Asia Trade. Weekdays only on Bloomberg TV. Context changes everything.
The conversations that matter, the insights you need. This is The Pulse. I'm Francine Lacroix, live from the UBS European Conference here in London. Now, there's a lot going on since Vladimir Putin's invasion. The need to develop and fund weapons has pushed Ukraine to become a drone superpower. Now, as Europe is confronted with a wave of airspace violation, Ukrainian companies are looking towards European markets. Well, Pavlo Shevchuk, the international CEO of Skitan, a Ukrainian drone firm, spoke with us earlier.
Ukraine is definitely very unique in adapting and scaling up the new technologies in the battlefield. Having this experience and having the technology adopted and improved over the last more than 3.5 years of war, we definitely can offer something unique to strengthen the European defense system. The whole world is very much dependent on Chinese supply chain and Chinese components, electronic components. And that's changing both in Europe and in America. It takes time, obviously.
Now, for more on the story, we're joined by Bloomberg's global defense editor, Jerry Doyle. Jerry, what about Ukrainian drones is attractive to Western countries and customers?
Well, primarily, the thing that's most attractive to them is that Ukrainian drones have been tested over the last few years. All the techniques for manufacturing them, all the technology for keeping them in the air, keeping them flying in challenging conditions, those have all been tested in the battlefield, and that sort of data, that sort of know-how is extremely valuable to non-Ukrainian countries at the moment.
Jerry, when you look at how they can be supported by the U.S. and Europe, how does this develop? Again, it's the million-dollar question.
Well, so right now, Ukrainian companies making drones have quite a bit of manufacturing capacity. They're producing 4 or 5 million drones a year. they've gotten to the point where they can essentially supply Ukraine's war effort, and they have the slack to produce elsewhere. But they need money. They need money for research and development. They need money to expand their production capacity, to invest in new technology. And that's really where Western allies can help out, and where they see there being an opportunity for a win-win situation. They're able to export technology and military hardware that is in hot demand outside Ukraine at the moment, and in exchange, they will get the funding to improve their own products.
Jerry, thanks so much. Jerry Doyle there, Bloomberg's global defense editor. Now let's stick with security. Moscow and Beijing remain top security concerns for Western officials. Bloomberg understands that the European Commission is exploring ways to force member states to phase out China's Huawei and ZTE from their telecom networks. Now, the UK and Sweden banned the use of Chinese vendor years ago, but others like Spain and Greece continue to allow them. Let's discuss all of this with Simon Gass, former chair of the Joint Intelligence Committee in the UK and former ambassador to Iran. Ambassador, thank you so much for joining us. There's a lot going on to try and understand allies and friendships and, frankly, enemies. Are we in a more uncertain world because allies and allyships are really being tested?
Well, we are in a more uncertain world, and one of the main reasons for that is that for many years our countries benefited from the security of a kind of rules-based international order in which there were principles, there were agreements, there was multilateral diplomacy. What we've seen over the last few years is some very important countries coming to the conclusion that actually that framework doesn't suit their national interests and stepping away from it. So we're now facing a world in which coercive behaviour is much more common than it used to be, and cooperative behaviour much less so. And that is why when we look at the climate change summit, which is happening in Belém in Brazil at the moment, the United States has not sent a senior delegation. That is just an example of the way in which those collaborative networks are eroding.
So one of the key questions is, for example, how should the UK deal with a Hong Kong company, CKI, potentially buying Thames Water?
Well, the British government faces a dilemma. On the one hand, it really mustn't come to the conclusion that all Chinese investment in the United Kingdom is problematic, because it obviously is not. But it is interesting that in the summer, the British government went out for consultation to ask the opinion of people who are knowledgeable as to whether water utilities should be added to a list of potentially problematic sectors for investment in the United Kingdom. And that was clearly in recognition of the fact that investment in water companies can be an issue. Now, in respect of CKI, it's already invested very widely around the world, including in the United Kingdom. It's a major shareholder in Northumbria Water, for example. So it isn't necessarily a problem. But what it does mean is that the British government is going to have to examine this case from a security angle and not simply from a utilities provision angle, and explain why it would allow that bid to be successful if it materialises.
I mean, do you think they should block it again because it could potentially be a risk to national security?
I doubt whether they should block it, but they might want to put in place some safeguards around it so that they can ensure things like continuity of supply and proper protection of data systems and so forth.
Ambassador, I mean, you were also posted in Iran for quite some time. There does seem to be more, operations or plots coming from Iran that could be a threat to the UK. Have these gotten worse since the Gaza situation?
Well, they've certainly got worse in recent years, and the head of the British Internal Intelligence Service spoke recently about the rising number of plots which we detect in the United Kingdom. They're not generally against British citizens. They're generally against what the Iranian regime sees as Iranian opponents overseas, but also increasingly concerns about Iran targeting Israeli-linked or indeed even Jewish-linked targets. We've just seen, for example, some media reporting of a reported threat against the Israeli ambassador in Mexico City, for example. So this is increasingly a problem, and Iran really needs to face a united pushback against this sort of behaviour.
Do you think some of these threats or plots will increase as Iran feels like it's backed down in a corner?
Well, I think the risk is that they will, but that is why we need international action to make clear to Iran that there is a price for this sort of activity and that we are capable of defending ourselves effectively. Obviously, Iran feels under massive pressure at the moment following the strikes by Israel and the United States in the summer, and the threat that this could happen again in respect of Israel. That is something which is really worrying people in Tehran at the moment. So they do feel cornered, you're right, and in consequence their instinct may be to lash out. We just have to make clear that that is not going to work.
Given all of the conflicts around the world, what do you think is the biggest threat to the UK right now?
The biggest threat to the United Kingdom at the moment, I would say, it's very hard to pick one threat, but I would say the increase in Russian interference in Europe is something which is really occupying people's minds at the moment. You will know that we've seen a significant uptick in drone sightings over airports, ships dragging their anchor over communications and energy cables, cyber attacks, targeting of Russian opponents overseas. All of it adds up to a pretty heavy charge sheet, which looks as though it comes from Moscow.
What do you think is Putin's end game?
I think Putin's end game, in his mind, is victory. And that is what the rest of us are determined should not happen. Russia must not succeed in Ukraine. And the Ukrainians, of course, are fighting valiantly to protect that. What we need to ensure is that our countries, including the United States, including all the European countries, are backing Ukraine so that they can continue in that fight.
But, Ambassador, victory as in actually taking bits of Ukraine, or is he still going after the whole territory?
I think the key, I would say, for Putin is that Ukraine has to fall within Russia's orbit. That is what Putin needs. Yes, he needs some territory from the Ukraine. He wants Donbass. He needs those areas that he has annexed, wrongly, of course, to Russia. But I think in his mind, what he wants to do most of all is to make sure that Ukraine is not able to turn westwards and has to look to Moscow for security and its future.
How do you view China?
Well, China, in that respect, of course, has been supporting Russia since the beginning. And if it is correct that they have not provided lethal equipment to Russia, they have provided everything short of lethal equipment and, of course, are buying large quantities of Russian hydrocarbons. There's been an intense dialogue with China over this. But China at the moment is determined to continue to support Russia. So that is a challenge for European countries, the United Kingdom, and of course for the United States as well.
Ambassador, thank you so much for joining us. Simon Gass, there, former chair of the UK's Joint Intelligence Committee. Now, we'll have plenty more, of course, throughout the day. We'll have a full analysis of what the markets are doing. Up next, Bloomberg Brief, and this is Bloomberg.
At a time when policy in Washington is driving Wall Street, we draw a distinction between the rhetoric and the action, bringing you market-moving guests and original reporting. This is Bloomberg Surveillance.
NYK sustainability efforts have produced a breakthrough. The tugboat Sakigake is the world's first ammonia-powered vessel in commercial use.
LNG can decrease emission of the carbon dioxide compared with the heavy fuel oil, the 25% more or less. But ammonia, 95% decrease can be achieved.
According to Bloomberg NEF, ships powered by LNG and other alternative fuels make up nearly 40% of the global shipping order book.
This is funded by the NEDO, so-called Japanese agency. And also the NEDO has the kind of the GI funds and the Green Innovation Funds. And also the Japanese government is supporting the usage of the ammonia as the power-generating fuel.
It's more expensive than normal standard fuels.
Yes, it is. And at this moment, and the supply of the ammonia volume is very much limited compared with the LNG and also the heavy fuel oil. But in order to promote ammonia as a marine fuel, together with the other industry players, and we can have the kind of the mass production, then the cost will be decreased. Then the next 10 years, we try to increase the number of the vessels powered by the ammonia.
It's the world's second largest economy with a growing influence in global affairs. Bloomberg The China Show brings you the unmatched expertise you need to keep track of breaking news, in-depth market analysis, and the most influential newsmakers in and around China.
We need to do more to engage the market more. We're risk on. I think we caught a little sweet spot.
Massive savings right now.
It's already a different game.
Bloomberg The China Show. Weekdays around the world, right here on Bloomberg. Context changes everything.
Good morning. This is Bloomberg Surveillance.
Welcome back to the opening trade.
Watch
Bloomberg Tech. This is the Asia Trade.
This is Wall Street Week. Welcome to Balance of Power.
This is Bloomberg Television.
It's 5 a.m. in New York City. Good morning. I'm Bonnie Quinn with your Bloomberg Brief. Here's what you need to know. In the home stretch, the House gears up for a vote as the Senate passes a temporary funding bill to close out a potentially 41-day government shutdown. Inching closer, President Trump says the U.S. is nearing tariff agreements with Switzerland and with India. And a surprise move, SoftBank unloads its entire stake in NVIDIA, raking in close to $6 billion. Well, it was a good Monday for stocks, I can tell you that much. It was NVIDIA's fourth best day this year, in fact. Palantir was up almost 9%. We're seeing a little consolidation today after another Monday. As Cameron Kai says, everybody seems to like Mondays this year, particularly after a Friday drawdown. But as you can see, we are consolidating a little. Obviously, the bond market is closed today. It is Veterans Day, so let's have a look at some other asset classes. We're seeing the VIX Volatility Index just up very slightly. It is under 18, but those stocks pointed lower will mean that the VIX probably rises today. Gold up another 0.2%, back above $4,100. And then the yen back above 154. It's an interesting story. The dollar carry trade has been very popular this year. So yes, the BBDXY has been down 7% for the year, but at the same time in the last month, it's up 3% as this carry trade, particularly buying yen and placing your money in dollars, has really taken hold. We're going to talk about all of that in the next hour. First, though, let's get to some individual movers. Over to London now, and Kriti Gupta. Kriti.
Let's start with a check on NVIDIA. Vonnie, the shares are on a back foot. As you mentioned, it was a spectacular Monday session for NVIDIA. The shares rising to near 6%, their fourth best session of the year. So maybe no surprise that we're taking the foot off the gas of the rally. NVIDIA shares down 1.4%. We also got some negative news out, though, from SoftBank. They have unloaded all of their holdings of NVIDIA in the month of October. That also adding to the negative sentiment. Staying with the tech theme, let's move over to CoreWeave. They were out with earnings after the bell yesterday. They did cut their guidance when it came to sales. And this is an interesting one, Vonnie. On the back of some delays by a third party in order to build out a data center, they were unable to fulfill some customer contracts. And so they had to mark down their guidance. CoreWeave sinking down 9%, but reminding us that this AI boom that has gone so rapidly, some bottlenecks are maybe likely to appear on the way forward. Lastly, let's end in the media space. The recently merged media company Paramount Skydance in the green this morning, up 4.2% after they did claim that they are seeing more efficiencies when it comes to this merger. They now see their cost efficiencies at $3 billion. They previously saw it as $2 billion. So these efficiencies, as well as further announcements of job cuts, is seeing a boost to the shares this morning. Funny?
And in fact, Valerie Teitel, thank you so much. That is Valerie Teitel there. Later this hour, we're going to speak to Amy Wu Silverman of RBC on this equity market and some volatility potholes. But first, now we get to Kriti Gupta, the United States inching closer to getting back to business.
I think based on everything I'm hearing, they haven't changed anything, and we have support from enough Democrats. and we're going to be opening up our country. It's too bad it was closed, but we'll be opening up our country very quickly.
The record-setting 41-day government shutdown may end as soon as tomorrow after the Senate passed a temporary funding measure backed by a group of 8 centrist Democrats. Joining us now is Bloomberg's Kriti Gupta. So, Kriti, what happens to the ACA subsidies after this, and how did we come to this decision?
Well, it's fascinating here, Vonnie, because this is something that a lot of economists are worried about. You don't have the extension of the ACA credits. That means inflation costs, and medical coverage is going to go up for a lot of Americans across the board. But this was part of the negotiating tactic when it comes to what Republicans wanted. They said that you have to open the government first, then we'll talk about the ACA extensions. And that's basically what's on the table here, that this funding bill will push some of the funding to January 30th. So we get to go through this all over again in early 2026. And that's when these ACA extensions can come about. Now, part of these negotiations have been the idea that Democrats say, well, all right, we get that if you don't want the extensions forever, how about extensions for just 1 year? That was a proposal that was dead in the water from the get-go. So this is really something that is still very much on Democrats' minds, but maybe doesn't feature in this round of budget talks.
Well, as you say, there are many Senate Democrats that are calling this basically a capitulation and saying that it's a cowardly move, a surrender, if you like. Kriti, what happens next with the rest of the Democrats?
Well, it's tricky here because at the end of the day, now that you do have these 8 kind of rogue Democrats that voted against their party in favor in the Senate, the question now is, do you see the same support from the GOP in the House? Now, the expectation from Speaker Johnson is absolutely the House should vote in line or on party lines, which should get this across the line. The problem here, though, is that a lot of these ACA extensions also affect some of the rural communities that you are seeing in Republican mandates. And that was some of the reasons, some of the concern and some of the tension that you saw within the GOP, that these ACA extensions could actually affect some of their own jurisdictions and some of their own arenas. And that's where this whole idea of ACA credits and how this actually shows up in the midterms really focuses. I should point out to everyone that the 8 Democrats that were kind of, quote, went rogue against the party in the Senate are either retiring or either aren't up for renewal until as late as 2030 or 2031. And that seems to be a key piece of the politics behind this agreement.
Kriti, just give us a sense of the timeline here. So the House was going to be given 36 hours to get back to Washington to have this vote. But then what happens? I mean, will the government automatically reopen after that?
It takes a little bit. I'd like to think that the government was as efficient as you laid out, Vonnie, but it's crucial. You said the 36 hours. 36 hours are already in play. The question here is now, can Speaker Johnson get all of the voting members of the House in Washington to actually conduct the vote? But Vonnie, as we've been covering on Bloomberg Television and radio across the board, there are flight delays, there are logistical delays. With this government shutdown may come delays to get everyone actually in Congress. So that's hurdle number 1. Hurdle number 2 is getting everyone on board. This is not a done deal just yet. And hurdle number 3 is, of course, will the president sign it in time for Friday, when a lot of economists and folks on Wall Street are maybe expecting some of the early decisions on the non-farm payrolls. It's unlikely that we'll get that as soon as Friday. That would, again, rely on a lot of swiftness from the government. But, Vonnie, you never know.
Yeah, you never know. Kriti, thank you so much. Kriti Gupta there in London. Well, on the trade front, Switzerland is close to securing a 15% tariff on its exports to the United States. This would be a relief for the country after it was hit with a punishing 39% levy back in August. Bloomberg's trade czar, Brendan Murray, joins us now. So, Brendan, obviously this would have been bad for Switzerland if it were to continue. What do we import from Switzerland that, they would have been taxed on?
Well, the key thing is pharmaceuticals, and it sounds like they're inching closer to some sort of agreement around producing more drugs in the U.S., according to the U.S. Trade Representative Jamieson Greer and some comments he made last week. So, but what we have are both sides signaling that the optics, the mood music is heading in the right direction. Reporting this week tells us that a deal could be coming either next week or the week after. So, fairly imminent. And President Trump didn't deny any of that in his comments in the Oval Office yesterday. So it sounds like they're getting through the toughest of the disagreements, and they're close to some sort of an agreement.
And it's not just Switzerland. The comments were the latest signal of a possible thaw in Washington with Switzerland, but also in this New Delhi trade dispute. Let's have a listen.
We're making a deal with India, a much different deal than we had in the past. So right now they don't love me, but they'll love us. Again, we're getting a fair deal, just a fair trade deal.
So what did India do to make this happen, Brendan?
Yeah, the key thing is its reliance on Russian oil. There are some signs that Indian refiners are reducing their imports of Russian energy. So that has been a key U.S. demand in any deal that leads to a lower tariff rate for India from the 50% that it's paying currently. And so it sounds like India is offering some concessions, albeit at a slow pace, that will make the negotiators in Washington think that the deal is close. I should say, though, that they've been saying an India deal has been close since March or April, and it's turning out to it's looking more and more like a traditional kind of trade deal in terms of the duration that it takes. They deal with the easy stuff first, and then they get down to the more difficult things at the end, and that's where this is headed.
Yeah, and then, of course, we have to talk about China as well, Brendan, because China seems to have put in place now a system for its rare earth exports. Can you explain to us what happened?
Yeah, it seems to be some sort of express lane for the permitting that they're going to issue for rare earth critical minerals that the U.S. and Europe so depend on. So that could work to the advantage of American and European companies if they're if they need these materials for commercial purposes. But it's the attempt here from China is to identify quickly which companies need them for military uses and to prevent those flows from happening. But it sounds like China is moving another step closer to implementing its trade deal pledge to the Trump administration to get critical minerals flowing again. Whether or not it actually does that, we'll have to continue to watch that.
So it's pretty much all positive trade news this morning for once. Brendan, thank you so much. That is Brendan Murray in London. Now to other top stories trending on the terminal this morning. The dollar defying talk of the Sell America trade. Based on Bloomberg calculations, the dollar carry trade looks set to beat risk-adjusted returns on European stocks and Chinese bonds. The appeal of borrowing in yen or the Swiss franc has been helped by a sharp drop in dollar volatility. Unemployment in the UK rose 5% in the 3 months through September. That's the highest level since COVID. Traders boosted bets of a BOE rate cut when they meet again in December. And LVMH is betting bigger on China. Louis Vuitton, Dior, Tiffany and Loro Piana all set to open major stores in Beijing next month. The expansion comes on signs that the slump in China's luxury market has bottomed out. Coming up, SoftBank unloading its Nvidia stake. We'll get all those details next. This is Bloomberg.
Okay, ready?
David, what initially sparked your interest in this topic of longevity?
15 years ago, I turned 60, and I began to wonder how much longer I'm likely to live and what I could do to extend my life. On longevity, I talk with the leading experts in science and medicine to educate people about how they might be able to change their conduct so that they can live a happier and healthier life. I'm David Rubenstein. Join me on a 4-part journey as I explore the great quest for longevity. Only on Bloomberg.
Key investors, top executives, global innovators. Join me for in-depth conversations with the biggest newsmakers on the day's top stories. Insight with Haslinda Anand, only on Bloomberg.
Join me each week on Wall Street Week for stories of capitalism from business, markets, economics, tech, and climate. More than what you need to know, it's what you need to think about.
It's the world's second largest economy with a growing influence in global affairs. Bloomberg The China Show brings you the unmatched expertise you need to keep track of breaking news, in-depth market analysis, and the most influential newsmakers in and around China.
We need to do more to engage the market more. We're risk on. I think we caught a little sweet spot.
Massive savings right now.
It's already a different game.
Bloomberg The China Show. Weekdays around the world, right here on Bloomberg. Context changes everything.
This is Bloomberg Brief. I'm Bonnie Quinn in New York. NVIDIA is lower in U.S. pre-market trading. SoftBank said it sold its entire stake in the company for $5.8 billion. Joining us now is Peter Elstrom, Bloomberg's executive editor for global technology. So, Peter, give us a little bit of the history here. This isn't the first time that SoftBank has sold a portion of NVIDIA. It's NVIDIA Holdings, but it seems to have exited completely now. What's behind that?
Yeah, that's exactly right. Yeah, SoftBank has invested in NVIDIA a couple of times in the past. In fact, the last time that they held the shares, they did sell all of their shares in 2019. That was just before the big run-up during COVID. And Masayoshi Son, the founder of SoftBank, has said many times he regrets that. If he had held on to that stake, it would now be worth about $230 billion, which is more than the value of SoftBank itself. Now, in this case, they made a second investment. They were in NVIDIA. He and Jensen Huang know each other. They had taken this stake, but they decided to take the money off the table. It's about $6 billion. This is part of their earnings report today, and the CFO, Yoshimitsu Goto, explained afterwards in a conference call that what they're doing here is not a signal that they don't believe in NVIDIA or the AI boom, rather the opposite. They want to take that cash and they want to make some of their own investments. They're partners with OpenAI in this venture, SoftBank, Stargate in the United States. So they want to be able to put hundreds of billions of dollars, maybe as much as $500 billion into that U.S. project as they try to build out their own infrastructure. They have a couple of other things going on. As we've reported, they have held talks with the chip company Marvell in the past, possibly about acquiring that company, which would be the biggest deal in the tech industry. So there are many things that Masayoshi wants to do with that cash, and that's why he took the money off the table here.
Yeah, Masayoshi-san, always fascinating with his strategic twists and turns, right? I want to ask you a little bit about CoreWeave as well, though, because that stock is really getting punished in the pre-market. The NeoCloud cut its forecast, but because of a delay to a customer contract. Is the reaction overdone, Peter, or what are analysts saying?
Yeah, it's interesting to see the analysis here and the explanation from the company. The company's been growing very quickly. It is one of the companies, as you say, that's been building out these data centers for AI, and its shares have soared because of that. Now, the CEO had to come out and say they're not going to grow as quickly as they had anticipated before. That's largely because one customer was having some troubles with execution. They think that they're going to get all of that revenue, but as you see in the stock market, shares are down pretty hard. Expectations are very high for these kinds of companies, including CoreWeave, and now investors are a little bit disappointed. We'll see how long that lasts.
Peter, does this mean anything in terms of the broader macro AI story? You know, we've had a very strange earnings season, and then, you know, for example, yesterday NVIDIA had its best day and, you know, one of its 4 best days this year, and now you have NeoClouds potentially getting whacked. Are investors just grasping around for another narrative related to AI?
I think these valuations are getting so high right now that you do have some people calling a bubble, betting against this. Probably the most famous, Michael Burry, has taken a position betting against Palantir and NVIDIA in particular, saying that the AI bubble is overdone at this point, and he believes that that's going to come down a bit. But as you mentioned, yesterday was a very strong day in the stock market. There have been some pretty strong results from NVIDIA and some of their partners. TSMC, the company that actually makes those chips for NVIDIA, reported monthly sales yesterday that were quite strong. It seemed to reassure investors. Also, because we're getting this budget deal in the United States, there's some optimism about stocks overall, so that's kind of pushed up the stocks. But yeah, we still have to see whether these perceptions of a bubble play out or whether we're going to see some sort of a pullback.
Absolutely. Peter, always a pleasure. Thank you so much. That is Bloomberg's Peter Elstrom. Coming up, a look at what else is making headlines in your front page news. This is Bloomberg.
case you missed it, on Bloomberg Crypto.
There's a debate going on right now in DC that I think folks need to start paying more attention to, and that is the yield. And the question really is, who is going to keep the yield? Who makes money off stablecoins? Well, right now, in the case of some of the large stablecoin issuers, there's a yield that on those deposits. So when there's a dollar, for example, deposited in a bank account, there's interest paid on that dollar. And so who's capturing that yield? And I think one of the really interesting things about the Genius Act is that it bans so-called yield-bearing stablecoins from giving that yield directly back to consumers. Now, that's not true everywhere. And I think if consumers have a choice, why would a consumer want an institution to keep that yield? Or would there be sharing of that yield? So right now, one of the debates going on is, will rewards be allowed? And I think these are really important questions.
Don't miss Bloomberg Crypto, live Tuesdays.
At a time when policy in Washington is driving Wall Street, we draw a distinction between the rhetoric and the action, bringing you market-moving guests and original reporting. This is Bloomberg Surveillance.
Technology is embedded in every aspect of our lives.
And laying the foundation for the future.
From finance to defense, AI to entertainment.
And from the road to the stars. Bloomberg brings you the latest stories of the people and companies pushing the tech sector to new frontiers.
And the politics that shape global tech markets.
I'm Caroline Hyde in New York.
And I'm Ed Ludlow in San Francisco.
Watch Bloomberg Tech every weekday.
Only on Bloomberg Television.
Earnings season is here.
Earnings season begins once again.
So much going on.
Bloomberg is first to break the numbers.
From Snowflake, from Pure Storage, from Urban Outfitters, yeah, from NVIDIA.
Coming up, we'll talk about some of the other earnings that are coming out.
With the smartest insights.
Third quarter numbers are going to be really important. The commentary is going to be important. It's all going to be about margins because margins lead to earnings. And if earnings come down, we have a problem.
You have to come back again soon. This is really excellent.
Continuing coverage on Bloomberg.
This is Bloomberg Brief. I'm Bonnie Quinn in New York. Nobel Prize-winning economist Paul Krugman spoke about the state of the U.S. consumer, saying it's worse than where it was during the financial crisis. He spoke on Bloomberg The Close with anchors Katie Greifeld and Romaine Bostick.
Basically, we have the worst consumer sentiment about current economic conditions, basically ever. Worse than, not just worse than the, 2022 when we had 9% inflation, but worse than the aftermath of the financial crisis, worse than the stagflation of 1980. People are really, really down on this economy, and I have to say I don't think that the way this drama has been playing out is going to change that. If anything, we're likely to see, I was just hearing the tail end of what you're saying, ordinary people. People who are not in on the stock market are hurting and feeling extremely stressed.
Well, Paul, it's interesting that, coming out of this shutdown, one of the consequences is that we're going to get economic data figures to actually put some numbers to this economy's performance. But you think about some of the reports that have been delayed, at least 2 employment reports, CPI, PCE as well. It's unlikely that the BLS has been able to collect and actually process the data for some of these reports. And with that in mind, I wonder, what kind of quality we can expect in terms of trying to put some context around these vibes.
Yeah, we're going to have a ghost month. It appears that on labor market data, there will simply be a month that we know, anything could have happened in there. The BLS will never be able to catch up on that lost data. And we do worry a lot. I mean, there's been a problem with declining response rates and understaffed BLS even before. So the data quality is going to be a real issue. And, we're all looking at the soft data, the private surveys, none of which says that the economy is falling off a cliff, but a lot of which is at least a little bit alarming. And I'm particularly struck. I've been looking at conference board on are jobs plentiful or are they hard to get? And that number has fallen off a cliff. People feel really, really bad about job prospects right now in ways that the BLS numbers weren't showing before, but does suggest a kind of frozen labor market in which people, if you're new to if you're young, just getting in, or if you've been laid off, it's a really tough world out there. So this is going to be, I mean, it doesn't look like, it doesn't look like September 2008 with everything falling off a cliff, but it does kind of feel like this is starting to feel like a tough economy. And as I said, ordinary people are extremely pessimistic about the state of affairs.
Nobel laureate Paul Krugman there speaking to Bloomberg's The Close. Time now for your front page news. First up, the Financial Times reporting investors' angst over big tech's AI spending is spilling into the bond market. The FT points to a widening spread to treasuries, up to 78 basis points now, saying it highlights rising concern with the way these tech companies are turning to debt markets to finance AI investment. Next up, the Wall Street Journal leading with the diverging growth strategies of Anthropic and OpenAI. The journal cites documents showing Anthropic is expecting to break even for the first time in 2028. OpenAI, on the other hand, forecasts operating losses will swell to about $74 billion in 2028. And on the Washington Post's front page, a draft map obtained by the Post shows President Trump and his officials planning to propose oil drilling off the coast of California for the first time in decades. The plan proposes 6 offshore lease sales between 2027 and 2030. It's a move the Post says is sure to antagonize Governor Gavin Newsom and other California Democrats. All right, let's take a look at how we have the macro picture shaping up for the day. S&P future is lower now, although off their lows of the session. It does look like it's going to be a day of at least consolidation. Very slightly stronger U.S. dollar index. The yen is above 154 today. And as you can see, the VIX is below 18, but trending just that little bit higher. Coming up, investors need to have enough of these large cap tech stocks. We'll speak to Amy Wu Silverman.
Such an incredibly exciting moment with AI. It is really the most profound technology of our lifetimes, and I think it has the potential to help us rethink literally everything. The potential for economic impact, societal benefit is honestly boundless. When we think about the economic impact for Europe in particular, it's around a 1.2 trillion euro estimate of the productivity growth that can be unlocked. This platform shift that we are living through, I think, is going to create untold amounts of value for the world, but also for the businesses and for economies, which is why I'm incredibly optimistic in this moment for Europe, but also for the whole world.
How do you think about job losses or safety for some of the AI tools?
You know, I hear the anxiety and I understand the anxiety about jobs. I think that we are certainly going to live through a massive transition about how people learn to work alongside these tools. I mean, the reality is I do think there'll be some number of jobs that are displaced. I think it is a smaller number maybe than some anticipate. We estimate it's around 7%. And I think what's important is that we have programs that help those 7% transition into new fields of work. I think what is more likely is that most of us are going to learn to work alongside these tools. So we estimate about 2/3 of us. If you think about the tasks you do in your daily life, when you look at every industry, there are administrative tasks that are happening everywhere, and that's what AI is most helpful in improving.
Why do the biggest names in business choose Bloomberg Television?
That's a great question.
It's a very good question.
Interesting question. Good question.
Great question.
I so appreciate that question. You certainly ask interesting questions.
Bloomberg Television. Top experts, great questions. Get your fixed income fix. Watch Bloomberg Real Yield around the world right here on Bloomberg. Context changes everything.
It's 5:30 a.m. in New York City. Good morning. I'm Bonnie Quinn with your Bloomberg Brief. Here's what you need to know. In the home stretch, the House gears up for a vote as the Senate passes a temporary funding bill to close out what could be a 41-day government shutdown. Inching closer, President Trump says the U.S. is nearing tariff agreements with Switzerland and also with India. And a surprise move, SoftBank unloads its entire stake in NVIDIA, raking in close to $6 billion. Let's take a look at those markets. It is Veterans Day, and so for everyone who served out there, this is a day honoring them. The bond market is closed, but we do have equity markets open and futures right now pointing lower, though well off their lows, I have to say. S&P futures pointing to a drop about 0.2% about 4 hours before that opening trade. And don't forget, we had a wonderful day yesterday for equity investors that were fully invested. The S&P was up more than 1.5%. The Nasdaq was up 2.2%. Palantir had its best day since April. It was up 8.8%. NVIDIA, its fourth best day of the year. So what will happen today? Volatility is certainly coming down if we look at the VIX, but we're still, just below 18. Gold is also rising. What does that mean? We're above $4,100 again. And the yen weaker. That's a slightly different story. It's at 154.30 today. So we want to keep an eye on all of these. We're going to speak to our guest about volatility potholes in a moment. But let's get to some individual stocks to watch first. Over to London now and Valerie Teitel. Valerie.
Good morning, Bonnie. Let's start with a check on those big tech names. NVIDIA on a back foot, down 1.25%. Now, this comes after NVIDIA had one of its best sessions of the year yesterday, up some 6% amid this broad optimism around the end of the U.S. government shutdown. But we are on a back foot this morning, and it's dragging the Nasdaq with it. We did also have some negative updates when it comes to SoftBank and their earnings. This is a famed tech investor, tech fund out in Japan. They did unload all of their shares of NVIDIA, actually looking to use that money into investing into OpenAI instead, perhaps telling us something of how they're viewing valuations between the publicly traded NVIDIA and the more privately traded OpenAI and other valuations in the private space when it comes to this tech trade. Staying in AI, let's talk about CoreWeave out with results after the bell yesterday. They did mark down their guidance, and this is a really interesting one, Bonnie. They marked down their guidance because they found a bottleneck in a third party and trying to build out a data center. They were unable to fulfill some of their customer contracts, so did mark down their guidance, and shares are falling nearly 9% in pre-market trade. But I think this does serve as a warning that this build out of AI, of data centers, is likely to hit some bottlenecks somewhere. It seems like CoreWeave hit one of them in the previous quarter. Lastly, let's end in the media space. Another earnings update from Paramount Skydance as they recently merged media company. They merged back in August, and they're finding some more efficiencies. The company said that their efficiencies are looking around $3 billion. They previously had said $2 billion. So we're on an upward trend for Paramount Skydance, up 4.2% in pre-market.
Should be an interesting trading day. Valerie, thank you so much. Valerie Teitel there. RBC's Amy Silverman calling on investors to have enough of the AI Mag 7 mega cap tech stocks. She writes this: to some degree, the necessity of protecting against so-called up crash risks is masking the sentiment that is very much in the market from institutional investors. Amy joins us now. She's head of derivatives strategy at RBC Capital Markets. So Amy, is your point that retail will get in because it's just too much? If we see a drop in some of these AI tech stocks, you have to get in, but institutional investors are much more wary.
Yeah, a lot of the clients we speak to have been frankly wary this whole time. But when you look at the risks for this year, that right tail, so that up crash risk really has been just as important as the down crash. You don't want to drag your benchmarks. There's such heavy concentration in the market. And so essentially what I think is happening is there is this shadow demand for downside protection that you don't actually see priced in, but is very much there, which makes me concerned that downdrafts, if they do occur, will end up becoming more exacerbated.
Where are you seeing this shadow demand, Amy? Can you point us to specific parts of the market?
Yeah, I think one aspect of it might be what you're seeing in credit. So that widening spread in credit is kind of showing you that there are concerns basically on capital structure in terms of the somewhat, incestuous loop you see in some of these AI CapEx spends. The second part is you do see it in longer term hedging. So that sticky skew, this idea that even when the market does sell off, you don't see that demand for hedges rolls off, to me is very interesting. But I think one aspect of what makes it shadow, quote unquote demand is the fact that you don't see it really that priced in, particularly in the near term, because again, that up crash risk keeps investors more with their thumb on that right tail, but it does not mean that left tail risk doesn't exist.
I mean, to some extent, you can't blame them, right? Because even after April 2nd, we had, as you're calling it, an up crash. And, we've seen that several times since. Every time there's been a volatility pothole, VIX has come right back down. The MOVE index is at, multi-year lows.
Yeah, you're exactly right. And so one aspect of that, one reason that's happened, in particular that whipsaw we saw April 2nd was because you have seen this very steady buy the dip from retail. And that has been something that I think we've basically been able to count on post-pandemic. And a lot of that, Vonnie, is from a cohort that's very young, that doesn't really remember the global financial crisis. Probably they started this market probably in the years after. And one of the questions I keep asking to clients is, if that cohort somehow does get scared off, or somehow they do start to lose that wealth, it's a little self-referential in the sense that a lot of that wealth is tied to the stock market, it's tied to crypto. So if that goes down even further, can we no longer count on that backstop in this market?
Yeah, I mean, it must be a pretty big backstop. I want to point to one of your statistics. You say it now costs more than 7 times to hedge the low-quality basket that you've identified versus the high-quality basket, whereas last year that spread was only 5 times. Explain what that means to us.
Yeah, that goes back to my comment about how sometimes this is a little bit of a shadow demand in the sense that, you don't necessarily see this outright in headline VIX or see this outright in hedging demand, but these other aspects of the market are telling you there's quality concerns. We talk a lot about this K-shaped consumer, and obviously that higher part of the K is driving a lot of the spend. There's also K-shaped quality in terms of volatility, and you can see that low quality basket. So companies that have negative cash flow, that have a lot of debt, the pricing of risk there is growing. The problem is you don't necessarily see that on S&P implied volatility because most of the concentration is coming from cash-heavy companies. It doesn't mean that quality creep isn't starting to occur.
Amy, will institutional investors eventually come out to hedge, in the open? And what would cause them? What would be the catalyst for them to do that?
Yeah, I think what it's going to cause it is, we're obviously going to at some point get some sort of exogenous risk. It could be anything like near term when you start to actually get the data that we've been missing from this government shutdown. If that is very disappointing, I could see that being a volatility pothole, so to speak. My main concern is if you start to get confirmation that there's downside momentum. So we've seen a lot of upside momentum as a factor. Downside momentum has not really been that sustainable because retail has bought that dip. If that starts to decline and you don't have that backstop, so you get sustainable downside momentum, I would be really interested to see what institutional investors do. My gut says they have been wanting to hedge, and they will take that as confirmation that they should begin.
Amy, always fantastic to talk to you. Thank you so much. Amy Silverman of RBC Capital Markets. Now to other top stories trending on the terminal this morning. Norway's finance minister Jens Stoltenberg said politicians suspended ethics rules governing the country's sovereign wealth fund after ethics advisors pushed for the divestment of Caterpillar. The advisors pushed the sale of Caterpillar in August because its bulldozers are used in the war in Gaza. Stoltenberg said the suspension of ethics rules came after it stoked fears of a fire sale of tech holdings. First Brands' new CEO, Charles Moore, says the company's founder, Patrick James, ordered the transfer of hundreds of millions of dollars of corporate cash to his personal bank account and businesses he controlled. Testifying in a federal court, the new CEO also said managers admitted to doctoring invoices used to secure financing. And And it's the end of an era for one of the world's most watched investing gurus. Warren Buffett says he's going to stop writing his Berkshire Hathaway annual letters and will no longer speak at its meetings. His latest letter disclosed he's donating more than $1.3 billion to family foundations. We'll still hear from him at Thanksgiving, though. Coming up, the end may be in sight. The U.S. government shutdown could end as soon as tomorrow. More on this coming up. This is Bloomberg.
Coming to you live from Kuala Lumpur. The whole world is here.
The APEC Leaders Summit bringing together heads of states of 21 APEC economies.
The White House is trying to use the stops to gain additional leverage.
This big deal with a number of the biggest companies in South Korea.
That's a big number.
Deals can't be done.
Trust Bloomberg for on-the-ground coverage.
Korea is not Japan.
Up-to-the-minute reporting.
In this latest salvo of this trade war.
What a visual.
And the analysis you need.
China's not going anywhere, nor are we.
We have two crises, two essential crises, and for both it's now or never: democracy and climate, and they are absolutely interlinked. And we have to solve them together. We're losing the democratic infrastructure and norms to deal with the climate, and we're losing the climate stability that is essential for a democracy. We have to solve them together. We've never faced a threat like this to our democracy at a time when it's a perfect storm, at a time when we're being told by climate scientists, some of you may be in this room, that we have to cut our emissions, fossil fuel emissions, in half in 5 years now. You know, when I started to realize what was happening, it was 12 years, and we haven't done it.
It's the countdown to the market open as we bring you the first trades across Europe.
We'll debate the most important stories and what will drive the big investment decisions throughout the morning. I'm Guy Johnson.
I'm Kriti Gupta.
And I'm Anna Edwards. Join us every weekday morning for the opening trade, live at 7 a.m. here in London.
Only on Bloomberg. Context changes everything.
President Trump supporting the bipartisan deal to end the U.S. shutdown, as the record-setting 41-day drag is on a path to close out potentially as soon as Wednesday. This all after the Senate passed a temporary funding measure backed by a group of 8 centrist Democrats. Bloomberg's John Harney joins us now from Washington, D.C. So, John, when is the earliest we could see the government actually reopen, data coming back into our terminals and so on?
Perhaps beginning as early as tomorrow. The Senate last night, as you reported, voted 60-40 with crucial 8 moderate Democrats who agreed to end this standoff. So now the House has to come back, and they are slowly drifting back here, coming back here to Washington, and they could vote by tomorrow. Their vote is required because there was a few changes made from the resolution that they approved back in September. They have not been in Washington since then. So the end credits could be about to roll on this. We'll see who gets credit and discredit for what.
Yes, exactly. I guess the president has to sign as well, but essentially that would reopen the government. I'm curious about this 50-year mortgage plan that sort of came out yesterday. President Trump calling it not a big deal, but it is a big deal. I mean, first of all, it's not clear that the president can do anything about banks deciding to extend, 30 years to 50 years. And also, wouldn't people be paying a lot more interest over that kind of time?
They would. The incentive is that they would be paying less each month. And that has, the interest rates and the cost of housing are one of the things that are a big concern of voters, which was reflected in last week's elections, in which Republican candidates were beaten for the most part. But a lot of questions have to be answered here. Would the banks want to do it? Would there have to be legislation that would, by Congress, that would compel them to do it? And it would mean that, say, if someone got a mortgage today, it would be unlikely that it would be paid off assuming their family stay in that house, they would be paid off in their lifetime. So this great American tradition of burning the mortgage might fade.
Yes, I know we're all living longer, but 50 years for a house, John, I don't know if it would be worth it. John Herney, thank you so much in Washington, D.C. Let's turn to trade now. Switzerland closing in on a 15% tariff on its exports to the United States. A relief for the nation, potentially, after it was hit with a punishing 39% levy back in August. Let's get more from Bloomberg's Brendan Murray. So, Brendan, did Switzerland have to offer concessions or some kind of sweeteners? How did this come about, assuming it is coming about?
Yeah, this looks like one of the harder trade deals that the Trump administration has negotiated with a trading partner. Switzerland has been to the altar before and been disappointed. They thought they had a trade deal a few months ago. Instead, President Trump hit them with that 39% on their national holiday on August 1st. And so it's been a slow but steady progress situation for the two sides. It sounds like they are legitimately closer to a deal this time around. It depends on what Switzerland can offer the Trump administration. Trump wants pharmaceutical production brought back to the United States. He wants that trade deficit that it has with Switzerland brought down, and so he wants a deal on paper that he can show that he's taking steps in that direction.
And progress on a different continent as well. Let's just have a listen to what Trump has been saying about India and getting closer to a deal with India.
I think based on everything I'm hearing, they haven't changed anything, and we have support from enough Democrats, and we're going to be opening up our country. It's too bad it was closed, but we'll be opening up our country very quickly.
I guess same question. He sounds more positive on India than he has done in many, many months. He was very, very down on India for a long time.
Exactly. This has been going on for 7 months. They've been saying that the Trump administration has that India would be one of the first to do a deal with Trump. That hasn't turned out to be the case. There are some key sticking points, among them India opening up its agricultural sector to U.S. exporters. And, of course, Trump is demanding that India decouple itself from its oil reliance on, its energy reliance on Russia. The U.S. has also said that it wants India to buy more U.S. military hardware rather than buy that kind of stuff from Russia. So it sounds like India is making steps in the direction of buying less Russian energy. And so the Trump administration is taking a look at this and saying, you know what, maybe they've sweetened their offer enough that we can do a deal with them.
The Wall Street Journal, Brendan, has a report this morning about China planning this validated end-user system for rare earths. What is this? Some kind of a system to track where they're going?
Yeah, exactly. China's making the distinction between commercial use of its critical minerals and military use, and what it wants to do is give sort of an easy pass to the commercial use companies, and so that will speed the flow of these magnets and other sorts of things that are needed for airplane engines and automobiles and the kind of heavy industry that run on critical minerals. And so it sounds like China is making another step toward the implementation continuation of its trade agreement that President Xi and Trump made a few weeks ago in Asia. And so, and the U.S. has done the same thing with its export controls. So that deal, that truce that now has another year to play out, both sides are following through on those commitments.
Brendan, thank you as always for all the context. That's Brendan Murray there. Turning to tech now, NVIDIA getting hit in the pre-market. SoftBank announcing that it sold its entire stake in the company. It was a surprise move. Bloomberg's Tom McKenzie joins us now for more. Masayoshi-san, as always, interesting, Tom, but why cut out of NVIDIA now?
Yeah, that was a surprise. I was watching for the earnings earlier this morning for SoftBank, and they came through with profits that comfortably beat. In fact, they smashed the estimates. But the key line was that they are divesting their stake then in NVIDIA, $5.8 billion US, as you say. And the key question, to your point, is why? What they've said is they need to free up their liquidity because of all their deal and infrastructure spending commitments they've made, whether that's Stargate in the US or this huge project that they're building out in Arizona around robotics and AI manufacturing, but also the deal making. They're planning to invest about $22.5 billion additional dollars in OpenAI by the end of this year. They're looking to take over Ampere, the chip design company. They are looking to buy ABB's robotic arm as well, which would come with a ticker price of a little over $5 billion, close to $6 billion US. So they need the liquidity. That was a rationale. Of course, for some, they'll be looking at this thinking, well, hang on a second. Is this SoftBank saying there's a bit of a bubble? They're selling down on NVIDIA. The CFO said, look, we can't say if there's an AI bubble, but they were very clear this is about freeing up the liquidity to spend on additional projects. They also gained, by the way, in terms of the net profit coming through, a huge beat at $16 billion, above $16 billion. They also have investments in Perplexity, in OpenAI. A lot of that came through, in fact, writing up the gains that have come through for their stake in OpenAI. That was the bulk of it, and that stake has increased by about $15 billion US since they invested.
Yeah, definitely a lot of vision there, you could say. Listen, CoreWeave getting completely killed in the pre-market, the Neo Cloud cutting its forecast, but it was just a delay to a customer contract. It's keeping the customer. So what does this mean in general? Are people losing faith in the Neo Clouds for some reason, and why?
It seems to be more a question of how they meet that demand and some of the constraints and some of the snarls that they face, this Neo Cloud, as they try to meet that demand and continue to lease out these AI accelerators. You're right, this is one customer that they say they've had to miss the rollout for. They've obviously said they're very disappointed, but what it means is they've lowered that full-year forecast. At the top end of the range, they had seen about $5.35 billion US by the end of this fiscal year. They've now moved that down to about $5.15 billion. Also, another negative was the margin. The margin came in at 4%. That was below the estimates. They did actually beat on revenues, and they also have a backlog in terms of the pipeline of projects as well, about $55 billion, which is almost double in the previous period. So that should support them going forward, but clearly the downgrade to the forecast for the full year is causing anxiety for some investors out there in CoreWeave.
Finally, Tom, since we do watch people moving around, Intel's AI chief, who just got the job earlier this year, is leaving for OpenAI. Lip Bhutan is going to take on his role as well. Is this just a money thing, or does it say something about Intel's AI achievements?
I think it probably tells you a couple of things. One, on the money, yes, obviously the talent war, the fight for talent around AI is and remains as hot as ever, and obviously these executives and those with the skill sets are being offered incredible packages and incentives to jump ship. I think it also tells you that OpenAI is very serious when it comes to not just building out AI infrastructure, but also designing its own AI chips as well. So I would read that probably into it. It's obviously a blow for Intel as they try to recover. They got that investment from the US government. They got the backing as well from SoftBank, interestingly. But the loss of this key name is certainly not good news for the team at Intel as they try to regain their footing in terms of being able to design and produce their own AI accelerators to compete with the likes of NVIDIA, a race in which, of course, they continue to be far behind.
Tom, thank you so much. That is Bloomberg's Tom McKenzie there in London. Coming up, we're going to get you set up for your trading day. We'll have some private jobs data later on. This is Bloomberg.
I'm David Weston. Join me each week on Wall Street Week for stories of capitalism from business, markets, economics, tech, and climate. We go on the road for a look at what lies behind the headlines of today and what will likely be the headlines tomorrow.
We need more transparency.
Oil and gas is still important.
They said every citizen should be investing in the market.
Accelerate progress in all fields of science.
Watch Wall Street Week right here on Bloomberg. More than what you need to know, it's what you need to think about.
Bringing you up-to-the-minute geopolitical news whenever and wherever it happens. I'm Lizzie Burden outside Windsor Castle, England, and this is Bloomberg.
Astonishing day for US technology.
It's shaping the region's technology ecosystem.
Asia's biggest tech news and innovation.
Tune in to Bloomberg Business Week Daily.
We got to talk crypto.
From the magazine that helps global leaders stay ahead.
What's the conversation around your company?
Bringing you insight on the people, companies, and trends shaping today's complex economy.
Planning very big things.
A new level of premium.
Plus global business, finance, and tech news as it happens.
The floodgates of innovation are going to open up.
You can't fake passion. You either are or you aren't.
Bloomberg Business Week Daily, only on Bloomberg.
Bringing you up-to-the-minute geoeconomic news whenever and wherever it happens. I'm Bonnie Quinn in Sao Paulo, Brazil, and this is Bloomberg. This is Bloomberg Brief. I'm Bonnie Quinn in New York. Now a look at what's ahead today. It is Veterans Day. We're honoring all veterans of armed forces. The U.S. Treasury market then closed. We do get some data today. The NFIB Small Business Optimism Index coming at 6 a.m. Eastern, so just about 5 minutes from now. And then later on, about 2.5 hours' time, we get ADP employment data, closely scrutinized, no doubt. So that's all on deck today. Let's take a quick look at some movers in the early going. Nvidia is lower. Mind you, most stocks are lower at the moment, but SoftBank is selling out of all its stake. It has done already $5.8 billion. It's funding its own AI bets. We've CoreWeave getting crushed, delayed a customer contract and put that in the forecast. And then Beyond Meat, well, it's down another 6%. We'll see what happens to that today. It did give a fourth quarter guidance that missed estimates. And then here are your macro movers. We have S&P futures, Dow futures, and NASDAQ futures all pointing lower, although we're off session lows. The dollar index, just a tiny bit of strength as the yen weakens. And as you can imagine, the VIX index, tiny bit higher, but we're still well below 20. That's it for Bloomberg Brief. Surveillance is next.
When I visited Fernandez at IMAX's headquarters outside Toronto, we went to the facility where IMAX designs and maintains its cameras. The latest next-gen equipment was out with directors on filmed for IMAX sets, but there was still plenty of cool gear on view.
As the head of the finance department, do you look at all the things in this room and think, this costs that amount of money, this costs that amount of money?
Thankfully, no, I don't. When I think about cameras in general and what we, when we first, I'll give you a really prime example, the film cameras. When you thought about it, okay, are we building 2? Are we building 4? Are you building 8, right? And that's where I start to think about, well, what makes the most sense from a return perspective? Because yes, Nolan wants the cameras, but how many other filmmakers out there use the film cameras? The lens that I look at it through is essentially, how many do we build and in what way? Because the one thing is we are going to invest to build it right and to build it for longevity. But do you need 10 of them? No. Building 4, that was the right number. And do we potentially want to build a couple more? Maybe a couple more, but I don't think we need 10 because they won't always be in use all the time.
I imagine that at different points you need to tell people no. What's that process like for you?
Oh yeah, it's a key role in the CFO position. It is a word that most people are used to, and yet they still think you're not going to say it.
From the world of politics to the world of business, Joe Matthew and Kaylee Lines deliver news, insight, and analysis live 2 times a day, every trading day. Balance of Power at 1 and 5 Eastern, only on Bloomberg.
Bringing you up-to-the-minute economic news whenever and wherever it happens. I'm Francine Lacqua in Sintra, Portugal, and this is Bloomberg.
Earnings are strong. The downside seems pretty limited.
These earnings better grow into some of these valuations. It looks like we've got a problem with hitting valuation ceilings everywhere we look.
This market has gotten very speculative.
That could cause some volatility in the near term.
This is Bloomberg Surveillance with Jonathan Farrow, Lisa Abramowitz, and Anne-Marie Hordern.
Live from New York City this morning. Good morning for our audience worldwide. Bloomberg Surveillance starts right now. Coming into Tuesday, the stock market rally stalling following big tech's biggest one-day rally since May. Neo-cloud firm CoreWeave is lowering its annual forecast, and SoftBank Group is unloading its entire stake in tech giant Nvidia, pocketing a cool $5.8 billion.
So, look, this raises a lot of questions. SoftBank is often known as the company that invests at the earliest levels of tech companies. First of all, a question of why they didn't have more SoftBank. But the second question is this more NVIDIA, but is this a sign that SoftBank is trying to get out at the top? Or is this a sign that SoftBank sees so many opportunities elsewhere that they're looking to cash in so that they can really make sure that they get in on those opportunities?
So let's take those 2 examples and go with what the companies are saying. Ultimately, SoftBank is saying we want this money to reinvest elsewhere. CoreWeave saying we've got ultimately a problem meeting demand, not a demand problem. And I would say that's the right kind of problem to have.
Potentially. It's the right kind of problem to have if you are beating expectations in cash flow, if you have a huge stockpile of cash, and if you don't have $11 billion of debt that is high cost, and with plans for an additional tens of billions of dollars of investments and lease payments over the next 10 years, at the same time that your revenue is coming in about $5 billion, and your profitability is actually coming in lighter than expected because margins are tighter. So this is a different story because of its leverage and because of it hinging on a couple of very big players. How much is this a very levered and concentrated bet on not only AI, but OpenAI, on Microsoft, on NVIDIA itself?
That's precisely why the stock is down by 9% in the pre-market so far this morning. More coverage of that stock a little bit later, but they're not the only one struggling to meet demand. Microsoft, Satya Nadella came out recently and talked about power constraints. That's a conversation we'll have a little bit later on the program too.
So this raises a question about whether it's sort of a race to see who can build out the most and whether we can handle some of the price increases that are going to come alongside this. With the energy usage in particular, this is increasingly a political issue, how much energy costs are going up, how you are going to power this. And it raises a question, is this a good kind of constraint? Or is this a bad kind of constraint for investors that are expecting exponential growth and may have the physical difficulty in actually reaching it?
And Nasdaq futures this morning down by about 1/3 of 1%. Of course, we'll talk about the government shutdown as well. More than 2,000 flight cancellations in this country already to start the week, and there will be more to come later on this morning. We've taken a major step towards ending this government shutdown. Just one more step to go.
Yeah, and first of all, the House has to actually sign off on it. The expectation is that everyone will come back from their prolonged vacation, all of the House members, that they can vote and get it through by tomorrow. Question's going to be how quickly can we reopen? How quickly can we get flights normalized? And how quickly can we get that data? Is this actually Payrolls Friday that we're going to be having coming up, and not necessarily the October payrolls, but the September payrolls report, which has already been drafted? That is the question. How long is it going to take to get the gears rolling again after more than 40 days of shutting?
Based on the estimates I've seen at the earliest Friday for the September payrolls report, maybe early next week, but it's coming. It's days away.
So it's not going to be Payrolls Friday. It's going to be Payrolls
I would
Monday.
like it to be Payrolls Friday, but It could be payrolls Monday or Tuesday.
That just sounds bleak. I'm sorry, absolutely not.
It's good to get back on track, Ramo. Get on board.
All right,
September 1st, then we'll deal with October, and hopefully we can get November together by early December. Then it's on to the Federal Reserve, a month away. If you're just tuning in, welcome to the programme. Big one-day rally in yesterday's session, slight pullback so far this Tuesday morning. Coming up this hour, we'll catch up with Peter Chair of Academy Securities on the government reopening, Sheila Kaiolu of Jefferies as flight cancellations pile up, and Jeff Curry of Carlisle on the race for powering AI. We begin this hour with stocks edging lower after the Nasdaq posted its biggest one-day gain since May. Peter Chair of Academy writing, markets are rejoicing the end of the government shutdown, but none of the other issues that have been bothering the market are resolved just yet. Pete joins us now for more. Pete, good morning. Good to see you.
Good morning.
Let's talk about those other issues. What are they?
I think you just talked about a lot of them. Was the valuation correct for AI or not, right? It feels a bit frothy. You're now seeing, mega caps move 10% on the back of earnings reports, which seems like a massive move. So I think it just shows how much uncertainty there is about whether we can pay for this. And, more and more people, I think, are questioning two things. One, will we get the electricity up on board and running in time to let this growth come out? And where does China stand on some of their own technology, right? I think it's been assumed that we are going to win this hands down, and yet the news out of China is a little bit disturbing as you see technology advancements after technology advancements.
There's been a mood shift, without a doubt. Faith has been replaced by skepticism over the last few weeks or so. Do you think we're forming a sustainable negative turn in risk tolerance?
This time of the year, seasonality is fairly positive, so that should help. But yeah, I think there's a chance we get a significant 5 to 10% pullback. We started having that last week. Yesterday's rally was not just, I think, on the reopening. There was a lot of news over the weekend that I think encouraged people. 15-year car loans, 50-year mortgages, $2,000 dividend tariff checks coming out. So I think there is this feeling, and I'm trying to adapt whether it's true or not, that this government is just going to flood the market and the consumer with money and liquidity, and that's all that matters coming into the midterms.
Okay, I want to actually get into that, but before we do, just one more beat on China and the development there. Do you see another DeepSeek coming out that could potentially disrupt fundamentally the concept of what kind of resources are needed to power the AI trade?
I think you're seeing it almost on all fronts. They're growing their energy production very quickly, right? So they've got nuclear growing. They're working probably harder and faster on fusion than we are. Then you've had DeepSeek, but you see all these other little announcements, and what they seem to be going for is efficiency, right? And I think we've had this, that we have the best gadgets, and they're clearly the best technology, the greatest technology, has all the bells and whistles, but can people do more with less? And I think that could derail what we're heading for. I don't think it will, but that's a risk.
Which is the reason why people were noticing CoreWeave and saying, okay, this is basically a levered data center bet. What are we going to understand from the returns there? When it comes to some of the stimulus and the potential checks for $2,000 early next year, the potential other benefits from some of the tax reform, how much are you expecting there to be a real reacceleration early next year that will fuel the equity rally, but also fuel inflation expectations?
If you asked me 2 weeks ago, I would have said very little. I thought we were kind of, moving towards, fiscal conservativeness. We are going to use some of those dividend money the tariff money. That's real. It's, we're coming in about $30-some-odd billion a month, help pay down the deficit, or at least keep the deficit from growing slower. All of a sudden, it looks like maybe after the midterm, those elections 2 weeks ago, government's decided it's time to spend and get money out there. So I think it's a real risk, in which case I think bond yields go much higher. I think you're going to see inflation if you get these stimulus checks. You're going to see the Fed reluctant to cut. I think they'll get down to 3% just because they're on that path, especially if Moran has anything to say about it. But it's going to be hard to get 10s much below 4%, I think, under that scenario.
Fed comes down to 3. 10-year bond yields go up to what? You said much higher. What's much higher?
So I think for now they push up towards 430, 450, and as we get those cuts, I think you see, 2s, 10s, maybe stuck at about 100 basis points if you get that sort of cut with the stimulus.
Credit to you. I remember 21, 22. You said this is real. This inflation story is real. At the time, a lot of people were going around using the T word, calling it transitory. Any differences between then and now?
I would have said, I think the CPI has been overstating inflation for a while, partly because of how they calculate housing and things like that, but you're starting to see this small uptick in other metrics, Trueflation, which you have in the Bloomberg terminal. They're showing these upticks to 2.5%. I think it's been a good leading indicator. When you look at a lot of things, I think there's just this creeping level of inflation. The tariff is starting to hit a little bit. And everything, again, if we are going to get, we've been calling it, production for security, if we're really going to start building out nuclear plants, energy plants, there's going to be a lot of demand for commodities. That's going to be a big pressure on commodities. I just don't see inflation coming down to, under 2.5% in the near term.
I wish we could just put a TM trademark whenever you say that coming out of your mouth. I think that would be great. So you can really, really highlight
We
your
have heard
term.
some other people use that term.
Okay.
Partly because it's really hard to figure out what to call this whole thing where it's going to be chips, pharma, across the board. This government's investing. I think just this morning on my way in, I read that they're going to support lending to nuclear facilities. Like, this is real.
Okay, so but this is the conundrum, and this goes down to the inflation story. How long can you have this technological overlay that's very strong when paired with a consumer that is weak and with a consumer that is pushing back? And when you talk about the inflation story, I think about some of the retailers that have talked about how much consumers are being choiceful and really not going towards some of the products that are more expensive. Their inability to raise prices more significantly. Why doesn't that give you some comfort when it comes to how quickly inflation can accelerate?
Because I think the build out of this, especially the energy industry, right? We are going to have to do solar, I think. Wind, I'm not sure whether Trump will ever cave on that. I do think he'll cave on solar. We'll see that. But you're going to see nuclear. You're going to see coal-fired plants. You're going to see all this. I think the effort to build those out will just be inflationary. It's going to keep a floor on commodity prices. You're seeing things like copper stuff, all the demand for these. Until the AI data center boom kind of slows, I just don't see inflation coming down, because that just drives too much of the economy. And unfortunately, it is going to keep, I've been calling it the little I-shaped economy, where you have this little dot that's doing phenomenally well, and the rest are doing somewhere between okay and maybe not so okay. So I don't like the K-shape, because I think it's really isolated, the small segment, and that's what's driving all the growth. So far, we haven't seen a turn. The bond markets have been very willing to fund this. I think there's going to be a lot more debt coming into the bond market. That might put some small pressure on spreads, but the money is there to fund this. So I don't see what stops that until we get real growth questions, and all of a sudden the stocks maybe, if you get stocks pulling back 10, 15, 20%, then I think you see the slowdown. But until then, they're just going to keep growing.
Pete, when does coherent ideology die in Washington, D.C.? It appears to have been replaced by some kind of fluid mix of activist populism. When did that die?
I'm not sure when it died, and some of it's been this, I'll even go back to this transition, Biden was trying to help the chip industry, right? Biden, I think, saw that. We had the CHIPS Act. I think it had some flaws with that. I'm not sure how we're doing it. It doesn't have its own set of flaws, but it just feels to me there's this acceleration. What we've been talking about Academy of Securities, I think I mentioned maybe last time, we're talking about a pre-war environment. So we've shifted to a mentality that's pre-war. And the reason we're pre-war is you want to do things that defend you so that you never actually get to the state of war. And I think that's creating a sense of urgency, which we didn't really have before on anything from rare earths to critical minerals. And ultimately, I think it will create this sort of, sacrifice, that people are willing to sacrifice some things for the greater good.
We're willing to sacrifice free markets at the altar of national security.
I think a little bit of that. I think we're going to have to sacrifice some of the regulatory, but I think there's going to be huge fights. You're going to see certain states embrace this and say, hey, we're open for business. We will do whatever it takes to create refineries. We'll do this. Then I think you're probably going to see states like California fight tooth and nail, saying we're not willing to change our rules and regulations to have this growth. So there is going to be, I think, some friction within this country on that. But I do think that's the stage we're at, as more and more people are looking at China and saying, you know what, we better take this seriously, and we might have to change how we think about life if we're going to have a really good life 10, 20, 30 years down the road, because China keeps eating our lunch in many little ways. And, again, it's so easy. 2005, right? China had almost no IP. The things they made were basically, sweatshops, and it was kind of mediocre quality. Circa 2025, it's robotics everywhere, really high quality stuff, and things, the IP scales are much more even, and somewheres they're leading. Other ways, we're still leading, so it's not like we've lost by any stretch of the imagination, but the world has changed in 20 years, and we have to prevent that from keeping on that path.
They didn't hide.
As always talked about China, its entire history always tells you what they're going to do. They march in plain sight, and everyone just chose to ignore it. I think we kept thinking, oh, eventually they'll want to be like us. They never wanted to be like us. They don't want to. And I think as that realization hits, okay, how do we deal with a China who has their own agenda? We know what their agenda is, and how can we be competitive, still work with them?
But Pete, does that mean we become more like them?
I think everyone's going to have to be a little bit more independent. Everyone's going to have to make sure that they are producing their own goods domestically, then working with their close allies, and then some fraction can be bought from the cheapest provider. But I think it's changing the mentality. To me, it's the new ESG, right? I think ESG put a lot of things on the table in terms of governance, sustainability, and now I think it's going to be, let's take a really hard look at this, and let's throw out the rose-colored glasses that everyone wants to be friendly and say, assuming not everyone wants to be friendly, what do we have to do?
Pete, It's good to see you. You're going to stick with us. Peter Chair of Academy. If you're just joining us, equity futures down by close to 0.2% on the S&P 500. With an update on stories worldwide, with your Bloomberg brief, here's Vonnie Quinn. Hey, Vonnie.
Hey, John, good morning. The longest government shutdown in U.S. history could end as soon as tomorrow. The Senate passed a temporary funding measure that would keep most of the government open through January 30th and the rest through the end of September. Now that measure heads to the House, where lawmakers are expected to take it up tomorrow. President Trump says he's close to a trade deal with India. The U.S. raised tariffs on many Indian goods to 50% earlier this year, in part to pressure New Delhi to stop buying Russian oil. Indian refiners have begun scaling back purchases from Moscow after President Trump sanctioned Russia's two largest producers last month. Shares of CoreWeave are trading lower in the pre-market. The company cut its annual revenue forecast due to a delay in fulfilling a customer contract. CoreWeave citing temporary delays due to a third-party data center developer. Shares of CoreWeave are up more than 160% since it went public just in March. And that is your Bloomberg Brief. John.
Hey, Vonnie, thank you. More from Vonnie later on this hour. Up next on the program, ending the government shutdown.
After 40 days of wandering in the wilderness and making the American people suffer needlessly, our long national nightmare is finally coming to an end.
The reality is, America is too expensive. That's why Democrats have been waging this fight, and will continue to wage this fight.
A conversation up next with Bloomberg's Mike Shepard, live from New York City this morning. Good morning.
Making money isn't about drowning in emotions. It's about understanding what's actually happening. Markets are the best way to glean signal from noise, and that is what we try to do every morning. This is Bloomberg Surveillance.
Morning, this is Bloomberg Daybreak Europe. I'm Tom McKenzie in London. These are the stories that set your agenda.
Taking you from the U.S. market's close to the overnight session in Asia, we'll walk you through what you need to know to kickstart Europe's trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in to Daybreak Europe, only on Bloomberg Television. Context changes everything.
Asia is at the forefront of some of the world's biggest stories.
And we're here, where the action starts in Sydney.
And in Tokyo, get ahead as the global trading day begins.
The Asia Trade, weekdays only on Bloomberg.
Just when the Bank of England thinks it's done, the data brings them back in. Unemployment, 5%. Guess when that data came out? Look at this chart. Sterling weaker off the back of that data. Cable down to 130, 136. T. Rowe Price this morning saying, Bramo, that rate cut's coming in December.
Yeah, and the misery index is climbing. The misery index is the sum of the inflation and unemployment, the idea that wage growth is just enough to keep things a little bit heated on the inflation side of things, but just bad enough to leave people without the spending power to really go out there and meet the higher costs that they're facing. This is the doom loop that no central bank wants to face.
It's about to get more miserable. Tax hikes still coming later this month. The next budget from Chancellor Reeves.
Look, Rachel Reeves had a couple of pledges. She's going back on them. She's raising money to try to plug a gap that she created for herself, to try to give herself headroom. Meanwhile, yields are going up, borrowing costs are going up, which just causes them to tax more and increase the costs, leaving people in a quagmire of what the solution is going to be for a brighter future.
Sterling down 1/3 of 1%, 130, 137. Broader equity markets pulling back following yesterday's rally. We're down 1/10 of 1% on the S&P, down by 0.3 on the Nasdaq. Under surveillance this morning, ending the government shutdown.
After 40 days of wandering in the wilderness and making the American people suffer needlessly, some Senate Democrats finally have stepped forward to end the pain. Our long national nightmare is finally coming to an end.
The reality is, America is too expensive. That's why Democrats have been waging this fight, and will continue to wage this fight. No matter what comes over to us from the United States Senate.
So here's the latest this morning. The Senate passing legislation to end the government shutdown with support from a handful of Democrats. The bill now heading to the Republican-controlled House. Joining us now is Bloomberg's Mike Shepard. Shep, just walk us through the progress we've made in the last 24 hours and the sequence of things over the next 24.
Well, we saw the Senate reach a breakthrough last night, John, with the chamber voting 60-40 to pass this interim spending measure that'll keep most of the government open at least through January 30th. And then we saw as part of that 8 moderate Democrats conceding, in essence, joining Republicans in passing this measure. And that concession really infuriated members across the party. It really raised questions, as you heard from Hakeem Jeffries, about where they would go from here. But as far as this bill is concerned, it is now in the hands of the U.S. House. They expect to vote sometime tomorrow. The exact timing of when they would take it up is unclear, but Mike Johnson is expecting it to pass. President Donald Trump has signaled his support for it and is expected to sign it as soon as it hits his desk. Republicans, as you heard from Mike Johnson, are trying to cast this as a victory. They are saying that they prevailed, holding out against the Democratic holdouts and looking at it as a victory. Meanwhile, for Democrats, they're regrouping now and trying to figure out how to rebound from this loss. Now, the question of timing, John, is an interesting one because House members have not been in Washington really since the end of September. They took their last vote on September 19th, and they have to get back to town. And part of their return could be impeded by some of the disruption to air travel that we have seen caused by the shutdown. So we'll have to watch that as a question of timing. And another thing we're going to have to watch is, as I said, not all of the government will be funded through the end of the fiscal year in September. Most of it, in fact, is only funded through January 30th. And that tees us up for another potential showdown over spending as soon as we get into the new year, John.
Hey, Shep, it's good to see you. We'll catch up with you a little bit later this morning. Mike Shepard there down in Washington, D.C. Peter Chief Academy still with us. Pete, this language coming from Congressman Jeffries. America's too expensive. That's why Democrats have been waging this fight. Will continue to wage this fight. You touched on it. What's that fight look like in 2026?
You know, it feels like there's this ongoing friction, and both sides somehow think they win from these shutdowns. To me, it's ridiculous that you make air traffic controllers, people are considered essential, go to work without getting paid. How that's not just set aside in the budget. And meanwhile, as far as I can tell, Congress is getting paid and on vacation. That seems a much better place to be. And I think there's going to have to be a rethink about some of this. Like, I think our military, anyone who's deemed essential, I don't see why their pay should be cut or, you know, held back. Yes, they get it eventually, but why? It seems like a silly way to run a country.
This does feel like a vibe shift, though, over the past month when it comes to the political landscape, with a focus on cost of living and a look for quick fixes to try to offset the near-term pain. How much is that factoring into your view of markets, your view of the deficit, and any kind of reluctance to address it?
That's why I'm a little bit bearish on yields. I think, you know, I've been fairly bullish. We got down to 4% on 10s. I think we go back to 4.30, maybe 4.40 on 10s because this persistent inflation. And there does seem that there's this potential that we'll get some sort of stimulus, that there's something, you know, in the works to kind of goose this economy even more than it's already, you know, being goosed. It's kind of so awkward. At one point, we're talking about the need to help the economy. The other second, we're talking about all-time highs on stocks. So we're in this very unusual thing. I think we're very prone to another round of inflation. I think that's been the frustrating thing for a lot of people. You're not seeing inflation coming down. And I think the biggest bite, and this one's really hard, I think politicians are just adapting to it, it's about electricity prices, right? That's really what's driving It sits on everyone's, you get your monthly bill. Wow, my electricity prices keep going up. I don't understand where they're going up. There's clearly demand for more and more electricity. And I think people are still stuck about gas prices. And gas at the pump, to me, is secondary from this sort of inflation and food inflation.
So what kind of proposals are you expecting to hear, aside from the ones that we've been talking about?
I don't know whether any of those will actually take off. Again, I'm struggling with some of this because it feels very politically messaged to me. It's, when I look at the U.S. government, I feel here's all sorts of income methods and here's all sorts of spending methods. I'm not sure how you can say, well, tariffs are going to go for this dividend check. That seems reminds me a little bit, honestly, of green bonds, where you have a company and like, oh, this slug's going to be green, but it feels false to me in some ways. And I think that's unfortunately where we're headed. We are going to see, I think, both sides try and set up for the midterms. And to me right now, it looks like the Republicans setting up for the midterms are going to try and flood this market with money, liquidity, and they're going to try and get to the consumers. And it seems like awkwardly, the Democrats are going to be fighting that because they don't want the economy necessarily doing well into the midterms.
Typically, I check in on the bond market, but the bond market's closed because of Veterans Day. The equity market should be too. We all agree on that, right?
100%.
Yeah.
You, of course, work at Academy. Let's talk about some of the tremendous work that you and the team have been doing with veterans. I believe 50% of the staff are veterans.
Yeah, so we've grown a lot in my 8 years there. I think we were probably 50 people. We're now almost 200 people, about 50% is veterans. One of the things that's just awesome, and I'll tell this story, I think it's great, but we have these interns come in. Our interns, though, one day come into our San Diego office and there's like bright orange Camaro or something outside. Like, who's that? That's the interns. Like, that's a weird thing. But then you realize the intern is 28 years old, signed up to be in the Marines at age 18, worked for 10 years on that. It's a very different. One of our other favorite interns, meet the intern. He's 32 with 3 children under the age of 5. So it's a very different thing. And it's really interesting that we're able to bring these people in, let them grow, give them, some experience on the business. And it's been a phenomenally successful thing. We're having a lot of success. We are really, really strong in money markets and short-term debt trading. We're probably in the top 10 of Fannie Mae debt, things like that. And that's been a great spot to really bring in young veterans who, and it's really hard to find a spot on Wall Street. You're just not the right age. You're not necessarily the right background. We understand a lot what they do. I wanted to give you guys these challenge coins. So challenge coins, my understanding is they started in World War I. It was pilots held these challenge coins, so if they were caught behind enemy lines, they could identify themselves. And it's grown to something where every military unit has one of these, and now more and more firms have these. You'll see veterans groups within large organizations have these. And I think there was actually a pretty cool thing of President actually giving his challenge coin to a kid at the Commanders game this weekend. So it's kind of a neat thing. It kind of represents, ours has a picture of the World Trade Center on it because we were started really post 9/11, and we kind of wanted to commemorate that on our challenge coin. And again, want to thank you for all the support you guys give to Academy, letting us be on.
Pete, this was special. Thank you, sir.
Thank you very much.
Right here on this
and
desk.
I am not a veteran, so I just want to make that clear. I don't want any stolen valor. So.
Of course, but you guys are doing tremendous work for the veterans, so thank you, sir, on this Veterans Day. Peter Chair of the wonderful Academy Securities. Coming up next, Jeff Curry of Carlisle on the rising demand for energy to power AI. Plus, we'll catch up with Yahara with your morning movers. CoreWeave cutting its annual revenue forecast. That name down by close to 10%. Live from New York City. You're watching Bloomberg TV.
issue right now for us in the diamond space is the declared divestment of Anglo from GBS. And as you know, Anglo holds 85% stake in GBS. Botswana, the government of the Republic of Botswana holds 15. We are resolute now, and we've communicated a firm intention to increase our stake in GBS to a controlling stake. We have lined up a number of potential collaborators with us, if I may put it that way. We have targeted funders, we have parties, we have the Oman Sovereign Wealth Fund, we have others who are willing and ready.
Right, okay, ready?
David, what initially sparked your interest in this topic of longevity?
15 years ago, I turned 60, and I began to wonder how much longer I'm likely to live and what I could do to extend my life. On longevity, I talked with the leading experts in science and medicine to educate people about how they might be able to change their conduct so that they can live a happier and healthier life. I'm David Rubenstein. Join me on a 4-part journey as I explore the great quest for longevity. Only on Bloomberg.
Kicking off the trading week with a decent day of gains in yesterday's session this morning, pulling back just a touch. We're down by 0.2% on the S&P. We're down by a third on the Nasdaq 100. The big winners on Monday were the big losers last week. Palantir, Nvidia helping to lead the gains. The Nasdaq, the worst week since April, followed up by the best session since May. It's been a choppy ride, hasn't it, over the last week or so?
And it hasn't really been determined by fundamentals, and this has been the tricky question around it. A lot of the losses came after earnings came out better than expected pretty much across the board when it comes to the big tech behemoths. So it raises a question about why exactly they're rallying now. Is it because the government's reopening? Is that really propping up the AI bet? Or is it just that people feel like there's enough froth that's been beaten out of the system that they could feel comfortable getting back in?
That's the latest on Washington. I'm not sure how much of it is Washington and the government shutdown.
I mean, on one hand, it could be momentum trades. I mean, the fact that gold rallied in tandem with stocks, all of a sudden, is it a risk asset that is responding to the government reopening? I mean, it's mind-bending, so it's hard to give narrative to this.
It opens the door to data, and that data might open the door to rate cuts in December. That's about as far as I can take this right now.
We can go derivative upon derivative
That's
reason.
About all I can do. Bond market's closed today for Veterans Day as we count you down to the cash open for equities about 3 hours away. Let's get you some morning movers with Yahira Anand. Hey, Yahira.
Hi, John. After an outstanding session yesterday, its best since April, NVIDIA shares are now in the red, falling 1.5% after SoftBank said it sold its entire stake for nearly $6 billion, with founder Masayoshi Son planning to use that cash to fund its other AI projects like Stargate here in the U.S. And while SoftBank says this has nothing to do with NVIDIA itself, we are seeing some skepticism in the market. We are also seeing some skepticism around CoreWeave. Those shares are falling now more than 9% in the pre-market after a delivery delay forced the company to trim its outlook. Add in the fact that shares have nearly doubled this year and general jitters around AI, and you get today's sell-off. Despite strong momentum for the company, with future sales nearly doubling to $55 billion thanks to fresh new deals with OpenAI, Meta, as well as others. And we end on a positive note with Paramount Skydance shares rising nearly 5% in the pre-market after the studio boosted cost cuts to $3 billion and pledged to slash 1,600 jobs in an efficiency drive. And we did hear from CEO David Ellison about M&A amid all those reports that Paramount has been aggressively pursuing Warner Brothers Discovery. And while he did not mention Warner Brothers by name, he did say that Paramount has the balance sheet to pursue deals. John?
It's a good start for David Ellison, that's for sure. Yahira, thank you. That stock is up in the pre-market by something like 5%. On a radar this morning, one of our top stories, the record-breaking U.S. government shutdown may finally be nearing its end. The House Speaker, Mike Johnson, saying a vote to pass the Senate's funding measure could come as soon as Wednesday. Elsewhere, SoftBank divesting its entire stake in Nvidia for nearly $6 billion, fueling its massive AI push. The move expected to fund other projects, including developing data centers and manufacturing robots right here in the United States. And finally, shares of CoreWeave sliding despite delivering a revenue beat. The AI firm cutting its outlook, citing delays in fulfilling a major customer contract. The company's CEO telling investors the setback stems from a third-party developer that's behind schedule.
Look, this is the epicenter of a lot of the AI fears. CoreWeave is essentially rent a data center, right? If you want to do your work and you don't want to actually invest in the infrastructure, go to CoreWeave. And so that's the reason why they have partners with the likes of OpenAI and NVIDIA and other big tech giants that are looking to offload some of the infrastructure build out. It just raises a question, A, about the concentration risk, given the fact that all these companies are leveraged on top of each other. But second of all, a question about how CoreWeave is at the epicenter of so much of this, and they have $11 billion of debt. They have $28 billion of lease payment obligations coming due over the next 10 years, and they've got profits of less than $2 billion in terms of what you saw in the quarterly results. It raises a question of how they get there, given the fact that they are not able to grow as quickly into their footprint, and they're taking on more debt in order to fund some of their additional build-out. It just highlights the leverage nature of certain nodes of the AI trade.
You're right to raise these questions because typically we talk about the balance sheet strength of the hyperscalers, the big CapEx spenders, and those balance sheets are strong. That's not true of the whole ecosystem.
No, this is the epicenter, really, of the speculative grade company that is at the heart of a lot of the rapid build-out. When you talk to people who are actually using some of these generative AI models and they're looking for something like CoreWeave, they're shifting from the cheapest one to the cheapest one, and they're racing, and they haven't determined who the winner is yet. So it's a big race to lower prices on one side, crimping margins, which you saw from CoreWeave, at the same time building out as much capacity as you can to meet all of the demand. It is a difficult recipe. You add on what Pete Scheer was talking about, the potential for China to come up with an efficiency, a DeepSeek moment. It raises a question, where is the overbuild? And are we missing something about how far this can go?
CoreWeave in a pre-market down by close to 10%. Let's stick with tech. Limited power capacity, creating major hurdles for meeting AI demand, including in NVIDIA's hometown of Santa Clara, California. Data centers there may stand empty for years, awaiting electricity supply. A man who tracks all of this, Jeff Curry. He's the Chief Strategy Officer for Energy Pathways at Carlyle, and he joins us now for more. Jeff, it has been too long, my friend. Welcome back to the program, sir. It's good to catch up with you. Jeff, let's just talk about this. I know you're tracking it, energy constraints. We were hoping that maybe this is something out in our future. Is it right here in our present?
Oh, it's right here in our present. You know, there's discussion around data centers. You know, you take gas. You know, the constraint on there is gas turbines. It's grid. Grid is copper. We look at what's going on in the oil market this morning. You know, it's restrictions around, you know, ships, availability of ships, refineries. You know, all of these old economy assets are really coming back to bite. And when we look at the commodity complex, that bull market that started in gold is broadening. You know, not only does it include, you know, base metals, it also includes agriculture recently with the big move in soybeans and corn, and even U.S. natural gas has joined the rally. So I think the one big laggard is crude oil. We can talk about that later. But I think when we look at the broader commodity complex, and the equal weighted GSCI is up 25% this year. So these physical constraints, they're biting.
Jeff, as you know, we went through an energy bust a decade ago. We did the same thing with other commodities as well. Anything tied to China went through a bust, and it brought a lot of discipline to some of the miners out there, the Rios, the BHP. They shifted from volume to value. Jeff, as they did that over the last decade or so, what have we built up to? Just how underinvested are we in the whole commodity complex?
Well, when we look at the growth in like copper, we're within a year or so of being in peak supply there. We look at across even like gold. Gold cannot keep up with the demand that's coming out of the central banks. We look at crude oil. There's no investment on a horizon beyond of March of next year for upstream. In fact, the point I like to say is, we look at all of the new major projects in oil. There's zero that are available beginning next year in non-OPEC. But I think your point here, that focus on returning value to shareholders, not overspending, is now creating a deficit in the availability of supply.
Jeff, how are some of these miners and other commodity producers financing future exploration and future build-outs so that they can meet the demand, which is increasing? Is it with debt? Is there sort of a misdirection of people investing in data centers rather than new, say, copper mines?
Absolutely. When we look at the upstream investment, that old point, cash is king. You typically need cash flow to be able to make these investments, particularly in the high volatile markets of commodities. And as a result, prices are not high enough yet to be able to stimulate that investment. We're now seeing copper getting up that level around $11,000 a ton, where it does start to make sense, and you'll see more projects. But then with copper, the problem is you don't have the pipeline of projects to actually do, even if we go to $12,000 a ton. But I think all of these markets, face the same constraints. And your point about where do you want to be in that supply chain? Well, I'm going to go back to where is the real bottleneck in this whole, AI process. It's really at the gas turbines and the grid. The grid is copper, and gas turbines are steel. So we have a lot of investment that needs to take place at that point in the supply chain before you can really begin to grow it.
This takes time. Everything that you just mentioned takes a lot of time. I just wonder how feasible some of the AI hopes and dreams and valuations are without the build out of what you're talking about.
Oh, absolutely. A lot of that CapEx spend that we're seeing, these $400 billion CapEx spends, a lot of that's going to go into the copper price and the commodity prices, because you hit that physical supply constraint, you start to spend more, and what happens? The prices go up. So that's why we look at commodities. They're the most undervalued asset on your screen today, and of all of them, oil is actually the most undervalued. So what will likely happen here is that we'll see these commodity prices rise as the demand begins to increase, and in base metals, we're already witnessing it. And in precious metals, we're already witnessing it. So this is going to be a continuous feature, not only this year, but by the way, you look at a chart of commodities in copper, and you take it all the way back to 2020, you had that spike in Ukraine, but it's just an upward trend in prices. You go from $5,000 all the way to around $11,000. So I think this is that broader super cycle. We're witnessing it in metals, and we're going to see a continuation of it throughout this decade.
So Jeff, let's talk about some numbers. As you say, copper in London's already close to 11K. Crude's down in the 60s. What are you expecting to see in the next 12, 18 months? With copper, when we look out 2 to 3 years, we put a target of around $15,000 a ton on it. So we got a lot more upside. By the way, that $15,000 a ton just comes from historical. What price do you need to create demand destruction? We really don't know how high it could actually go, and we're not getting that. We're not that far away at 11,000. So again, and I think with crude oil, the one thing we're seeing right now is refined product prices have dislocated to the upside relative to crude. That means you're struggling against refining capacity. I'm not going to say we're out of refining capacity or anything like that. And I think what happens as refineries come back online out of maintenance as we go into the end of this year, we're going to see some of that upside that is in the product prices be translated into the oil price. But I think the key point here is we look at the broader commodity complex. Pretty much everything but crude oil is moving. Even natural gas has moved in the most recent environment. Jeff, how price sensitive is the investment going on right now? You mentioned copper. Let's say we go from 11 and make our way to 15. You mentioned demand destruction. How are you thinking about whether that kicks in or not, based on the amount of money that's behind this story at the moment?
When we look at the demand destruction, it's a physical thing. It's not a price thing. And so when you think about it, bringing on a new copper mine is a 10 to 12 year proposition. We're not going to create supply tomorrow. So what you have to ask is, if you can't bring on the new supply, what price level do you need that they'll substitute into aluminium or some other type of commodity? And that's where we come up with that $15,000 a ton, price level. But we don't really know until you actually get there. What are the other factors? Where's the dollar at that point in time? Overall economic GDP, it could be, substantially higher than that. I would argue the risk here are, significantly to the upside, given the size of the CapEx spend going on the AI side.
Just quickly here, Jeff, what's the best way to get in on this? The raw materials, the equities of commodity companies, or the debt related to this build-out?
Oh, the debt I would put off to the side. Where I would be focusing on is the raw materials. When we think about, the absolute lever to the upside, if you own the commodities, but they're much more volatile, the way I like to think about it is the commodities themselves, you're playing that very front-end spot price. With the company and the equities that produce these things, you're playing that longer-term price. The way I like to think about it is those companies price inflation expectations, while when we think about the commodities themselves, they're pricing that spot, the unanticipated move in the commodity prices. So what it would argue, own a little bit of both. Own some of the commodity equities, they give you that long-term price, while owning the commodity will give you that, that near-term unexpected upward surprise in prices.
Jeff, this was thoughtful. Let's do it again soon. It's good to see you, buddy, as always.
Great.
Jeff Curry of Carlisle. Thank you very much. Thank you. Talking about a move on copper from 11K, close to 11K, towards 15.
This, to me, is the ultimate question going forward. Can the commodity side of the world keep up with the infrastructure demands behind some of the AI bet and the other kind of build-outs that we've heard from a lot of different companies and countries? If it can't, what does that mean about costs, and what kind of inflationary input is that?
What's it going to take to shake the discipline of some of these miners? The story used to be, give them $1, they'll dig a hole. That story changed a long, long time ago.
It also raises a question of how they get that dollar. Are they going to get it through equity financing, or are they going to get it through debt financing? Jeff Curry doesn't want to be part of the debt financing, but everybody else is part of the debt financing. So how much does this have to be a new wave of leverage that gets built into the physical world?
Copper right now positive by about 1/3 of 1%. If you are just catching up with us, equities down by 0.2% following yesterday's big gain. Let's give you an update on stories worldwide with your Bloomberg Brief. Let's cross over to Vonnie Quinn for more. Hey, Vonnie.
Hey, John, thank you. Switzerland close to securing a 15% tariff on its exports to the U.S. Sources telling us here at Bloomberg that a deal could be finalized within the next 2 weeks. A tariff deal would be a relief for Switzerland after Washington hit it with a 39% levy in August. Meta shares falling in the pre-market. The Financial Times reporting the company's chief AI scientist is planning to leave and create his own startup. The move comes as Meta founder and CEO Mark Zuckerberg is shaking up the company's AI strategy in order to keep up with rivals such as OpenAI and Google. And Apple is delaying the release of next year's version of the iPhone Air. According to the information, the delay comes after its first model sold below expectations. Although the length of the delay remains uncertain, the product won't be released in the fall of 2026 as previously planned. And that's your Bloomberg Brief. John.
Vonnie, thank you. Not sounding well. Did my channel checks, you go into the store, and I'm talking about the Verizons, the AT&Ts of this world, and the first thing they'll tell you is that the battery is not as good, and the camera isn't either.
I knew that's where you were yesterday.
They're like pushing you towards
talking, doing channel checks
the
of iPhone Air.
I'm always checking it.
Yeah, I know. I think it's great. It
Seeing
means
how
that
things are going.
It means you're actually looking for an iPhone upgrade, so that's actually bullish for Apple. But I digress.
Channel checks, Bramo.
Oh yeah, that's right.
For everybody else, equity futures on the S&P down by 0.2%. Up next on the program, restaffing the skies.
We should not have had people leaving their jobs. I want to reward the people that showed up without a lot of nonsense. A lot of people are getting through. I think the people are going to start showing up.
A conversation up next with Sheila Kahyaoglu of Jefferies. Live from New York City, you're watching Bloomberg TV.
Rodriguez. And I'm Jason Kelly. And we're back with another season of The Deal with athletes and entrepreneurs who are changing the game on and off the field. Jerry Jones.
Some good-looking trophies.
1-1
is 3 in sports, not 2. And it's because that 3 is imagination. That 3 is putting yourself in a way, having yourself hit the home run.
Erica Ayers-Badon.
I'm a high-energy board member. I'm very passionate. I have a lot of opinions.
Robin Arzone.
I want to light fires in people's lives, and that is still one of my core mandates for all of my businesses.
Justin Tuck.
I tell all of my friends that play in leagues now, make these relationships now while you're hot. Don't wait till you're like your 12th year in and you're just hanging on.
Stay tuned. You won't want to miss it.
It's the world's second largest economy with a growing influence in global affairs. Bloomberg The China Show brings you the unmatched expertise you need to keep track of breaking news, in-depth market analysis, and the most influential newsmakers in and around China.
We need to do more to engage the market more.
We're risk on. I think we caught a little sweet spot.
Massive savings right now.
It's already a different game.
Bloomberg The China Show. Weekdays around the world, right here on Bloomberg. Context changes everything.
Middle East and Africa, vibrant resources and high-yield investment opportunities abound. Join me on Horizons Middle East and Africa for the stories, newsmakers, and insight from this exciting region. Now weekdays, only on Bloomberg.
It's a multi-trillion-dollar industry. We'll show you what's happening in ETFs like no one else. ETF IQ, only on Bloomberg.
On stock to watch, here's Meta in the pre-market, down by about 1.3% off the back of this news from the Financial Times. Meta's chief artificial intelligence scientist, Jan LeCun, is planning to leave the social media giant to found his own startup. That according to the FT this morning.
All I can say is if you want to make big money, be an AI officer at one of these companies because it seems like a food fight over talent. This follows other stories that we've seen, both leaving Apple. Remember the string of exits there. Last night we heard the Intel CTO, an AI officer, leaving to go to, guess who? OpenAI. I would love to see the compensation lists and how quickly wage inflation is going up for this particular cohort of workers.
One way, just sort of one way. Up and up.
Exponential nosebleed. Yes. How many millions can you put on the end?
Crazy numbers, and apparently those numbers aren't crazy enough for Meta to keep Jan LeCun in the seat. Let's see how that turns out. Our stock is lower in the pre-market. The broader market doing okay. We're down by 0.2% on the S&P. On the Nasdaq 100, negative by 0.4. Under surveillance this morning, restaffing the skies.
I was not happy when I saw all these people. Oh, we have to look. Life is not so easy for anybody. Our country's never done better. We should not have had people leaving their jobs. I want to reward the people that showed up without a lot of nonsense, without a lot of talk. They did their job, and in many cases, they worked longer hours to get us through this period. A lot of people are getting through. I think the people are going to start showing up.
So here's the latest this morning. Flight cancellations piling up as President Trump is ordering air traffic controllers to get back to work. Sheila Kohler of Jefferies writing, the risk is that the shutdown extends through Thanksgiving, with that week around the holiday accounted for about 9% of total fourth quarter passenger traffic in both 23 and 24. Sheila, I think this morning there's a sense that that was the risk. The hope now is that we just sail right through this and we move on. Is that right?
Yeah, but I still think it'll impact, just given the schedule impacts we're seeing, 10% of capacity at 40 major airports. It's 6 to 7% of capacity for United, Delta, and American. And John, similar to you, as you're doing iPhone channel checks, I'm going to be doing a channel check soon heading to the airport myself. So we'll see how those delays and shortages are staffing up.
Sheila, can you just describe what happens in a period like this? Staff and crews in the wrong place, don't get back to the right place. How many days it takes to get things back on track?
It'll take a few days, but the immediate impacts are at these airports. Regional flights cut the most. And in terms of flights, we'll see, certain more non-profitable routes being cut. But I think, of course, it'll impact the profitability of the airlines who are seeing an improvement in Q3 and are doing a little bit better. So in general, it's very difficult for air traffic controllers to come to work. It's difficult for the traveling public. And of course, it impacts the airlines, the schedules, what sort of aircrafts they're using, where as there's 10% cancellations in some cases.
Sheila, let's say the government reopens tomorrow, or at least the vote to reopen the government takes place tomorrow. How long do you expect it to take before there is normalcy when it comes to flight patterns?
It'll be come pretty quick. The capacity will come back online. United said it's done its cancellations through tomorrow, so it's rolling cancellations essentially day by day. But airlines are, have very effective networks, so that'll come together really quick. It's just every day traveling, you have to plan for delays, although I haven't really seen any delays with TSA. It's just been in the air. You're seeing up to 30 to 40% delays.
Which carriers do you think are going to be most affected or longer term, not necessarily being able to make up for the volume for the business?
I think, Lisa, it's primarily a short-term problem. And once the shutdown's resolved, airlines will resume normal operations. And of course, because we're cutting back 10% of capacity at the 40 major airports, the biggest airlines are the most impacted on the short term. So that's United, that's Delta, and American at their hubs. That's where they have to cut back capacity. What they'll do is they'll cut back the most frequent flights, the most regional flights. So they'll keep the bigger planes in the air for longer. But you'll still see you'll encounter delays at the airport.
Sheila, typically, and we've had this conversation a few times with a number of people over the past few weeks, typically this is how it goes. How are things right now? They'll say it's problematic, it's not a big deal, we'll recover in the months to come, and I'm sure we will. And then we say, well, tell us about 26, what's going to do well? They'll say the premium cabin, fantastically positioned to do well. Then we'll say, what's your top pick? And they'll just turn around and say, Delta. Sheila, almost every conversation we have concludes with Delta. Outside of Delta, what is this industry now? What's left of it?
Oh, United has been our top buy, as well as Delta all year. It's the premium. I think in my coverage, it's the world of the haves and the have-nots, whether it's airlines, whether it's defense, whether it's the aftermarket names. So in general, the premium offerings are working. That's where you're seeing pricing go up. The main cabin is still deflationary, which is quite remarkable. Price down year over year in 25 after 24 being down. And that's really what drives the outperformance of United and Delta relative to the other two. American and Southwest are sort of stuck in their price ranges, unable to move, and they both have strategies. American's going into the wide body, increasing their wide body seats, increasing their Atlantic flights. And then Southwest, as we know, has Elliott involved and has a major overhaul of its strategy, assigned seating, extra legroom, essentially changing who the airline is. But it can't change where it flies, and that's part of the problem.
Well, what do you think needs to change to make the rest of the industry work outside of Delta and a sprinkle of United Airlines?
Less capacity, more interesting flights. United announced an expansion to 5 direct flights into Europe that we haven't seen before. It's less of a aggressive move than their previous flight last year to Nuuk, Greenland, but it is 5 new Atlantic routes that didn't exist directly from the U.S. market. What we see from the low-cost carriers is continued flights into Florida and the Caribbean. That market becomes saturated, pricing continues to be lower, and it doesn't end well for profitability for them. And also rising costs. A lot of the airlines have had labor agreements that increases their costs, so revenues aren't going up and costs are going up, and that's creating a bad environment for them.
Sheila, always good to see you. Thanks for the update. Sheila Coley there of Jefferies. Good luck at the airport, of course, and to everybody else attempting to travel later on this morning. It's always Delta and maybe, as you heard there, a little bit of United Airlines.
Yeah, and have you ever gotten one of those surveys? What interesting place would you like to fly to? Tell us, and then maybe we'll make it happen. That's kind of what she was responding to.
Want a direct flight from JFK to Puglia.
Okay, thank you.
On Delta Airlines. That's my request.
I'm glad that we got this in.
I'll write that in every time.
Yes, there we go.
And if you Mitch calls, 5 to 10% is the answer. All right. Coming up next, Dan Scully of Morgan Stanley, Henrietta Trays of Vader Partners, Heath Terry of Citi, Subhadra Rajappa of SocGen. The second hour of Bloomberg Surveillance next.
Technology is embedded in every aspect of our lives.
And laying the foundation for the future.
From finance to defense, AI to entertainment.
And from the road to the stars. Bloomberg brings you the latest stories of the people and companies pushing the tech sector to new frontiers.
And the politics that shape global tech markets.
I'm Caroline Hyde in New York.
And I'm Ed Ludlow in San Francisco.
Watch Bloomberg Tech every weekday.
Only on Bloomberg Television.
We're coming to you live from Kuala Lumpur. The whole world is here.
The APEC Leaders Summit bringing together heads of states of 21 APEC economies.
The White House is trying to use the stops to gain additional leverage.
This big deal with a number of the biggest companies in South Korea.
That's a big number.
Deals can be done.
Trust Bloomberg for on-the-ground coverage.
Korea is not Japan.
Up-to-the-minute reporting.
In this latest salvo of this trade war.
What a visual.
And the analysis you need.
China's not going anywhere, nor are we.
Key investors, top executives, global innovators. Join me for in-depth conversations with the biggest newsmakers on the day's top stories. Insight with Haslinda Amin, only on Bloomberg.
It's the countdown to the market open as we bring you the first trades across Europe.
We'll debate the most important stories and what will drive the big investment decisions throughout the morning. I'm Guy Johnson.
I'm Kriti Gupta.
And I'm Anna Edwards. Join us every weekday morning for the opening trade, live at 7 a.m. here in London.
Only on Bloomberg. Context changes everything.
Earnings are strong. The downside seems pretty limited.
These earnings better grow into some of these valuations.
It looks like we've got a problem with hitting valuation ceilings everywhere we look.
This market has gotten very speculative.
That could cause some volatility in the near term.
This is Bloomberg Surveillance with Jonathan Farrow, Lisa Abramowitz, and Anne-Marie Hordern.
Quite a choppy ride over the last week or so. Live from New York City this morning. Good morning, good morning. For our audience worldwide, the second hour of Bloomberg Surveillance starts right now. Your scores look like this. Equity futures pulling back by just 0.2% on the S&P. Last week, a week of losses. Yesterday, a big day of gains. On the NASDAQ, the worst week since April, followed up by the best day since May. On the NASDAQ 100 this morning, we're down by 1/3%. And look to these two names right here. NVIDIA, SoftBank, unloading its stake in the tech giant. That name is down by 1.4%. And some problems at CoreWeave. Lisa articulating them well. That stock down by 10% this morning.
Look, even if you did get gains yesterday, there still is this existential fear that we're at the top in terms of valuations, that maybe the hopes go beyond some of the actual capabilities in real time that AI can deliver. That seems to be the story that we saw from CoreWeave in terms of just how quickly they can build out what people are demanding in terms of their data centers, the rented data center kind of a location. And then when it comes to NVIDIA, SoftBank unloading now their stake for a $5.6 to $5.8 billion profit. Is this because they're selling at the top, or is this really because they're trying to raise money for other investments?
They say it's to raise money for other investments. Other people can decide and make their own judgment call on that. I don't see SoftBank getting out of anything too early. Usually they stay in too long, don't they? Isn't that usually the way this works?
The fact that they're getting out of NVIDIA to invest in data centers definitely will raise some eyebrows, given the fact that some people are raising questions about whether data centers are actually the place of some froth based on potential efficiencies, and the likes of Deutsche Bank are actually looking for ways to hedge some of their data center investments. So there are questions here about exactly what SoftBank is doing. Nonetheless, questions around valuations are going to continue to swirl, and that's what I think this underscores.
Less now from me, just to state the obvious. We've had triple-digit gains on some of these stocks. If you don't blow it out of the water, they'll be pushed back in this equity market. And we've seen several examples of that over the past few weeks. Meta, pushback. Palantir, pushback. CoreWeave, pushback.
And the argument on the other side, if you want to be optimistic, is that you're not getting the pushback, and this is a point you've made many times, from the bond markets where you've seen issuance received. So if there is a lot of liquidity out there and a lot of willingness to finance some kind of build-out by these companies, at what point can you say, well, it's going to collapse in some heaping pile of dust? This is the reason why people are nervous, but at the same time, they're still investing. Cliff Asness of AQR yesterday on Bloomberg Television really talking about that, saying, you know, it's not yet a bubble. Yeah, it makes them nervous, but it's not really ready to explode.
Greg Battle of BNP Paribas, I think, presented it well on the program yesterday. He said you're going to see the debt cycle take off, the credit market support it, and the price to pay is high volatility, but it's a higher market. So a higher market with higher volatility.
Yeah, his explanation is if it's 1998, yeah, you're going to get 1999 and it's going to be really ugly. But if you don't get in 1998, you're going to miss out and you're going to have reputational risk for not actually having the upside. So you might as well ride it while it's still expanding.
NVIDIA in the pre-market down by about 1.4%. The broader equity market down by close to 0.1%. Coming up this hour, Dan Skelly of Morgan Stanley as Wall Street chooses resilience over risk. Henrietta Trays of Veda Partners as Senator Schumer loses his grip of his party. And Heath Terry of Citi Research such as CoreWeave cuts its forecast. We begin this hour with stocks edging lower. Dan Skelly of Morgan Stanley writing, while the fundamental backdrop for the market has improved from the panic-stricken spring, at current valuations, investors are not being compensated for a high degree of policy and earnings risk. Dan joins us now for more. Dan, good morning.
Morning, John.
Do you think that captures the pushback we've seen across several single names over the past few weeks?
Definitely, and by the way, I think the volatility and the rotation that we're seeing among single names is healthy. I mean, the idea is if everything was going up euphorically, then maybe we could talk more about a bubble, but you are seeing the market reward winners and penalize losers, and so I think that's a healthy trend. I think, frankly, there's seemingly a bubble and everyone guessing whether or not we're in a bubble or not.
A bubble in bubbles.
Correct.
Not in the credit market. Credit market's wide open to support some of this spending. Do you think that remains the case?
I think that remains the case and is likely to be so for the foreseeable future. You've seen some of these bond deals way oversubscribed, as you know, in the last couple of months. And so we're just not yet at that point where things are starting to look more concerning.
Bubble of a bubble, bubble in bubble
bubble in
talk.
bubble talk.
Okay,
You know,
honestly, this is so derivative. I'm having a hard time.
Not my phrase.
The rate of increase
that.
of the bubble
Yes.
in bubble talk, I know, but it's true. There is this feeling that right now there is a lot of fear out there. I just want to go back to the point that you made that it's healthy to see swings like this. It's healthy to see swings in one stock name of valuations, market valuations of $264 billion in one day. The idea that we saw that kind of gain just on Monday alone in the likes of NVIDIA after seeing $200 billion lost in one day. How is this healthy? Doesn't it really point to concentration risk in another kind of way in the index?
Sure, and it's an excellent point, Lisa, and so I'll say a couple things. So first is, what I'm describing is among the Mag 7 themselves, you saw a handful, half of them up on earnings and half of them down on earnings. And so I think that's really what we're looking at. But I think to your point in terms of absolute market values, it certainly speaks to the crowding that's happened not only this year, but going back 15 years, really since 08. We've seen this winner-take-all phenomena for almost 2 decades now. And it speaks to just, again, just how much the market share winners have differentiated themselves versus everyone else. Last point, you referenced 98, 99, which we're starting to hear more and more of, obviously. Let's not forget that in the stretch from kind of the fall of 99 to the spring of 2000, the NASDAQ doubled over a 7 or 8 month period. That is truly what a blow-off top looks like. We haven't seen that of yet.
There's also this question of how far the AI trend is diverging from the underlying economy.
Sure.
And we keep going back to this, how difficult it is to get a gauge on what's happening with people feeling pretty negative on the economy, pretty negative about their spending power, at the same time that you're seeing these runaway gains and these expectations for all this profitability and efficiency.
Sure.
How do you square that?
So it's a K-shaped market economy. It's a K-shaped socioeconomic recovery post-COVID. Everything is diverging. We wrote about this recently in our letter, talking about the market is not the economy is not the market. And when you look at the changing nature of this economy, really since COVID, but going back, I'll say a decade plus, it's a services-led economy. All we've done is wring our hands around tariffs and trade this year. Trade is 11% of GDP. This is a services economy. AI spending is being funded largely by cash flow. So we're seeing that as being somewhat more insulated from ebbs and flows in the economy. And increasingly, it's a high-end consumption market. I mean, one of the things we haven't talked about enough, we think, is that 10% of the population controls 40 to 50% of the spending. And that's a cohort that's been reflated in terms of wealth effect, exposure to asset prices, houses, and stock markets. And so we're seeing that bifurcation across not just the market, but every component of the changing nature of our economy.
Does that make you want to expand out into some of the areas that are more susceptible to spending, whether it's on the high income, which seems like an AI trade at this point, or whether it's on the lower income, this sort of bet on some sort of cyclical improvement?
Very selectively, where there's also a fundamental catalyst. So we don't want to just make macro and factor bets. We want to also marry that with some type of idiosyncratic catalyst in whatever stock call or sector call you're making. For example, financials. Obviously, there's a lot of macro inputs, rates, the economy, lending, but at the moment, idiosyncratically, there's a capital markets recovery. There's deregulation coming from the administration. So you always want to have some type of fundamental catalyst. Lastly, as we've seen expectations around the Fed dial down for December, we were almost 100% priced a month or two ago. Now we're 60% priced. We've seen all of those small cap and higher cyclical stocks trade off as well. So tell me what the Fed's going to do in December, and I'll tell you if I want to make that trade.
Well, there's some excitement that maybe we'll get some economic data. How relevant is that data to this market?
It's super relevant, and all of your guests and you all have been talking about this concept of flying through the fog, which we've been doing with the government data. We think basically trying to triangulate all the different inputs in terms of private market surveys and providers, we actually might see a slight tick up in the unemployment rate when we come out of that fog in the following weeks.
Is that enough to hold back the index? Because we've had lousy job numbers all year, and the stock market's been just fine.
Probably not. So it's a great point. Probably not, and the index is going to continue to follow the AI sentiment and the earnings trend, which continues to be really strong.
So what's your highest conviction trade heading into year end?
So heading into year end, I have to say that the AI power and the AI infrastructure basket, which has sold off more recently, still looks really, really compelling. We came into this year expecting capital spend to be $300 billion. It's tracking towards $500 billion. But in terms of what we heard from the tech players over the last month, we're going to look at maybe $700 billion going into next year. So if you think downstream in terms of all the industrial power and different utility components, we think that trade still looks really compelling. And it's come off a little bit off the highs.
Dan Skelly of Morgan Stanley. Dan, it's good to see you.
Likewise.
Thank you, sir. The energy story, part of the big tech AI thing.
Yeah, can it catch up to how much people are expecting to build out? And Jeff Curry talking about how absolutely this is his main bet, and you're going to see an ongoing outperformance in all sorts of commodities. It's the best time ever to get invested because of just how much they have to catch up, and that does seem to be playing out in markets.
You think the politicians just stand by and let this happen? A wave of populism taking over Washington, D.C., worried about affordability. You think they just stand by and watch this happen?
I did notice that Bernie Sanders held a rally yesterday on energy costs, so probably not. It's probably going to be a pretty big issue. Question is, how do you address it? Do you suppress it? Do you juice production of energy in some capacity with national subsidies? Do you just say this is for a better good? Do you hope for efficiencies in terms of AI? A lot of different ways to skin this cat.
I would say it's a big story for 26, but I think it's a big story for right now. Equity futures on the S&P down by about 0.2% with an update on stories worldwide with your Bloomberg brief. Let's cross over to Vonnie Quinn. Hey, Vonnie.
Hey, John. Thank you. Shares of SoftBank rising in Japanese trading. The company announcing it sold its entire stake in NVIDIA for nearly $6 billion to help fuel its massive AI push. The move is expected to fund other projects, including developing data centers and manufacturing robots in the U.S. SoftBank also announcing a 4-for-1 stock split. Paramount Skydance shares also rising in the pre-market. The company reported financial results for the first time since an investor group took over the company in August. Revenue fell short of analyst estimates, but it raised its target for jobs cuts and cost-saving measures, announcing a goal to achieve at least $3 billion in cost savings. Flight cuts ordered by the Trump administration entering their 5th day. The FAA restrictions are set to increase over the coming days as lawmakers push to end the government shutdown. The disruptions will boost costs for airlines, but could also improve their fourth quarter margins as carriers drop unprofitable routes. And that is your Bloomberg Brief. John.
Hey, Vonnie, thank you. More from Vonnie in about 30 minutes. Up next on the program, shutdown, backlash.
I cannot support the Republican bill that's on the floor because it fails to do anything of substance to fix America's health care crisis.
I've worked with Senator Schumer, but it's time for him to be replaced.
The pressure's building in the Democratic Party. Up next, Henrietta Trays of Veda Partners, live from New York City this morning. Good morning.
At a time when policy in Washington is driving Wall Street, we draw a distinction between the rhetoric and the action, bringing you market-moving guests and original reporting. This is Bloomberg Surveillance.
I'm David Weston. Join me each week on Wall Street Week for stories of capitalism from business, markets, economics, tech, and climate. We go on the road for a look at what lies behind the headlines of today and what will likely be the headlines tomorrow.
We need more transparency.
Oil and gas is still important.
They said every citizen should be investing in the market.
Accelerate progress in all fields of science.
Watch Wall Street Week right here on Bloomberg. More than what you need to know, it's what you need to think about.
Why do the biggest names in business choose Bloomberg Television?
That's a great question.
It's a very good question.
Interesting question.
Good question.
Great question.
I so appreciate that question.
You certainly ask interesting questions.
Bloomberg Television. Top experts, great questions.
Live from New York City, welcome to the program. A tone of things for you so far. Quick snapshot of the market. Equities down by about 0.2% on the S&P. On the Nasdaq 100, down by 0.3. Under surveillance this morning, shutdown, backlash.
I cannot support the Republican bill that's on the floor because it fails to do anything of substance to fix America's health care crisis. When people's out-of-pocket costs double or triple, very soon Americans will know Republicans made it happen.
This deal would never have happened if he had not blessed it. I've worked with Senator Schumer, but it's time for him to be replaced. He is not meeting the moment. He's out of touch with where the party's base is.
So here's the latest this morning. An increasing number of Democratic lawmakers calling for Senate Minority Leader Chuck Schumer to step aside after failing to stop members of his party from agreeing to a Republican deal to reopen the government. Bloomberg's Mike Shepard is tracking a story. Shep, Congressman Ro Khanna, this deal would never have happened if he had not blessed it. What do you make of that statement?
Well, they are pointing the fingers very clearly at their leader in the U.S. Senate for somehow either blessing the deal, allowing it to go through, or at least failing to keep his caucus in line and holding the line against what the party had cast as a Republican-generated shutdown by refusing to negotiate on the health care subsidies that were at issue and that the Democratic Party had staked their shutdown fight on. They really wanted to ensure that those Obamacare subsidies got a vote and were preserved and restored next year. They're set to expire in December, but they didn't even get that as a concession in exchange for their agreement to vote with the Republicans yesterday. Now, some Democrats, including Ro Khanna, are pointing the finger at Schumer and saying he should be replaced. But there is something important to note. Republicans, including President Donald Trump, were willing to keep this shutdown going for as long as they thought necessary, and the pain would have kept growing for the economy. And so for the moderates who decided to vote in favor of the measure, they were trying to be pragmatic and say, look, this is a battle we should be taking into the midterms rather than trying to wage it now and inflict that kind of pain on the public, John.
Shep, the old guard falling to one side, Pelosi, next Schumer maybe. Shep, who's stepping up? What's the leadership of this party look like into the midterms next year?
Well, it's a good question, and it may be an open fight at this point. The old guard really is drawing the blame from younger members, including Hakeem Jeffries in the House and Ro Khanna in the House. Jeffries yesterday was asked about whether Schumer should stay as Democratic leader in the Senate, and he just offered a yes and a yes. And that was it. It was not the ringing endorsement that you might expect from a fellow New York Democrat. So there are a lot of internal misgivings. And what they're trying to do now is refocus the party and perhaps regain some of the momentum that they saw from last week's elections when they put the whole affordability question on the table for voters and succeeded. That was a message that resonated in New York, in Virginia, and, of course, in New Jersey. And in Virginia, in fact, health care was one of the top issues for voters as they went to the polls. So it is something that they could try to play to, especially once those Obamacare subsidies expire at the end of the year and we start seeing premiums rise and seeing voters start to look for who to blame on this.
Shep, it's good to see you. As always, Michael Shepard there down in Washington. Joining us now, Henrietta Trays of Vader Partners. Henrietta, a reality check for politicians in Washington. They've had two already. They had one 12 months ago in the general. The general public weren't happy with affordability, the cost of living in this country, and looked to Republicans to try and fix it. And they're willing to vote for whoever is going to come out with a good idea. And their ideology is not cemented, it's not fixed. They'll shift from one party to another with ease. You and I have talked about that. How do you think that sets us up for the midterms next year?
Yeah, I mean, that's exactly what last Tuesday's election showed. It wasn't just that Democrats came out. The exit polling shows that it was Trump voters who went for him in 2024 who swung right back to the Democratic Party this cycle. And that's a combination of the president's economic policies more than anything else. And so what Democrats have done here with this shutdown is not keep an eye on affordability, which was, of course, the talking point of the Tuesday elections, but the inflation, grocery prices, healthcare prices. I mean, I'll be honest, you guys know I don't like healthcare. Even I know now that the insurance premiums for people over the age of 60 are going to increase $919 as a result of not extending these ACA subsidies. And we just spent 41 days saying that back to back. We're going to have a vote on it in December, and we'll do it again in January. So I think that for the Democrats, just keeping this message alive is outside of the Beltway, sending the message that has just won an election and looks like it'll be a repeat of 2018 based on what we're seeing in the polling.
To build on that, Henrietta, do you think that this shutdown was futile for the Democrats, or do you think that it actually yielded some political benefits?
I think it yielded a lot of political benefits. I'll cover a couple. Number one, I think it's setting up Schumer to step down and pave the way for the senator from Hawaii to come in and be the next Democratic leader in the Senate side. That's, pretty plainly something that's building within the Democratic conference on the Senate side. I think that's something that Schumer is ushering in himself, and he took a lot of arrows by voting against this bill, by agreeing to let the 8 moderates cross the line. It's exactly however many you needed. I think that's what leadership does, especially on the Democratic side. You've seen it in the past. Joe Biden just did it last year. On the messaging side, think about where the numbers are. President Trump's approval rating has cut again in half. He went from -7 to -13 in the polling averages just since October. And on the congressional ballot, in generic polling, the Democrats went from +1 in the generic ballot on October 1st to +4 now. That's enough to get you the midterm House elections, and that's the goal of leadership.
There's a lot of time between now and the midterms, and it really includes the beginning part of next year when we could potentially get tax rebates. You can call them the tariff dividend. You can call them whatever you want, but a lot of people are expecting more money in people's pockets come January and February. How much do you expect that to really skew things the other direction, back toward the Republicans heading into the midterms?
Why do you need a $2,000 rebate? What's the problem? Is the inflation still rising? Is affordability still a problem? Didn't we just pass a one big beautiful bill with $3.5 trillion of deficit increases? Why do we need a $2,000 dividend check that, by the way, will not be paid for by tariffs, because the tariffs don't bring in that kind of revenue? In the 2000 CARES Act, when we passed the exact same kind of rebate check Trump is talking about right now, it cost $292 billion. The tariffs have brought in $89 billion. If we give $2,000 to every, eligible American, that's a $400 billion spending provision. So you're going to increase the deficit to provide tax cuts to Americans who are suffering from inflation because of tariffs. I don't think that's a winning message.
At a time when there's a question mark over the policy itself and whether it withstands the scrutiny of the Supreme Court in the coming month as well, Henrietta,
exactly.
Where do they have space to offer some kind of giveaways and change policy?
It's amazing, because when I speak with Republicans, they plainly don't want to go through the very difficult activity of passing a fiscal year 26 budget and a fiscal year 26 reconciliation bill. Democrats wouldn't want to either. It's extremely difficult. Voters opens up all your members to vote-a-rama. But what you could do is you could get 60 votes to extend the ACA subsidies. And then think about what we just talked about. You get every family with 2 60-year-olds in the house on Medicare, Medicaid, you can get $919 for each of them back in their pockets. If you are a household with kids, with 20, 30, 40-year-olds, the ACA subsidies get extended, you get $200 a pop. So there's a pretty easy path to 60 votes if you want it. And we'll have those votes in December and then again in late January. And if you want to stimulate the economy quickly, get money back into consumers' pockets, the ACA subsidies is a really fast way to do it. And a lot of Republicans would like to see that too. Look at Alabama, Louisiana, Mississippi. That's where those voters are.
As you've said, that effort just had a 41-day commercial over the last month or so, Henrietta, so we'll see where we end up. Just before you go, really want your reaction to the prospect of a 50-year mortgage in this country. It's come up repeatedly since the weekend, Henrietta. Do you think that's the direction of travel here?
Sure. Why not just rent your house forever?
That's what it feels like, right?
100%. I mean, the whole idea is to reduce the premiums in any given day, then pay off in 50 years. Given the fact that the median age for home buying right now is 61 years old, that means that when they're 111,
I thought it was 40 now.
That's the median for new first-time U.S. home buyers. The median age for just U.S. home buyers in general is now 61. This is someone's game that is not the new home buyer of, say, or the home buyer at all of, say, 20 years ago.
They're the cash-rich players. The boomers of this world, Bremo, with all the money.
Yeah, the boomers are supporting their kids, though, in fairness. But yes, you're right, the boomers. How could you?
They bought their houses for a bag of beans. I mean, come on.
But this is the whole point, right? You need to have some sort of reset in the housing market. You need prices to come down.
Prices have to come down.
So if prices don't come down, if you just keep inflating them, the affordability just gets worse. That's the whole point.
It's been a problem for decades. They don't want prices to go down. Why don't they want prices to go down? Because the people that vote for them, the boomers, ultimately don't want the value of their houses to come down.
But this is what happened with the auto loans, right? We saw 10-year auto loans. Auto prices went up, so people had to take out more loans. This is the same kind of thing with a 50-year mortgage. How much is that actually going to help things? And oh yeah, by the way, about a third of the CPI input is from housing costs. So imagine that any increase there will just feed into the perceptions of inflation. I'm not sure this is the remedy.
You don't solve a price problem with a demand-side solution. I just don't know why they don't understand this, but politicians, I think, do get it. And ultimately, what they get is they need these people to come out and vote for them all the time, every single year. So they keep doing the same thing. Demand-side solution, demand-side solution. Housing, it's their ticket to get re-elected. Has been for a long time.
I love the idea, though, that Henrietta Trey's just said, which is basically rent your house forever. It's essentially what you're saying, because ultimately, either you're going to stay there forever or you're hoping to flip it at a higher price, and then we're back to, 2005.
Henrietta, appreciate your time. Henrietta Trey's there, Fader Partners. Nobody wants to go back to that era in the housing market of 20 years ago. Coming up on the programme, we'll catch up with Heath Terry of Citi Research. As CoreWeave cuts its revenue forecast, plus Yohara's coming back to give you your morning movers. Shares of crypto exchange Gemini sinking after posting a wider-than-expected loss. That name is down by 9%. For the broader market, equity futures doing okay. We're down by about 0.2% on the S&P 500. A monster rally to start the trading week on the Nasdaq yesterday. More than 2%, a 2% plus gain on the Nasdaq 100. The biggest one-day rally going back to May, following the worst week for the Nasdaq since early April. It has been a choppy ride over the last week or so. From New York City, you're watching Bloomberg TV.
Bloomberg Business Week Daily.
We got to talk crypto.
From the magazine that helps global leaders stay ahead.
What's the conversation around your company?
Bringing you insight on the people, companies, and trends shaping today's complex economy.
Planning very big things.
A new level of premium.
Plus global business, finance, and tech news as it happens.
The floodgates of innovation are going to open up.
You can't fake passion. You either are or you aren't.
Bloomberg Business Week Daily, only on Bloomberg.
Astonishing day for US technology.
Shaping the region's technology ecosystem.
Asia's biggest tech news and innovation.
U.S. jobs numbers are released. Bloomberg has the report under surveillance with crucial data and expert analysis at terminal speed. Nobody covers Jobs Day like Bloomberg.
Morning, this is Bloomberg Daybreak Europe. I'm Tom McKenzie in London. These are the stories that set your agenda.
Taking you from the U.S. market's close to the overnight session in Asia, we'll walk you through what you need to know to kickstart Europe's trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in to Daybreak Europe, only on Bloomberg Television. Context changes everything.
Waking up to a freezing New York City in the low 30s. For the Brits watching, that is 0. Freezing brown in New York City, the start of winter.
Yeah, it actually, my youngest son last night was saying, look, it feels like it's 20. It's going to be so cold. So yes, wear a jacket today. We are actually in winter, and it is snowing in Chicago and upstate. And so this is going to be what we experience this year.
Just on the airlines and the amount of cancellations we saw over the weekend, there was some discussion of how much of that was weather-related and how much of it was related to the government shutdown.
Well, when you take a look at Chicago in particular and O'Hare, you see the level of cancellation far above what you're seeing in other major airports in New York City, for example, and other hubs. So, yes, it does seem like there is some sort of snow-related cancellations. Nonetheless, if you do have the Transportation Secretary coming out and mandating a cap on how much volume there is, that's going to have ramifications and ripple effects.
That was for anyone out there looking to sponsor the weather segment right here on Bloomberg Surveillance.
I will 100% do it.
Yeah? You up there?
I did it in Fargo, North Dakota for a while.
Did you? You did the weather?
Yeah.
On TV?
No. It was. I would write articles for like, a month straight about, yes, it's still -30 today.
It's cold out there.
Go. Anyway, I digress.
That works. Didn't Bob Iger do that back in the day?
I don't know. I was 21. Yeah. Anyway, let's move on.
All right, we can move on. People want more, though, don't you? You're going to Google the articles that Bramo used to write on the weather.
They're not even on the internet anymore.
Oh,
but they were actually really fun. But I'll be honest, there were some great ones about, lip balm sales flying off the shelves. Nice. You've got to really dig deep.
This is when print truly was print. All right. Equity futures on the S&P, negative by 0.2% this morning. The broader market pulling back by 0.4 on the NASDAQ 100. Yesterday, the biggest one-day rally on the NASDAQ since May. Last week, the worst week for the NASDAQ since April. The small caps this morning down by about 0.1%. As we count you down to the opening bell about 2 hours away, let's get you some single names, some morning movers with Yahara. Hey, Yahara.
Hi, John. CoreWeave's earnings beat shows the demand for AI infrastructure is alive and well, but you wouldn't know it by looking at the stock now down more than 10% after a delivery delay forced the company to trim its outlook. Add to that general jitters around AI, plus that the stock had doubled heading into earnings since it IPO'd, setting a high bar, and you get today's sell-off. Meanwhile, moving on to Gemini. This is a crypto exchange founded by the Winklevoss twins. It also reported earnings. Shares are down 7.4%. It posted its first earnings since going public, and they posted a wider than expected loss than expected, despite soaring revenue due to high costs. And unlike CoreWeave, our first stock, which also went public this year and has seen massive gains, Gemini has not had the same fortune, with the stock falling nearly half since it IPO'd. And we end on the luxury resale platform, The RealReal. Shares are soaring 15% in the pre-market on a strong beat and a raise, with analysts over at BI saying that the momentum could continue into 2026 as shoppers continue seeking value. It also comes at a time when all the luxury brands like Chanel are hiking prices, with a bag there now costing you more than $10,000. Add to that tariff pressures, and you get more people heading to the secondhand market. John?
Yahara, appreciate the update. Thank you. More from Yahara. In the next hour, on a radar this morning, the Senate passing a temporary funding bill to end the government shutdown. It now moves to the House, which could hold a vote as soon as tomorrow. Democrats criticizing the deal for dropping their demand to renew healthcare subsidies. Elsewhere, SoftBank selling its entire stake in Nvidia, making nearly $6 billion to help pay for AI investments. Despite the sale, SoftBank remains tied to Nvidia through several AI ventures, including the $500 billion Stargate project for U.S. data centers. And finally, President Donald Trump downplaying criticism of a potential 50-year mortgage, saying it would help make home buying more affordable.
It's not even a big deal. I mean, you know, you go from 40 to 50 years, and what it means is you pay something less from 30. That some people had a 40, and then now they have a 50. All it means is you pay less per month. You pay it over a longer period of time.
Affordability, the buzzword down in Washington, D.C., a reality check for politicians. That effort keeps building.
And it's going to be a difficult one to solve, because not only do you have a market that's probably going to push back in 50-year debt right now, given the fact that 30-year debt alone has been had somewhat of a difficult time. I mean, 20-year debt auctions are exciting enough, but 50-year auctions, let me tell you, that will be a fun day. At the same time, there's a question of what the ultimate goal here is. Is it to reduce overall prices? Is it to create more homes that are affordable? Or is it to have people renting for longer? Because ultimately, as we heard from Henrietta Trades, and I think it's a really astute point, that's essentially what it is for 50 years.
Ultimately to reduce the monthly price. But the bank's going to make more money over the duration of the loan. And that's the problem that a lot of people have with a 50-year mortgage.
A lot of people saying that, say, if you take a $400,000 loan out, you're going to be paying about $200 less in your monthly payments, but you're going to be paying hundreds of thousands more in interest payments over the entirety of the loan. So it raises a question about the financialization of the mortgage market, which led to elevated prices relative to people's incomes in the first place. And that, I think, continues to be the rub.
We've got to build more homes. We had this conversation a million times in the UK, and the conclusion was always the same. From everybody else, we've got to build more homes. And from the politicians, they would say, well, I've got this really interesting demand-side solution. Why don't we do a 110% mortgage? That will really address things.
Yeah, on the flip side, whenever they try to build more homes, people say, not here. Don't do that here. And there are a lot of different, red tape and red lines that people are forced to jump the hurdles of. And you look at home builder sentiment, and it's fallen off a cliff. So how do you incentivize it? It's a difficult thing to fix. And right now, offering a 50-year mortgage sounds like something that actually addresses something, but it's unclear that it actually is either feasible or addresses the ultimate problem.
That's a snapshot of the conversation in Washington. Let's turn back to tech, where CoreWeave shares are tumbling in the pre-market. The company cutting its annual revenue forecast after failing to meet customer demand due to data center delays. Joining us now around the table here in New York, Heath Terry of Citi Research. Heath, good morning to you, sir.
Morning. Thanks
for being here. You track the AI industry, so can we put some numbers on it? Just how much have we been spending on CapEx over the last year, and how much will we spend in the next year?
Sure. So we're going to spend about $400 billion on CapEx just across the hyperscalers in the U.S. hyperscalers over the course of this year. For what it's worth, that's about double what we thought we were going to spend this time last year. So those numbers have been coming up pretty consistently. Going into next year, we're expecting that number to be closer to about $600 billion. And if we look out over the next 5 years, we're talking about nearly $2.8 trillion when you factor in all of the sovereign investments that are being made, all the investments coming in from neoclouds and others that are building outside of just the Amazons, Metas, Googles, and the rest.
Can you give us a sense of that $400 billion, how much of that is just money coming into those companies, and how much of it is money that's being borrowed? And how do you expect that to change in the year to come?
So of the $400 billion, when we're talking about 2025, this is still all money coming into the companies. As a matter of fact, there's a lot more money coming into the companies than that. Total CapEx is running about 65–70% of operating cash flow. So we're nowhere near the point that we're going into debt for this. Now, that's on a macro basis. When you start talking about individual companies like CoreWeave, like Oracle, like Caruso, like Inscale, like Nebius this morning as well, those companies are starting to use leverage, but clearly they're a much smaller part of the market than Microsoft, Google, Amazon, Meta.
Do you see any pockets of froth? Because this is ultimately the key question as people start looking at pockets of leverage or questions about how long the revenues can continue. Is there anything that raises concerns for you?
Yeah, absolutely. I mean, any time you try to do something this big, and to be clear, we have never done anything this big before. But anytime you try and do something this big, there are going to be inefficiencies that develop. There are going to be pockets of froth. This is not going to be the first technology that develops in a straight line. Companies are going to overbuild in some places. We're already at a point where we're underbuilding. That's the issue with CoreWeave here. They can't build as fast as they thought they were going to be able to, or their partners can't build build as fast as they thought they were going to be able to, and so that's going to create this volatility that we've seen over the last few weeks, and this is not the last of it that we'll see. Valuations in places more in the private markets than the public markets are getting frothy, but it's still really early stage in this.
Going forward, you've gamed out some projections for the next 5 years, which seems very difficult to do given the fact that this seems to be accelerating pretty quickly. And I just wonder how constrained that is based on our conversation from earlier this morning on the energy story, on some of the just ability to build out as quickly as they will come, which seemed to be the issue for CoreWeave.
Yeah, look, we tell everybody when we're talking about projections that our projections are going to be wrong. We're just trying to get to the most useful version of wrong that we can. But we do. We look out over the next 5 years and we see about $1 trillion in AI-related revenues in 2030. That implies about an 85% growth rate annually over the next 5 years. And you see the early development of that in all of the acceleration in the cloud revenues from those big hyperscalers. The backlog number, as you look at the backlog number out of CoreWeave last night, massive acceleration there. And it's because the end user, and this is the most important part of all of this, the end users, the Citibanks, the JP Morgans, the Pfizers, the AT&Ts, we're all onboarding these tools going from proof of concept to production, and that's driving the demand up for inference capacity at all of these hyperscalers.
Do you think we're underestimating the boost we might see to productivity?
Yeah, absolutely. I mean, I think right now we're underestimating all of this, right? We are underestimating the impact that this is going to have, particularly on productivity. You hear it early on from the developers. So when you talk to CIOs and CTOs about what this is doing to their development organization, they talk on average about a 30% improvement in employee efficiency. Well, if you make people 30% more efficient, you're going to have a big boost to productivity.
Can we work less? Fewer hours. We always do this. We make these productivity advancements and then we work even longer.
Yeah,
take the phones home with us,
human
work
nature.
the weekends.
Yeah, well, look, the bond market took the hint. What about the stock traders? Please, call in. Why did you decide to work today?
Heath Terry, will we work less?
Look, I think we won't. It's just human nature. We're going to take all of these tools that we're going to be given because you know what? It's not going to get less competitive, right? And people say this about our industry all the time. They're like, well, if we have these better tools, then we're going to need fewer junior employees. We're going to need fewer people sort of going in. If you're in a competitive industry, if you're going in to compete with your competitor who also has those tools, and you show up with 3 people and he shows up with 5, you lose. And so I don't think we're going to see any less work because of this.
How susceptible is this space to some sort of new development, whether it's quantum computing or some energy efficiency akin to DeepSeek, that completely disrupts the models and the build-out that we've seen so far?
But go back to DeepSeek, right? We got DeepSeek in January. What did it do? It gave us this great efficiency in AI, and all we did was use it to do more. And so when we get these new efficiencies, whether it's going to be quantum, whether it's going to be new models, we see this with a lot of the newer models or newer sort of tweaks to the technology that are being done that make these things more efficient. We're not using them to do less, to use less power, to be cheaper. We're using it to get better productivity out of it. And again, I think that's just the way we're all sort of designed to operate.
What we've seen so far from about 35,000 feet is that earnings growth is still tremendous, but employment growth has really dropped off. Now, a range of explanations for what's happening down at the bottom here, but the space in between is the space for a lot of societal tension and political pushback. How are you considering, what's your assessment of potential political developments which may constrain this advance?
Yeah, look, I think we are in a little bit of a wait-and-see moment where companies are trying to figure out exactly what kind of impact this is going to have and where they can be more efficient. And not so much do we need fewer employees, but do we need different types of employees for this. And so there's a little bit of a just sort of pause, digestion period, as some people have caused it, that's happening in the employment space. I think as companies start to understand the technology better, as you start to see these things go into into production in ways where companies have an understanding of what their employment needs are, you'll see that kind of pick back up. But in the meantime, there's going to be dislocation. We're not going to be able to take call center employees and immediately turn them into electricians, which is what we need. And so that's going to create some issues, and that always ends up showing up in the political environment.
What's the best use case that you've seen so far that convinces maybe some people on the other side of the conversation that you are going to see that productivity boost that they're skeptical of?
Well, I mean, the best use case is what we're seeing in the code development world, right? I mean, we have 75,000 developers inside of Citi that we are seeing become more productive. Everyone that we talk to across the technology environment will tell you the same. Jensen Huang talks about seeing a 2 to 3x improvement in the developers inside of NVIDIA because of their rollout of Cursor, and so that's where you're seeing it first. But that's just because they're the earlier adopters. Like even as we start to kind of roll through this throughout the rest of these companies, you're seeing those same kind of production gains, but that's the one where it's the biggest.
Lisa asked the question earlier, and I'm going to ask it in a different way. The best way to play this, is it moving from enablers to adopters? Is it something else, the energy story? What's your call?
Look, we look at that entire spectrum, that entire sort of supply chain. We're still very much in the infrastructure layer of this. So all of those companies, the chip companies, the connector companies, the storage companies, the memory companies, they're going to be the biggest beneficiaries here in the near term. But we are moving into the stage where the hyperscalers themselves are now where the bottleneck sits. You see this in sort of the CoreWeave numbers. So we like those. We like that layer, the Microsofts, the Googles, that sit there, and then one layer up where you see the data side of this, Snowflake, Mongo, where those consumption-driven models are benefiting from this huge inflection in inference demand.
Heath, this was thoughtful. It's good to see you. Let's do it again. Thank you, sir.
Anytime.
Appreciate it. Heath Terry there of Citi Research. With an update on stories worldwide, let's check in and get your Bloomberg brief with Vonnie Quinn. Hey, Vonnie.
Hey, John. Thank you. First Brands' new CEO testifying in federal court saying he uncovered evidence of massive financial fraud at the auto parts company, which included using fake invoices to double pledge collateral. The CEO also saying the company's founder transferred millions of dollars to his personal bank account, family trust, and various businesses he controlled. Warren Buffett says he's, quote, going quiet. In a letter, the Berkshire Hathaway CEO, who's stepping down from the role at the end of the year, says he'll stop writing the firm's annual letters and speaking at its meetings. The 95-year-old billionaire also says he'll be giving more than $1.3 billion to his family foundations, with plans to accelerate donations while he's alive. New York Giants are looking for a new head coach after firing Brian Daboll midway through his 4th season. Offensive coordinator Mike Kafka will be the interim replacement. Daboll led the Giants to the playoffs in his first season and was named Coach of the Year, but has gone 11-33 since. And that is your Bloomberg Brief. John.
Brutal. Vonnie, thank you. Appreciate it. Up next on the program, a fractured Federal Reserve.
We don't want to make the mistake of holding on too long for rates, only to find out we injure the economy.
I think there is limited room to ease policy further without policy becoming overly accommodative.
It's a divided Fed. Savannah Rajapra of SocGen joins us next, live from New York City. You're watching Bloomberg TV.
In case you missed it, on Bloomberg Crypto.
There's a debate going on right now in D.C. that I think folks need to start paying more attention to, and that is the yield. And the question really is, who is going to keep the yield? Who makes money off stablecoins? Well, right now, in the case of some of the large stablecoin issuers, there's a yield on those deposits. So when there's a dollar, for example, deposited in a bank account, there's interest paid on that dollar. And so who's capturing that yield? And I think one of the really interesting things about the Genius Act is that it bans so-called yield-bearing stablecoins from giving that yield directly back to consumers. Now, that's not true everywhere. And I think if consumers have a choice, why would a consumer want an institution to keep that yield? Or would there be sharing of that yield? So right now, one of the debates going on is, will rewards be allowed? And I think these are really important questions.
Don't miss Bloomberg Crypto live Tuesdays.
Okay, ready?
David, what initially sparked your interest in this topic of longevity?
15 years ago, I turned 60, and I began to wonder how much longer I'm likely to live and what I could do to extend my life. On longevity, I talked with the leading experts in science and medicine to educate people about how they might be able to change their conduct so that they can live a happier and healthier life. I'm David Rubenstein. Join me on a 4-part journey as I explore the great quest for longevity. Only on Bloomberg.
From the world of politics to the world of business, Joe Matthew and Kaylee Lines deliver news, insight, and analysis live 2 times a day, every trading day. Balance of Power at 1 and 5 Eastern, only on Bloomberg.
Bringing you up-to-the-minute geopolitical news whenever and wherever it happens. I'm Stephen Engel at Japan's Akasaka Palace in Tokyo, and this is Bloomberg.
Equity markets pulling back by 0.2% on the S&P 500, on the Nasdaq 100 down by 0.5. Under surveillance this morning, a fractured Federal Reserve.
I'm looking at both inflation and productivity. And if you look at inflation, you're seeing that it's been pretty contained so far. We don't want to make the mistake of holding on too long for rates, only to find out we injure the economy.
It's very important that we tread with caution here. I think there is limited room to ease policy further without policy becoming overly accommodative.
It's the latest this morning. Traders pricing in a 1/4-point rate cut next month as Fed officials walk a dual mandate tightrope. Subhadra Japa of SocGen writing a December cut is likely and should get fully priced in. The uncertainty around inflation argues for fewer cuts by the end of 2026. Subhadra joins us now for more. Subhadra, let's move with the first move first before we get to the longer-term story. The move in December. Why do you believe the President dailies beat the President Muslims?
Because of the fact that you are going to start getting data when the government shutdown ends, and what you're going to see is some level of weakness. You're already seeing warn notices suggesting layoffs. You're going to see perhaps some of that data that we, from the shutdown start to creep in. GDP growth for the fourth quarter is going to be lower than anticipated. The drag's probably going to be somewhere in the order of 1.5% to 2%. So all of that is going to be something that's going to work into the sentiment of the Fed over the near term. But over the longer run, you look at the trajectory of growth, the momentum in the second half of this year has been very strong. There's significant amount of CapEx investment coming in for the 2026 and perhaps even 2027. A lot of fiscal stimulus in the first half of next year. There's not going to be that much of a reason next year to ease. So there's still a case to be made that they could ease one more time in December, but beyond that, there's not much of an urgency to cut.
Subhadra, this is interesting, especially after Peter Scheer was on and he was talking about how he sees upside pressure on 10-year bond yields. You see the same. Can you explain just what the path of that is and why we haven't seen it so far?
So we did see a significant move lower in yields, partly, I would say, because of the shutdown and the fact that investors were moving into safety. You saw a bid for gold. Really, investors were starting to get a little bit more cautious. There was perhaps a buy everything environment where equities were rallying and bonds were rallying. But I think once we get past this and we start getting the data, I wouldn't be surprised if we start seeing yields start to rise towards that 4.5% level. In our weekly last week, we said that the risk to yields are two-sided. It's not anymore a one-way move in yields towards that 4% in 10s and 3.5% in 2s. You're going to start seeing yields start to reprice and reflect the fundamentals in the economy. And to us, the fundamentals are still relatively strong. that would argue for modestly higher yields.
So let's talk about some of the data that we're expecting to get. The first being the September jobs report, and then after that, it'll sort of trickle out with a series of retail sales and other types of indicators that we have been lacking over the past month and a half. Which do you think has the ability to really move the needle on yields?
So for me, I think the outlook on inflation or the inflation read is going to be the most important, because if there's one data point that we haven't, say, gotten the kind of clarity that you would, to me, it feels like it's on the inflation side. On the labor market side, you do get state initial jobless claims, and as well as the Fed surveys that show, both the Beige Book as well as other surveys that show that the job market is okay. Yes, you're seeing some increase in layoffs. Warn notices are going up, but that might be more temporary as opposed to something that's more permanent. On the inflation side, we just don't have a good read, and we really need the BLS to start producing the CPI data. So that's kind of what I'd be looking towards.
Subhadra, looking forward, what I'm hearing from the White House is that they're looking to juice demand. The president's very focused on helping the affordability issues that maybe haunted the Republicans in recent elections. We could debate that another time. But ultimately, he's bringing up repeatedly the prospect of handing out $2,000 checks. Should we take them seriously? As a bond investor, is that something you should take seriously?
Yeah, if they're going to go down that path, we should definitely take it seriously, because that's going to increase deficits quite substantially. And if you look at, say, the revenues that you're getting from tariffs, it's not nearly enough to offset the increase in deficits coming from those $2,000 checks. So, again, you also have a little bit of uncertainty on the courts on what they're going to rule on tariffs. So you don't have the revenue side to offset those $2,000 checks on the deficit side. So to me, that would be a clear signal towards higher yields in this environment.
What do you think, Subhadra, the yield curve is going to look like, with the prospect of maybe juicing demand a little bit, perhaps a re-acceleration in early next year, which is what President Muslim's expecting? On top of that, a more dovish Fed chair taking over from Chair Powell. What does the back half of next year look like in your mind?
So that's a very, very good question, John, because to me, what that suggests is that we've seen kind of this flattening of the yield curve. We could very easily see the yield curve start to steepen out, one, because of rising deficits, but also because of higher inflation expectations, because the Fed is cutting into strength. That would typically mean that inflation expectations will start to rise if more cuts are being delivered than what the economy needs. So to me, that would mean longer yields would start to drift higher. Of course, it's a little bit murky because from a refunding perspective, the Treasury has said that they'll keep coupon issuance sizes stable. So that would perhaps cap the rise in yields somewhat. But the bias would be towards steeper curves and I would say wider inflation expectations.
Subhadra, thanks for talking to us on a bond market holiday. We appreciate it. Subhadra Jappa there of SocGen, thank you very much. What did Peter Cheer say this morning when he walked into the studio? Bond market's closed, we'll let the kids take charge today.
Yeah, this is pretty much 2 days of the year that they let the kids take charge on Veterans Days and Columbus Day, and that seems to be where we're at. Don't hate me.
Only the bond investors would call the equity investors the kids, right?
Yeah, but at least the kids are having fun.
True. A lot of fun in the last 24 hours. Maybe not so much this morning. We're down about 0.25% on the S&P 500. Up next, we'll catch up with Omar Aguilar of Schwab Asset Management, Lorena Urici of T. Rowe Price, and Venu Krishna of Barclays. From New York City, the third hour of Bloomberg Surveillance. Up next.
Let me break down our CapEx into the buckets that we spend. Big part of it is to expand our reach of fiber. You cannot wait until there is certainty to build that. These have long lead times that require you to have conviction about where demand is going. Another bucket is, as more people are on our network, we also have to add more coverage and capacity. It's almost like a variable expense. Third, we are modernizing our wireless network right now. Through the investments we're making, we are driving down our unit costs over time and providing more capacity to serve the demand that we think is coming.
Do you have less confidence in that 3-year plan now than when you first came out with it, given that some people are having trouble deciding how things are going to look in the next 3 days?
No, I really don't. I look at the nature of our business. It doesn't matter the economic cycle. This is a critical goods or service, and We have every confidence demand for it will remain. Will it be harder in a more challenged economic environment if that ends up being the case? Of course, but remember, we are investing at record levels. Slight moderations of that would allow us to deliver a lot more incremental cash to the bottom line. So I have every confidence we're going to be able to deliver our guidance.
It's the world's second largest economy with a growing influence in global affairs. Bloomberg The China Show brings you the unmatched expertise you need to keep track of breaking news, in-depth market analysis, and the most influential newsmakers in and around China.
We need to do more to engage the market more. We're risk on. I think we caught a little sweet spot.
Massive savings right now.
It's already a different game.
Bloomberg The China Show. Weekdays around the world, right here on Bloomberg. Context changes everything.
We have two crises, two essential crises, and for both it's now or never, democracy and climate, and they are absolutely interlinked. And we have to solve them together. We're losing the democratic infrastructure and norms to deal with the climate, and we're losing the climate stability that is essential for a democracy. We have to solve them together. We've never faced a threat like this to our democracy at a time when it's a perfect storm, at a time when we're being told by climate scientists, some of you may be in this room, that we have to cut our emissions, fossil fuel emissions, in half in 5 years now. You know, when I started to realize what was happening, it was 12 years, and we haven't done it.
Technology is embedded in every aspect of our lives.
And laying the foundation for the future.
From finance to defense, AI to entertainment.
And from the road to the stars. Bloomberg brings you the latest stories of the people and companies pushing the tech sector to new frontiers.
And the politics that shape global tech markets.
I'm Caroline Hyde in New York.
And I'm Ed Ludlow in San Francisco.
Watch Bloomberg Tech every weekday.
Only on Bloomberg Television.
Join me each week on Wall Street Week for stories of capitalism from business, markets, economics, tech, and climate.
More than what you need to know, it's what you need to think about.
Earnings are strong. The downside seems pretty limited.
These earnings better grow into some of these valuations. It looks like we've got a problem with hitting valuation ceilings everywhere we look.
This market has gotten very speculative.
That could cause some volatility in the near term.
This is Bloomberg Surveillance with Jonathan Farrow, Lisa Abramowitz, and Anne-Marie Hordern.
Live from New York City this morning. Good morning, good morning. For our audience worldwide, the third hour of Bloomberg Surveillance starts right now, and your scores look like this. Equity futures on the S&P pulling back from yesterday's biggest gain. Since May on the NASDAQ 100, we're down this morning by 0.5%. On the S&P 500, we are down by 0.2. The bond market is closed for the Veterans Day holiday. What is open is a stock market waiting for all of this to happen. The government reopen, and for us to actually receive some economic data. Maybe we'll get payrolls on Friday. I've got no idea. What we will get is we'll hear from the Treasury Secretary again on Wednesday at a Treasury market conference. We heard from him just moments ago. Scott Bessent saying we inherited an affordability crisis. That's the story of the moment down in Washington.
And the real question is, how do you address that, given the fact that right now it is a very difficult thing to change? Do you try to get prices to come down, a sort of deflation in certain key prices? That's going to be a hard thing to do, especially given the fact that the economy isn't crashing. So that's going to be tough. Do you end up with $2,000 rebate checks in January, or do you end up with a 50-year mortgage? Any commentary about how the dialogue is shifting and what that could mean for policy will be very important.
The Treasury Secretary's on point. They inherited a major adjustment in the price level through the Biden administration. The debate now is, can they make it better? And are they actually making it worse with the policies we've seen over the last 12 months?
The difficulty is that people are upset about the price level increase, but inflation still is going up. So you're not going up, but inflation, the rate of increase is coming down, but prices are still going up. And so people are feeling that. The question is, how do you deal with this without crashing the economy? And how do you have some sort of boom? The question that you've been raising all morning, which I think is a key one, do you answer with some sort of give them more money? The idea of checks that are similar to, say, the COVID checks that people received that will probably only exacerbate inflation. These are the things that people in the market are trying to figure out.
Checks, and improved access to credit. Checks and improved access to credit. We're not talking about supply-side solutions here to address the housing market. That's not the conversation. It's $2,000 checks, to your point, and the prospect of a 50-year mortgage. I'm not sure that's going to get it done for a lot of people.
Which is the reason why people are looking at the inflationary aspect of this, not the fact that cost of living is going to come down. Either way, this is setting the tone for the rest of the year heading into midterms next year. And the question is, do you end up with a populist tilt that will bias this market toward a higher degree of inflation and a higher degree of supply-side response, at least in the terms of cash and liquidity, versus supply-side response in terms of building more homes and offering more supplies?
The S&P just a touch softer so far this morning. The opening bell about 1 hour and 27 minutes away. Equity futures down by 0.2%. Coming up this hour, we'll catch up with Omar Aguilar of Schwab Asset Management as stocks are edging lower. We'll speak to Blarina Urucci of T. Rowe Price as we break down the latest jobs data. And Vinu Krishna of Barclays maintaining his bearish outlook for the end of the year. We begin this hour with the latest stock rally on pause. Omar Aguilar of Schwab Asset Management writing, we are getting some corrections within the frothy areas of the market. It is time to use volatility to rebalance exposures to reduce concentration. Omar joins us now for more. Omar, always good to get your thoughts on things, sir. Let's get into it. What would you be reducing right now? What would you be taking advantage of?
Well, we have been experiencing one of the biggest and largest momentum markets that we have had since the late 90s. And think, the exposures that people may have had to the traditional and momentum, type trades are very high. And I think we have been encouraging clients over the last, 2 months to try to use these periods of volatility to try to reduce exposure to that momentum trade. We have seen these, that can actually go very quickly as, the AI trade, expanding on CapEx, increasing CapEx, continue to just emphasize that sort of mega cap, dominance that we have seen. One of the statistics that we keep on showing is that, only 17% of stocks within the S&P 500 have been able to outperform the market this year. So that tells you a lot of that level of concentration that, if we go back in history, when it comes down to momentum trades, they tend to be unwind very, very quickly. And we have seen some of these head fakes already over the last, couple of months.
Omar, I've heard this argument repeatedly throughout the whole year. And if I listen to people as they offer that encouragement to move out of these names, I would have missed out on the rally because that's what supported the index. Omar, what are you suggesting people should buy instead?
Well, I think if you look at the fundamentals of the economy, if you look at what is happening, we have been encouraging clients to just take this barbell approach and take a look at the fundamentals of what is the corporate earnings growth that you see on these areas. Normally what you see in these, probably not very clear economic picture because of the lack of data. We have seen this softness in the labor market. We have seen softness in the housing market. We clearly see this deceleration of economic growth when inflation stays, high. And what that would recommend is for people to start moving into the cyclical part of the market and being more defensive. We're not necessarily thinking that the economy is going to crash or is going to go into a very hard landing, but clearly we see, the potential for these to go to a slowdown, and only companies with strong balance sheets will do. We actually saw underperformance of dividend payer stocks, this year. This is the opportunity to take a look at those companies that can actually do well. So starting to go into that part of the market is started well. Interest rates are probably coming down. They already started the Fed, reducing rates. That also provides a little bit of ability for cyclicals and sort of mid-sized companies to start doing well. And I think I will emphasize the fact that, earnings potential is sort of the biggest part of what the market might look like.
Omar, does defensive mean something different today than it meant, say, 5 years ago?
Stability, Lisa. Stability is what we actually think about defensive. It's not the traditional consumer staples, utilities trade. And in fact, utilities tend to be more driven by AI these days than what is the traditional AI. But it's really more stability in earnings, what we actually think about being defensive. Higher quality names in terms of profitability and profit margins, so stability is a big part of it. You think about it. Companies that did very well through all this period of uncertainty around tariffs and around, labor market cost increasing, et cetera, were those companies that had very good, profit margins. So they are the ones that are able to still not necessarily pass through the increased prices to the consumers. those companies that are squeezing their profit margins will have no choice to actually, pass through those prices to the consumer. So we clearly emphasize that ability of continue to have sustainability of earnings, quality of earnings, and healthy profit margins.
A number of people have come on the show this morning and have talked about how there still is quite a bit of dynamism under the surface, and you talked about the cyclical sides of the market that could potentially do better, especially if the Fed cuts rates again next month. At the same time, people are seeing more inflationary pressures come in, whether it's from stimulus efforts, whether it's from the energy costs, and I'm just wondering whether increasingly the idea of diversification is starting to look very different for you, with the bond market maybe not having the same kind of profile as it has in the past.
Well, diversification is clearly the name of the game, and that has not going to change. I think the main concern that we continue to have is the fact that, yes, as we see in the bond market, a steeper yield curve, when we see inflation expectations continue to rise, and that is a big component of what I think, we may see. We're starting to see a little bit of movement on the credit market. Clearly, this is the time where, diversification and maintain the levels of quality in the bond selection is actually a key part of it. I don't necessarily think that duration is sort of at play in the bond market at the moment, but I guess the expectations have been set. But I think the shape of the yield curve and the movements that you have as you see, sticky inflations, and you see a continuation of that expectations that we're going to have a more steeper yield curve is sort of a big part of what we are encouraging clients to look at. On the equity side, again, earnings, potential and diversification suggest reducing the concentration. And I cannot emphasize that even more because, the level of concentration that there is in terms of the majority of portfolios, it is, pretty high. And I think diversifying away from it, even if it means that having to buy some of the companies that have been underperforming this year, is actually a healthy thing to do for investors.
Omar, can I just follow up? Because we get this argument so many times on this program, we can't just buy something else for the sake of buying something else for the sake of reducing concentration risk. Concentration has been a theme because that's where the earnings power has been. And Omar, I'm trying to understand why you want to go somewhere else. What is it about being somewhere else if it's just for the sake of being somewhere else?
Well, I think the fundamentals or the corporations, tend to basically look at, where the market and the price tends to be driven is about that earnings potential and the free cash flow generation. And yes, you're right. The companies that have done very well so far, tend to be driven a lot by that sort of earnings potential and free cash flow generation. And in many cases that have provided a good performance. Now, when you look at what that means in terms of sustaining that rate of earnings potential, that's where the risk, stays. And therefore, the size of that, concentration, when you have companies that could be between 3 and 4% of the active risk that goes into your portfolios, that tends to be fairly risky. Now, there are areas that are still also generating significant amount of earnings that are significantly potential for free cash flow generation that are not, that high levels of valuation. So looking at those undervaluation companies that still have the same characteristics, the same factors as some of the others, but you don't necessarily have to go into these very high multiples, is actually a very healthy thing to do.
Where do I find them, Omar? Where are they?
Well, they are, significant in areas in infrastructure. There are significant areas, within even technology. If you actually look just at technology, excluding, the Max 7, there are components within, technology that are still pretty good, that their capex expenditures still to increase. Their ROEs and the ROAs continue to use very, very healthy. There are still, this is the time where stock selection matters and looking at factors that drive performance, matter. You actually see areas within, the cyclical markets, whether it's in materials, whether it's in energy, in those, areas, there's very, very good opportunities that you can have. Again, we have been talking about it, I've been talking into your program about, going into small cap. We still think that it's early to go into small cap. There still need to be some structural pieces that could benefit those small cap companies. You don't necessarily have to go all the way and try to overweight small cap, but then looking at those, that tend to be, multiples that are decent with earnings potential and free cash flow generation is the way to go.
Omar, good to see you, as always. Thank you, sir. Appreciate your framing. Omar Aguilar of Schwab Asset Management. There is concentration on the S&P 500. With that, there is no doubt. Is it a risk? Is it a welcome feature or an unwelcome bug? how many times we've been asking that question, and it just keeps going up and to the right.
Every time people try to sell the AI trade, it just ends up coming back to bite. A real question here, though, of other areas that are part of that that concentrated trade without seeming like it. And you talked about, say, some of the utilities, or say even consumer spending at the higher levels. How much is that levered to the AI trade? Because people are making money from the stock market, which is mostly AI, and they feel good and they go out and they buy new Fendi purses. So this is really the key question for me is, do we even understand the concentration risk?
Or second-hand Fendi purchases, based on what we heard from Yahira a little bit earlier. I thought the real.
The kids are doing a lot of secondhand these days. That's what I've noticed.
Yeah, but I thought the kids were also sort of spinning them off and selling them afterwards.
Yeah, that's why they have to preserve them. Well, that was back about 5 years ago. Now it's just buying them. But they do preserve them and they sell things. But it's this whole trade online. It's sort of, anyway.
I think that's great.
I think so, too. I think
some
it's good to recycle.
entrepreneurial spirit of flipping your sneakers.
Flipping your sweatshirts, flipping your sweatpants, everything can be flipped.
Can't keep up. Futures on the S&P negative here by 0.2%. The opening bell about 1 hour, 17 minutes away with an update on stories worldwide. With your Bloomberg brief is Vonnie Quinn. Hey, Vonnie.
Hey, John. Good morning. The longest government shutdown in U.S. history could end as soon as tomorrow. The Senate passed a temporary funding measure that would keep most of the government through January 30th open and the rest through the end of September. Now it heads to the House, where lawmakers are expected to take the measure up tomorrow. Meta shares falling in the pre-market. The Financial Times reporting the company's chief AI scientist is planning to leave and create his own startup. The move comes as Meta founder and CEO Mark Zuckerberg is shaking up the company's AI strategy in order to keep up with rivals such as OpenAI and Google. C3.ai shares jumped in Monday's trading following reports that it's exploring a sale. According to Reuters, the sale process is in its early stages and other options are still on the table. One of those options is reportedly fundraising from private investors. Shares of C3.ai are now giving up some of Monday's gains in the pre-market. And that is your Bloomberg Brief. John.
Hey, Vonnie, thank you. More from Vonnie in about 30 minutes' time. Up next, we'll get you some morning calls. Plus, we'll break down the new weekly ADP numbers. That's just around the corner. Live from New York City this morning. Good morning.
Making money isn't about drowning in emotions. It's about understanding what's actually happening. Markets are the best way to glean signal from noise, and that is what we try to do every morning. This is Bloomberg Surveillance.
We're coming to you live from Kuala Lumpur. The whole world is here.
The APEC Leaders Summit bringing together heads of states of 21 APEC economies.
The White House is trying to use the stops to gain additional leverage.
This big deal with a number of the biggest companies in South Korea.
That's a big number.
Deals can be done.
Trust Bloomberg for on-the-ground coverage.
Korea is not Japan.
Up-to-the-minute reporting.
In this latest salvo of this trade war.
What a visual.
And the analysis you need.
China's not going anywhere, nor are we.
Asia is at the forefront of some of the world's biggest stories.
And we're here, where the action starts in Sydney.
And in Tokyo, get ahead as the global trading day begins.
The Asia Trade, weekdays only on Bloomberg.
Is the valuation correct for AI or not, right? It feels a bit frothy. You're now seeing, mega caps move 10% on the back of earnings reports, which seems like a massive move. So I think it just shows how much uncertainty there is about whether we can pay for this. I think there's a chance we get a significant 5 to 10% pullback.
That was the brilliant Peter Chair of Academy Securities weighing in on the equity market a little bit earlier this morning. Good morning to you all if you're just waking up and tuning in. Welcome to the program. Equity futures on the S&P negative by 0.2% on the S&P 500. On the Nasdaq, we're down by about 0.4. On the Russell, we're down by about 0.16%. That's the price action this morning. Let's get you some morning calls with one stock in focus, CoreWeave. First up, JP Morgan downgrading the stock to neutral, citing mounting supply chain pressures. Your second call from Mizuho, cutting its price target on the stock to 120, noting less optimism about its revenue upside. And finally, Morgan Stanley raising its price target on the stock to 99, saying it's the market's most effective GPU cluster builder. That stock is down by 9% this morning.
This has been the big question, and I think that you framed it really well. This is a stock that has more than doubled so far this year, at least since its IPO earlier this year. So not even for the full entirety of 2025 so far. How much is this people just taking their chips off the table, bump, and how much is this actually something that's longer lasting and a question around some sort of existential risk with the AI trade?
The stock is a cluster something else this morning, isn't it? We're down by about 9% in the pre-market. Let's leave that there. So we get something new this morning, a weekly ADP report. It took you a while to get that, didn't it? Okay, we'll move on from that. Okay.
Good job.
Bloomberg's Enda Curran joins us now for more. Enda, welcome to the program. I don't see the number yet. How's this going to work this morning, and how will it work going forward?
Well, it is a new data set, like you said, John, coming from the ADP. It's going to be a weekly average. Obviously, a lot of focus on it, given we don't have the official non-farm payrolls data. The thinking on this number this morning, when it comes out, is if it's going to be a positive number, it would lean into the ADP monthly data, which we had last week, which showed a gain of around 40-odd thousand, turning around after 2 months of declines, leaning into this idea that maybe the jobs market is stabilizing. So, you know, it's that kind of low hiring, low firing, notwithstanding some of the headlines we've had on high-profile layoffs. Now, if this number is in negative territory, then of course it will lead into the idea, hang on a second, these headlines are gaining momentum here, we can't ignore what's going on. Bigger and bigger companies are starting to let go of staff, and perhaps we are starting to see now a kind of an acceleration in the deterioration in the jobs market. Some complications, of course, one of which includes the federal workforce situation with the shutdown. Some people are saying be cautious in terms of how that's interpreted, but you know, all eyes are hanging on this ADP data, given we don't have much else in terms of official data to guide us on the jobs market right now.
And you've followed this a million times, we all have. Typically, when the monthly ADP number comes out, people would ignore it, pour cold water on it, and say it's not a good suggestion, a good read, indicator of what's happening with the broader labour market. Do you think that's changed, Enda, this year?
Well, certainly there's a lot more scrutiny and focus on this number, as purely because we don't have the payrolls data, John. So I think everyone's clamouring for whatever they can get, be it at state level, be it private level data, such as the ADP, or be it the headlines from companies themselves. But I think broadly speaking, though, there's a big division right now in terms of where we are in the labour market. No matter what data set you're looking at, you have those who are arguing, no, we're clearly seeing deterioration. These headlines will eventually show up in the data. These headlines of layoffs, so there's that camp saying the jobs market is softening. And of course, you have those saying, no, you're discounting the supply side story, the big immigration crackdown. And, you know, these layoffs are really coming from a high level, given the very strong hiring we've had over the past few years. So it's a very split view in the labour market, John. Everyone's clamoring for every piece of data they can get, whether it's the ADP or anything else.
Enda, appreciate it. Stay close, won't you? When we get that number, we'll come back to you. Enda Curran there of Bloomberg on the weekly ADP data. Let's turn from the data to the earnings. Let's turn to media. Paramount Skydance shares rising in pre-market trading after reporting plans to save at least $3 billion in its first earnings report after its merger. Joining us now is Geetha Raghunathan. Geetha, welcome to the program. How did David Ellison do on the call yesterday?
I think he did really, really well, John. I mean, the management team came off as extremely strong. They laid out this really good game plan for transforming this company. I mean, this is a company that has been undermanaged, underinvested in for many, many years now. They had a great plan out there for cost savings, taking it up from $2 billion to $3 billion. And then the big surprise, I think, was just their forecast for 2026 EBITDA based off of those numbers. So, you know, a lot of investments in content, in technology, and you know, what they seem to suggest, obviously the biggest question was M&A, and they seem to suggest that they have a really good plan just organically and that they can build and they don't necessarily need to buy. But overall, I think it was a really strong earnings call.
Geetha, all of these questions or all of these words, the idea like organic growth or efficiencies speaks to the benefit of M&A being the job cuts that come along with it, the idea that there are an additional 1,600 people who will lose their jobs as a result of this. How much is that the ultimate goal of a lot of these tie-ups, to remove some of the staff necessary to allow just the creative juices to go and backfill the rest with technology?
Yeah, it is unfortunately so, but it is true. Yeah, synergies are a big part of, any media transaction. At the end of the day, you want scale, you want cost efficiencies. A lot of what, David Ellison spoke about was getting cost efficiencies even in their existing structure. So you're kind of looking at, the DTC platform, the direct-to-consumer streaming services. They have 3 services, Paramount Plus, Pluto, and, BET Plus. They want to come and integrate all of that onto a single tech stack. So it was a lot about, content and tech investments. But yes, you're absolutely right. If they do go and pursue Warner, for instance, Warner Brothers Discovery, the whole thing, the whole rationale of that deal really banks on synergies. I mean, we're looking at something like $4 or $5 billion that can be extracted in synergies in the case of a potential transaction. So you're absolutely right. A lot of it is cost savings, and it is going to result in a lot of restructuring. So that is a little bit still, I think, a show-me story when it comes to Paramount Skydance.
How closely, Geetha, is this story being watched? How closely is this media tie-up being watched by others in the space to see if it's a template for additional merger, additional deal activity? Do you expect that coming down the pike?
I think it's absolutely necessary. I mean, we are very much in this phase of consolidation. Yes, we've seen Netflix kind of completely decimate, the legacy TV model. So I think it's really important at this point, for the existing media companies to kind of manage the melting ice cube, which is, the linear TV model, to the best of their ability. And the only way that they can do that is by combining forces.
Disney reporting in 2 days' time, Geetha. What are you expected to see?
Disney is a really interesting story, John, and I think it's still very underappreciated in terms of just the amount of earnings power that they can show, both in terms of their streaming assets as well as parks. So we expect, obviously, fiscal fourth quarter to be pretty good. There's going to be a little bit of noise with the whole Jimmy Kimmel controversy and whether they lost a lot of, Disney Plus subscribers. There's also this ongoing YouTube TV dispute. But other than that, if you kind of really look big picture, fiscal 2025, solid. Fiscal 2026, even more solid. I mean, they have multiple growth levers. You think of cruise ships. You think of, just the film slate. You have Zootopia. You have Avatar. You have, you name it, all kinds of, Toy Story, Mandalorian. So it's going to be a blockbuster year. So just multiple growth levers. And, of course, I think the big thing that we are really looking for in fiscal 2026, John, is who is going to succeed Bob Iger. That is the biggest question. So a lot to look forward to in Disney when they report.
Geetha, don't you just get the feeling he loves this job? Has he shown any indication he wants to leave?
No, he will. I think he has to this time around. But I think it's going to be so important to see who exactly succeeds him in terms of laying out the strategy. I mean, there's just so much coming in terms of content investments, in terms of AI. So obviously the new leader has to kind of really embrace technology to take the company forward.
Geetha, appreciate the update. Thank you. Geetha Raghunathan there of Bloomberg Intelligence. We'll have more from Geetha throughout the week. 2 days' time before the market on Thursday, we should get those results from the Walt Disney Company. Coming up in just a moment, we'll regroup. We'll catch up with Marina Urucci of T. Rowe Price as we break down the path ahead for the Federal Reserve and get you some data from ADP. Plus, Yahaira has your morning movers. NVIDIA sliding after SoftBank sells its entire stake in the tech giant. That name is down by 1.9%.
the countdown to the market open as we bring you the first trades across Europe.
We'll debate the most important stories and what will drive the big investment decisions throughout the morning. I'm Guy Johnson.
I'm Kriti Gupta.
And I'm Anna Edwards. Join us every weekday morning for the opening trade, live at 7 a.m. here in London.
Only on Bloomberg. Context changes everything.
Middle East and Africa. Vibrant resources and high-yield investment opportunities abound. Join me on Horizons Middle East and Africa for the stories, newsmakers, and insight from this exciting region. Now weekdays, only on Bloomberg.
Get your fixed income fix. Watch Bloomberg Real Yield around the world right here on Bloomberg. Context changes everything.
I'm David Weston. Join me each week on Wall Street Week for stories of capitalism from business, markets, economics, tech, and climate. We go on the road for a look at what lies behind the headlines of today and what will likely be the headlines tomorrow.
We need more transparency. Oil and gas is still important.
They said every citizen should be investing in the market.
Accelerate progress in all fields of science.
Watch Wall Street Week right here on Bloomberg.
More than what you need to know, it's what you need to think about.
Live from New York City. Welcome to the program. The opening bell 60 minutes away. Equities down by 0.3% on the S&P, down by 0.5 on the Nasdaq. With your morning movers, back with us, here's Yahira. Hey, Yahira.
Hi, John. Rocket Lab shares have roughly doubled this year, and it's getting another boost today, up 8% in the pre-market. The company handily beat on revenue and net loss per share. That's thanks to a busy launch schedule that's made it the second most active space company in the U.S. behind SpaceX. And that strong momentum is overshadowing a delay of the first launch of one of its bigger rockets, which investors had been looking forward to. Meanwhile, we are seeing shares of Paramount Skydance also in the green, up nearly 5% after the studio boosted its cost-cutting plans from $2 to $3 billion and announced a fresh wave of job cuts. All of this, as Geeta says, as it tries to invest more in its content. Also, we did hear from CEO David Ellison about M&A amid all the reports that Paramount is aggressively pursuing Warner Brothers Discovery. And while he did not mention them by name, he did say that Paramount has the balance sheet to pursue deals. And we end on NVIDIA. Had such a strong session yesterday, its best since April, but shares are now down nearly 2% after SoftBank sold its entire stake for nearly $6 billion, with founder Masayoshi's son hoping to use that cash to fund some of their other AI projects here in the U.S., including Stargate. And while they insist this has nothing to do with NVIDIA itself, we are seeing some skepticism in the market. John?
Yahara, appreciate the update. Thanks for this morning. Thanks very much. Of course, the Treasury market is closed today because of Veterans Day, but you are seeing some moves develop in the last 5 or 10 minutes. You're seeing it in Treasury futures. They extend their advance. You see it in the FX market. The dollar, a little bit weaker, euro stronger, euro dollar, session highs 115.96, just short of 116. Some soft data crossing moments ago. Bloomberg's Andy Curran has more. And what do you see from ADP?
So we have the ADP saying that jobs fell an average of 11,250 on a weekly basis in the 4 weeks up to October 25, John. Now, on a headline basis, taking that at face value, it suggests that it certainly leans against the labour market stabilisation idea. It probably does capture some of those headlines we've been seeing on big high-profile companies making job cuts across the country. There are some caveats with this data set. Number one, it's new, so all the economists are getting used to it and working out what trends they can extrapolate from it. And then secondly, of course, some are cautioning that maybe the government shutdown, the federal workers' layoffs might be complicating this figure, and you might see a rebound as we go forward in the weeks and months ahead. But right here, right now, this ADP figure suggesting that the weak labour market story remains intact.
And how does that stack up with the other data points that we've had outside of the official data over the past few weeks?
Well, we're getting mixed data points. We did have an interesting read on small business this morning, John, seeing a dip in their confidence, which is quite interesting, talking about declining sales and demand there. And of course, small business are the biggest employers in the country, so that's one to keep an eye on. As you know, we're kind of flying a little bit blind on the jobs market side of things, plucking what we can from state level and plucking what we can from private sector. We have had one official read on the CPI since the government went into shutdown, and that suggested the inflation story was perhaps, at least it wasn't worsening. It's certainly well above the Fed's target, but maybe not worsening, all of which suggests that the Fed are in a position to, it's a wide open decision as to what to do in December, whether they cut or not. It all comes down to how do you weight inflation versus jobs. And from here in the weeks ahead up to that meeting, a lot will depend on what official data do we get, what time period will it cover, and of course then there will be a debate over the quality of that data. So I'd say, John, it's all about what numbers we get in the weeks ahead in terms of getting a good handle on where the economy is actually at right now.
And thank you, sir. Appreciate the update and the current down in Washington, D.C. I think we're all hoping for some stabilization here, maybe even some re-acceleration to start 2026. You don't see it in this data. So what do you see in the market? Equity futures near session lows, down about 0.2% on the S&P. Not a major deal. Treasury market's closed, but futures advanced, which implies that if the Treasury market was open, bond yields would be a little bit lower off the back of this data, unlocking some dollar weakness, some euro strength. That's what you see playing out in foreign exchange.
Yeah, real question here about how much, given the fact that we're seeing some of these new indicators move the markets to the degree that they are, how much when we actually get the data from September and then potentially from October, that will cause some pretty big swings as a gut check to see whether this is actually the correct read. You asked Denda, how much is this usually the correct read or one that you can sort of parse through to that non-farm payrolls report? It has been inconsistent. A real question here about whether maybe the inflation read's going to take on increasing importance as people look forward.
When we finally get the inflation data, of course.
Which will be after the Fed's meeting, that's the expectation.
Weeks and weeks and weeks, so maybe.
It might not be relevant, but, you know,
I hope it's sooner than that. I think we all hope it's sooner than that. Let's get the view of Blarina Uruchi of T. Rowe Price, writing, if we see more official economic data that shows labour markets softening, this will increase the odds of the committee coming together and supporting a cut in December. Blarina joins us now for more. Blarina, welcome to the programme. How much weight are you putting on the kind of numbers we've been discussing in the last few minutes, weekly ADP numbers?
Good morning. And I think right now we just have to go ahead and interpret this data because this is all that we have. Now, a word of warning that the weekly ADP data is noisier, is not as reliable as the monthly data or the payroll data that we are usually getting from the BLS. But with what we have in hand, we knew that ADP had shown some early signs of stabilization for employment in October. And today, both the small business survey and the weekly ADP data go against this view that the labor market has stabilized. Because when you look at the details of the NFIB business confidence, you also see there that demand for labor has also been tracking lower in this survey. So it's not very encouraging for my view that in Q4 we stabilize and in Q1 of next year we bounce back for the US economy. So tracking this closely, but also keeping in mind that the October data is going to be very noisy and it's going to be affected by the government shutdown. So I think that's another point that we need to highlight to investors.
What gives you the belief that we bounce back next year? What supports it? Where's it come from?
We're seeing a bottoming out in some of the confidence surveys and diffusion indices that I track. We've also had very, very significant easing in financial conditions, both because of how well financial markets are doing, but also because expectations about rate cuts have been priced in for some time now. Usually that takes 2 to 3 quarters to support the economy. We're also getting a modest fiscal boost ahead of the midterms. I think as economists, we tend to underestimate the effect of fiscal on the economy, both on the business side and on the consumer side. I think that's going to boost consumption in the first half of next year. I'm also seeing signs of a CapEx cycle that's been driven by AI. And as you know, we are a bottoms-up fundamental research house. All that we hear from our credit and equity analysts is that this CapEx cycle has legs and firms will continue to invest in the coming quarters. I think that's going to be another point that helps growth in 2026.
Growth in terms of GDP, not necessarily growth in terms of employment. And I wonder whether you're looking out to 2026 and see a jobless acceleration. The idea that the jobs picture isn't really displaying what's going on under the hood, which could be more of a productivity boom, which could be something different that's really fueling a new regime rather than something akin to some of the Taylor rules of the past.
This is such a good question, and it's so critical for evaluating the outlook for next year, in my view. We know that we have a slowdown in the break-even pace of employment. I think that stays with us for 2026 as well. That's partly demographic driven. We have an aging population. We also have a different immigration policy now, so we have fewer migrant flows into the country. So employment growth will be slower next year because of we don't have enough workers to have a faster pace of employment. We also I think have this backstory of the labor hoarding during, so we overhired during 22, 23. Companies hoarded labor, and perhaps they don't need to hire as much in 2026. This is very important. Now, I think what happens next is key for the Fed and for where interest rates are going to be. And I'm going to get to your productivity point in a minute. So essentially, we have this labor market dynamics with not enough workers. If we don't have productivity gains, we might end up with a very tight labor market with a low unemployment rate and high wage increases. That's bad news for the Fed. However, if we make advancements in AI in the next 2 to 3 years, and that's complementary to labor, we can get that productivity shock that you discussed. And I think that's this virtuous cycle, right? Because you have better productivity, better potential growth, and that boosts the GDP numbers without necessarily creating pressure on capacity and inflation. And this can give the Fed a little bit more room, I think, to keep interest rates where it is and to keep inflation under control.
Could isn't a great strategy. And I guess that I wonder, what's the right data to be tracking if it isn't necessarily employment? And if we're not getting CPI, so it doesn't really matter.
I mean, this coming month is going to be pretty tough. We hope that with the government reopening, we can get very quickly October and November employment data. CPI, I don't think it's going to come in time for the Fed, but I'm a fan of watching the regional and national ISM surveys. They've been giving us very good information about turning points in the economy, and the services side of the economy there is looking better than it did a few months ago. And of course, we'll be looking at all the private sector data that you've done a great job at highlighting in your program.
Lorena, thank you. We appreciate the support, as always. Final question from me, just quickly. Why does it take so long to collect the inflation data? What is it about the collection process for that means it's going to take a while, and maybe we don't have it by the time we get to the next Fed meeting?
They have people on the ground going and collecting prices the old-fashioned way in shops. It requires resources, human resources. It requires time. And the BLS likes to do it at 3 different points during the month to have a balanced, unbiased sample. And again, if you're starting the collection process towards the end of the month, you're basically missing at least 2 out of those 3 data collection points.
There you go. Lorena, we appreciate it. It's good to see you, as always. Lorena Urici there of T. Rowe Price on the inflation data. It's going to take a while to collect. Imagine that situation at the Federal Reserve. It was kind of the opposite last time. We had CPI, but we didn't have payrolls. And this time we're going to have payrolls, but we're not going to have CPI.
And what's fascinating is people have been saying it's all about the labor market. It's all about the labor market. And increasingly, as we are on the cusp of getting some labor market data, more people on this show have said it's actually all about CPI. So the pendulum's going to keep swinging as we try to pinpoint. It seems like a moving target.
It does keep moving, and it will keep moving going into next year. Lorena and others are looking for a re-acceleration in this economy, a pickup in the first quarter. President Musalem as well of the Federal Reserve looking for exactly the same thing. That's the divide right now. President Daly to you on the program yesterday, she's talking about maybe not holding rates too high for too long. Other people on the committee are saying, hold on, early next year you get the bounce back. That's what the market's priced for.
But what kind of bounce back are we talking about? And this, I think, is key. Is it a re-acceleration in productivity? Is it a re-acceleration in capital expenditure? Or is it a re-acceleration that is more broad-based with an inflationary tilt? We don't have a sense of that. And I don't really have an understanding of exactly what data you can look at to try to determine that, because a lot of this you only know in retrospect. So really, the data that you need is a crystal ball.
Weekly ADP, that's guiding the moment. That's guiding the story.
That's the crystal ball?
Weekly ADP is the crystal ball. That's all we've got this morning, at least. We're down by 0.25% on the S&P 500 with an update on stories worldwide. With your Bloomberg brief, here's Vonnie Quinn. Hey, Vonnie.
Hey, John. Thank you. Well, let's get to a recap of that ADP employment data just out. So private employers shed an average of 11,250 jobs a week over the 4-week period ended October 25th. The figures suggest that the labour market has struggled to consistently produce jobs as we get later into the year. ADP had previously reported that 42,000 jobs were added in October. Switzerland is close to securing a 15% tariff on its exports to the US. Sources telling us here at Bloomberg that a deal could be finalized within the next 2 weeks. A tariff deal would be a relief for Switzerland, apparently, after Washington hit it with 39% levies in August. Apple is delaying the release of next year's version of the iPhone Air. According to the information, the delay comes after its first model sold below expectations. Although the length of the delay remains uncertain, the product won't be released in the fall of 2026 as previously planned. And that is your Bloomberg Brief. John.
Vonnie, thank you. Thanks for this morning. Up next on the programme, we'll set you up for the day ahead. Plus, we'll catch up with Venu Krishna of Barclays, maintaining his bearish outlook for the end of the year.
The key issue right now for us in the diamond space is the declared divestment of Anglo from DBS. And as you know, Anglo holds 85% stake in DBS. Botswana, the government of the Republic of Botswana holds 15. We are resolute now, and we've communicated a firm intention to increase our stake in DBS to a controlling stake. We have lined up a number of potential collaborators with us, if I may put it that way. We have targeted funders, we have parties, we have the Oman Sovereign Wealth Fund, we have others who are willing and ready.
To Bloomberg Business Week Daily.
We got to talk crypto.
From the magazine that helps global leaders stay ahead.
What's the conversation around your company?
Bringing you insight on the people, companies, and trends shaping today's complex economy.
Planning very big things.
A new level of premium.
Plus global business, finance, and tech news as it happens.
The floodgates of innovation are going to open up.
You can't fake passion. You either are or you aren't.
Bloomberg Business Week Daily, only on Bloomberg.
Investors, top executives, global innovators. Join me for in-depth conversations with the biggest newsmakers on the day's top stories. Insight with Haslinda Ahmed, only on Bloomberg.
Bringing you up-to-the-minute geopolitical news whenever and wherever it happens. I'm Lizzie Burden outside Windsor Castle, England, and this is Bloomberg.
Anytime you try and do something this big, there are going to be inefficiencies that develop. There are going to be pockets of throw-off. This is not going to be the first technology that develops in a straight line. We see about $1 trillion in AI-related revenues in 2030. I think right now we're underestimating all of this.
Brilliant conversation with Heath Terry there, the Citi Research Head of Technology and Communications. Caught up with him a little bit earlier this morning. There's a lot of skepticism right now. And there's a man who's wanted to step up and say no. I think a lot of people are really underestimating the productivity surge you'll see off the back of this technology.
You know, I was speaking to somebody who's in this industry, and they say when you talk to New York, there's incredible skepticism and discussion around bubbles. And when you go to San Francisco, you go to the West Coast, it's all about how quickly this is moving and how they have to get in that much more because it is going to transform the way that we live. And it seems like the world is actually moving to the West Coast more than it is to the East.
For the record, he just came back from San Francisco.
Fair
the West
point.
Coast,
It's true.
Kind
There's
of
a lot of that.
Speaks to that, doesn't it? Equity futures on the S&P 500 negative this morning by a quarter of 1%. The opening bell about 42 minutes away. We're down by 0.5 on the Nasdaq 100. On the equity market, stocks edging lower, heading into the opening bell. Venu Krishna of Barclays maintaining his bearish S&P 500 year-end target of 64.50 as earnings season continues. Venu joins us now for more. Venu, good morning, sir.
Good morning.
64.50. Justify yourself, my friend.
So that is a base case, and we have an upside case of 7,000. So
Okay,
I
that's
would
different.
argue that you look at it more as a range at this point in time. But listen, it's just that the market has been moving ahead. So we moved our price target in early September, right? And so already the market has moved ahead. So, we remain cautiously optimistic. Actually, looking into next year, we are more optimistic. We expect earnings to increase, double digits, 10 to 11%. So I think, and the earnings season right now is extremely robust. I mean, this has surprised even us to the upside. We were more optimistic, but this is building momentum.
Companies doing?
So I think one is, if you look at the tech companies specifically, they're already monetizing AI to a decent extent, and that is showing up in their overall profitability. So they're laying off people, and yet they're highly profitable, and they're still spending. So that's one part of it. AI, of course, is being tested and adopted to varying extents. Still, enterprise usage is quite low. But one of the interesting things we are noticing right now is operating leverage is improving to a broader cross-section of industries. In other words, companies are doing a better job at cost control relative to their sales growth. Now, that has been our fundamental concern, outside of tech especially, that there's been a problem, pressure on margins. So it doesn't mean it's good across the board. Some sectors are still having a tough time, for example, staples, discretionary. But overall, we have seen an improvement in cost control relative to sales growth. So more positive operating leverage in the system.
It sounds like you're kind of leading into the bull case. At what point do you just reject the base case and go with the bull case heading into year end?
Good question. So if you wait for 2 weeks, you'll know the answer.
So in other words, you might become the base case in 2 weeks. Okay.
So, the point is, we normally come up with our outlooks, sometime towards the second half of November, where we, update our numbers for this year, next year. So directionally, it's very evident that the U.S. is turning out to be strong. So especially when you compare U.S. to the rest of the world, which means Europe and APAC, the revisions are running better, the profitability is running better, the expectation of margins are better. And that's the reason why we traded a higher multiple than the rest of the world.
You've been traveling around a lot. I don't know how you made it back. Congratulations. But there is this sense that the dialogue has completely shifted from earlier this year, where it was sell America, go into Europe for the promise of growth, the actual spending of Germany. That's flipped. What was the environment like? What was the sentiment like?
Yeah, I would sense, I just came back from Europe, and so there's a certain layer of frustration over there because my trip earlier, I would say in early March, there's a lot of skepticism about US, about tech, about what multiples you pay for it, about AI more broadly speaking, and underlying that was enthusiasm about the fiscal spending expectation out of Germany, for example. So I think what many of them realize is that they were wrong. So they were right for about 2 months. So there's a level of frustration on that. There's also this fear of missing out. So the question of, do we jump in or not? So that's an overall question. But if you just look at the scale, like somebody was pointing out to me, German fiscal spending in Germany over the next 10 years is going to be in a few $100 billion. We're talking about $1.5 trillion in AI capex in the next few years. So the scale of what's happening over here is simply astounding. But I think some level of skepticism I sense in terms of the return on investment in AI, that is, I think, reasonable because nobody knows, which is a fact, as to what the true profitability will be. And that is important not in itself because the scale of spending is so massive that the market is effectively putting a 100% probability that this is going to be truly transformational, more so than the 4 other big tech cycles we've had since the mid-'80s, right? From the PCs to internet to mobile, they're in the middle of cloud, and we have AI. Now, that better play out because that's what the market is telling you is going to happen.
That's why people are so skeptical. I just heard from a Bloomberg subscriber directly. I can share the message with you. We know the enormous AI capital spend numbers, but what we don't know is the return on that capital. The market is discounting that the returns on the AI capex will be significantly superior to the tech companies' legacy returns. Is this really going to be the case? Is it durable? Feels like a stretch. Do you hear a lot of that kind of sentiment on the road?
Yeah, so I think I hear a lot of that, and I think the frustration, the difficulty is literally nobody, even if you talk to tech experts, have an idea about how to quantify the scale of productivity improvement. The other thing is, still a lot of it is coming from having a better cost base, right? In other words, being able to do more with less. But the real use case will also come in the top line itself, which is we're in the early stages. And like I said, enterprise usage is still in the early stages. So I think that skepticism is reasonably warranted. But what I do point out, and I think we have discussed it in the past, that big tech as a group who are doing most of the spending, their multiples have generally been easing over the last 2 to 3 years. So they are earning into the multiples, they're spending. But I think the big question now is also shifted into the funding landscape. So far, all the funding has come from organic cash flows. And in fact, the big tech companies are spending 50-50 on buybacks and on capital spending. But going forward, given the scale of spending, increasing the credit markets are going to be tapped to varying extent, public, private, asset-backed, and things like that. And so that's a question.
Is that good news for stocks?
Well, some amount of leverage being used by companies is actually optimal, right? So you're using a balance sheet efficiently. But it also means that the equity markets now have another source to take a cue from in terms of how risk is being priced, right? And where is risk clearing? And how does it compare to what we see in the equity markets? But if you look at the scale, I think as of now, we broadly estimate that in the tech area, AI related, there's been about, call it 160-odd billion, which has been raised in public and private markets. If you look at the market cap of big tech companies, I'm not even include Oracle in this, it's touching 21 trillion. So I think the scale is very modest, and many of these spenders are highly profitable. But as the scale of spending, so if you tell me that $1 trillion is going to be funded in credit markets, that's slightly a different story, right? And I think that's what people are asking.
Venu, it's always good to catch up. It's good to see you.
Thank you.
Thank you, sir. Venu Krishna there of Barclays. Coming up tomorrow, we'll catch up with Matt Miskin of Manulife John Hancock Investments, Rick Reeder of BlackRock on the program, Julie Beal of Kane Anderson Rudnick, and Sarah House of Wells Fargo from New York City this morning. Good morning to you all. That does it for us from New York City. You've been watching Bloomberg Surveillance.
Day 2 at the Nitto ATP Finals. Taylor Fritz silenced a home crowd with a dominant opening win over Lorenzo Musetti. The American hit 29 winners in the victory that was his first over the Italian in 3 years. Defending champion Yannick Sinner also clinched his first win after he took out Felix Auger-Aliassime in straight sets. After taking the opener 7-5, the Italian closing it out 6-1 in the second.
Morning, this is Bloomberg Daybreak Europe. I'm Tom McKenzie in London. These are the stories that set your agenda.
Taking you from the U.S. market's close to the overnight session in Asia, we'll walk you through what you need to know to kickstart Europe's trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in to Daybreak Europe, only on Bloomberg Television. Context changes everything.
We are in such an incredibly exciting moment with AI. It is really the most profound technology of our lifetimes, and I think it has the potential to help us rethink literally everything. The potential for economic impact, societal benefit is honestly boundless. When we think about the economic impact for Europe in particular, it's around a 1.2 trillion euro estimate of the productivity growth that can be unlocked. This platform shift that we are living through, I think, is going to create untold amounts of value for the world, but also for the businesses and for economies, which is why I'm incredibly optimistic in this moment for Europe, but also for the whole world.
How do you think about job losses or safety for some of the AI tools?
You know, I hear the anxiety, and I understand the anxiety about jobs. I think that we are certainly going to live through a massive transition about how people learn to work alongside these tools. I mean, the reality is I do think there'll be some number of jobs that are displaced. I think it is a smaller number maybe than some anticipate. We estimate it's around 7%. And I think what's important is that we have programs that help those 7% transition into new fields of work. I think what is more likely is that most of us are going to learn to work alongside these tools. So we estimate about 2/3 of us. If you think about the tasks you do in your daily life, when you look at every industry, there are administrative tasks that are happening everywhere, and that's what AI is most helpful in improving.
I'm Alex Rodriguez.
And I'm Jason Kelly.
And we're back with another season of The Deal.
With athletes and entrepreneurs who are changing the game on and off the field. Jerry Jones. Some good-looking trophies.
1 and 1 is 3 in sports, not 2. And it's because that 3 is imagination. That 3 is putting yourself in a way, having yourself hit the home run.
Erica Ayers-Badon.
I'm a high-energy board member. I'm very passionate. I have a lot of opinions.
Robin Arzone.
I want to light fires in people's lives, and that is still one of my core mandates for all of my businesses.
Justin Tuck.
I tell all of my friends that play in leagues now, make these relationships now while you're hot. Don't wait till you're your 12th year in and you're just hanging on.
Stay tuned. You won't want to miss it.
Bringing you up-to-the-minute geoeconomic news whenever and wherever it happens. I'm Vonnie Quinn in Sao Paulo, Brazil, and this is Bloomberg.
All right, we continue to be nervous on this Tuesday. 30 minutes until the start of the cash trade. I'm Matt Miller. Danny Berger is off. Bloomberg Open Interest starts right now. Coming out of the surprise move, SoftBank sells its entire stake in NVIDIA as Masayoshi Son tries to carve out his own foothold in AI. A weak outlook from CoreWeave as well, giving investors another reason to worry about the strength of the tech industry and these lofty AI valuations. And in the home stretch, the House gears up for a vote as the Senate passes a temporary funding bill to end the government shutdown. In terms of the stocks to watch this morning, obviously NVIDIA is front and center. The stake that SoftBank held was, at least to me, surprisingly small, less than $6 billion, so like 0.1% of this entire company. But Masayoshi Son maybe needs the money. He's got to fund some other AI investments. CoreWeave cut its forecast due to delays from external factors like third-party data center developers, and you can see CoreWeave shares getting punished more seriously, down more than 8% in the pre-market. And Intel lost its chief technology and AI officer to OpenAI. Right now, those shares down about 0.9%. I think it says a lot for the company that OpenAI wanted to steal from their ranks. So let's talk about the nervousness, though. BlackRock's Helen Jewell summed up what investors are feeling right now about the AI equity rally.
The valuations don't look crazy, but they do if there's nervousness on the growth story. And that's why I think the AI story, of which we do remain bullish, and we do think that there is a lot further to go, it is likely to be a volatile ride.
Joining us now is Bloomberg Tech co-host Caroline Hyde. And Caroline, a couple of reasons to make AI investors nervous. I mean, after all, if Masayoshi Son, who is a famed investor, really believed in the future of NVIDIA and thought that the value was cheap, he would have held his stake, right?
But then you, as you rightly pointed out, $5.8 billion versus almost $5 trillion market cap. A man, the CFO of SoftBank, trying to paint that, look, this money, this $5.8 billion, comes out of NVIDIA, but then is reinvested in all of the people who are going to continue to buy NVIDIA chips. Maybe that $5.8 billion is better spent elsewhere from NVIDIA's perspective, because that then suddenly escalates in terms of future supply chain. It is right. It adds to the narrative of nervousness. It adds to the narrative that maybe NVIDIA's run too far, too fast. But since they held held and bought back a stake in NVIDIA. Remember, SoftBank sold back in 2019, regretted it, slowly clawed back, had about a $3 billion stake at one point, and then that has gone up to $5.8 billion because of the sheer scale of market capitalization accretion that we've seen happen to NVIDIA. I think they were saying, it's the right time to sell, right time to deploy into maybe OpenAI and some other bets, and eventually that will probably serve NVIDIA pretty well. But I'm right, it just adds to some of those nervousnesses.
Well, and CoreWeave doesn't help,
Yes,
right?
no.
Cutting its forecast, regardless of the reason, is not something investors want to hear from a company like this.
And one that's still relatively new to the public markets, one that people are still trying to understand the business model of. And it's interesting, Mizuho's writing Jordan Klein today saying, look, this is why a lot of the people he speaks to are nervous about neoclouds, because CoreWeave's not the only one. You've got Nebius over in Europe. You've had plenty of others come into the space, but they're not really in charge of their entire destiny. They are deeply overexposed to supply chain headaches, to whether they can get access to the overall chips, whether they can get the data center builders to build the data centers on time, and this seems to be the issue there. It's good to see that they've managed to placate the overall purchaser of the data center, that they're still managing to hold on to that entire commitment of money being funneled their way, but it's not a good look. But these are some of the most read stories across the Bloomberg, day in, day out, when data centers aren't riding out on track and all the supply chain headaches, power being one of them.
And we still have many multi-billion-dollar deals in tech. You mentioned Nebius, although it missed its third quarter revenue. It got a $3 billion deal, right, with Meta, and Microsoft is investing $10 billion on a data center, in Portugal?
Exactly.
Because it's so much nicer there.
It's lovely in Portugal, pretty tech heavy, and they also can scurf, I know, all things to all health. But look, this is about the sovereign AI deployment as well, isn't it? This is about the fact that, yes, we can build in Texas, yes, in the US, we can continue to build out data centers, but Europe wants its skin in the game. We're seeing Asia wanting to build out as well. We need neoclouds worldwide, it feels like right now. But all of this still begs the question, are we seeing some sort of AI bubble? Some people are out there writing that this is silly media headlines, clickbait. Dare we do such a thing, Matt? But I think that at the moment there is just needing that vindication. NVIDIA's numbers are going to be so important to this. The earnings and what little bit of fundamentals we can grab hold of. So it's not great when a CoreWeave misses, for example.
I mean, we don't need any clickbait, or certainly you don't on Bloomberg Tech, with these stories really driving the market every day. And we're talking about billions and billions and billions of dollars in deals. Carolyn Hyde will be anchoring that program with Ed Ludlow at 11 o'clock. Definitely tune in for that, because they have an interview with the CEO of CoreWeave. That is, again, at 11 a.m. New York time, an interview you don't want to miss. It is likely to move the market. Back to earnings. Paramount Skydance issued its first earnings report. It boosted plans for cost-cutting measures, including an additional 1,600 layoffs to help achieve $3 billion in savings. Bloomberg Intelligence media analyst Geetha Ranganathan joins us now. Geetha, tell us what you thought about the earnings, the layoffs, and in an industry where we could see even more job cuts if M&A continues.
Yeah, thanks so much, Matt. I think it was a really solid earnings report, given that this was the first one after the deal closed. Yes, there was some messy things in the quarter, but overall, I think the management team seems really solid. They obviously laid out a really good plan in terms of content investments, in terms of a lot of technological investments, how to drive AI for recommendation algorithms. The direct-to-consumer or the streaming product is one where they anticipate a lot of different cost savings. But you're absolutely right. I mean, just with the Paramount Skydance merger itself, a lot of it is banking on synergies. A lot of it is banking on job cuts. Obviously, we will see more of that if they do actually make a bid that is accepted by the Warner Brothers Discovery management team. A lot of that, still remains to be seen. But yes, job cuts are part of, the whole cost savings process, and they took up their synergy targets pretty dramatically. But the good thing is they are going to reinvest a lot of that into the content, into the tech platforms. So that's the bit of the good news there.
I mean, I wonder about the Warner Brothers Discovery takeover bid and how regulators are going to see that in an industry that has already, been decimated in terms of jobs. Would it be more difficult if they know that David Ellison wants to pursue the same model there?
I think it will be easier because it is David Ellison. We know that the Ellisons are obviously very close friends of the current administration. They just navigated this whole complex regulatory and antitrust landscape closing the Skydance deal, even though that took much longer than initially anticipated. So I think, if anything, they are the best positioned to potentially close a deal with Warner Brothers Discovery. Yes, you're right in terms of the job cuts, but in terms of antitrust, concerns, I don't think that's a big worry for them at all.
All right, Geetha, thanks very much. Geetha Ranganathan there runs our media coverage at Bloomberg Intelligence. Let's turn, though, now to Washington, D.C. as the Senate passed a temporary funding measure to end the U.S. government shutdown. It will keep the government open through January 30th. For some funding vehicles, it'll go beyond until next September. The bill now heads to the House, where they will vote on it tomorrow. Bloomberg senior editor Mike Shepard joins us now. So, Mike, what do we know about what this funds and for how long, and how likely it is to get passed in the House?
Well, first, the question of whether it is going to pass. House Speaker Mike Johnson is assuring us of passage. He has said that he has locked up the Republican majority, and House conservatives, who can sometimes give their speaker a little bit of difficulty on sensitive votes, have indicated that they will support the measure as well. It has been embraced by President Donald Trump, who promises to sign it as soon as it hits his desk. The timing, though, is a little bit unclear, Matt, and that is mainly because the House has been out of session since late September. Lawmakers have to now make their way back to the Capitol, and of course the shutdown has made that so difficult with all of the disruption to air travel. So we'll have to watch how that impacts the timing of the vote tomorrow. And as you said, this will keep the government open until January 30th. Some agencies, and those include the Department of Agriculture, the Department of Veterans Affairs, the Food and Drug Administration, those will be funded all the way through the end of the fiscal year in September. But most of the other government's operations will only be funded until January 30th, and that tees us up for possibly another showdown over spending as soon as we hit the new year.
All right, Mike, thanks very much. Bloomberg's Michael Shepard there covering the end of the government shutdown for us. We'll keep you posted on anything that rolls across the ticker. Quick check on what's going on in terms of the pre-market headed into the bell right now. S&P futures down about 0.2%. NASDAQ futures off 0.5%. In terms of the individual movers on our radar, Microsoft, as I was just talking about with Caroline, will spend $10 billion on an AI data center along the Portuguese coast, one of its largest European investments this year. Rocket Lab earnings topped estimates and shares are higher despite a delay to the launch of its Neutron rocket to take on SpaceX in some regards. And the RealReal's turnaround efforts are taking shape. It boosted its outlook as the resale market continues to grow, as does its market cap. This company is now worth more than $1 billion. Coming up, CEOs are sounding remarkably upbeat about the economy this earnings season. We'll take a look behind the optimism next, as well as the incredible growth of the U.S. dollar. This is Bloomberg Open Interest.
Technology is embedded in every aspect of our lives.
And laying the foundation for the future.
From finance to defense, AI to entertainment.
And from the road to the stars. Bloomberg brings you the latest stories of the people and companies pushing the tech sector to new frontiers.
And the politics that shape global tech markets.
I'm Caroline Hyde in New York.
And I'm Ed Ludlow in San Francisco.
Watch Bloomberg Tech every weekday.
Only on Bloomberg Television.
Do you think the dollar will remain the only reserve currency in the world, and are you as comfortable with the dollar as it used to be?
The dollar has been, as you say, a reserve currency for about 80 years. Actually, if you wanted to go further back, you could say it's almost after World War I, when the US had lent money to Europe and the UK for ammunition and so on, and then they had to get paid back in dollars. And that's when the strength of the dollar really began. So it's 100 years, 80 years, 100 years of dollar strength. So much so that important commodities, gold, oil, are denominated in dollars. Dollars are part of the payment system. When countries talk to each other, they represent their GDP and various figures in dollars. I think undoing that will take a long, long time. And, 3% in foreign exchange terms is not that much.
Okay, so you think the dollar will stay as the reserve currency of the
Absolutely.
Bringing you up-to-the-minute political news whenever and wherever it happens. I'm Tyler Kendall in Washington, and this is Bloomberg.
Astonishing day for U.S. technology.
It's shaping the region's technology ecosystem.
Asia's biggest tech news and innovation.
Get to high interest now. Look at what's making headlines around the world. Blackstone's Kathleen McCarthy, who helped lead the firm's $320 billion real estate business, will leave the company after 15 years. She'll step down by year-end to pursue new opportunities. Her co-head will take over as sole leader of the business, which spans everything from apartments to data centers. In a statement, McCarthy called it an honor to lead the unit, and she's done it all at a remarkably young age. She's only 47 years old. Use of synthetic securitizations, deals that help them offload loan risk and free up capital. Volumes have been climbing 18% last year to $673 billion. Santander surpassed Barclays as the biggest user, while JP Morgan and Standard Chartered also expanded. Regulators are warning of systemic risks as the market, now topping $1 trillion since 2016, continues growing at a quick pace. And Morgan Stanley is adopting KKR-backed technology to make it easier for wealthy clients to invest in alternative funds. The bank's wealth platform has added software that uses blockchain to automate and speed up fund transactions, a process that's been long bogged down by manual paperwork. KKR, Apollo, and Franklin Templeton are among firms offering products through the system, which aims to cut the clunkiness of semi-liquid fund investing. Executives are sounding more upbeat on the U.S. economy. Bloomberg data shows mentions of an economic slowdown during conference calls are at their lowest level since 2007. The confidence comes despite the disruption to official economic data due to the government shutdown, or maybe because of it. Joining me now is Michael Ball, Bloomberg macro strategist. So, Michael, this is fascinating because at the same time we have consumers who are facing, at the bottom end, slower wage growth and sticky inflation. Why are CEOs so confident on the economy?
I think they went in with really dire outlooks because obviously the tariff uncertainty was max going into the quarter in a lot of ways. We didn't have the China deal done. We're still seeing some peripheral deals getting done. And they weren't sure how much of that cost increase was going to actually be and also how much they would be able to pass on. So now they have a better sense of their ability to defend margins, and margins have been doing well. It's obviously different by sector to sector. We've seen that in tech having the best performance followed by healthcare. But it wasn't as bad as feared, and that's a big relief. And now looking forward, we're going to get the benefits of the one big beautiful bill. We're also going to see an easier financial conditions from the Fed easing, but also just generally from the better market conditions. And all that is helping them get a better outlook for next year.
What are those benefits expected to be from the one big beautiful bill? I've heard Scott Bessent lately extolling the tax cuts again, but for example, on the auto loan interest deduction, it has to be only up to $10,000 a year, only if you make less than $100,000 a year. And, the average new car costs $50,000, which people, I'm guessing, who make less than that aren't buying a new car, and it has to be a new car, and it has to be built in the U.S. Like, there's so many stipulations that it doesn't seem to matter in the end.
And on the consumer side, to your point, exactly, I've seen very varying numbers for how much money is expected to go back into the pocket of the U.S. consumer. I think one thing that's helping is the CapEx deductions are really giving a lot of confidence to where spending and costs will be on that side of the balance sheet and income statement. So overall, you're right. The consumer may not actually see as much benefit as the administration is trying to boost up, but generally the CapEx side will be better supported, and that will help.
But it does seem that the best way for corporate CEOs to navigate this tariff issue, the hit to margins, is to lay off employees? Are we going to start seeing the labor market start to loosen up?
Yeah, I mean, that's the worry, right? And that's what this week was sort of trying to get through. ADP today was interesting in some sense, but last week was all about Challenger and Warren bringing up cuts. These are obviously imperfect measures, and the earnings calls themselves leaned into that, saying that basically AI was replacing sort of lower skilled workers already in pockets of the economy. On top of that, when we look at NFIB today, when we look at Beige Book, this is all echoing that this no hire, no fire is sort of transitioning now into somewhat of a layoff concern. And that's why we've had the jitters in markets. Obviously, this valuation concern was on the forefront, but that alone is never enough. So I think it was this growth scare and the Fed itself pivoting to a more hawkish stance right as that was occurring that got sort of the risk sentiment to come off.
Let's talk for a moment about the dollar, because I know Joe in our control room has got a long-term chart. And, you know, when you talk about things being less bad than we may have expected, the doom and gloom that we heard on the U.S. dollar was so severe this year that this looks shockingly sanguine to me, right? We haven't really had the dollar devalue or dollar debasement relative to other currencies that we may have expected.
Right, and again, it's a couple things going on. One, it's other houses are not in order as well. We're seeing that in our major crosses, the UK, Europe, and Japan. Second, the Trump administration didn't come forth with all these capital account targeting things like sovereign wealth fund, the Mar-a-Lago Accord, all these things we thought was a purposeful devaluation by the administration, and why would you fight that? And that's what the buzz was in sort of the April time period when we not only had the tariffs to build credibility, but all these other things we're worried about in the backdrop. Remember, 899 section in the big budget bill came out, and that would have taxed holdings of treasuries. So it looks like the administration has stepped back from purposely devaluing the currency to basically promote our manufacturing base and our national security interests. So a lot of that has cooled, and that's a big part of this.
All right, that I think is absolutely fascinating and plays a big part in the markets. I mean, I'm looking at right now real U.S. underperformance, but especially for dollar investors. If you own the Euro Stoxx 50, you're up 31% year to date in dollar terms. If you own the IBEX in Madrid, you're up 57% in dollar terms.
Oh, even like on the periphery, like Poland's one of the best performing stock markets. It's wild. And the carry trade's back. People are borrowing in yen or borrowing in Swiss francs and basically putting it elsewhere. They're coming back into the U.S. We have low volatility across the FX spectrum, and it's allowing for people to basically look and hunt for the best returns on a sharp basis.
All right, Michael, thanks very much. Bloomberg's Michael Ball writes for the MLive blog. You can get his work on your terminal by typing MLIV. Go. In terms of futures right now, we're still looking at red on the screen, about 0.2% down on S&P futures, NASDAQ futures down a little more because obviously these jitters, this nervousness continues around AI investment. Coming up, Joanne Feeney warns that the bottom percentile of consumers have seen slower wage increases while inflation remains sticky. But can AI investment and the increased productivity from that make up for it? Stay with us for the answer. This is Bloomberg Open Interest.
I'm David Weston. Join me each week on Wall Street Week for stories of capitalism from business, markets, economics, tech, and climate. We go on the road for a look at what lies behind the headlines of today and what will likely be the headlines tomorrow.
We need more transparency.
Oil and gas is still important.
They said every citizen should be investing in the market.
Accelerate progress in all fields of science.
Watch Wall Street Week right here on Bloomberg. More than what you need to know, it's what you need to think about.
It's a multi-trillion-dollar industry. We'll show you what's happening in ETFs like no one else. ETF IQ, only on Bloomberg.
What is going to be the consequence for U.S. markets? We are basically deep in the European earnings season.
Take a look at how we're faring when it comes to Asian markets.
The Middle East and Africa regions are home to some of the biggest deals and fastest growth in the world. Vibrant resources and high-yield investment opportunities abound. I'm Jumana Versace. Join me on Bloomberg Horizon's Middle East and Africa for the stories, newsmakers, and insights shaping the decisions of traders across this exciting region.
You had heightened levels of volatility.
There's still room to maneuver.
We do see opportunities. It allows you to increase significantly your net income.
Every trading day, only on Bloomberg.
Good morning. This is Bloomberg Surveillance.
Welcome back to the opening trade. Watch Bloomberg Tech.
This is the Asia Trade.
This is Wall Street Week.
Welcome to Balance of Power.
This is Bloomberg Television.
Concerns around AI firms investing in one another as the sign of a bubble may be overblown. Advisors Capital partner and portfolio manager Joanne Feeney says these circular deals are another form of vertical integration. Through these deals, we have separate chip networking software and IT web-scale services companies behaving as a single entity. The separation is a better solution, allowing investors to choose to weight each source of risk differently by mixing and matching ownership stakes. And Joanne joins us now. Joanne, it's an interesting perspective, and we've got this chart that shows all of the circular deals, and you can easily imagine that it's just one company, investing budget in each of its units. But where does the revenue come from, if not for the hyperscalers putting money into the chip stocks, putting money into software? I mean, don't they need each other for revenue?
Yeah, that's exactly it, Matt. They do need each other for revenue, and that's why we're seeing companies like NVIDIA invest in the companies that are building the infrastructure, which ultimately leads to the applications. And it's those end applications that we're all sort of on tenterhooks waiting to see. We're seeing some of it. Some of the industrial companies have been out saying how they're using AI. Some of the financial companies have been out saying how they've been gaining from the application of AI within their firms and for their customers. So I think that's why investors are nervous, though. It's really, when are we going to see more revenue from the applications? And I think that's going to be pretty hard to measure. But this, set of circular deals is sort of an indirect way of vertically integrating from the applications providers to the data center builders to the chip providers. If they were all one company, we wouldn't be so worried about a company investing in its own development for new applications. So it's not a bubble in our view. It is simply a step in the progress of building this new capability that we are starting to see deployed into applications.
What if one of the links of this chain is weak? I mean, for example, what if consumers and institutions decide to use Gemini or Claude or any other AI chatbot than OpenAI, which seems to be assumed as the leader and winner already?
Yeah, I actually think that they're not assuming OpenAI is going to be the winner. I think what these companies are recognizing is that it's a race, and they're trying to enable their best prospects, like for NVIDIA, to sell chips into whoever is going to be the winner. And so, funding the expansion of AI is a way to be diversified and so to be exposed to whomever becomes the winner. They already know that, Google, Microsoft, Amazon are buying their chips and are in the race. And they just want to make sure they're exposed to all the potential winners.
All right, Joanne, you're going to stick with us. We have a lot more to talk about ahead of this, or after, I should say, this market open. That happens next with the opening bell, one of which we'll see being rung from the Intrepid. As it is Veterans Day, we're seeing futures lower right now. This is Bloomberg.
When I visited Fernandez at IMAX's headquarters outside Toronto, we went to the facility where IMAX designs and maintains its cameras. The latest next-gen equipment was out with directors on filmed for IMAX sets, but there was still plenty of cool gear on view.
As the head of the finance department, do you look at all the things in this room and think, this costs that amount of money, this costs that amount of money?
Thankfully, no, I don't. When I think about cameras in general and what we, when we first, I'll give you a really prime example, the film cameras. When you thought about it, okay, are we building 2? Are we building 4? Are you building 8, right? And that's where I start to think about, well, what makes the most sense from a return perspective? Because yes, Nolan wants the cameras, but how many other filmmakers out there use the film cameras? The lens that I look at it through is essentially, how many do we build and in what way? Because the one thing is we are going to invest to build it right and to build it for longevity. But do you need 10 of them? No. Building 4, that was the right number. And do we potentially want to build a couple more? Maybe a couple more, but I don't think we need 10 because they won't always be in use all the time.
I imagine that at different points you need to tell people no. What's that process like for you?
Oh yeah, it's a key role in the CFO position. It is a word that most people are used to, and yet they still think you're not going to say it.
We're at the epicenter of a global realignment on a scale not seen for decades. At the intersection between markets, economics, and geopolitics, a forum for sophisticated conversation. This is Bloomberg Surveillance.
Bringing you up-to-the-minute economic news whenever and wherever it happens. I'm Francine Lacqua in Sintra, Portugal, and this is Bloomberg.
Moments away from the start of trading on this Tuesday. This is Bloomberg Open Interest. I'm Matt Miller. We are looking at drops in futures, about 0.2% on S&P futures, a little bit more on NASDAQ futures, as SoftBank sells out its entire stake in NVIDIA. I say entire, it's a very small stake. I mean, $5.8 billion to you and me is probably a lot of money. To Masayoshi Son, to SoftBank, it's a lot less money. And to NVIDIA, it's far less, about 0.1% of that company. Nonetheless, it has rocked investors, or given them jitters, maybe is a better way to put it. Alto Neuroscience is a company that actually has tripled in value year to date. It's up 201%, but if you've owned it for 5 years, you're still underwater. It's off by a fifth. Down at the USS Intrepid, you've got senators there to ring the opening bell for the NASDAQ, as well as servicemen to honor veterans on this Veterans Day. Remember, the bond market is closed today, but the New York Stock Exchange is trading. In terms of stocks to watch, let's take a look at what's going on here. NVIDIA is down 2.2% right now in the cash trade, so that shows a little bit of a lack of confidence, probably more than the selling of that stake is worth in the company, far more. CoreWeave is down 8.5%. So another knock to confidence is that CoreWeave cut its outlook, and this is one of the darlings of the AI build-out, one of the cloud service providers. And then Intel down 1.2%. Intel lost its chief technology officer and its chief AI officer to OpenAI. So across the board in big tech, you've got drops. Let's bring back in Advisors Capital Partner and Portfolio Manager Joanne Feeney. Joanne, would you say, I mean, if you're bullish on this sector, is this a buying opportunity for these companies?
Well, selectively, Matt. We do like NVIDIA here, and we do think it's a core, should be a core holding for investors who have a sufficiently long time horizon, because it's likely to be volatile. You get news out of CoreWeave like that, quarter to quarter, they're likely to see some volatility. We know that it's awfully hard to maintain a steady pace of a build out and even to sell those application possibilities. So volatility is going to be the name of this game for a while. But we do see a pretty resilient build out on its way. It's been happening for a number of years now. We think it's going to happen for some years more. And, I think what we're seeing in SoftBank is a pivot towards being positioned to develop and sell those applications. So in some ways, that's a very positive move in the market because it's ultimately the applications that are going to prove the value of all this construction.
We see this rally in stocks all year, and maybe the last couple of years too, in part because of the huge CapEx spend here. The funding of this build-out is expected to drive growth in the U.S. economy. Is it enough to make up for the loss of consumer spending at the lower end? Because we've also seen income inequality exacerbated to a level some say we've never seen before.
Yeah, that certainly is an issue for the broader economy. And we're seeing that in the wage data, the data that we do have, showing that the lowest percentile of earners have seen a pretty sharp slowdown in their wage growth. It's still keeping ahead of the measures of inflation that we have, but clearly their spending power is being constrained, and we're seeing that in some of the lower-end retail shops who are suffering from reduced spending at their places. But clearly the CapEx spend is elevating not just the technology sector, but also we're seeing it in utilities, we're seeing it in industrial service providers who are helping build those data centers. So it's having a pretty broad effect on the economy on that side of things, even as some of the lower-end consumer households are really suffering here from past inflation and from potentially more limited job opportunities.
Does that continue? Inflation at 3% or more as the Fed cuts rates. Are you concerned that they boost inflation with these rate cuts?
Yeah, I mean, I think the concern, Matt, is that tariffs are going to boost inflation, and we've only seen some of the pass-through of tariffs to final prices, right? Firms have been absorbing a fair bit of it. They've been trying to rework their supply chains. Ultimately, does more of the tariff impact get passed through to consumers? And then, we'll see that in the broader price indices. It seems likely that that's going to happen. We have to see, obviously, how the SCOTUS decision comes out with regards to the legality of those tariffs. We may see a broad change in that structure. But clearly the consumers are under pressure, and that's why we tend to like some of the more sort of high-end consumer retail plays like a Williams-Sonoma. And back to the AI build out, we like some of the peripheral plays into AI, whether it's in the energy sector or industrials. There seems like there are an awful lot of opportunities out there. Companies that pay dividends, by the way, which can help investors ride out this volatility. Something we build into our balance strategy to create a more conservative approach to this market.
Joanne, we saw the sell-off last week was driven by these tech jitters, this lack of confidence. But now the gains that we saw in yesterday's market were said to be because of the government shutdown coming to an end. So maybe investors did care about the government shutdown. If you had a crystal ball and could see that the Supreme Court decided against the legality of these tariffs using IEEPA, wouldn't you want to be short this market?
If they rule against the use of the tariffs,
the use of IEEPA to put tariffs in place, I mean, doesn't that cause at least short-term chaos?
Yeah, chaos is a good word, but think about the direction of that uncertainty, right? We have these high levels of tariffs now across countries. If SCOTUS rules against the legality of those for whatever reason, then presumably tariffs have only one direction in which to go, which is lower, which would be a positive for a lot of firms and small businesses. And we would expect to see their profit margins rise. Now, we know that there are a lot of deals already in place that are unlikely to be around, and we also know the administration has other tools for imposing tariffs, but those would take a long time. What it is sure to do is to create more uncertainty, Matt, which I think is kind of your question, and we've seen that uncertainty can delay things like factory expansion, hiring, and other things. So that would not be a good thing, but putting more money in the pockets of households would be a positive, and putting less pressure on profit margins for firms would also be a positive.
Yeah, it is an interesting thought experiment, but nothing more than that, because obviously neither of us knows, none of us knows what's going to happen. With regards to something that's maybe a little bit more predictable, and that is earnings, how confident are you that we continue at this pace of growth, or do we slow in 2026?
That is the question. What we've seen for the third quarter of companies reported so far is 13% year-over-year earnings growth, and that's up from the expected 7.9% before companies started reporting. So we've seen a lot better earnings than expected. We probably shouldn't expect that pace of earnings growth to keep up. We've had a massive surge in spending this past year on those data centers. We should expect that to slow down, but put valuations in context. You look at NVIDIA, people have been concerned it's too expensive. You know, they're trading at like 34 times. The market's trading at 23 times earnings. But NVIDIA's earnings are growing at 3 times the market. And it's only 150, you know, it's only 50% more expensive. So that makes NVIDIA look like a value. So I think people are a little bit over-concerned about the valuations in this group of fast-growing companies. The real risk, to your point, Matt, is what are earnings going to do in the future? We do expect a slowdown. It's only natural as the build-out sort of continues, and it's going to go at a slower pace. But right now, we see valuations in this group as being pretty well justified.
All right, Joanne, thanks very much for your time. Really appreciate it. Advisors Capital's Joanne Feeney there on a broad-ranging conversation. Let's get a check on the market right now. We are looking at a drop in the cash trade, although it's pretty slight. You can see 0.2%. We're down not even 13 points here. This is the move screen, so you can see the breadth is more to the upside. 323 gainers and only 173 fallers. Of course, the big problem isn't on the gaining side of the ledger, but on the loser side, NVIDIA, which is almost a $5 trillion company right now, losing 2.25%. That takes off all 12 points by itself because SoftBank sold its $5.8 billion stake. You can see Microsoft down today with a $10 billion investment in Portugal. Meta is down today with a $3 billion investment in CoreWeave, I believe. So a number, or sorry, the other Nebius, the other, what do they call it? A neurocloud, a new cloud, neocloud services, data center. Well, they offer solutions, obviously, for AI. Coming up, SoftBank sold all of its teensy-weensy little stake in NVIDIA, worth only 0.1% of the world's largest chip maker. But it could be a sign that Masayoshi Son has lost the faith. Or perhaps he just needed the money. We'll talk about that with Ed Ludlow next. This is Bloomberg Open Interest.
Climate change is going down right now. It's going down. And we've tried everything to shame people and blame people and put them in their place and tell them that they're doing things wrong and that they're killing everybody. But if we keep telling them that, then we are going to kill everybody. So we got to figure this out. And we're not going to do it by blaming people who are just trying to wake up and make ends meet every day, especially when a lot of those people have the same connection to nature and the environment that we all share here. I hike and I ski and I love the environment just as much as anybody else, but so does somebody who works in an oil field. The Cabela's shopper and the REI shopper want the same things. They want clean air and they want clean water and they want to be able to recreate outdoors. So until we figure out how to get on the same page, we will continue to lose. We cannot afford to lose anymore. We need to build a winning coalition of people across the political spectrum, or we will never create the solutions that we need.
It's the world's second largest economy with a growing influence in global affairs. Bloomberg The China Show brings you the unmatched expertise you need to keep track of breaking news, in-depth market analysis, and the most influential newsmakers in and around China.
We need to do more to engage the market more. We're risk on. I think we caught a little sweet spot.
Massive savings right now.
It's already a different game.
Bloomberg The China Show. Weekdays around the world, right here on Bloomberg. Context changes everything.
Bringing you up-to-the-minute global economic news whenever and wherever it happens. I'm Lizzie Burden in Florence, Italy, and this is Bloomberg.
From the world of politics to the world of business, Joe Matthew and Kaylee Lines deliver news, insight, and analysis live 2 times a day, every trading day. Balance of Power at 1 and 5 Eastern, only on Bloomberg.
We're coming to you live from Kuala Lumpur. The whole world
world is here. The APEC Leaders Summit bringing together heads of states of 21 APEC economies.
The White House is trying to use the stops to gain additional leverage.
This big deal with a number of the biggest companies in South Korea.
That's a big number.
Deals can be done.
Trust Bloomberg for on-the-ground coverage.
Korea is not Japan.
Up-to-the-minute reporting.
In this latest salvo of this trade war.
What a visual.
And the analysis you need.
China's not going anywhere, nor are we.
Quick check on stocks right now. We are looking at drops here. You can see very little change in the last 20 minutes of trading. The last 15 minutes of trading right now. The S&P still down 0.2%. The NASDAQ down a little bit less than 0.5% on concern that maybe some of these AI high flyers are overvalued. Time now for our top calls, some of the analyst action that's in focus this morning. And JP Morgan is up first with an upgrade to the satellite communications company Viasat to a buy, saying a separation of its defense and advanced tech units looks more and more likely, and so they're in for that. Viasat today up 4.5%. Next up is Instacart getting upgraded at BMO. The firm cites strong customer loyalty and rising order frequency. The analyst calls the company's outlook conservative and says shares trade at an appealing discount. You can see Instacart up 3.8%, 3.9% on that call. And finally, JP Morgan is cutting it trading on CoreWeave after the cloud computing firm said a data center delay will weigh on fourth quarter results. Barclays says the delay adds to poor optics in an already nervous market. So a number of analysts weighing in on this move. CoreWeave shares getting decimated today, down 10.5%. On top of CoreWeave, we're also keeping an eye on NVIDIA after SoftBank unloaded its entire stake in the world's most valuable company. Bloomberg Tech co-host Ed Ludlow joins me now from San Francisco. And Ed, you know, this is such a fascinating story. It could be read either way. Maybe Masayoshi Son thinks NVIDIA is fully valued, or maybe he just needs the money. Either way, it's not a very big stake, certainly not 2.5% of NVIDIA.
Right. The SoftBank narrative on it is that it's just purely financing, that they want to take the proceeds and use it to finance either their M&A strategy or the funding of the Vision Fund too. You know, NVIDIA is down, what now, 2.5% in the session, and that's having an impact on markets, but it did gain almost 6% in yesterday's session, which put it on track for its biggest jump since April. It's also not unprecedented. SoftBank has sold out of a full NVIDIA position before. They did it in 2019, but then they changed strategy again in 2020 and built it up. And the paper gains that they've realized 2020 until about March of this year, significant anyway. So the way that the street's reading this is very much a SoftBank thing, not some kind of doubt about NVIDIA or NVIDIA's place in the AI build-out.
It's a great point. Even with today's drop, NVIDIA is still worth more than its closing price on Friday because of the huge jump to almost $200 a share yesterday. Nonetheless, there continues to be concern about the sort of cyclical nature. We've been using that term, I guess, for the last 4 or 5 weeks at least, ever since that fantastic chart was created by Bloomberg News, of these companies' relationships with one another. And specifically with regards to OpenAI, they have to spend over $1 trillion, according to Sam Altman's plan, and they don't have anywhere near that kind of revenue. What are these companies saying with regards to how they're going to make the money to do this investment?
Yeah, I mean, to be fair to us, every time we've had an interview with NVIDIA or AMD, for example, we've asked the question, are OpenAI good for it? Because that's who is putting forward the capital commitments. We've not really had that answer. NVIDIA's position on the chart that you've just shown is that when it makes an investment in kind into OpenAI, an equity investment or chips in lieu of cash, they are not making any of that flow of capital to OpenAI a quid pro quo. OpenAI is not required to use NVIDIA chips. They could take capital from NVIDIA and use it on AMD chips if they wanted to. I think the bigger issue right now, if you want to kind of extend this to the CoreWeave story, is that all of the commits are there on paper. OpenAI says, we're going to do this. NVIDIA says, no problem, here are all the chips that you need. But the other parts are still missing. So in CoreWeave's case, a third-party data center builder has let them down. and they therefore are not going to book revenue that they had previously guided to. The energy side of it, I think, Joe Amfini was just talking about utilities, right, in the previous segment with you. There is a lot of concern you can't print electricity, and that we don't actually in the real world see the electricity availability to match the on-paper commits to build data center infrastructure. That's what's happening in the market right now.
Yeah, it's got to be the biggest concern that investors don't talk about as much, right? The fact that there just isn't the energy there. And CoreWeave has had an incredible run-up. It's at least doubled since they went public earlier this year. So, and it's been one of the sort of darlings of the neo-cloud market. What does this? What do you expect to hear from the CEO? Because I know you're going to interview him in just about an hour's time.
So CoreWeave cut its revenue forecast for fiscal 25 to a range of $5.05 to $5.15 billion. It had previously been $5.35 billion at the high end. And what they were saying is that they're not able to meet a contract for a specific unnamed customer because a third-party data center builder let them down. Now, in the end, I'm just doing the math. That impact is less than $200 million, and the stock's down almost 11%. So the questions that a lot of the street have for CoreWeave are just like operational. Like, how can you control any of this? You keep telling us that you're supply constrained, that the demand from your customers is greater than your ability to provide the compute. But again, go back to the electricity portion or just the physical infrastructure portion. CoreWeave is a little bit at the whim of those that it partners with to build the capacity. And it's a very reasonable question to ask, like, how in the future are you going to prevent this happening again, where a third party lets you down? Because they keep telling us that in the future, that backlog or that demand for compute is going to double. So if it doubles in the future, are you doubly in trouble because you aren't able to get the concrete and the tin can data center up quick enough?
All right, Ed, great to get some time with you. Really looking forward to your interview. We'll all be tuned in at 11 o'clock. Bloomberg Tech co-host Ed Ludlow has an interview with the CEO of CoreWeave today at 11 a.m. New York time. And suffice to say, this is one of the two main companies in the spotlight when you talk about the market jitters that we're looking at today. Coming up, Warren Buffett says he's going quiet. We'll look at what that means from the Oracle of Omaha next. This is Bloomberg Open Interest.
Join me each week on Wall Street Week for stories of capitalism from business, markets, economics, tech, and climate. More than what you need to know, it's what you need to think about.
Key investors, top executives, global innovators. Join me for in-depth conversations with the biggest newsmakers on the day's top stories. Insight with Haslinda Amin, only on Bloomberg.
Tune in to Bloomberg Business Week Daily.
We got to talk crypto.
From the magazine that helps global leaders stay ahead.
What's the conversation around your company?
Bringing you insight on the people, companies, and trends shaping today's complex economy.
Planning very big things.
A new level of premium.
Plus global business, finance, and tech news as it happens.
The floodgates of innovation are going to open up.
You can't fake passion. You either are or you aren't.
Bloomberg Business Week Daily, only on Bloomberg.
Up-to-the-minute news whenever and wherever it happens. I'm Haslinda Amin in Bangkok. This is Bloomberg.
This is Bloomberg Open Interest. I'm Matt Miller. Let's get a quick check on stocks. Almost 25 minutes into the session right now. We are looking at losses, but they're pretty consistent in the first part of the trading day. S&P 500 down about 0.2%. NASDAQ down about 0.5%. The concern is the story that SoftBank has sold its entire stake in NVIDIA. It turns out to be a very small stake, maybe even smaller than you would have imagined, only worth $5.8 billion, so 0.1% of NVIDIA. Nonetheless, investors are asking questions about AI because of that and because of CoreWeave cutting its outlook. You can see NVIDIA down about 3% and change, so a drop that's accelerating, and then CoreWeave down more than 10%, right now about 12%. A reminder, Ed Ludlow is going to speak with the CEO of CoreWeave at the top of Bloomberg Tech at 11. We see Rocket Lab gaining. This company has had to delay its little tiny rockets, but nonetheless, its earnings are good and investors have faith. It's up 5.7%. Core Scientific down about 10%. These are some of the bigger movers. The Real is getting a huge boost with strong earnings. It's worth $1.3 billion, or it was before this gain. Now it's worth 25% more. And then Berkshire Hathaway. It's unchanged, but I put this here because we had news yesterday about Warren Buffett, and we're joined now by Alex Rajbandari. He covers Buffett, he covers Berkshire for Bloomberg News. And Alex, Warren Buffett says he's going quiet with regards to the amount of writing he does for Berkshire Hathaway, with regards to the amount of speaking he does for Berkshire Hathaway, because he's obviously still very busy there. But what should we expect now from him going forward?
So he said he's no longer going to write the annual report, which was, a must-read for all Berkshire fans, full of witticisms and investment advice and pearls of wisdoms. He's also not going to speak at the annual meeting in Omaha in May. That is a big change because he was speaking for more than 4 hours and entertaining and taking questions from shareholders. However, he's
95 years old, we should point out. Yeah. So any kind of 4-hour speaking engagement for a 95-year-old must be difficult.
Yes, definitely. And it makes sense that he kind of gives that off to Abel going forward, who's going to be CEO next year.
Now, he is going to do a couple things, right? I think he's going to write still his Thanksgiving missive, and he's still going to the office every day.
He's going every day, 5 days a week in the office, looking at opportunities that come up. He speaks about that in his letter. And yeah, we're going to have more letters about that. These are the letters where he details all the donations to the 4 foundations of his late wife and children. That's going to happen in the years going forward.
He's done what, $1.3 billion?
$1.3 billion. He wants to this year, and he wants to step up the pace of donations to his children because they are in their 60s and 70s. So he wants to make sure that they have his whole estate before he passes away. However, he cautioned that he will keep a significant amount of Class A shares to make sure that shareholders are still comfortable with Abel as much as they were with Buffett and Munger.
Now, he still has an absolute ton of money, right? $150 billion, according to the Rich Go function on the Bloomberg. He wants to give away all of this by the time he dies or on his death.
That was his pledge, and then his children are going to take care of this and make donations. And he says that they are fully grown now into philanthropic people, and they can take care of this in a useful way for the society.
Alex, great to get you on the program. Great reporting on this. Alex Rajbandari covers Warren Buffett and Berkshire Hathaway for us at Bloomberg News. Coming up the next hour, Crossmark's Victoria Fernandez says the bullish narrative for equities is alive, but is it well? Then DWS Group, America's CEO, and taking advantage of a new American desire for European assets, and Tim Draper's AI clone joins us, or maybe he joins us. This is Bloomberg.
supply chain sustainability efforts have produced a breakthrough. The tugboat Sakigake is the world's first ammonia-powered vessel in commercial use.
LNG can decrease emission of the carbon dioxide compared with the heavy fuel oil, the 25% more or less. But ammonia, 95% decrease can be achieved.
According to Bloomberg NEF, ships powered by LNG and other alternative fuels make up nearly 40% of the global shipping order book.
This is funded by the NEDO, so-called Japanese agency. And also the NEDO has the kind of the GI funds and the Green Innovation Funds. And also the Japanese government is supporting the usage of the ammonia as the power-generating fuel.
It's more expensive than normal standard fuel.
Yes, it is. And at this moment, the supply of the ammonia volume is very much limited compared with the LNG and also the heavy fuel oil. But in order to promote ammonia as a marine fuel, together with the other industry players, and we can have the kind of the mass production, then the cost will be decreased. Then the next 10 years, we try to increase the number of the vessels powered by the ammonia.
Making money isn't about drowning in emotions. It's about understanding what's actually happening. Markets are the best way to glean signal from noise, and that is what we try to do every morning. This is Bloomberg Surveillance.
Bringing you up-to-the-minute geopolitical news whenever and wherever it happens. I'm Stephen Engel at Japan's Akasaka Palace in Tokyo, and this is Bloomberg.
News on the Hour, sponsored by Progressive Insurance.
I'm Deborah Rodriguez. The Senate has passed a bill to end the government shutdown. Next up, the House.
8 Democrats crossed the aisle last night to approve the Senate plan, which does not include the health care tax credit extensions Democrats had been holding out for. Vermont Independent Senator Bernie Sanders.
What the fight was about was health care. It was a loss.
The bill funds the government through January and reverses the layoffs enacted during the shutdown. Maine Republican Senator Susan Collins.
I think this is a great victory for the American people.
Michael Wallace, CBS News.
The House could hold a vote on the bill as soon as tomorrow. There are more than 2,100 flight delays and cancellations in the U.S. so far today. Debbie Moydell and her husband slept at the airport in Dallas, then took a flight to Houston just to get to Tulsa.
Glad we're already here because I think it's getting really bad, getting a lot worse. And we're thankful that we made it and my luggage all showed up.
Correspondent Chris Van Cleve.
Last night we counted at least 18 FAA facilities reporting staffing shortfalls, so the staffing woes continue.
Amid all that chaos, 18 people were injured yesterday when a vehicle carrying passengers from one terminal to another at Dulles Airport near Washington crashed as it was docking. None of the injuries life-threatening. The president will honor former military members this Veterans Day.
President Trump's expected at Arlington National Cemetery in Virginia, where he'll lay the traditional wreath at the Tomb of the Unknown and make remarks. While big annual observances like that one are going on as planned, many others are not. Due to the government shutdown, several events across the country have been disrupted because of a lack of federal employees, access to military facilities.
The ceremony at Arlington gets underway next hour. Some former military members have gone to court. Here's CBS's Jim Krasula.
Several transgender former service members, some of whom served up to 18 years in the U.S. Air Force, are suing the military for depriving them of their retirement benefits. The lawsuit alleges the Air Force promised them pensions as they were forced out of the military, only to rescind the offer.
The end is in sight for a soccer superstar.
Suddenly red shirts flooding back. Chance for Cristiano Ronaldo!
40-year-old Portuguese forward says next year's FIFA World Cup will definitely be his last. He tells CNN he's been in the game for 25 years, did everything, owns major records, and he's enjoying the moment. Ronaldo has scored 143 international goals. He's the first ever male player to score at 5 World Cups. This is CBS News. First the Louvre, now a museum in the Middle East.
Officials in Damascus say thieves have broken into Syria's National Museum and stolen ancient statues dating back to the Roman era. The museum reopened in January in the aftermath of the country's 14-year civil war and the fall of the Assad regime. The theft was discovered Monday morning. 6 marble statues now missing. An investigation is underway. Vicki Barker, CBS News, London.
Syria's new leader met with President Trump at the White House yesterday. ByHeart has just broadened its voluntary baby formula recall. The company says it now includes all batches of its ByHeart whole nutrition cans and Anywhere pack across the country. The FDA says some tested positive for Clostridium botulinum spores, but ByHeart says no opened can was affected. Deborah Rodriguez, CBS News.
This is Bloomberg Intelligence with Scarlett Fu and Paul Sweeney.
How do you think the Fed is looking at tariffs, the uncertainty of tariffs?
Let's take a look at the sectors and how they perform.
A lot of investors getting whipsawed every day by news events.
Breaking market headlines and corporate news from across the globe.
Could we see a market disruption, a market event?
Are people just too exuberant out there?
You see some so-called low-quality stocks driving this short-term rally.
Bloomberg Intelligence with Scarlett Fu and Paul Sweeney on Bloomberg Radio, YouTube, and Bloomberg Originals.
Good Tuesday morning from the Bloomberg Interactive Broker Studio in New York City to our worldwide audience. We're streaming live on YouTube. Head over to youtube.com and search Bloomberg Podcast. That's where you'll find us. Coming up, we're going to take a look at what's happening in the world of technology. Ed Ludlow, BTech co-anchor. We got a lot of stories out there in BTech, namely that SoftBank selling its NVIDIA stake for $5.8 billion. What does that mean for the space, and what are they going to do with the money? George Ferguson, Bloomberg Intelligence Senior Aerospace, Defense, and Airlines Analyst, is going to talk to us about what we're going to do here with the U.S. airlines and maybe getting this government reopen here when we get back to normal, so to speak, on the airline business. Henrietta Trey's Managing Partner and Director of Economic Policy at Beta Partners. She's our go-to person on what's happening down there in D.C. Maybe she can give us some color on when this government can get reopened. So we got a lot coming up in the next couple hours. We've got earnings. We've got the government reopening. We don't have economic data. Presumably, that'll start flowing next week. Right now, let's kick this whole thing off with Lisa Mateo in a Bloomberg Business Flash.
You got it in this Bloomberg Business Flash, brought to you by Commonwealth, supporting more than 2,000 independent financial advisors with a 2-to-1 advisor-to-staff ratio. Small firm attentiveness, big advisor impact. Go to commonwealth.com to learn more about the consultative support and technology. All right, well, we've got a mixed look on the screen. This is after some private eco data. We had that report from ADP. It showed U.S. companies shed 11,250 jobs per week on average in the 4 weeks that ended October 25th. Also, sentiment among U.S. small businesses that eased in October to a 6-month low. Traders backing away from those high-priced tech companies. That's after SoftBank sold its entire NVIDIA stake, and CoreWeave, they warned revenues will be lower than expected. So we look at NVIDIA shares, they're down more than 3%. CoreWeave is down about 12%. 0.5%. Over to the NASDAQ, down 0.6%, 145 points. We have the S&P 500 falling 0.3%, 20 points. And the Dow, that's up about 0.1% or 57 points. The bond market closed for the Veterans Day holiday. Moving on to commodities, we have gold and oil on the rise. COMEX gold up about 0.1% at $4,126 an ounce. Brent crude at $64 a barrel. To earnings we go. Shares of Paramount Skydance, they're up about 10%. The recently merged media company had raised its target for job cuts and cost-saving measures, so investors like the sound of that, and that's why those shares are higher. Beyond Meat, they're falling. Their shares down nearly 4%. That's after the company's fourth quarter net revenue forecast missed estimates. For on-demand news 24 hours a day, subscribe to Bloomberg News Now. Wherever you get your podcasts, I'm Lisa Mateo. That is your Bloomberg Business Flash. Scarlett and Paul.
All right, Lisa Mateo, thank you so much. We appreciate that. Scarlett Phil and Paul Sweeney. We're live here in our Bloomberg Interactive Broker Studio in New York City. We're streaming live on YouTube as well. Market Drivers today is brought to you by IBKR. Will the U.S. Fed funds target rate be set above 3.625% at the FOMC meeting ending December 10th, 2025? Well, at IBKR forecast trader, the yes was recently at 23%. Start predicting today at ibkr.com/forecast. Last trading day for this contract is December 10th. Got it red and green on the screen here. Let's take a look at some of the stocks on the move today. I'm Paul Sweeney alongside Scarlett Fu, and we're joined by Bloomberg's Christine Aquino. Christine, what are you looking at?
Well, Paul, let's start with the red today, shall we? That is NVIDIA, of course. It's been all over the news this morning. So ticker NVDA. Those shares are down more than 2%. So we know, right, that the headline is SoftBank selling its entire stake in NVIDIA to bankroll their own AI investments. Now, to put it into context, though, the stake is worth $5.8 billion. Wow. That's kind of a drop in the bucket, though. Like, for us normal folk, it's a lot of money. You know, like, I can retire off of that. But for these companies, it's not really that much, you know. And SoftBank saying that they do have a lot of projects they want to fund. There's target data centers, AI robot manufacturing sites. And so this is mainly a necessary financing measure. Very interesting, though, because their executives were asked, is this you trying to stave off an AI bubble, trying to prepare for that? But they kind of sidestepped the question. CFO Yoshimitsu Goto of SoftBank saying that they can't say whether we're in an AI bubble or not, but this measure is merely a financing step.
Right. If nothing else, it shows how much capital is needed to chase AI investments. Let's take a look at Paramount Skydance, which I initially typed in PARA, but realized that
it's changed.
It's changed. It's a new ticker, exactly.
It's a good ticker, though. P-Sky.
P-Sky. Yeah, it's very, it rolls off the tongue easily. But yes, Paramount Skydance, P-Sky, those shares are doing well this morning, up more than 11% now, so extending some of their opening gains there. And again, we saw their financial report results for the first time since a new investor group took over in August. The third quarter revenue missing a little bit, $6.7 billion versus analyst forecast for $6.87 billion. But the good news here really is the fact that they are raising their cost savings goal. It is now $3 billion. They're also planning an additional 1,600 person workforce reduction. And analysts also commenting on some of the areas that they're investing in. So Bloomberg Intelligence saying that they're really trying to ramp up their investment in content, which is going to be a good generator of future revenue. And JP Morgan also noting that their main priority at the moment is direct-to-consumer services. And that's really going to be important in driving engagement and higher quality growth. And so they're optimistic in the company's future prospects here.
And are they going to buy/merge with Warner Brothers Discovery? That's kind of the big question.
That's still a big question.
Unanswerable right now.
Yeah. Yes. Estee Lauder?
Yeah, let's take a look at Estee Lauder as well. So ticker EL. Those shares doing well today. They're up 0.6%, so slightly lower from their opening gains of nearly 1%. But they're still up because Argus raised their recommendation for the company to buy from hold. They also raised their EPS estimates for 2026 and 2027. And the strategist Argus saying that, their management has increased innovation significantly, and they're entering new channels. Amazon Premium Beauty, Sephora, and Ulta all kind of open for the company at the moment in terms of where they put their products. We did get results from Estee Lauder not too long ago at the end of October. Those beat expectations, but the Asia Pacific net sales missed estimates. And so now investors are going to be looking forward to their annual meeting, which is coming up on Thursday.
All right, Christine, thanks so much. Appreciate that. Christine Aquino, Managing Editor for Markets Live, joining us live here in our Bloomberg Interactive Broker Studio. And for more conversations like this, subscribe to our Stock Movers Reports. Listen for 5-minute audio reports on the biggest winners and losers in the stock market. Subscribe to Stock Movers on Apple Podcasts, Spotify, and anywhere you listen here. A lot of news flow today on the tech front, and Christine was just reporting on that in NVIDIA. I mean, when Masa-san sells stock in a company, that's news to me.
That is news, but I mean, does he have great timing or does he have poor timing? That's my question.
Yeah, I don't know. I mean, he sold it for $5.8 billion. What are you going to do with that? It's Ed Ludlow. He does all this tech stuff out there in San Francisco. He is the B-Tech co-anchor alongside Caroline Hyde. So, Ed, whenever Masahiro-san does anything, it really gets people's attention here. Sure. What do you make of this trade?
Your heads are in the right place. I mean, they're selling out the entire stake, and that's worth reiterating. It's all of it in one go, $5.6 billion, which for a $5 trillion company, almost $5 trillion company, is not that much, but it's also not unprecedented. And what Scarlett was saying about timing, SoftBank sold out of NVIDIA once before. That was in 2019, right before the kind of ChatGPT explosion in AI data center demand. But then they kind of realized 2020 they needed to get back in, and they slowly built up a stake, which resulted in, on paper, gains that were really significant. So the market's seeing this, even though NVIDIA's down, I think it's down 2.5%, right, guys? Not necessarily as an issue with NVIDIA or a signal that SoftBank has concerns about NVIDIA. They're seeing it, or taking SoftBank at its word, that this is just financing for the other things they want to do.
Okay. And in terms of the other things it wants to do, it's got a lot of different AI projects going on, doesn't it?
Yeah, across both public and private initiatives, right? There are some AI startups in the compute space that they're looking at taking private, for example. They still want to deploy capital out of the Vision Funds and Vision Fund 2. And, they didn't tell us much, the CFO in particular, on the call, but that's it. Realizing gains, using the realized gains to generate cash, and using that cash for investing. That's what they do, right? I think.
Yep, exactly right. Do you think that Masa believes that he and the fund have a proper allocation to AI at the moment?
This is the really important question, because there is a lot of exposure with SoftBank to OpenAI, both in terms of direct investment, but also co-financing and partnering on the Stargate data center project. Some people have concern about the concentration risk. Right now, OpenAI is seen as the world's leading frontier model lab or AI lab. But that's not guaranteed, of course. And so they would ask, well, is it diversified enough? But yeah, it's a really critical question. Remember, through ARM and the board representation that they have with ARM, there is an idea that if ARM designs data center chips, SoftBank benefits from that. What they're doing with Ampere in the compute space as well. That's why they need this $5.6 billion, they say.
Okay, so that's one of the big stories on the top worldwide page on the Bloomberg terminal. The other one is CoreWeave's results, and we talked a little bit about NVIDIA earlier. NVIDIA actually owns about a 6.5% stake in CoreWeave, one of those neo-cloud companies. What was the takeaway from the latest earnings report?
Yeah, so they cut their full-year revenue guidance for fiscal 25 to a range of $5.05 billion to $5.15 billion. The previous high end of the range had been $5.35 billion. So they've lowered it by about $200 million. And they say that is because a third party that was building data center capacity for them let them down. They're behind schedule. And because that data center won't be up and running, they can't realize the revenue for a specific customer, which they're not naming. Does that justify the stock being down 11%? That's not a question for us. That's a question for the sell side and for the investors themselves. But there's a lot of commotion about what is a $200 million trim because some capacity is delayed. And the thing you need to know, Scarlett, is generally speaking, CoreWeave cannot get data center capacity up and running quick enough to meet the demand that it has.
Well, if you like this story, you got to like it.
I know.
Even more so, down 13%. It's like one of those, this is an opportunity to get in on a name.
It's struggling to keep up with demand for AI, and the initial reaction is, let's sell the stock for long-time bulls, might be an opportunity.
And coming up, CoreWeave CEO Michael Intrator, if I'm pronouncing that correctly, speaks with BTech anchors Ed Ludlow and Caroline Heights. That'll be coming up just after the 11 o'clock top of the hour. Ed will bring that to you, which will be a fascinating discussion on a day when the stock is moving. So Ed Ludlow, Bloomberg BTech co-host, joining us from San Francisco. Again, he'll have that interview with the CEO of CoreWeave coming up in just a moment there. So looking at the market, red and green on the screen here. Not a lot of direction here, it seems.
Well, we're waiting for the House to get back and to actually sign off on this bill.
Maybe
to make
they're
sure
stuck
that
at
the
an
government...
airport somewhere.
You think?
That would be too bad, wouldn't it?
I wonder who
What a
caused that.
shame. Yeah, exactly. How ironic would that be for some of these folks stuck on the tarmac like the rest of us have been over the last several weeks. S&P down 22 points. This is Bloomberg. Good morning.
Markets, headlines, and breaking news 24 hours a day at Bloomberg.com, Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
And this Bloomberg Business Flash brought to you by Oracle. Attention growing businesses. Oracle offering to cut your current cloud bill in half if you move to Oracle Cloud Infrastructure. For new U.S. customers with minimum financial commitment, see if your company qualifies at oracle.com/Bloomberg. Well, we have the longest government shutdown in U.S. history. It could end as soon as tomorrow, but some AI caution overshadowing the news, pushing stocks mostly lower. You have Japan SoftBank sold its entire stake of NVIDIA. Its CFO said the move was to generate capital. We look at NVIDIA shares, they're down about 3%. We go to the NASDAQ, down 0.6%, 152 points. The S&P 500 falling 0.3%, 21 points. And the Dow, that's rising about 0.1% or 78 points. The bond market closed for the Veterans Day holiday. The Bloomberg Dollar Spot Index, that's weakening by about 0.1%. Over to company news, sources telling the Financial Times Meta's chief AI scientist planning to leave the company. He's going to create his own startup. And Apple, they're looking to add a second camera to the next iPhone Air to help boost its sales. Customers were asking for it.
Second camera?
Yes, second camera. You got to have more cameras, Paul. It's all about that. They're telling the information the company is going to delay the release of that phone in order to work on that redesign. And Microsoft spending about $10 billion. It's on an AI data center along the Portuguese coast. It's marking one of its largest European investments this year. And sources saying LVMH set to open major stores in China in December, including Louis Vuitton, Dior, and Tiffany. For on-demand news 24 hours a day, subscribe to Bloomberg News Now, wherever you get your podcasts. I'm Lisa Mateo. That is Bloomberg Business Flash. Scarlett and Paul.
Thank you so much, Lisa Mateo. This is Bloomberg Intelligence. Paul Sweeney and Scarlett Fu here. We are, of course, live in our Bloomberg Interactive Broker Studio in Midtown Manhattan. And luckily, you and I don't have any travel plans in the near term.
I'm only flying when somebody pays me to fly. That's my new policy.
Unfortunately, we do have others in our circle who are flying. My husband is due to fly out today internationally, so hopefully
that should be
he'll be spared. Yeah. So I want to bring in George Ferguson. He's our senior aerospace, defense, and airlines analyst at Bloomberg Intelligence. George, what do we know in terms of the flight reductions that are being planned? Because yesterday it was supposed to be 4% of flights reduced. And actually, it got to somewhere in the neighborhood of 8% because there was this unexpected weather issue in Chicago.
Yeah, and my understanding is that we're going to continue to ramp up. At least I think the sort of the controller-induced reduction in flights through the end of the week. I mean, I think until the government shutdowns ended, I imagine this continues to ratchet up. And obviously, you got sort of weather that sits on top of this problem and creates even more disruptions. I think the controller issue's a lot more manageable because weather kind of. You don't always know how it's going to affect you, and it puts equipment in bad places and people out of place, and I think it interrupts operations worse. I think the controller-induced issue is a little easier to manage, and I mean you're in November now, right? So you're dealing with both, and that creates an even bigger challenge for the airlines.
Hey George, assuming the U.S. government does open in the next couple of days, how long will it take the airlines to kind of get back up to, I don't know, kind of normal capacity, if you will?
I think given that they're sort of, less than a 10% cut here, my guess is within a week or two, they should be back up, to full schedules, something that would get them, I think, back on plan by Thanksgiving, which would be, I think, a great thing. Otherwise, I think you'll see some real turmoil because Thanksgiving's sort of a crunch time. But I just can't imagine it's going to take more than a week or two to get operations back to normal.
So, George, this is a dumb question, but I got to ask it. We talk a lot about how the international flights are not being targeted for cancellations. Why is that? Is it as simple as these make more money for the airlines and therefore they want to preserve it?
So I get the sense that it is partly that, they've got higher revenue bases and probably profitability. I think the other thing is they're long haul. They're going inside or outside the country. I think typically when they get to the end of their flights, they don't have a lot of ability to get diverted to other airports, and sort of I sense that their flexibility is less. It's just less numbers. I mean, when we look at U.S. flights, domestic are like 25,000. I think the international adds another 3,000 or 4,000 a day. So they're fewer as well. I think they're on these decent routines that you don't want to interrupt, and so I think that combination kind of keeps them from being touched too much.
George, the shutdown kind of just highlighted what's been a problem for the airline industry in general, which is the dearth of air traffic controllers. Is there a solution out there? Is it simply just paying these folks more money to attract more people?
Look, I think that's probably part of the solution, but I still think that it's probably a job that we need to find a way to attract more people that love the business. And I think it's sort of lost some of its allure in the last bunch of decades. I think back in the day when I was a young boy, airline travel seemed like cutting edge stuff. It's not anymore. Folks would rather work for tech companies. They'd rather not have to go to the office every day. Not something you can get them in air traffic control. But I mean, it's a great industry, and so I think we just have to do a better job. We, meaning the industry, of recruiting folks to come in and want to take those positions, because I think the baby boomers are going away, and there's going to be a real need to backfill for them.
Yeah, I go back to that movie Pushing Tin with John Cusack and Billy Bob Thornton, and I just remember how they were like coming out of a 9-hour shift at 9 in the morning and getting breakfast at the diner.
Exactly. And that stress in the job there.
Exactly. All right. Thank you so much, George Ferguson, Senior Aerospace Defense and Airlines Analyst from Bloomberg Intelligence. And hopefully we won't have to talk to him for too much longer, because that'll mean things have returned to normal. All right, let's get a check on these markets right now, because yesterday, when there were signs that perhaps the government shutdown was coming to an end, we had a rally in risky assets, starting with stocks. And today, we're seeing a mixed picture, with the Dow higher, but the S&P 500 lower. Christina Hooper is the Chief Global Market Strategist over at Man Group, and she is here with us at the Bloomberg Interactive Brokers studio. And Christina, one of the reasons why perhaps there's less enthusiasm for equities today is because we're getting private data that shows the labor market is, I don't want to say deteriorating, but is not necessarily holding up as well as earlier indications.
Yes, and that really is part of what I've seen as a longer-term trend. I mean, we've seen weakness in this economy, but it's been growing for months, and I would anticipate it gets worse. I'm one of the few that has called a recession for the coming year. I think that's still very much on track. It might be a very modest recession, but I think we will see one. This is an economy that is being hit by a number of different headwinds at the same time, including tariffs, including immigration policy that's negatively impacting certain industries. And we've got government spending cuts, and add to it the government shutdown. I can't see a way that we don't end up in at least a modest recession.
The bulls, or the economic optimists, will talk about the economic benefits of the one big beautiful bill. They will talk about easing monetary policy. Those maybe not be enough to offset just some underlying challenges?
I think those are certainly tailwinds that should be positive, but I think the headwinds are just too powerful in this environment. And if we think about what the key drivers have been of this economy thus far, it's been consumer spending, but higher income consumer spending, and of course the big AI CapEx boom. So if we see any kind of reduction in the magnitude of CapEx spending on AI, or in terms of high income consumer spending, I think what we will end up with is a recession, and I think that's likely. I think there's a very good chance we see a moderation in AI CapEx spending, and I think there's an even better chance we see a moderation in consumer spending as we see more white-collar layoffs, and if, for example, the stock market has any kind of a drawdown, that will impact those higher-income consumers.
Yet, when you look at earnings, they're doing remarkably well, and according to Bloomberg data, executives sound very upbeat about the economy in this earnings season. The mentions of the words economic slowdown or something similar to that during these earnings calls are at the lowest since 2007. Why do you think that is? Is it because we haven't gotten to the consumer-driven companies, the retailers reporting, that we aren't seeing that kind of more cautious commentary?
I think that's so. I mean, we tend to see the consumer companies reporting later. Certainly some have already. But I also think that in general, there is a lot of excitement around what is going right, and that certainly translates into earnings call. It is worth noting that the last time we saw so much enthusiasm and optimism was 2007, so that might not be the best predictor of what the future holds, or maybe it is a good predictor of what the future holds. And
If the U.S. economy may be slowing, how about the European economy? Because we've seen, this is a year where we've seen a lot of economies led by Germany talk about ramping up spending for defense and infrastructure and things like that.
I'm certainly seeing some positive surprise there. We've seen the most recent Eurozone PMI readings for both manufacturing and services is above 50. It's in expansion territory. I think that while we don't have really strong consumer sentiment yet, that will come. But to me, the key is fiscal stimulus, that commitment to get to 5% of GDP in terms of defense and defense-related spending. Germany is well on the way, and I think it's going to be a powerful engine for the European economy.
If you need to put money to work and you haven't done it yet, what do? Do you hold off and wait for the S&P 500 to stumble, or do you add it to any of the equity markets that have double-digit percentage gains for 2025?
Well, I think you can do both, right? You can certainly put some money to work, start dollar cost averaging in, but also I think there is the potential for a significant drawdown. I also think there's an argument to be made for diversification. So taking some of that great exposure that many investors have had in AI-related names in the U.S., or largely in the U.S., taking some of that and putting it into China AI-related names because the valuations are significantly lower and arguably they're in earlier innings.
How about the fixed income market? Where's the opportunity there? Because we look across the fixed income spectrum and a lot of positive returns this year, and even the more riskier, like high yield and leverage loans, have done really well.
They have done really well. Credit spreads are still tight. But as you know, I'm a little worried about the U.S. So I would turn my attention to European investment grade. I think there's opportunity there. I'm excited about that. And emerging market debt. In an environment where I expect the U.S. dollar to go down, that tends to be an environment that's supportive of emerging markets assets in general. And I think Asia EM debt looks attractive.
Is there any one area that you're very bullish on in the U.S.?
That's a great question. I think you have to be really selective in the U.S. Certainly continue to have some exposure to AI-related names, but be well diversified. I think you have to be particularly selective when you look at consumer discretionary because it is really the high-end consumers that are driving so much of the spending, and some will continue to do that even if we start to see more and more white-collar job losses.
Hi, Christina, thank you so much for joining us. Really appreciate it. Christina Hooper, she is Chief Global Market Strategist at the Man Group, joining us live here in our Bloomberg Interactive Brokers studio. And we've got a market that's red and green on the screen here. Coming up, we're going to check in with Henrietta Trez, Managing Partner and Director of Economic Policy at Veda Partners. When is she going to get this government open for? She's got the inside scoop. She knows everybody down there in D.C., so we'll get the latest there. S&P off 23 points. This is Bloomberg. Good morning.
Markets, headlines, and breaking news 24 hours a day at Bloomberg.com, Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
From the Bloomberg Interactive Broker Studio, I'm Lisa Mateo. Well, the rally in stocks kind of losing some steam. This is over worries of high valuations in the AI space. Japan's SoftBank unexpectedly sells its stake in NVIDIA, pocketing $5.8 billion. SoftBank shares are up about nearly 2%, but NVIDIA shares, they are down this morning about 3.5%. Over to the markets. The NASDAQ down 0.7%, 180 points. The S&P 500 down 0.3%, 21 points. And the Dow, that's rising 0.3%. 167 points. The bond market closed for Veterans Day holiday. We go over to commodities. COMEX gold down about 0.3% at $4,109 an ounce. Brent crude rising more than 1% at $64 a barrel. WTI crude at $60 a barrel. Shares of Gemini Space Station, they're taking a hit down nearly 14.5%. It's the crypto exchange fund founded by Tyler Cameron Winklevoss. It reported a steeper loss than analysts expected. Its first earnings release since going public. And then Real, that's that online marketplace for luxury goods. Well, it boosted its revenue guidance for the full year, topping estimates. Its shares are up 30%. And finally, Walgreens, looking to cut costs under its new owners. Bloomberg reporting that it will no longer give many of its retail workers paid vacation time for Thanksgiving, Christmas, and other major holidays. For on-demand news 24 hours a day, subscribe to Bloomberg News Now. Wherever you get your podcasts, I'm Lisa Mateo. That is a Bloomberg Business Flash. Scarlett and Paul.
All right, thank you so much, Lisa Mateo, with our Bloomberg Business Flash. This is Bloomberg Intelligence. Paul Sweeney and Scarlett Fu here with you, and we have a mixed market. A day after investors were seemingly cheered by the idea that the government shutdown is will soon end. We're now kind of waiting for the next step to take place. Henrietta Trays has been on top of all of this. She is managing partner and director of economic policy at Veta Partners and joins us from Louisiana. And Henrietta, you and I spoke on television on Friday, and you called it that the government is on track to reopen this week. And that's what it looks like is going to happen. But the question is, when? And I know there's a lot of issues with regards to getting the congressmen and congresswomen back to Washington for the House vote. How are you seeing this play out right now?
Yeah, it's great to be back with you. I think that by tomorrow night, we should have all the votes wrapped up on the House side to get this government reopened by Thursday. My expectation is that, obviously all the members have seen that the Senate took the votes. They knew that there was forward progress on Friday, as I suggested, and we talked about, and I think that it's possible that we start getting economic data by Friday. So top of mind for my clients today is, when do we start getting info from BLS? And I think on Friday, we should be able to get some of the September jobs data and economic reporting. So October and November will be delayed, but I'm getting cautiously optimistic signs from staff that we might be able to get some data on Friday.
All right. If we do get this government open this week, Henrietta, what's the to-do list for Congress coming back?
Well, it's now pretty comprehensive. And the good news is the government's reopened, but the bad news is it's basically just the absence of an overhang. Now we have to deal with the continued fallout of jobs losses, the continued fallout of inflation as a result of the president's tariffs, the Supreme Court's ruling on whether or not the president's tariffs are even lawful or not. And as you can see from the president's own focus this last week, he really wants Congress to pass another piece of legislation. When you call for repeal of the filibuster, it's because you want to do more stuff. So we need to get the ACA subsidies extended. We need a bailout for U.S. farmers. He's talking about a $2,000 rebate check to all Americans who qualify. I think that's a non-starter, but the to-do list is long. And if the economy really does inch into, as your previous guest was saying, something that looks like a mild recession, they're going to have a problem going into the midterm elections next year, and they'll want to juice the wheels with something on the legislative front.
Wow, so that is a long to-do list, and it doesn't necessarily mean that it's one that will help investors feel encouraged about where we stand. In terms of clarity on where the Supreme Court or how it sounds right now when it comes to the arguments before it with regards to the IEEPA tariffs, what are you hearing and what does it look like right now?
You know, the trade universe, the legal universe, constitutional lawyers are all really in the same camp. You can get a couple outliers who will put, 40% odds on the Supreme Court repealing the IEEPA tariffs, but I'm at 65%, and I feel really comfortable with that, especially after listening to 3 hours of oral arguments recently. The Supreme Court is facing, what I think is a pretty clear instance of Article 1, Section 8 coverage of the U.S. Constitution. Who has the power to tax? These are plainly revenue-generating tariffs. The president's own commentary suggests that these tariffs can be spent because they're bringing in so much revenue to either reduce the deficit or $400 billion worth of that revenue, if should it ever get collected, would have to go to those $2,000 rebate checks. I think the Supreme Court is going to rule against the president. The main question I have is when. So they could issue that ruling in mid-December. That's everybody's hope in trade and tax and investment land, just so we have some certainty and we can understand that the administration is going to start pivoting to other sectors of the trade universe. But there's a universe here where they don't issue a ruling until next summer. And that would serve the president by allowing him to keep collecting tariff revenue, keep trying to collect, initiate these trade deals with other nations and finalize those. And we don't find out that they're illegal until June of next year. So that is a possibility. I'm hoping it's a low odds event. We're optimistic that we'll get it in mid-December.
Did the shutdown, shine a light on any new leadership potentially in the Democratic Party? Because this is a party that is looking for leadership. We had Speaker Johnson acquit himself pretty well, it seems like, from the shutdown. How about on the Democratic side?
Yeah, that's a great question. I think there's a lot of shakeup coming on the Democratic side, especially with Senator Schumer. The conversations I have with Democratic staff on the Senate side, former staff, former leadership, have all suggested that we are in, the early days of migrating away from Leader Schumer and into a Leader Schatz situation, the Democrat from Hawaii. I think there is, especially for those who've been in politics for a long time, that leadership has to take a lot of arrows, and that's exactly what Schumer did. So the movement, the migration towards having Leader Jeffries get propped up, especially as former Speaker Pelosi is stepping aside, really putting him front and center. They're going to have the headwind, or the tailwind rather, of last Tuesday's elections, which are pointing to what should be a pretty robust turnout and vote share for Democrats in the 2026 midterms next year, with as many as 41 seats up for grabs if it's any kind of repeat of 2018. And that really creates an opportunity for new blood. And that's especially going to be true on the Senate side. I think the House is set. The Senate needs some movement.
So following on Paul's question, we know that 8 Democrats voted in favor of this temporary funding measure that allows the bill to move forward for the government to reopen. And none of these 8 Democrats are up for re-election next year in the midterms. But what do you think are the likely consequences for them defying the rest of their party?
That's exactly right. And I would encourage questioning whether this was actually defiance. I think this was a situation where you wanted to vote no and hope for yes. And that's exactly what Democrats got. When you instigate a shutdown like this, that's usually where the bulk of the party lands. You still get most of the conference who wants to vote against something, message to progressives in their constituency that they're hearing what happened in New Jersey and Virginia and New York on Tuesday, see how the affordability message is really resonating with voters, and let the 8 who are not up for re-election in 2028, some not even until 2030, fall on the sword and take it for the team on this one. And that's exactly what happened. And I think that speaks to the deftness of Leader Schumer, not, a misstep.
Henrietta, thanks so much for joining us. Appreciate it. Henrietta Triz, Managing Partner and Director of Economic Policy for Veda Partners, joining us here again. Maybe get this government open sometime Thursday, perhaps?
Yeah, she said Thursday, and maybe by Friday we might have economic data, although that would be a mess, because does it come out at 8:30 a.m.? Does it just come out when they're ready to release it?
I don't know. I can't remember. We've been through this before, but I'm just not sure because we missed. This was a long shutdown.
This was a really long one, and it comes at a critical time for the labor market where there are a lot of questions about just how strong it is.
Yeah, absolutely. So, but we'll be here, and when it comes out, EcoGo is kind of the function you need on the Bloomberg terminal. That is where all the economic data and the forecasts reside. And we'll be paying attention to that, and they'll be updating that, I'm sure, starting, maybe Thursday.
Yeah, check out EcoGo because it could be lit up in all kinds of colors.
Yeah, exactly right. So looking at the markets right here, kind of mixed on the screen here. The S&P is down 22 points. That's about a third of 1%. The Dow's up 166 points. That's about 0.4%. And the Nasdaq's off 187 points. That is 0.8 of 1%. Coming up, we're going to check in with Amanda Mull, senior reporter, Bloomberg Business Week, on Ulta becoming a $11 billion beauty behemoth.
This is Bloomberg Intelligence with Scarlett Fu and Paul Sweeney on Bloomberg Radio.
All right, it is 10:53 a.m. on Wall Street, and we are keeping an eye on one of the stocks that have done extremely well. That is Ulta Beauty. It's a cosmetics retailer, but it's a little bit more than that because it's also about wellness and it's also about little luxuries. And Amanda Mull, who is a reporter for Bloomberg Business Week, is joining us. She has written a story on this and about how Ulta has become this $11 billion beauty behemoth, largely by conquering the suburbs. And it's really more of a Home Depot than it is a high-end Sephora. Amanda, great to speak with you.
Thank you so much for having me.
So Ulta Beauty has a formula. When it expands and it opens stores, it looks for a certain kind of location with certain kinds of neighbors. Tell us what that looks like.
Yes. Ulta Beauty is sort of fascinating to me, and I first got interested in it for this story because when you think of the beauty industry, when you think of high-end products, which is a fair bit of the stuff that they sell, you think of expensive urban shopping districts and high-end malls and things like that, but Ulta really looks for normal suburban urban strip malls, normal exurban strip malls, rural strip malls. They look for places that have like other sort of like big box, moderately priced stores around them, like a Marshall's, a TJ Maxx, things like that, a PetSmart, and they are able to get a lot of square footage and a lot of space for different kinds of product in there. They're about twice the footprint of a typical Sephora, and keeps their overhead low, and it makes them convenient to a lot of people who don't want to deal with them all.
Yeah, I'm glad you wrote the story because I had no idea about this company. I look at it and it's a $23 billion market cap company. The stock's up 20% year to date, so another one I totally missed. Talk to us about how do you compare Ulta? I do know Sephora because Sephora's across the street from the Bloomberg, and I always was just amazed that during the peak of the lockdown, Sephora wasn't locked down. People were going in and out of Sephora. It doesn't matter, wearing masks and wrapped up and doing all this craziness. How do you compare Sephora to Ulta?
Well, Sephora calls itself a prestige beauty retailer, and that is significant because beauty is a really segmented market. It's very, usually where it's sold and what kind of products are stocked together is really striated by, among other things, price. And Ulta is different in that they sell all price ranges. They sell beauty products like CeraVe or Maybelline or Revlon that you could get at a drugstore, at Target, at Walmart. And they carry Chanel perfume and Dior cosmetics and all of this like very, very expensive high-end stuff. So Ulta is a strange retailer in its market because it really carries the entire spectrum of products that are available in beauty and wellness. And Sephora carries a section of that market. Drugstores carry a section of that market, but they're really the only one that carries the full spectrum.
And talk to us about the president and the CEO, Kecia Steelman. Am I pronouncing her name correctly?
Kecia Steelman.
Kecia Steelman, okay. She is an insider, meaning she worked at the company itself as an operations executive, and she's a consumer of the products, and she kind of lives and breathes this brand. And she's got a very specific philosophy towards Ulta Beauty.
Yes. Kecia was named CEO in January of this year, so she's been on the job for a little bit less than a year, but she has spent a decade at the company previously in operations roles, and that, I think, is significant because beauty is still a very in-person business. The share of purchases made online has grown, as it has with everything, but people want to smell perfume, they want to look at an eyeshadow palette and see how the shimmer works and how glittery it is. So having a background in operations, I think, is really important for beauty retailers and people leading them. And she's also just like a beauty girl. When we had lunch together, she was like, I grew up squirreling away makeup products at home so I could wear them to school without my mom finding out. She matched her eyeshadow to her dresses in high school. Like, she loves the product. She knows the consumer. She's from a very, very small town in Iowa, and Ulta is Midwest-based and caters to a lot of people who are like her, who come from similar backgrounds, who have similar stories of their relationship to these products. So I think her performance on the job so far has been impressive, and I'm sure that all of that informs it.
I've been told by an expert that you have to invest in your face. Alex Steele, thank you. Is this business recession-proof? It seems like, again, people buy their perfume and buy all that stuff, cosmetics, no matter what.
The beauty industry is pretty recession resilient, I would call it.
Yep.
There's something that's called the lipstick effect, which was coined by Leonard Lauder, a legend of the game, based on what he saw in Estee Lauder Company's results after 9/11. People were very scared about the economy, about the geopolitical situation, but people bought more lipstick. They bought more cosmetics, and he called it the lipstick effect. So when people are nervous about economic conditions, about macro disruptions, they still want to buy things that are treats. They still want to buy, have a little something for themselves. So they tend to go from buying, an expensive handbag or something like that to, maybe you buy a new lipstick, maybe you buy a new perfume or something like that. So beauty tends to benefit from economic nervousness in that way, which makes it like especially resilient, I think.
Amanda, before we let you go, what's something that is, a headwind for the company? Is it tariffs? Is it something else?
Well, tariffs are looming for all retailers, and Steelman told me that they haven't seen a ton of tariff disruption in products themselves. She said that because most of the products they carry are MSRP'd, which means that the brands set the prices and they're the same across the industry, no brand really wants to be the first to move their prices. But where they're seeing it is in their ability to expand their store footprint. They want to open new brick and mortar locations, but construction materials fixtures have been highly impacted by tariffs, so they're having to curtail that just a little bit.
Amanda, thank you so much for joining us. Amanda Mull, senior reporter for Bloomberg Business Week. This is the cover story on Bloomberg Business Week here. So great stuff from Amanda. You can check that out at BloombergBusinessWeek.com or on the terminal or anywhere you get those magazine things. So very cool story there on Ulta. This is Bloomberg.
This is Bloomberg Intelligence with Scarlett Fu and Paul Sweeney.
How do you think the Fed is looking at tariffs, the uncertainty of tariffs?
Let's take a look at the sectors and how they performed.
A lot of investors getting whipsawed every day by news events.
Breaking market headlines and corporate news from across the globe.
Could we see a market disruption, a market event?
Are people just too exuberant out there?
You see some so-called low-quality stocks driving this short-term rally.
Bloomberg Intelligence with Scarlett Fu and Paul Sweeney on Bloomberg Radio, YouTube, and Bloomberg Originals.
Good morning, and this is the second hour of Bloomberg Intelligence with Paul Sweeney and Scarlett Fu. We are live in our Bloomberg Interactive Broker studio here on this Tuesday morning, and we have a lot coming up with a lot of questions over whether this is an AI bubble and how long the spending on AI can sustain itself. We've got a conversation with the CEO of CoreWeave, Michael Intrator. We'll be speaking with our B-Tech anchors Ed Ludlow and Caroline Hyde. We'll also get an outlook on the markets as it appears that the government shutdown will be ending soon. Walter Todd, President and CIO of Greenwood Capital, will be joining us later on. Geetha Ranganathan is our U.S. media analyst here at Bloomberg Intelligence, and she will recap Paramount Skydance's latest earnings. They've upped their post-merger savings goal to $3 billion. And Justin Teresi, Bloomberg Intelligence antitrust litigation and policy analyst, will talk to us about the Visa MasterCard fee case that perhaps makes it more favorable to merchants. We'll get into all of that later on. But first, let's get you a Bloomberg Business Flash with our Alexis Christoforous.
Thanks, Scarlett. We've got ourselves a mixed market here after yesterday's big rally. The Dow Jones Industrial Average up 149 points, but the broader market pulling back. The S&P 500 down 21. We've got the NASDAQ Composite off 181. Traders backing away from some high-priced tech companies after SoftBank said it sold its entire stake in NVIDIA for $5.8 billion last month. SoftBank's quarterly profit more than doubled, though. That's thanks to gains from its investment in ChatGPT creator OpenAI. We've also got another sign of weakness in the labor market from the private payroll provider ADP, which found U.S. companies lost an average of 11,250 jobs per week in the 4 weeks that ended October 25th. Nearly 1.1 million job cuts have been announced so far this year, according to the outplacement firm Challenger Gray & Christmas. That's the most since 2020. And Paramount Skydance, among the big-name companies, handing out pink slips. The media giant plans to lay off another 1,600 workers and hike prices for its Paramount Plus streaming service early next year. It's also raising its cost-cutting target to at least $3 billion. Shares of Paramount Skydance now up better than 8%. For on-demand news 24 hours a day, subscribe to Bloomberg News Now wherever you get your podcasts. I'm Alexis Christoforous, and that's a Bloomberg Business Flash.
All right, Alexis, thank you so much. We appreciate that. Let's take a look at some of the stocks on the move today. I'm Paul Sweeney alongside Scarlett Fu. We're joined by Bloomberg's Nora Melinda. Nora, what do you got?
Well, let's look at shares of CoreWeave. This has really been in focus so far this morning. This is ticker CRWV. We are seeing shares in focus right now down as we're trading about 13% lower right now. This is after the company lowered its annual revenue forecast. They're really citing a delay in fulfilling a customer contract. This, of course, also due to temporary delays related to a third-party data center developer. Of course, we know CoreWeave is a company that IPO'd just back in March, so it definitely has been part of the heightened emphasis right now on the IPO market. But it's interesting to see it tumbling here, especially as we're thinking about it and the productivity here. So this has really been in focus for a lot of investors so far in the trade.
And number two?
Number 2, looking at shares of RealReal. We're seeing shares. So what is RealReal? It's like an online website that a lot of people go to buy like luxury purses and things like that.
Luxury
kind of like a
reseller.
resale marketplace for luxury goods. Not familiar, Paul?
No.
Not on RealReal. Well, we do see shares of RealReal soaring, gaining as much as 32%. Wow. This is the highest level since 2021 here for the company. This is after it boosted its revenue guidance for the full year. This, of course, beating analyst expectations. KeyBank is saying that the fact that the macro still remains choppy, they believe that the company is well positioned to capture further share in the resale market.
And very quickly, NVIDIA?
Yes, NVIDIA, of course, we know this one's still on the mind of a lot of people right now. Shares falling as much as 3.8%. This is after we, of course, know SoftBank sold a stake in NVIDIA for $5.8 billion. This, of course, to fund AI bets.
All right, good stuff. Thank you so much, Nora Melinda, with our market movers. And of course, for more conversations like this, subscribe to our Stock Movers Reports, 5-minute audio reports on the biggest winners and losers in the stock market. You can subscribe to Stock Movers on Apple Podcasts, Spotify, or anywhere you listen. All right, let's head over now to our B-Tech colleagues who will be speaking, or who are speaking, I should say, with the CEO of CoreWeave. Let's listen in.
There has been a stumble. There's an issue. The issue is going to be cleaned up rapidly. But I wouldn't say that they're not a good partner. I think that, we've gone back and contracted with them again and again, and, they've contracted with us again and again because, we do work well together. It's just, occasionally you hit a bump in the road. What we're talking about here is a contract that gets pushed back by, 1 quarter, let's say, and the impact of that on our revenue is a delay of revenue, not a loss of revenue. And, I think that is the definition of working with an ecosystem of good partners.
Michael, good morning. Which customer was it, please, that was impacted by this delay?
We don't speak to specific customers within the data centers. That's not how we look at it. But, we really are working with the whole, or a material part of the broader kind of ecosystem that consumes compute at this scale. So, that's this is a large project. It's from a large counterpart. And, like I said, they understand the impact of this delay and that they are shifting with us the contract back to ensure that the total contract value that was being contemplated is going to be captured at this facility.
I thought you might say that, but I wanted to offer you the opportunity to explain who the customer was anyway.
I appreciate that.
This is going to sound a little bit like I work in your internal audit team or in your risk team, but there is a bigger issue here of managing third-party risk as much as you can. So if your supply is tight today, what procedures are you putting in place for the event that your backlog doubles and supply is even tighter down the road?
Listen, that is the question that we work on across our company continuously, right? And if you think about the messages that I was trying to communicate during the earnings call yesterday, I talked about the incredible impact of the effort that we've had to diversify our clients. We started the year with 85% of our revenue to a single client, and we are coming out of the year with our backlog which has reached all-time highs, where no specific client is more than 35% of it, and that is down from 50% even last quarter. So you're seeing tremendous progress on the contracting side. On the supply side, when you're looking at the powered shells, the data center providers, there is no single provider of data centers that represents in excess of 20% of our 2.9 gigawatts of power that we will be delivering to the market over the next 24 months. So you're seeing a real focus by our company to diversify on both sides of the ledger. The clients that we are delivering infrastructure to, as well as the suppliers that are delivering us the components that we need to be successful.
What can be done? Because we hear about power issues. We hear about how much people maybe need government to help speed up contracts, supply chain headaches. What is it in this particular data center issue that won't be replicated down the road? How are you making sure, or is it just something we are going to see time and time again, do you think?
Look, the way that we are handling this is we're doing several discrete things to ensure that we are future-proofing ourselves against these type of delays, right? So we have our team that has been built out over the past year that builds and delivers data center. And so we have a self-build organization to be able to deliver our own data centers. For instance, Kenilworth in New Jersey, or Lancaster in Pennsylvania, where we are building from the ground up. Those skill sets, being able to deploy those individuals with those talents down to the data centers as they're being constructed by third parties, if they encounter problems where we can be useful, helpful, thinking through ways of solving and driving the process forward, is really important to being able to mitigate these type of delays. We have massively diversified our data center providers, so we're not exposed to any specific data center provider in too large of a component. And then the third piece of it is, it's important to understand that as we get larger, as our delivered power gets larger, the relative impact of a delay at any one given site becomes less and less meaningful and less impactful on our run rate. And that's really important. Like, you're encountering scaling issues within a company that's encountering scaling issues within a supply chain. Both of those will get better. Time solves that, scale solves that.
We are currently seeing that time isn't particularly helping the share price as we speak. It's now down 14.3%, worst day since August. We are here with Michael and Trader across radio and TV. And I want to sort of ask whether you think more broadly the US is stunted by the supply chain headache, or do you think there is something that can be done from a federal perspective here to ensure that you can build at the rate you want to build? You're not having these sorts of headaches.
So we and many others have been, quite forceful in making the case that there is a role for government in helping us with some of the permitting issues, speed to which we can get our infrastructure and others can get their infrastructure attached to the grid. All of those type of things where there's a great role for the government to help in that. They are the organization or government entity that is correctly positioned to help facilitate that. And I think that's a great role where government can lean in and make an impact across the space broadly.
Michael, you have an agreement with NVIDIA that lots of people find very interesting, that down the road, if there is spare capacity, there's some flexibility for you to deploy it elsewhere. That's a simple summation of it. But I'm wondering how you're thinking about serving some of the smaller AI labs and casting that net even wider in your customer base, if indeed that capacity gets freed up down the line.
Yeah, it's a contract I'm actually incredibly excited about, right? It's a contract that we did with NVIDIA where we will deliver them compute for the next 6 years. But in the contract is the capacity to interrupt the flow of compute to them, and that will allow us to repurpose that compute to new companies, startups, companies that have struggled to get access to the compute that they require to bring new companies, organizations, ideas into existence. And I think it's just an incredibly important component of how the infrastructure is so important to allowing the ecosystem itself of these startups, of these new companies, of these new ideas to become more resilient, to become more scaled. And it's just a great contract for us to be able to position ourselves. It also provides this wonderful on-ramp for us to be able to work with the new amazing companies that are coming into existence, so that they integrate into our solution and get to make use of the best alternative that exists in the market as they're scaling their companies.
Michael, to finish, to what extent is NVIDIA still the gold standard, NVIDIA's GPUs, for your customer base? And what data are you tracking on demand for those kind of more inference-specific chips that are offered by others?
Yeah, so look, we have always been client-led, right? Our clients come to market and tell us, hey, we would like you guys to help us build a cluster. We need it to be this size and this location and this type of network. And we work with them in a very kind of interactive way to ensure that the infrastructure that we're building is the best infrastructure for them, is fungible for us, like all of these type of requirements to make for successful delivery of infrastructure. Right now, the reality of the situation is the buy signals from our clients overwhelm our capacity to deliver infrastructure to the market. Matter of fact, they overwhelm the entire market's capacity to deliver infrastructure to the market. You have a systemic shortage of ability to deliver the GPUs, the computing infrastructure for the build out of artificial intelligence. And we have never wavered from that position. We have been very, very clear that, you know, when we look at the demand signals coming into CoreWeave, the totality of that overwhelms the capacity of the market to deliver that, and will continue to do that for quite a while.
Michael Intrator, CoreWeave CEO, thank you for coming back on Bloomberg Tech.
All right, that was CoreWeave CEO Michael Intrator speaking with BTech anchors Ed Ludlow and Caroline Hyde. The company just reported some numbers, a little bit lower than expected. A guidance stock down about 13% today, but this stock's been just a rocket ship that IPO'd back in March of 2025, so just a few months ago, at $40 a share, and it's trading right now at $90 a share, so it's had a nice move here. Right now, we're looking at some images. President Trump is at Arlington National Cemetery participating in a wreath-laying ceremony on this Veterans Day, which is always a moving event.
Absolutely. And again, live shots there of the president at Arlington National Cemetery. Veterans Day, which means no bond market trading.
Right.
It's quiet on that front. And a holiday, a public holiday, I should say, for kids in public schools as well.
Oh, is that right?
Yeah.
Okay.
The stock market remains open.
Yep, of course.
So.
I don't know who's in charge of coordinating that stuff.
I know. I always wondered about that. You know?
It seems like if, you know, I don't know.
The bond market gets twice as many days off as the stock market.
It seems like it.
I mean, you know from your days as an equity guy.
Yeah, we always came in. Yeah. So it's just easy. My kids knew if the stock market's open, Dad's going to work. That's how you keep track.
Right. And they're like, well, we'll be here watching TV. Thanks, Dad.
Exactly.
You look at the market, and we were talking about CoreWeave and how its shares are off by about 14%. Tech stocks are leading the way lower right now. So the S&P 500 is down about 1/4%, and the NASDAQ is off by 3/4%, with chip makers leading the declines. There's also a lot of concern. Maybe concern is too strong a word for it, with NVIDIA after SoftBank sold its stake in that chip maker for $5.8 billion. That was the entire stake of NVIDIA.
Yeah, and that's just a data point. I don't think most people make that much out of it here. I mean, you still have a NASDAQ that's up, 21% year to date, so a little profit taking here, no problem there. But I thought earnings generally, across the board, I'm looking at the Bloomberg terminal, the EA function for the S&P 500, up about 12% earnings growth this quarter, which was pretty darn solid. So we'll see how that plays out for the remainder of the year and into next year, because some folks say there might be some lingering impact from tariffs. We just had not seen it, period.
Well, we'll hear from the consumer companies when they begin reporting, because they're definitely at the front end of that. The front line, especially seeing waning demand from the lower income consumer as well. NVIDIA will be reporting earnings next Wednesday, too. So that's the last Mag 7 earnings name.
Yeah, that'll be a big one. They set the tone, of course. And I think they kind of kicked off the whole AI trading frenzy 2.5 years ago when they reported that big revenue
that no one saw coming.
Yeah, and the forecast that was just billions of dollars ahead of where the street was, and that typically does not happen. And that started it all. People said, "Oh yeah, I guess this AI thing really is something big."
NVIDIA earnings became like an event. People would have watch parties for the earnings report.
Exactly. So anyway, we'll stay on top of that. This is Bloomberg.
markets, headlines, and breaking news 24 hours a day at Bloomberg.com, Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
11:21 on Wall Street. I'm Alexis Christoforous. We've got a tale of two markets on Wall Street today. The Dow Jones Industrial Average is rallying 227 points, but the broader market is pulling back a bit, with the S&P 500 down 10. The NASDAQ Composite off 134, with chip giant NVIDIA leading tech lower after the Japanese tech giant SoftBank said it sold its stake in NVIDIA last month for $5.8 billion. That sale comes as SoftBank focuses its attention on OpenAI, the startup behind ChatGPT. But SoftBank is still involved with NVIDIA through other AI ventures that use the chip maker's technology, such as the Stargate projects. Shares of SoftBank up now 2.25%, but we've got shares of NVIDIA down by 3%. And shares of CoreWeave taking it on the chin today, down more than 13%. The provider of cloud computing services saying revenue more than doubled last quarter, boosted by the AI boom. Its loss narrowed, but CoreWeave CEO joined us on Bloomberg TV moments ago, and he flagged a delay by a data center developer, which is expected to hurt revenue this quarter. And the space company Rocket Lab shares rocketing up 2% right now after posting a smaller than expected quarterly loss, while revenue topped forecasts. For on-demand news 24 hours a day, subscribe to Bloomberg News Now wherever you get your podcasts. I'm Alexis Christoforous. That's your Bloomberg Business Flash. Back over to Paul and Scarlett.
All right, Alexis, thank you so much. We appreciate that. Scarlett Fu and Paul Sweeney live here in our Bloomberg Interactive Broker studio, streaming live on YouTube as well. Head over to YouTube and search Bloomberg Podcast, and that's where you'll find us here. We're pretty much done, about 95% of the way through the earnings for the S&P 500. We've got some retailers coming up, and as Scarlett just mentioned, you got NVIDIA. They report next week, I believe. So pretty much done with earnings. Pretty solid earnings quarter, to say the least. Let's see what the pros are thinking. Walter Todd, he's president, he's chief investment officer, and he's managing director, which I think makes him the boss at Greenwood Capital in Greenwood, South Carolina. Where is that? A little bit west of Columbia, South Carolina. Walter, thanks so much for joining us. We always appreciate getting a few minutes of your time here. What did you take away from this earnings cycle from corporate America?
Yeah, let me start by saying Happy Veterans Day to all the veterans out there. Thank you for your service. But as you said, the earnings have been very good on an overall basis. 82% of companies beating on EPS, which is above average. 77% on revenues, which is well above average. So when you look at that kind of top-down picture, you feel pretty good. Kind of mid-teens growth, much better than expected going into earnings. But when you kind of drill down a little bit, some of the individual name volatility, both up and down, has been quite dramatic. We've seen this, in large names like Oracle and Google and Amazon, for example, on the upside. But on the downside, you've seen what are being called idiosyncratic issues with, Chipotle, Cava, CarMax pre-announced last week. I guess the question is, when do enough idiosyncratic issues become systemic issues? And we're seeing a pretty consistent message from the lower end of the consumer from some of these names that have reported.
I like that. When do idiosyncratic events become systemic events? Because if you ask anyone in the credit market, they will insist that everything is a one-off and none of it's linked and the overall market is fairly healthy. And I can see that given where credit spreads are. You talk about this K-shaped economy. Which kinds of companies would benefit from the K-shaped economies? I know on the restaurant side, you look at McDonald's and it's certainly doing well, but can smaller players, hold their own, or do you have to be big and have scale and be able to absorb all kinds of impacts?
Yeah, I think it kind of depends on what part of the demographic you're catering to. So, for example, Walmart's obviously done very well this year, getting the trade down. You've seen TJX, Dollar General more recently, Dollar Tree more recently, although they've been dealing with some tariff issues. So I do think it's the larger companies that cater to and have good values in their stores on the retail side is what you're seeing are benefiting. Conversely, those more expensive areas, like we talked about Chipotle in the restaurant space, is losing customers to either eating at home or some of the lower cost providers like a McDonald's. Domino's has been able to weather the storm with good value as well. So it kind of depends on companies that can offer a better value to consumers.
Walter, we all talk about diversification is key here, but boy, when 35% of the S&P's return comes out of NVIDIA, Microsoft, and Google, it gets hard to do. How do you guys stay diversified? How do you define diversification for your clients?
Yeah, it is. It's a super concentrated market. It has been for the past 3+ years, and so for us, it's looking at not only individual names but just sector allocations, right? I mean, 35% of the S&Ps in technology. If you expand that a little bit to include communication services, you're pushing 50%. We just don't think you should have that much and kind of follow the index there. So we think there's other opportunities in the likes of healthcare, even some areas that are just left for dead, like energy and materials. We think there's tremendous values there. We hear a lot about the energy shortage for all these data centers. You need the companies that produce copper, produce oil, produce natural gas to power those data centers, yet they're getting no value in the market right now. In fact, NVIDIA's by itself is larger than the materials, energy, and utility space combined.
Wow.
Right now. So that's where we see value.
How do you think about mid caps and small caps? I mean, in terms of whether they are finally going to get a closer look from investors who are going to sift through winners and losers, or as a group overall, do they just provide more value given that the big caps have run the show?
Yeah, it's really interesting, Scarlett, when you look at the small cap space. So while the large cap space has run to the largest names, the small cap space, or at least over the past 2 to 3 months, has run to the smallest of the names and the lowest quality of the names, those that don't earn any money. And so coming off the April lows, those non-profitable small cap companies have vastly outperformed those profitable small cap companies. So we think there's an opportunity within the small and mid cap space as well to kind of sift through that and look for quality names within those market cap spaces that have, again, kind of been left behind a little bit on this dash for trash, if you will, in the small cap space over the last several months. We saw that unwind a little bit last week, but went back to it again yesterday.
All right, Walter, thanks so much for joining us. Really appreciate it. Walter Todd, President and Chief Investment Officer at Greenwood Capital, joining us from Greenwood, South Carolina via Zoom here. I think my new favorite stock symbol is P-Sky.
Yeah,
that's
a
cool
good one.
I like that one. It's for Paramount Skydance. The company reported earnings yesterday, kind of in-line numbers, but there's a lot of cost-cutting going over there, and the stock's up 10% on the news today. So let's check it out with Geetha Ranganathan, because she covers all the media stuff for Bloomberg Intelligence. And Geetha, I'll ask you the one earnings question, but then I want to get to the meat of the matter here. How were the earnings for this newly combined company, and what's the outlook?
Yeah, Paul, earnings were a little bit messy. They were mixed, but the good news was that the company kind of over-delivered when it came to streaming profitability, which is the big thing that everybody's looking for, given that, they've just lost tons and tons of money on their streaming business. So that was good news. I think why Wall Street is really cheering, Paramount Skydance today is because the guidance that they provided for 2026 was pretty promising. So Street was in at about $3.1 billion for EBITDA for next year. They came in with $3.5 billion, and a lot of that, as you just pointed out, was because of the cost savings. So they've taken it up from $2 billion to $3 billion. Very, very aggressive measures across the board. But I think overall, it was, what really kind of came across was that this is a solid management team that really knows what they're doing. They're super focused, on driving that transformation within the company. And I think that really kind of cheered investors.
Speaking of driving transformation in the company, the big question for Paramount Skydance is whether it's going to buy Warner Brothers Discovery wholesale, or at least parts of it. Did we hear anything from the executives in the earnings call?
Yeah, Scarlett, that's a great question. I mean, obviously, that was the first thing on everybody's minds. So, obviously, no specific commentary on Warner Brothers itself. But the one thing that they did say was that they think, there's no must-have for them. So they really kind of downplayed the whole need for M&A. They said that, they have all of the, they have a great portfolio of assets. Of course, we all know that these assets have been undermanaged for many, many years, underinvested. So there's a lot of work to do there. There's a lot of restructuring that needs to happen. But they really kind of downplayed, Warner Brothers. Of course, we know that, yes, they are making huge content investments. They are making huge technological investments. But if you look at their streaming service, which is Paramount Plus, it has roughly 80 million subscribers. Okay, they do have, all of these new content investments, let's say the UFC, Zuffa boxing, all of that, South Park. not enough to move the needle. And I think they know that, the street knows that, which is why they do need something transformative like Warner Brothers Discovery, which will really kind of put them on the map when it comes to streaming for sure. And also in terms of extracting more synergies on the linear TV side of the business, where they have huge exposure. Over 55% of revenue still comes from linear TV.
So when you look at the enterprise value of Warner Brothers Discovery, it's almost 3 times the enterprise value of Paramount Skydance, suggesting that if Paramount Skydance wants to do a deal here, they're going to need a ton of equity, whether it comes from Mr. Ellison or whether it comes from private equity or some combination. Is that kind of where people are thinking about it?
That is kind of where people are thinking about it. And, you know, what was really interesting, Paul, was, you know, they've made 3 bids for Warner Brothers Discovery thus far, all of which have been rejected. The last one was for almost $24 a share, which was basically 60 billion equity value, about 90 billion enterprise value. And the thing there was they were offering 80% cash. I mean, they first started out with 60%. They sweetened it to 80%. But David Zaslav, as we know, is really a tough negotiator and basically said no. So we think he's looking for something north of 30. I'm not sure Paramount Skydance is going to be willing to cough up that much, but let's see.
Yeah, that's a big question mark. Geetha, as you look at the media landscape, we're focused so much on Warner Brothers Discovery and what happens to its assets, what's happening to its businesses. What are we missing when we look at what else might be up for sale or might become, not up for sale, but something that a buyer might be interested in pursuing?
Yeah, I mean, when we look across the landscape, you're absolutely right, Scarlett. And the reason why there's so much of attention on Warner Brothers Discovery is because it's really kind of the last big, iconic studio. If you're looking at it, a huge streaming property with HBO, huge names in the business, just iconic big franchises. Big brands, core franchises, things that can really move the needle for any company, for any buyer. We don't really have anything quite like Warner Brothers. Yes, we have a lot of smaller names. You can think of it AMC Networks. You can think of Lionsgate Studio. You can think of Comcast's new spin-off cable TV networks, which is called Versant. But none of them as attractive, as Warner Brothers. So there are a lot of opportunities for consolidation. You have a lot on the broadcast TV station side, whether you're thinking of a Gray or a Sinclair. But again, nothing quite as attractive or as massive as Warner Brothers Discovery.
Timing. When do you think something might happen with Warner Brothers Discovery?
It has to happen quickly, Paul, because they, if Warner Brothers Discovery doesn't decide to go ahead with a sale, they do have a split of the company, which is, splitting the company into the TV networks division and the streaming and studios division. That is supposed to happen sometime mid-2026. So I'm assuming, things have to move pretty quickly in the next couple of months.
All right, good stuff. Thank you so much, Geetha Ranganathan, Bloomberg Intelligence Analyst on U.S. media. She is the go-to person for us here on all things related to U.S. media. And there's a lot of excitement, Paul, about U.S. media because this consolidation that everyone's calling for has been long awaited.
Yeah, we've had many rounds of consolidation in this industry over the last 15 years as it's dealt with technology really upending the industry. And there's probably another round to go here.
Yeah, well, we'll see. We know that Warner Brothers Discovery is looking into all possibilities. This is Bloomberg.
Markets, headlines, and breaking news 24 hours a day at Bloomberg.com, Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
11:40 on Wall Street. I'm Alexis Christoforous, and stocks are taking a little bit of a breather after that big broad-based rally we saw yesterday. Investors still hopeful the longest U.S. government shutdown in history will end possibly by tomorrow. The Dow Jones Industrial Average up 235 points at 47,602. In the broader market, the S&P 500 down 18 points. NASDAQ off 186 points right now, pulled down by big tech, including shares of NVIDIA. We've also got shares of CoreWeave on the downside today. The cloud service provider cut its annual forecast in its latest earnings. Bloomberg's Valerie Title explains why.
They had a delay within a third party on building out a data center, and that delay means that they could not fulfill a customer contract, and they had to essentially mark down their guidance when it comes to sales for the remaining quarters of the year.
CoreWeave is part of a group of companies known as Neo AI Chips. Microsoft and OpenAI are among its biggest customers. Gemini Space Station shares there off nearly 15%. The crypto exchange founded by the Winklevoss twins reported a steeper loss than expected in its first earnings release since going public. And we've got shares of Beyond Meat coming under pressure, off 8% now. The plant-based protein company's loss widened and sales sank last quarter as demand from customers and restaurants fell. To recap, stocks are mixed. The Dow is up 234. For on-demand news 24 hours a day, subscribe to Bloomberg News Now wherever you get your podcasts. I'm Alexis Christoforous. That's your Bloomberg Business Flash.
All right, thank you so much, Alexis. This is Bloomberg Intelligence with Paul Sweeney and Scarlett Fu. And one subject that I can't get enough of is premium credit cards and the rewards that you rack up if you use them only and certain times at grocery stores versus restaurants versus to pay for your plane ticket. Well, there's been a settlement between Visa, MasterCard, and merchants that may change the way that we use our premium credit cards. And Justin Teresi is here with us. He is a BI litigation analyst here at Bloomberg Intelligence. Justin, what happened and what does this mean for my Chase Sapphire card or my Amex Platinum card?
Yeah, really big news here. So first of all, this case has been going on for about 20 years now. Longer. It started before I went to law school, which was a long time ago. There's salt and pepper in my hair, so we're talking about a really, really ancient case. But basically, what a lot of folks don't know is when you have those really valuable premium cards, right, the airline miles cards or the cashback cards, there's a fee associated with those, and it's the merchants who are eating that fee, typically around 3 or 4%, depending on the varying swipe fee when you use it at a register. So merchants, no surprise, they're upset about that, right? So Visa, big litigation here, the accusation being that they fixed those fees and that, the merchants are basically the ones eating the cost there. So big deal announced yesterday between Visa, MasterCard, and merchants would make a little bit more flexibility on the part of merchants here. They could basically say, hey, we're going to take the lower tier version of a Visa and MasterCard, but we're maybe not going to accept airline miles cards or cashback cards. And then alternatively, they also might have the option of passing those fees onto you, the consumer, at the register if they do take them. So some big changes here and how things are shaping up.
Well, I've noticed in the last couple of 3 years, they are doing that.
Yeah.
I mean, almost every merchant I go to now, I don't know if it's just a state of New Jersey thing, but they're saying, hey, here's the cash price, here's the credit card price.
Yeah, Paul, this is actually a really interesting issue here because state by state, there's a lot of differences in how this actually plays out. In New York, and I see this too, when I go to my dry cleaner, it's like, oh, maybe that's 4% more if I'm going to use my credit card here. That's actually illegal in New York right now to do that, but the enforcement seems to be lacking. That this is a new law passed in 2024. There has to be an upfront kind of price on a tag if they're going to pass a surcharge onto a consumer in New York. Massachusetts, Connecticut, you can't surcharge at all. So if this settlement goes through, that's a big question mark too.
Interesting that you say that surcharge is illegal in New York, because what I've seen is the dry cleaner will say, we'll give you a discount if you pay in cash. Here's the regular price, but you get the discount if you pay in cash. So it's no longer a surcharge. Justin, you said that this has been a case that's been around for 20 some odd years.
Yes,
so
yes.
This settlement that was announced yesterday, I mean, is it just going to get caught up in more legal quagmire?
It really could. So last year there was a first attempt at this. This is the second try now, right? And the big issue that blew up the deal last year is that the smaller merchants kind of pushed for the terms that they set in the first place. And big folks like Walmart, et cetera, kind of got iced out from the discussions on that. It seems like that might have happened again here. The National Retail Federation was out yesterday saying, wait a minute, what kind of business practice would this be for us to say, hey, we're going to take these cards and not those cards? And they're also criticizing the fee concessions that were part of this deal, too, for the next 5 years or so. So I think there's still a lot of questions here. There's probably enough changes from last year's deal to get it over the finish line, but there's a big period here with objectors who are going to be weighing in on what they think of the deal. And honestly, the judge last year, she said, look, you guys can do a lot more than you're offering to do in this deal. So is this enough? That's going to be a huge question moving into an approval hearing.
What are the dollar amounts we're talking about here? In this?
Yeah, you know, so it's quadrupled according to the National Retail Federation since 2009. But Visa and MasterCard, they've got 80% of this market for the card fees, right? $111 billion last year alone collected in these swipe fees, according to the NRF. So really massive, massive. But, you know, these companies are also diversifying their streams, right? They're looking into digital wallets and other payment platforms, too. So there's a lot more on the table now than there was when this was first brought back in 2005.
And to be clear, this is Visa and MasterCard and merchants. What about American Express? Where does it sit here?
Yeah, so that's another great question. American Express basically settled a version of this lawsuit, or won a version of this lawsuit years ago. Their card acceptance terms are a little bit different. Surcharging isn't really allowed with those when it's not applied to all card types, right? But that begs the question, if you start allowing surcharging through cardholder or through acceptance agreements for Visa and MasterCard, does Amex now have to allow surcharging on its card? So that's another big question mark if this deal goes through. It really has the potential to impact everything, not just Visa and MasterCard.
Paul, I remember when Amex used to be accepted everywhere. And then after a while, it was like, oh, we'll take Visa, MasterCard, but not American Express.
Yes.
Because it was always, for the merchants, too expensive.
Too expensive, okay. Yeah, I can't remember the last time I used my Amex card. Literally can't.
It's there in your pocket, though.
It's in my pocket.
Okay, see, that's the thing. I mean, what does this mean for companies that have corporate cards, Justin?
Yeah, so that's one of the different brackets here, too. So the way the settlement works is that it's going to divide cards into 3 different types. So it'll be commercial cards, standard customer cards, and then premium customer cards. I think the commercial and standard cards, you know, you want that corporate business. I think those two really are of the less concern. It's those premium cards, I think, with the rewards that really are on the line here in terms of whether or not they continue to have that universal acceptance everywhere.
So there's so many businesses built around how to gamify your points.
Oh, yeah. I love it.
And how, so you do that, Chris?
I absolutely love it. I mean, every day it's like, oh, these Amex offers, you know, what can I get here for this discount?
Do you keep a spreadsheet tracking your spending?
I don't, but I really should, honestly. I mean, it's that good, I think. So
Paul's like, I cannot get into this.
No, but the kids are, because I mean, I've noticed it that they really are good at gaming the system.
Yeah.
And to the point where, you know, I'm going to Barcelona for the weekend on points. You know,
right,
kind of
exactly. And these premium credit cards are almost like coupon books in many ways, right? Because they offer, you know, like $50 a quarter at, well, actually it's $75 a quarter at Lululemon, for instance, under the Amex Platinum card. And then people try to buy a gift card and stack them and use them like a year later. Paul's laughing at me.
Absolutely true. And they carry those really high annual fees. But then again, I always think to myself, look how much I'm getting back for this. It outweighs the fee sometimes, at least in my mind. So there you go.
All right.
What are Visa and MasterCard saying about this?
So they signed on to this deal. They reached this agreement. I think they're pretty happy with the terms of it because, you know, that kind of lets them walk away. The issuing banks like JP Morgan, Bank of America, all of them are also defendants. They get to walk away from this litigation. The overhang would be removed, right? So it's really the merchants. Are all of the merchants going to sign on? And what do those objections look like in the next coming months to the court? So,
all right, Justin, thank you so much. Appreciate that. Justin Teresi, antitrust litigation and policy analyst, Bloomberg Intelligence, joining us live here in our Bloomberg Interactive Brokers studio.
What do I do now? What credit card do I use?
I don't know. I mean, remember the old days it was just Visa. It was just like no branding on it.
Right, and that's what you thought, except like this Visa, you pay a lot in annual fees for, but at least you get something back. But now if I have to downgrade to a basic card, that's fine, but you know, which one? Because they can then make a distinguish. They can distinguish between this one versus that one.
All right, very good. We'll pay attention there. It's in the courts, 20 years. We'll see if they can get it right here. S&P 500 off 13 points, kind of coming off at the bottom of the day. The Dow up 285 points at 0.6%, and the NASDAQ down 175 points, about 0.75%. Coming up, we're going to check in with Matthew Palazzola. He's a Bloomberg Intelligence insurance analyst. He's been covering Berkshire Hathaway for many, many years. We're going to talk to him about Warren Buffett. Says he is, quote, going quiet, and he's going to pursue his philanthropic efforts a little bit more. What does that mean for Berkshire Hathaway and for the insurance business. That's coming up. This is Bloomberg.
This is Bloomberg Intelligence with Scarlett Fu and Paul Sweeney on Bloomberg Radio.
I don't know, for a lot of us that have been in this market for a long time, this is kind of the end of an era, if you will. Warren Buffett saying that he is, quote, going quiet, marking the end of an era for one of the business world's most watched investing gurus. He will stop writing Berkshire Hathaway's annual letters and speaking at its meetings. Let's bring in Matthew Palazzolo. He's a senior analyst. He covers Berkshire Hathaway and the property and casualty insurance business. He joins us here in our Bloomberg Interactive Broker studio. Boy, again, for most of corporate America, this is a big piece of news that Warren Buffett is stepping back from the day-to-day, which he's been doing over time, I guess.
So, kind of sad day, sad for us Berkshire watchers. But we've known it. I mean, so we knew this letter was coming out. He does this every year around Thanksgiving. We also knew he was stepping down as CEO. So not huge surprise in this letter. I think the going quiet thing was kind of took everyone a little bit by surprise. I think maybe the thought was, hey, he's stepping back as CEO, but maybe he'll kind of be out there in the public, and he's still chairman. So maybe we'd still hear more from him. A little while ago, he said he wasn't going to speak at the meeting, and now he's going to kind of focus on his philanthropic work. And he's also 95 years old. He's maybe a little tired.
Yeah, exactly. And he's going to donate more than $1.3 billion to 4 family foundations and plans to, quote, step up the pace of his charitable giving to his kids' foundations while he's still alive. So that seems to be the point of life he is. Any reason to think that the business strategies, the operations of Berkshire Hathaway may change now that he has kind of step back another step, I guess?
So I don't think so right away. So he is always praising his successor, Greg Abel, talking about how he maintains the ethos of Berkshire, and they'll be doing the same thing. I think Abel walks a fine line now where I think over the next couple of years, he will want to put his own stamp and make a name for himself, but also not stray too far from what has led to this massive value creation at Berkshire. So I don't think anything dramatic happens in the near term. You know, we talked about this, I think, in the past. The amount of capital they're sitting on, and Abel is a good capital allocator, at least according to Buffett. Maybe something happens there, special dividend or something like that. You know, no guarantees on any of that stuff, but I could see Abel wanting to put that kind of stamp on the company.
Because again, what we learned, I guess, from the last quarterly release was the cash is now $382 billion. You know, it's a number that's, you know, most portfolio managers wouldn't know where to start.
It boggles the mind. I think even in the letter he had mentioned, there's just not a lot of things that move the needle for them. So they bought a $12 billion company in Allegheny a couple of years ago. It doesn't really move the needle that much. It helped the insurance businesses grow a little bit, but overall for the company, not dramatic. They bought this $11 billion chemical business from Occidental. You know, these are $10 and $12 billion deals, but they're just not moving the needle for the company. So there's not a ton they can do too dramatically.
Historically, why is Warren and the company, what's been their thought about returning cash to shareholders?
Their thought has been, we don't want to do that, right? He even said, you know, Berkshire shareholders have foregone dividends for reinvestment in America, something like that. I forgot the exact line. And that was Buffett's, he likes collecting dividends. He doesn't like paying them. I think he always thought we are the best allocators of this. So if you're a owner of Berkshire shares, would you rather have some money, or would you rather have Warren Buffett invest that money for you?
Right.
I think over the past couple of years, again, they've had so much money that it's been tough for them to invest it in effective ways, but that's been the philosophy.
Yeah, because, I mean, I guess my response would be, I can put it in cash too and get similar rates of return to you. And I guess that when it's 10, 20, 50, $100 billion lying around, not that big of a counter argument. Now it's,
you know, it's significant, and it helped their earnings over the past couple of years. Just getting 4% on that was a dramatic tailwind to their earnings. So, you know, it didn't do much for the stock after Buffett said he was leaving. That's been the thing that's weighed on it more than anything else. But and you'll see short-term rates going down, so that tailwind diminishing. I mean, I think there is a school of thought that Berkshire, you know, not the same without Buffett, but just maybe not as good at almost all of their things. That's one school of thought. I could see other ones where, you know, still Abel maybe takes a different direction, so that's another maybe catalyst for the shares. But, you know, it's a kind of darker time for Berkshire.
And what's Warren's ownership stake in the company?
So I don't, off the top of my head, I don't remember.
Is he still controlling?
Yeah, oh, for sure.
Yeah.
And
so you're not going to have an activist investor come in here and say, this is just a poor allocation capital.
It would be impossible. He owns too much. And the A shares, I believe, are 10,000 votes to a B share. He owns most of them. He's going to step up the amount he's giving away, but he still owns too much for anyone else to step in. And should he die, in his will, he would, I think it's over 10 years, his ownership goes to these foundations run by his children, who I can't imagine would, you know, let them kind of immediately fall into the hands of some sort of activist investor. I think he'd set a time frame of over 10 years that he'd want that stuff divested. But he does want it divested. He doesn't want them to just hold on to it.
Right, very good. All right, Matt, thanks so much for joining us. Matthew Palazzoli, he's the senior analyst covering the property and casualty insurance industry, talking to us about Berkshire Hathaway and Warren Buffett, saying he is going to go quiet and step up the pace of his giving. So there you go, a change in that story as well. For our listeners in the U.S., a reminder, you can listen to us via satellite radio on Sirius XM Channel 121, access the world's only global audio business network, coast to coast 24 hours a day. Bloomberg Radio on Sirius Channel XM 121 is presented by Oracle. Stay tuned for the latest market news and industry research. Your top stories and global business headlines are coming up in just a moment. The S&P's down 15 points. The Dow's up 300 points. That's 0.6%. The NASDAQ is down 185 points. That's 0.8%. The bond market is closed today. Looking at Brent crude, it's up $1.65 a barrel. We'll have more coming up. This is Bloomberg. Good morning.
CBS News on the Hour, sponsored by Progressive Insurance.
I'm Steve Kathan. Veterans Day at Arlington National Cemetery.
Ceremonial cannon fire rang out as President Trump's motorcade arrived at Arlington to preside over remembrance of the nation's veterans on the 11th hour of the 11th day of the 11th month. In a solemn event, the President and Vice President Vance placed a wreath at the Tomb of the Unknowns and then on to the amphitheater. The President joined military, family members, and the public for a Veterans Day program. Linda Kenyon, CBS News, the White House.
The measure to end the government shutdown is headed to the House of Representatives, where there could be a vote as soon as tomorrow. CBS's Natalie Brand at the White House.
The president signaling that he does, in fact, support this and hoping that government reopens as soon as possible. And because of that support, the Senate Majority Leader John Thune believes this will clear the House with House Republican support.
However it all plays out, the situation is still tense and unsettled at the nation's airports due to shortages of air traffic controllers. More than 1,000 flights have been canceled today.
The head of the National Air Traffic Controllers Association, Nick Daniels, says they are suffering.
They can't pay for gas to get to work.
In Jacksonville, Florida, this traveler says,
we need to get them paid. There's a lot of lives at stake.
This traveler in Newark, New Jersey, says she's just hoping her flight leaves on time after a very challenging process.
Very tired, exhausted, and so we're here early.
Allison Keys, CBS News.
Officials tell CBS News several Border Patrol units are pulling out of Chicago this week. Some will be deployed in Charlotte. An early blast of winter that brought snow to the Great Lakes region also features bitter cold air. Wind chills were in the teens this morning, stretching from the upper Midwest to the east and parts of the south. CBS News meteorologist Rob Marciano.
These are record lows, 28 degrees in Mobile, Baton Rouge 30 degrees, 23 degrees in Montgomery. My goodness, this is and 25 in Macon, so you get the idea.
A country hit made by artificial intelligence has climbed to the top of a Billboard chart, a first for the genre.
Been beat down, but I don't stay low.
The song Walk My Walk by an artist known as Breaking Rust is now #1 on Billboard's country digital song chart. Checking Wall Street, it's a mixed bag. The Dow is up 323 points. The S&P is down 10, and the NASDAQ is also trading lower. This is CBS News. Has the Pope gone Hollywood?
Pope Leo has invited filmmakers like Mad Max director George Miller, Spike Lee, and actors Cate Blanchett, Adam Scott, and Viggo Mortensen to a meeting Saturday. The Vatican says the pontiff wants to explore possibilities for using artistic creativity to promote the mission of the church and human values. The Vatican's also shared the Chicago natives' favorite films. Among them, The Sound of Music, It's a Wonderful Life, Ordinary People, and Life is Beautiful. Deborah Rodriguez, CBS News.
3 Chinese astronauts have been temporarily stranded at the country's space station after the vehicle they were set to travel aboard back to Earth was hit by debris. The extent of the damage is not clear, and it's not known when the astronauts will be able to return. I'm Steve Kathan, CBS News.
from Washington, D.C., this is Balance of Power with Joe Matthew.
The government could reopen as soon as tomorrow, but it may not feel like it. Welcome to the Tuesday edition as the House heads back to Washington after the Senate at last passed a stopgap bill to fund the government. Air delays, though, and food assistance could get worse before they get better. We'll have the latest on all of this for you when we sit down with Bloomberg's Laura Davison here in Washington. And we'll talk to our political panel. Rick Davis and Jeannie Shanzano are with us for the hour, Bloomberg Politics contributors, as we wait for the voting. New questions about the AI spend today after CoreWeave cut its revenue forecast. It might be a little more complicated than that, though, and we'll talk it out with Caroline Hyde from Bloomberg Tech. All after we update Wall Street. Let's see how stocks are moving with Alexis Christoforous at World Headquarters in New York. Alexis?
Well, Joe, we're seeing another sign of weakness in the labor market from private payroll provider ADP. Bloomberg's Enda Curran has the numbers.
Jobs fell an average of 11,250 on a weekly basis in the 4 weeks up to October 25, John. Now, on a headline basis, taking that at face value, it suggests, it certainly leans against the labour market stabilisation idea. It probably does capture some of those headlines we've been seeing on big high-profile companies making job cuts across the country.
ADP's report comes as major companies such as Amazon, IBM, UPS, Target, Microsoft, Paramount, and General Motors announced plans to eliminate tens of thousands of jobs. Stocks are mixed on Wall Street, a record-setting 42-day U.S. shutdown on a path to end as soon as tomorrow after the Senate passed a temporary funding measure which would keep most of the government open through January 30th. The Dow up 330 points, but the S&P 500 down about 5. We've got the NASDAQ off 134. Shares of plant-based protein company Beyond Meat down nearly 7%. The company's loss widened and sales sank last quarter as demand from customers and restaurants fell. And shares of Occidental Petroleum up 2.5%. The oil and gas producer posting mixed quarterly results. Adjusted earnings topped expectations, but revenue disappointed. For on-demand news 24 hours a day, subscribe to Bloomberg News Now wherever you get your podcasts. I'm Alexis Christoforous. That's a Bloomberg Business Flash. Back to Balance of Power and Joe Matthew.
All right, Alexis, good to see you. We'll have more on the markets with Alexis Christoforous in about 15 minutes here on Balance of Power, on Bloomberg Radio, on satellite radio, channel 121. Put it in the memory bank, put it in the presets. We're here every day, and you can always watch us on YouTube where we're streaming live. Search Bloomberg Business News Live to watch the radio show on TV. It's day 42, and it's not going to be the end of the shutdown, but we appear to be on the eve of something actually happening here on this 11th of November, Veterans Day. About 24 hours from now, a little more than that, it looks like there will be a vote in the House. And this, of course, follows the vote last evening in the Senate. 60-40, just like the procedural votes that led up to the big one. 8, I won't say Democrats because there's one independent in there, but of course he votes for the Democrats, crossed the aisle, said no to Chuck Schumer and voted for this, and now we're rolling to what appears to be the government reopening. Some 54 days since the House has been in session. And, you know, you see lawmakers here every day on Balance of Power. A lot of them have stayed in town, but a lot of them have gone home. And if you've heard about what's happening at the airport, you realize it may not be as simple as just calling everyone back. But if everybody gets back here by tomorrow morning, you're going to see some things happen. Speaker Johnson telling reporters he believes he has the votes to pass this with the changes in the House. He's not going to have Gregory Meeks with him. We talked to the Democrat from New York on the late edition of Balance of Power yesterday, not mincing words on what he thinks about this. Here's the congressman.
This is a terrible bill. It does not do anything about the Republican trying to destroy health care for Americans. And we know hundreds, thousands of individuals on December 31st could be without health care. They can't afford it. That's devastating. The whole issue of the election this past Tuesday was about affordability.
Recalling the elections of a week ago today. Now, that was a sentiment shared by pretty much every Democrat we talked with yesterday, in many cases outraged that there was a jailbreak in the Senate, all based on the promise of a vote. This is how this went, right? John Thune said, I'll give you an up or down vote on extending health care subsidies, Obamacare subsidies, once we reopen the government. but there's no idea, no detail on what a deal might look like in terms of extending them. In fact, there's no promise even for a vote in the House. So there are big questions right now about what Democrats may have just walked away from. Mike Johnson is refusing to commit to an Obamacare vote in the House, even as we prepare to reopen the government. Laura Davison is with us here in Washington for her take on all of this, our deputy Washington bureau chief, who has been knee-deep in all of this stuff since long before the shutdown. 42 days, huh? Just making history every day around here.
42 days, and it looks like we'll probably be 43 or maybe 44 by the time this is all done. So, you know, 8-9 days beyond the record that was set in Trump's first term. So lots of history.
Yeah, so top that. Well, maybe in January when we shut down again, we'll top that. I'm not sure, although maybe we are going to be talking about that, but because this goes through January 30, correct?
Most of the government, yes, is funded through January 30. There's a couple things, the Department of Agriculture, for example, so SNAP benefits are funded for the full fiscal year, but we could very much be in this place in just a couple months from now, particularly, as you were talking about earlier, this vote on the Affordable Care Act subsidies does not go Democrats' way. They may decide to push forward on a shutdown yet again.
What are we hearing, if anything, about lawmakers getting back to town? Will Speaker Johnson have a quorum by the time he needs it tomorrow?
If he doesn't, come 4 o'clock, that's when they're supposed to be back at the Capitol, you can expect that he's going to wait because he's going to need every single person in the building to get this done. Democrats have said they're not going to vote for it. There may be a handful of moderates who decide it's in their political interest too. But so Johnson's going to have to keep his conference together. He's got a 2-vote basically margin for error there. Thomas Massey's probably a no because he's always a no. So we're going to be looking closely at the Freedom Caucus folks, some of the other members who don't like to vote for some of these spending bills, and Johnson's going to be, arm twisting on the floor. The Freedom Caucus has come out and said that they think this is a good bill, and it looks like they'll vote for it. But
really, okay,
Johnson has a lot of unruly members, and we've seen this time and time again, where there's a vote that they're keeping open for hours potentially, as they're trying to cut side deals, get something done to get this across the finish line.
Look, obviously, Obamacare subsidies are going to go up in red states just like they are in blue states. Is there an assumption that an extension would pass if it got to the floor? Because we have no guarantee that this even gets a vote in the House.
It very much depends on what the Democrats decide they want to vote on. Remember that even those details there are not fully decided. Is it a 1-year extension? Is it something bigger? Do they put some restrictions on those tax credits so to maybe get some more Republicans on board? There was a meeting in the Senate yesterday with Democrats. They came out of this basically being like, we have concepts of a plan. Remember that was Trump's term, but they do not have a fully formed plan of attack here. So that's going to be really critical. But as the pressure really comes on Republicans, that's when you may see more and more saying, hey, we need to do something because I'm getting hammered in my district over this issue.
More than 1,100 flights canceled this morning as we now clamp down 6%. It's going up a little bit each day, 6% capacity cut. Chicago's O'Hare, Hartsfield, Jackson, Atlanta were in tough shape yesterday. 10,000 delays since this all started. And that's going to keep getting worse till we get to 10% at the end of the week here, right? Reopening the government in the middle of the week, for the sake of our listeners right now, some of whom may be on their way to the airport, or God forbid are flying in the next couple of days worried about what's going to happen. This will not be relieved for more time. It's going to take days, if not weeks, to get the entire air traffic system up and running.
Yes, because you have planes, you have pilots, you have crews all in the wrong places because they're having to cut flights day by day. So we could even see, if the government, is fully reopened, say by Friday, we, through the weekend into next week, we'll still to see some of these latency delays. That's the same for kind of all the other pain points of the shutdown. Federal employees are supposed to get paid as soon as possible, but unclear exactly when that pay date will be. And same with SNAP benefits. States need to turn that machine back on. So there's a whole reopening process that, depending on when Trump actually signs that bill, when people get back in the building, federal workers, it's probably looking like they may not necessarily be called back into the office by Thursday, but maybe by Friday they should have their business casual dusted off and ready to go back to work.
Okay, all right. You mentioned SNAP. This is important. Just yesterday, there was already a path to reopen the government. The administration again asked the Supreme Court to block a lower court decision that would require it to pay food assistance in full under the SNAP program. I have never heard of politics like this before. What is the administration trying to do here, and how do they expect that to play middle America when people aren't getting food.
This is a really surprising political move. When this court first came out and said, hey, you have to pay these SNAP benefits, the Trump administration said, okay, great, we're not going to appeal, we're just going to do it. But then there was sort of a question about where exactly the money would come from, and they've just made the choice to fight this sort of every step in court. So that means that the benefits that people were expecting to get, October 31st, November 1, it's now, almost 2 weeks past that deadline. They haven't gotten. So you're starting to see, the lines outside the food banks, a lot of private groups trying to fill the gap here. But this has, been a bad political story and potentially an issue we could see play in the midterms of people saying, why were Republicans, actively trying to keep, my family from being able to buy groceries?
Is there an answer for that? We're talking about 42 million Americans, and I believe the administration is paying half of the benefits right now, or it's 50 or 60% based on a prior ruling. But are they just trying to make this a legality issue? This is about the letter of the law, funding. How do you not pay SNAP benefits?
This is really, this is in past shutdowns, SNAP has always been paid. So this is a new, novel legal fight, but it's in line with what we've seen more broadly from the Trump administration of trying to pull back, pause payments. We saw, transportation payments, say to New York, be paused during the shutdown. Part of the deal in the bill that would reopen the government is that funding would resume. But you're starting to see the Trump administration really, and this is under Russ Vought, the OMB director's guidance, really test the boundaries of where, how you can centralize power within the White House and keep it away from Congress when it comes to federal spending.
So we step back from all of this and imagine the president signing a bill on Wednesday night or Thursday morning. Is that the going thought?
That's the going thought. Okay. It really depends. The House, they're supposed to come back at 4, but I imagine we are going to be way into Wednesday evening, perhaps even early Thursday morning by the time it's all said and done.
Is there or maybe you're not hearing this, is there a signing ceremony, or is this just done quietly? Thank God the government's open again.
We will see. Nothing is scheduled yet. It's almost certain that they're going to want to do this quickly. So if they're able to pull something quick in the Oval, they may do it, or they may just have Trump sign it and get everything back rolling again.
No auto pen, I guess. Well, it's going to be interesting. To your point, it's going to take days, if not a couple of weeks, to refill EBT cards. That would be SNAP, right? It's going to take time to get air traffic controllers from Uber Eats and DoorDash back into the tower. And it's going to take some time to get people paid again who work for the government. We don't have a timeline on any of those right now.
None of that. We're waiting for guidance from each agency will come out. OMB will also put out some of this guidance. Okay. But it's right now in kind of this waiting period where no one really knows. And remember, the federal government today is extra closed because it's Veterans Day. So even some of the people who may be getting some of these things prepared to push out, in advance of the president's signature are also not working.
I hadn't heard that. Did you know that, James? The government's extra closed today. We got the holiday. That makes a lot of sense. Laura Davison helps to run the bureau here in Washington, our deputy Washington bureau chief. Great to have you back, as always, Laura. We're going to dig into this CoreWeave issue next. Is the AI spend at risk? It's next on Bloomberg.
12:21 on Wall Street. I'm Alexis Christoforous, and stocks are mixed as investors remain hopeful that an end to the longest government shutdown in U.S. history is near. The Dow Jones Industrial Average sprinting ahead 350 points, a gain of 7.1%. The S&P 500 is basically flat, and the NASDAQ Composite off its lows of the session, now down 120 points, a loss there of 0.5%. Bond market is closed today in observance of Veterans Day. Japanese tech giant SoftBank says it sold its stake in NVIDIA, raising $5.8 billion to pour into other investments. Quarterly profit nearly tripled from a year ago thanks to gains in its investment in ChatGPT creator OpenAI. SoftBank is a major investor in the $500 billion Stargate project here in the U.S. Shares of NVIDIA down 3%, but SoftBank rallying 1.5%. And Walgreens will no longer give many of its retail workers paid vacation time for Thanksgiving, Christmas, and other major holidays as the company looks to cut costs under new owners. Now, full-time hourly employees have to work on the holidays to get paid, according to records reviewed by Bloomberg News. Walgreens Food Alliance was taken private in August by Sycamore Partners. For on-demand news 24 hours a day, subscribe to Bloomberg News Now wherever you get your podcasts. I'm Alexis Christoforous. That's a Bloomberg Business Flash. Back to Joe Matthew now and Balance of Power.
Alexis, thank you so much. We'll have more on the markets with Alexis Christoforous. Just about 20 minutes time in for Charlie Pellet today on Balance of Power, and it's good to see you. Welcome to the Tuesday edition. The government is still closed, but about 24 hours from now could be set to reopen, and we're going to have more on that coming up with our political panel. The bill passed the Senate last night. Lawmakers in the House are scrambling to get on airplanes around the country right now. Maybe Matt Shirley can tell them how to get here on time. Thousands of delays as we wait for everybody to get back for a vote to reopen the government. It does look like the Speaker has the votes. Don't ask me about Obamacare yet, because that remains very much up in the air. I woke up this morning to this headline, Bloomberg Daybreak, surprise sale. There was a big picture of like a dump truck dumping NVIDIA shares. Now we've got some kind of other graphic up here. SoftBank unloads entire NVIDIA stake, it says, for $5.8 billion. What? Coming off recent all-time highs for NVIDIA, and of course, big questions about the AI spend. That then goes crashing into a headline about CoreWeave cutting its revenue forecast for the year. And people are saying, wait a minute, maybe this bubble talk was real. Stocks are heading lower. But when you start looking under the hood at the why, you might draw some different conclusions. And I'll point you no further than Bloomberg Tech today. What a fascinating conversation. Caroline Hyde, Ed Ludlow talking to the big boss at CoreWeave, Michael Intrater, about what exactly is behind this warning. Is this a major problem for the AI spend or a problem with one customer? Listen to Intrater earlier today on Bloomberg.
Occasionally you hit a bump in the road. What we're talking about here is a contract that gets pushed back by 1 quarter, let's say, and that the impact of that on our revenue is a delay of revenue, not a loss of revenue. And I think that is the definition of working with an ecosystem of good partners.
Okay, we've got good partners, he said. Just, I guess, one of them hit a speed bump with the headline on the terminal. CoreWeave cuts forecast after delay to customer contract. I'm sure Michael Intrater's having a heck of a day. Although anytime you get to talk to Caroline Hyde's got to be a good day. She's with us right now, live from World Headquarters in New York. Coming off of that interview, Caroline, I'm so delighted that you could join us here. And I've got a couple of very simple questions for you, as always. And you're really good always at helping to translate what's going on here to our listeners and viewers. Is this a CoreWeave problem or an AI spend problem?
I so appreciate that, Joe. And this is a supply chain problem. And this is a neo-cloud, as they're now known, basically compute providers, of which there are now more and more springing up, that used to be Bitcoin miners, had a load of compute, had a load of GPUs, and can now put them to work in AI. CoreWeave is the leading one out there thus far. And this is Michael Intrater saying, I have to depend on third parties. I have to depend on data center builders, and they have their own supply chain headaches of whether it be getting the sign-off to be able to build the data center out, whether they got the power, whether they've got some of the things that they put in the power cell, as they call it, really the power shell of the overall data center. That's complete. It's the interior that is having an issue, it would seem. And so therein lies the concern, is that this is a supply chain headache. It's not a demand side issue. It's not an AI bubble side issue. It's a, do we have enough boots on the ground, infrastructure to build out at the pace that we need to? And thus far, he's saying we've had a slip up with one particular contract out. He wouldn't name who it was for, but the data center provider is the one that's causing him the headache right now.
Yep. Wow. So is this an isolated event, or are we going to start hearing more warnings like this as we bump our head into the ceiling and can't grow as fast as we need to?
I think you're exactly right. And one of the best read stories yesterday was all about the power issues that many of these data center providers are running into, and they can't get it out as quickly as possible. And we've heard it come from the very top of the hyperscalers. Microsoft saying we would have had more Azure growth if we'd had the supply. And that's why the likes of Microsoft are depending on neo clouds. We've just seen once again that they're scaling up with Nscale over in Europe and building out in Portugal. The fact that we are seeing some of these companies, AWS and of course Amazon, really having to depend not just on homegrown, but maybe having to expand out to how they look out to different providers of the key infrastructure. And so I think more and more you're seeing Meta sign deals with the likes of CoreWeave, and CoreWeave has been desperate to say, look, we aren't so dependent on the key end demand, and they've been getting far more types of diversification as to who buying their compute, but they're also at length to try and tell us that we've also got diversification on who's building our data centers. He says, look, as we scale, as we continue to grow, this will become less and less of a headache because each individual data center becomes less and less integral to our entire business model. But I think really the supply chain issues are going to be a key one. And he told us in our interview that actually this is maybe where the US government can come on. We are relying on them to speed up the process.
Fascinating. Stock's paying for it. It's down 14% at the moment, and I know we've seen worse today. Caroline, tell me about SoftBank. You see a headline like this and people panic, frankly. $5.8 billion. Is this a SoftBank issue or an NVIDIA issue?
And is it a supply or a demand side issue? And once again, I think this is a supply of cash issue for SoftBank more than anything, because we've actually seen SoftBank before. Masayoshi Son has had this long-term love affair with Jensen Huang and with NVIDIA more broadly. He'd made an awful lot of money by betting on it very early days when really the GPUs were used for crypto and gaming, but he sold out in 2019 entirely, and boy did he rue the day of that, because he missed out on a huge upside in terms of NVIDIA. They started buying back and they got to about a $3 billion stake. That just escalated in value because of the $2 trillion that was added onto overall market capitalization of NVIDIA in that time that they built that stake. So they're cashing out, they're taking profit, and they said it's nothing to do with NVIDIA, it's to do with the fact that we need to use this money to put to work elsewhere. OpenAI, a key investment area of those. But they're also buying a chip maker, Ampere. They've been, of course, scaling out into robotics. They want to be working with TSMC here in the United States to build out the new AI gigafactories. They need money for that. And so they're selling off this particular winning bet. And winning bets have been aplenty. OpenAI already seeing a real impact on their bottom line in terms of the amount that the shares are now worth since they bought into that company. Interestingly, I think NVIDIA in the longer term might benefit from actually SoftBank selling out of their stock, because that $5.8 billion maybe gets put into their end demand.
Wow. All right. I like this. See, I knew this would help to talk to Caroline Hyde. Someday I want to know how you read in. Unless you're just brilliant.
Not using enough Gen AI yet, Joe. Yet I'm not using enough. Gen AI.
Yeah. Well, introduce me to your digital twin next time I'm in New York. Co-host of Bloomberg Tech. Thank you so much, Caroline. So there's this story. Let's get to the stocks and the reaction that we've been seeing around it. Interesting what Caroline mentioned, by the way. There is a Washington angle here, as so many of these companies ask the government to deal with red tape, to streamline regulations, and to deal with the NIMBY issue. But we're not going to solve all that today. The fact of the matter is, when you look at the markets and you go through the space, you've got the likes of Micron Technology down pretty hard today, 4%. NVIDIA, of course, itself is lower. Broadcom, slightly lower as well. So it's kind of hanging on certainly the stocks that are in the AI ecosystem, and that's why we had to dial up Christine Aquino, who's also with us from New York, managing editor, Bloomberg Markets Live blog, and a great help to us always when we're trying to get the landscape on Wall Street. Christine, it's great to see you here. How severe does this feel? Because a lot of these stocks, I just mentioned Micron, I think that was an all-time high just yesterday. So we're we're pretty frothy going into news like this.
Yeah, absolutely, Joe. And you can see it in the market reaction today, right? Because yesterday was such a big rally, mostly fueled by optimism over the potential end of the shutdown. And then 24 hours later, we get this news about SoftBank selling out of NVIDIA. And it really didn't take that much. I mean, NVIDIA's down, what, more than 3% at the moment? But because it's such a big stock and it's such a big driver of the rest of the equity market, it's dragging the rest of the S&P 500 and really the rest of the U.S. equity market along with it. And this is exactly the problem, right? Because when you have a stock like NVIDIA single-handedly driving moves in the equity market, this is where the concentration risk comes in. And this is when people start worrying, hey, is there too much kind of cross-pollination among AI companies? And if something stumbles, the rest of it will follow along.
Well, you know, that whole conversation about circular investing and the rest comes up on a day like this, right? Because one stock gets a sniffle and the whole sector gets a cold, or vice versa. I'm not good with my cliches today, Christine, but give me a sense of what the market thinks about this shutdown. Yesterday, it was all good vibes, but the market wasn't really worried about it to begin with, was it?
Well, it's very interesting, Joe, because there is a bit of a divide among markets. I mean, we did conduct a Markets Pulse survey most recently among Bloomberg clients. And, you know, on the one hand, they were saying that, look, another 1 to 2 weeks of the shutdown is really, that's when it's really going to start to bite for stocks in terms of just cementing the end of its record run. You know, we've had more than 40 record highs this year. That's all going to end if this shutdown lasts another 1 to 2 weeks. But then we also got from the same group of people saying that, you know, more than half of them or half of them are happy to just ignore it and keep buying stocks. And then the other half are probably trying to hedge against the downside or maybe look to havens like treasuries and gold. And so what you really have here beneath the surface of this rallying market, or you know, at least yesterday, is really a divided investor base where they're trying to think about next steps, even though at the moment they're still happy to hold risk assets and like stocks.
Interesting. I mean, it's not like we're selling off here. Actually, I mean, gosh, you've got the Dow up 400 points. Maybe a little bit of a mix up there as we try to look to quality, or I don't know, whatever we're going to talk about as an excuse when we get to writing stories later. But Christine, the bond market's closed today with it being Veterans Day. Does that have an impact on the stock market?
I mean, I think it really just kind of maybe limits the full extent of the reaction that we would have gotten today if both bond markets were open along with stock markets. And so that's something to watch out for when they reopen tomorrow in Asia and see, you know, how will the bond markets take this? And is this something that will be enough to extend the run of gains that they've been enjoying recently as the stock market was selling off? Or, you know, is this something that's kind of a bit of a storm in the teacup? Because as Caroline mentioned earlier, maybe this is more of a SoftBank financing issue rather than a bigger issue related to AI stocks. So we'll see how that goes.
Storm in a teacup? Is that a saying on Wall Street? I love that.
Let's start using it now. Why don't we?
Okay, I'm with you. All right, Christina Kino, the great Christina Kino, coining phrases live on the air. Storm in a teacup. That could be the name of your first album. Christine, great to see you. Thank you. And find the Markets Live blog unless you're already looking at it. This is the force behind Bloomberg's Markets Live blog. I'm Joe Matthew in Washington. We'll assemble our panel next. Yeah, Rick and Jeannie are back together this day. We're in the sandwich day between votes. The Senate passed the bill last night. The House is expected to time for life to get back to normal. This is Bloomberg.
1240 on Wall Street. I'm Alexis Christoforous. Stocks are mixed one day after yesterday's big, broad-based rally. The Dow Jones Industrial Average rocketing 385 points to 47,755. The S&P 500 basically flat, but the NASDAQ Composite is down 132 points. AI cloud computing company CoreWeave warning that revenues will be lower than expected this quarter because of a delay by a data center developer. We've got shares of CoreWeave coming under pressure, down about 14%. And shares of Meta down more than 1%. The company's chief AI scientist is leaving to launch his own startup. Bloomberg's Valerie Teitel has more.
This is a French-U.S. scientist who is considered one of the pioneers of modern AI. He worked on longer-term research products under Meta's AI research lab, and recently the CEO, Mark Zuckerberg, at Meta has been radically overhauling Meta's AI operations to focus more on rapidly rolling out models and AI products instead of long-term projects.
Zuckerberg has been luring staff from OpenAI and Google with $100 million pay packages to join his AI team. And Bloomberg News reports that Greece plans to raise as much as $9.3 billion from bond markets as the country prioritizes paying down its debt. Greece has succeeded in turning around its finances from the debt crisis that nearly forced it out of the euro a decade ago. For on-demand news 24 hours a day, subscribe to Bloomberg News Now wherever you get your podcasts. I'm Alexis Christoforous. That's a Bloomberg Business Flash.
Alexis, thank you, and great to have you with us here on the Tuesday edition of Balance of Power. We'll get another update on the markets coming up top of the hour, 1 p.m. Eastern Time, as we welcome our global television audience to the conversation. We do this every day live from Washington. Balance of Power, it's great to have you on the radio side here. Satellite radio, channel 121. If you've got a Sirius XM, we're always there. And, of course, on YouTube, where you can even pause this thing and back it up. Although they do that now at Sirius XM, right? We didn't have that when I worked there. Brand new age of media. So we're trying to get a sense of when the voting is going to take place tomorrow. We understand around 4 p.m. That might be the case with the House getting back to town today. The Rules Committee is going to get to work because the Senate did its job. They passed this CR plus minibus. I don't know if we have a nickname for it yet. It's going to go to the House tomorrow, and it's expected to pass. Speaker Mike Johnson says he's got the votes. Then magically, the president signs the bill. Government reopens. And we'll wait days, if not weeks, for airports to get back to normal, for SNAP benefits to be restored, for federal workers to get back on the job and start getting paid again. Never mind specifically air traffic controllers. That's a big issue here, and it's going to take some time to unwind. All of that, of course, leads us to a big floor vote on Obamacare. That was the so-called deal, right? John Thune's promising, he says he'll set aside floor time for a Democratic-led bill to extend Obamacare subsidies. We don't know if it's going to be a year or permanent or whatever. They've got to figure that out and write it. Republicans pivoting from the debate around the Affordable Care Act tax credits as we speak, though, to maybe coming up with their own plan. And Speaker Mike Johnson says, I never promised anybody a vote, so that may not go anywhere. Enter Donald Trump. On Laura Ingraham, Fox News last night sat down for an interview in which he talked about a lot of stuff. We went through the 50-year mortgage, talked about the shutdown itself, but also specifically health care. Remember concepts of a plan? The president's been working on these concepts, and it involves sending you money. Here's what he told Laura Ingraham about this last night.
What I want, and probably what you're alluding to, is the fact that I want, instead of going to the insurance companies, I want the money to go into an account for people where the people buy their own health insurance. It's so good. The insurance will be better. It'll cost less. Everybody's going to be happy. They're going to feel like entrepreneurs. They're actually able to go out and negotiate their own health insurance. And they can use it only for that reason. That's the beauty, only for that purpose. And if we did that, that would be so exciting. Call it Trump Care. Call it whatever you want to call it.
Trump Care, okay, to replace Obamacare. Well, then maybe that's what will happen. But the president's talking about the entrepreneurial exercise of you or me negotiating with an insurance company. That is the idea of how this works, right? You get a whole bunch of people together, pay into a pot, and then have some leverage to negotiate with said insurance company. Now it's going to be every man for himself. I bet you producer James gets a better rate than I got. Well, let's see how the panel feels about it. Rick Davis and Jeannie Shanzano are back with us today with the idea of Trump care on the menu. Bloomberg Politics contributors. Jeannie is our Democratic analyst and democracy visiting fellow at Harvard Kennedy School's Ash Center. Rick is our Republican strategist and partner at Stone Court Capital. Jeannie, the concepts of a plan are being fleshed out. And you remember Joe Biden used to talk about the dignity of having a job. He said it wasn't just about making a paycheck. It was being able to look yourself in the mirror, look at your family in the eye, and say everything's going to be all right. Now we suggest the dignity of entrepreneurialism. Is this what America needs, Jeannie?
It's as if he didn't live through all of the fighting on Obamacare. And, you know, Joe, it reminds me of in the early 20th century, conservatives pushed this idea of liberty to contract. We don't need minimum wage, minimum working hours. Let's let everybody be free to contract without remembering the imbalance in power between workers on the ground and managers and owners. And of course, that's the same idea here. We as individuals, without a collectivity, have no powers against the big insurance companies. Donald Trump thinks we all want to go out there and be entrepreneurs and spend our lives negotiating with insurance companies. I'm not sure what he's thinking, but I think my favorite quote in the last few days was when Kevin Hassett was on CBS asked about this over the weekend, and he said, oh, there's not really a plan. The president is just brainstorming. I don't know if this is like his riffing, but I can tell you it's not the thing you're supposed to do when you're president of the United States as it pertains to something as important as healthcare, to be out in public brainstorming, but he's continuing.
Well, I'll tell you what, Rick, the president, again, he said, it's so good. The insurance will be better. It'll cost less. Everybody's going to be happy. They're going to feel like entrepreneurs. Is there a chance that he's right?
It's hard to parse through the dialogue with the president. You know, he's not precise with the words he uses. It sounds a little bit like Bill Cassidy's idea, the Republican senator for Louisiana, who's on the negotiating committee that Thune just appointed. And he has this idea that you create accounts at corporations that you, if you're an employee who work for you, they put money in a pre-tax situation, which technically then maybe means you pay less because you're not paying taxes on the money that then is going to purchase insurance, and that you can purchase insurance through that account. Bill Cassidy's a really smart guy. He's a doctor. He knows the industry better than anyone. I would be deferential to him because he's looked at it from a point of view of, you know, ACA is fine with a lot of people, but it does raise the cost of medical care in the United States, and we should all be working to try and bring it down. But as you also point out, Joe, insurance companies like actuarial tables. They want millions and millions of people in a pool to then grade a price for the insurance. They don't want to just negotiate with you and me. And so there's a lot of wood to chop here. But look, Thune's put his group together that includes Cassidy, Schumer's leading the negotiators on the side of the Democrats. Somewhere in there is a way to manage the ACA subsidy issue and any other things that the Republican caucus wants to try to put forth.
Bill Cassidy's name's been coming up pretty often, Jeannie, and I'm not sure what he would think about what the president said last evening. Does he have the model for a Republican plan?
There are models out there, but none that has been a selling point. I mean, as we know, this has been the Achilles heel of the Republican Party for years. Anytime the conversation turns to healthcare, it has been a political loser, bar none. I'm just surprised that we're talking about this more than Chuck Schumer in the last 48 hours. But putting that aside, I mean, just think about what the president is saying. Has anybody, I'm expecting he hasn't, recently tried to call their insurance company? Do we all want to be waiting on lines to negotiate with some kind of robotic voice, press 1, press 3, go here, go there? I mean, what are they talking about? And until they can articulate a plan, which both Kevin Hassett and Scott Besson has said does not exist or is just, you know, they're just brainstorming about now, they have to be very cautious about this. And who knows this? Well, the president's poster, Tony Fabrizio, in July, big memorandum, which said, this is the death knell of the Republicans going into the midterms. They will lose by double digits in the 20 plus contentious districts if they are talking about this issue. So in fact, Democrats have been doing them a favor by trying to get a resolution. Extend the subsidies. I'm surprised they haven't done it just for a year until after the election. But since they're insisting on not, they are looking at a political loser. And my only guess is that Donald Trump doesn't care much because he's not on the ballot. And that's why people like Marjorie Taylor Greene do care an awful lot, because they are looking at their district and they know this is a loser for Republicans going into 26.
Well, Rick, we've got two different stories in the two different chambers as well. John Thune, as I mentioned, promised a vote. I believe that was part of the deal with Jeanne Shaheen here. The White House, I guess, was on board with this. Katie Britt started making phone calls, and here we have an off-ramp. But Mike Johnson is refusing to commit to an Obamacare vote on the House floor. What makes Democrats think this is going anywhere?
Because they still have a bullet in the chamber, if you want to call it that, with a vote at the end of January to extend either the appropriations bills or another CR. I mean, this isn't over, right? We just extended government funding from 2025. We didn't solve the problem, save for those three minibus appropriations that were passed in the Senate. Those come off the table, so it's not as horrific as it was before. But we could be waking up on February 1st with another shutdown. And so there is leverage. And my guess is, too, the president's already signaled that he wants to have a conversation about health care. And I don't disagree with Tony Fabrizio, as Jeannie points out. I mean, if I were looking at the results of Tuesday's elections and said, gee, we want to pivot to talking health care because that affordability thing isn't working for us, it's like, let's dig deeper and see whether or not we can really cover ourselves over with earth before the election day.
Wow. All right. Well, okay. So that said, Jeannie, if there's no extension of Obamacare subsidies, if Democrats don't get the deal they want, do we set a new record shutdown starting the end of January?
Oh, boy, I certainly hope not. But I do think it's possible. Even Jeanne Shaheen was out saying that, listen, to Rick's point, we have this deadline. It's there. We can be back at this all over again. The reality is that you've got the president who, even last night in that interview with Laura Ingraham, reiterated that affordability is a con job. He's not going to talk about it, doesn't want to talk about it. And to Rick's point, he's going to talk about health care. None of that makes any political sense for Republicans. Again, Fabrizio, July, I think the memo was, a 15-point loser for Republicans in these competitive districts for the House. And so, it would be a gift for Republicans to make a deal with Democrats on health care. I think it's possible they can do that in the Senate. But then they hand that hot potato over to Mike Johnson. And to your point, he told Jake Tapper on CNN, he said repeatedly, it's a non-starter there. And I don't know what happens, because who needs it politically more than anyone are the Republicans in the House. But they are dead set against it. And let's not forget, they're dead set against it without articulating a plan to move forward. So that's what they should be spending their time on. And they haven't, in 15 years, by my estimation, articulated a plan to combat the Affordable Care Act, and one that can sell to voters. And they're going to pay the price at the ballot box if they keep this up.
Well, I'll tell you, if you want to explore the split in the Democratic Party here between the moderates who voted yes in the Senate and progressives who are calling for their retirement, as written in The Hill appropriately, Thanksgiving dinner in the Shaheen household might be a little awkward. Enter Stephanie Shaheen, Democratic candidate for Congress in New Hampshire, same state where her mom is in the Senate, of course. Says she cannot support this deal and, in fact, demonizes it. Improving health care has been the cause of my life, she writes. It's why I am running for Congress, so I cannot support this deal, when Speaker Johnson refuses to even allow a vote to extend health care tax credits. Stephanie Shaheen says too many people will see health care costs already too high skyrocket even further starting in January. Knowing that her mother is the one who helped to spearhead the deal here, the meet in the middle with the White House and with John Thune in the Senate. It's going to be interesting to see how these two get out there in public. Our panel's going to stay with us in our next hour. Rick Davis and Jeannie Shanzano will be back in hour 2 as we welcome our global television audience. And Tyler Kendall will be with us for the hour as well. Thank you, Rick and Jeannie, Bloomberg Politics contributors. We're going to spend some time as well in our next hour with a member of Congress on his way back to town, Byron Donalds, the Republican from Florida, will join. And we'll talk to Jared Bernstein, former economic advisor in the Biden administration, about the job market with new ADP numbers out today. This is Bloomberg.
From Washington, D.C., this is Balance of Power with Joe Matthew and Kaylee Lines.
New signs the job market is slowing. Welcome to the Tuesday edition as ADP fills the data void with lower payrolls from October. We'll be talking about this coming up throughout the hour. I'm Joe Matthew alongside Tyler Kendall in Washington. She's in for Kaylee Lines here on the Tuesday edition of Balance of Power on Bloomberg TV and radio. Tyler, The reason, of course, why we have a vacuum of data is the government is still closed, although that may be changing in the next 24 hours.
Right. It feels like we are inching closer to the government reopening. It's now our understanding that the House is going to hold this vote on the package at 4 p.m. Eastern tomorrow. House Speaker Mike Johnson, though, still has some work cut out for him. He can only afford to lose 2 Republican votes, and that's if they all make it to town amid the shutdown delays related to our air system.
Trains, planes, and automobiles for House lawmakers, at least those who are not here, and they'll have about 24 hours to get back to town for what looks like will be a vote to reopen the government tomorrow evening. Then the president would sign that bill. How long it will take for us to start getting economic data remains a question, though, Tyler.
Right, as well as how long is it going to take for those recipients that get food benefits from SNAP? When are they going to see their accounts replenished, as well as when are we going to see our air travel system back up and running? Now, of course, you mentioned at the top there the ADP numbers came out. That, of course, is one of the metrics that investors have been watching amid this lack of data, and it's something that the markets responded to earlier today. So for a check on the Tuesday trade, we go now to Alexis Christoforous in World Headquarters in New York for a look. Hey, Alexis.
Thanks so much, Tyler and Joe. Yeah, stocks are trying to bounce off their session lows as optimism that this U.S. shutdown is coming to an end. That's helping to offset a technology sell-off today led by NVIDIA. We've got the Dow at its best level of the session, up 479 points. The S&P 500 now in the green by 10. And the NASDAQ off its worst level of the day, now down about 80 points, still pressured by declines in key artificial intelligence stocks following big gains in the previous session. Japanese tech giant SoftBank says it sold its stake in NVIDIA last month for $5.8 billion. The sale comes as SoftBank now focuses its attention on OpenAI. That's the startup behind ChatGPT, but SoftBank's still involved with NVIDIA through other AI ventures that use the chipmaker's technology, such as that Stargate project. Shares of NVIDIA down 2.7%, SoftBank rallying 2%. And CoreWeave, the provider of cloud computing services, said revenue more than doubled last quarter, boosted by that AI boom, while its net loss narrowed. But CoreWeave is flagging a delay by a data center developer, and that's pushing shares down today. And finally, Rocket Lab shares rocketing 3.3%. The space transportation company reporting revenue that beat Wall Street's estimates. For on-demand news 24 hours a day, subscribe to Bloomberg News Now wherever you get your podcasts. I'm Alexis Christoforous, and that's your Bloomberg Business Flash.
All right, Alexis, thank you so much. And thank you for being with us here on the Tuesday edition of Balance of Power. Over the course of the next hour, we're going to speak with Republican Congressman Byron Donalds of Florida. He, like many, are on their way back to Washington for an anticipated vote tomorrow to reopen the government. And we'll have some things to ask Congressman Donalds when he joins us later this hour. Jared Bernstein is going to be talking with us as well, Tyler. This idea that not only do we have a lack of data, but also data that may not reflect the way Americans are feeling. This is something that Donald Trump talked about a lot last evening in his interview on Fox News. Not buying the idea. He said he doesn't believe the polls and he thinks it's a Democratic con job that people are not feeling the benefits of this economy.
Right, and one of those polls was one of ours conducted by the Harris poll for Bloomberg News, which found that a majority of Americans aren't happy with the state of the economy right now. But what's important from that survey is that that is up from 41% back in February when President Trump originally took office. Affordability, of course, Joe, is going to be top of mind as we head into the midterms.
It was 1 week ago tonight when affordability featured prominently in elections, of course, in New York, New Jersey, Virginia. California might have been a slightly different matter, but that was a wake-up call for some Republicans, and that's why many Democrats were surprised to see the moderates flip in the Senate a couple nights ago.
Right, exactly, because the government shutdown has really been overshadowing those national headlines as it continues to drag on, and Americans feel the impacts. So for the latest on where we stand, on how close we are to reopening the government, we bring in Bloomberg's Wendy Benjaminson, a senior editor here in our Washington bureau, for a look on where this is all heading. So Wendy, just give us an update. Are we looking at the government potentially reopening by tomorrow evening?
It could be, because remember, but we're really close. I was just thinking whether it was Wednesday night or Thursday morning. President Trump has to sign the bill once it passes the House. So whether he chooses to sign it on Wednesday night or do it Thursday in front of cameras to make a big deal about it, which I suspect would be his preference, then that it could be Thursday. But the country is certainly on its way to reopening at this point. It'll be this week.
Now, what do we think about the optics here? Does President Trump have a signing ceremony at a moment like this, after the longest shutdown in history? Does he try to take credit for what happened here, or do we just do this quickly and get on with our business?
I don't know. I think he certainly could spin it, and this is what the liberal Democrats are so angry about, is that he could spin it as the Democrats caved in. It's all nonsense. As you talked about, he's mentioned a Democratic con job about how voters are feeling about the economy. Yeah. I would page Joe Biden to find, on whether it's really a con job or not. When Americans say they're unhappy, they're often unhappy. But so yeah, he could spin it as a total victory for himself. I also think that Democrats, were able to do this because they had won, as you mentioned last Tuesday. There was a Democratic sweep in generally liberal places, but Virginia is certainly purple. And it had become clear that they had won in terms of who was getting blamed for the shutdown. It is, at least I think by about 10 points, voters are blaming Republicans for the shutdown because they control the White House and both chambers of Congress. But so they've gotten that, and then the American public could turn on them very quickly if Thanksgiving travel is messed up, if people aren't getting their SNAP benefits, if this just keeps getting worse and worse and people are going without a third paycheck. I think the collective electorate might turn on the Democrats. So they can also spin this as the strategic thing to do to get the country back up and running.
Well, back up and running until at least January 30th. I'm curious if we can talk just a little bit more about what's actually in this package that we're voting on. One, are we going to be set up for another fight come the end of January? And two, I'm wondering how the White House is feeling about an important provision that Democrats got, which reverses those mass federal firings that we saw starting on October 1st and puts a block on them through at least January 30th. It's perhaps a simple stopgap measure, but there's also a lot of other things included that we should keep in mind.
Absolutely. There are all those things you mentioned, and you're right, blocking the mass firings was something Tim Kaine, the senator from Virginia, really wanted in there and got that. And so that will be good for federal workers, but you're absolutely right, Tyler. We are back here again, Groundhog Day, in mid-January when everybody gets back from the holidays, and here we are facing that again. There's also other little weird things in there, like some senators can now, there's a provision that allows senators to sue over their phone records being seized in one of these investigations, which shouldn't really even be in a spending bill, but this is what they call the Christmas tree ornaments. So there's a lot of little hidden gems throughout this bill.
Hidden gems with Wendy Benjaminson. Thank you, Wendy. Bloomberg senior editor in Washington, which helps us set up our conversation with Jared Bernstein. Having listened to the president last evening, he sat down with Laura Ingraham on Fox News, who actually challenged the president on the idea that it is the greatest economy in history, as he puts it. More importantly, though, when it comes to costs, this is something that we've heard the president check reporters' questions on frequently, suggesting that it's a Democrat hoax that costs are going up, that people are not feeling the benefits of the broader Trump economic agenda, and more specifically, the big, beautiful bill. Listen to what he said last evening.
Is this a voter perception issue of the economy, or is there more that needs to be done by Republicans on Capitol Hill, or done in terms of policy?
More than anything else, it's a con job by the Democrats. They're saying, they just have to say, they put out something, say today costs are up. They feed it to the anchors of ABC, CBS, and NBC, and a lot of other, and CNN, and et cetera. Are you ready? Costs are way down. Gasoline is going to be hitting $2 pretty soon.
Well, of course, we've been keeping a very close eye on gas prices, and the national average remains quite a bit higher than $2. It's closer to $3, in fact. And I'm still waiting to get the memo on the talking points here, because this is a conversation we used to have with officials in the Biden administration frequently. You remember Jared Bernstein standing on the North Lawn talking with us about this and why Americans were not always feeling the lower prices the data were showing. And we thought, well, Wendy suggested we page the Biden administration. And, well, here we go right now. Jared Bernstein, of course, was chair of the White House Council of Economic Advisors for 4 years under Joe Biden. He's now senior fellow for economic policy at the Center for American Progress. Jared, it's great to have you back. And I wonder what you thought of that conversation, listening last evening to the president speak about a very different world than what data are showing or anecdotal evidence are showing, and you start to get this push and pull here where it's very difficult to tell people how they feel. What did you make of the rhetoric last evening?
Well, as your setup for our conversation underscored, I think the president is making just a foundational, fundamental error here by trying to tell people they're better off than they think, really than they know they are. Now, he mentioned the gas price. It's not $2 a gallon. It's $3.08 a gallon this morning, and that's exactly the same price it was a year ago. It's actually $3.07, and so not much there. Now, I think the thing that's going on here is that President Trump often is able to persuade his followers of his reality, even if that reality isn't backed up by the facts. But I feel very firmly that that particular superpower of this president, who really is an effective communicator to his followers, simply doesn't work when it comes to affordability. We certainly saw that result at the polls with the affordability election a week ago today. And I'm sure that the kinds of comments he was making last night are going to do him more harm than good when it comes to that very issue.
Well, affordability isn't about any one item, one issue, and President Trump was asked about one potential proposal last night in this interview when it comes to a 50-year mortgage. We want to play you a little bit more sound because Fox News pressed him on it as he's getting some pushback from some of those in his own base.
It's not even a big deal. I mean, you know, you go from 40 to 50 years, and what it means is you pay something less from 30. That some people had a 40, and then now they have a 50. All it means is you pay less per month. You pay it over a longer period of time.
The idea is light on details, but Jared, is this the direction of travel we're headed in when it comes to attempts to lower monthly payments? I'm wondering how you would jumpstart the housing market and the impacts that we could see from the economy if a proposal like this went into place.
Let me give you some interesting information on that, unpacking that important question. First of all, on this 50-year mortgage idea, it's being lambasted pretty broadly. And I did a calculation this morning. I revved up the old spreadsheet just to see what happened. If you look over the course of a 30-year versus a 50-year mortgage, I think you have to kick up the mortgage rate a little bit because lenders will ask for a little bit more for locking up 50-year loans. You're literally paying over $300,000 more in interest over the life of the loan. So yes, you might pay a little bit less on a monthly basis, but over the life of the loan, you're hundreds of thousands of dollars more on interest. But there's a broader point here. I think that the Republican Party in general, and President Trump specifically, have really lost any policy chops when it comes to affordability policy. It's actually fairly gnarly stuff. You really have to roll up your sleeves and get into the analysis. You can't have Director Pulte of the FHFA come in and say, here's a great idea, and then 10 minutes later, as I believe you've reported, the president goes out and says, new idea. Same thing with his stimmies, these $2,000 stimulus checks to offset the effects of the tariffs, which, by the way, he claims don't have price effects. Same thing with their health savings account, which is really just a tax shelter for wealthy people, not a health insurance program. So they really have a problem in that their muscle memory for affordability policies is quite unutilized. And I think there the Democrats have an advantage. And again, I think you saw that in the election.
You ever meet anyone or know anyone who had a 40-year mortgage, Jared? I heard the president saying that some people are paying 40. That would be, would that be a qualified mortgage, or are those available commercially?
They were for a time, and then they weren't. So you might find a few people who have them, but by far the most common mortgage is, of course, the 30-year FRM, the fixed-rate mortgage. And by the way, it would take legislation to implement a 50-year mortgage. I don't think this is going anywhere. I think this is some stray voltage, the idea of the day. But my broader point is I do think they're flailing here, and I think they'll continue to do so. By the way, I didn't answer the very good question of, well, what the heck would you do if you wanted to deal with the housing market? And here I'm going to give you a little bit of a lead, which is that very shortly, I think next week, the Center for American Progress, where I'm a policy fellow, I might even be a distinguished policy fellow, that just means you're old, where I'm a policy fellow, we'll be releasing a housing a document on housing policy, wherein we have numerous ideas that have been, again, we rolled up our sleeves and got into the weeds, but we have ideas that should significantly reduce the cost of both home ownership and rentals. So that's a little bit of a tease for something coming out next week.
Okay, looking forward to it.
All right. Well, we want to ask you about another one of President Trump's proposed policies, including this potential $2,000 rebate check tied to tariff revenues. We know that rebate stimulus checks would have to be approved by Congress. I'm wondering how feasible you see this being and what that impact would be on the broader economy if it even gets approved.
I think it would be a heavy lift for Congress. Even Republicans, when they see the price tag, I think would balk. There were numerous analyses out yesterday showing that almost any way you cut it, this idea would absorb well over what the nation is collecting in tariff revenues right now, which is something in the 200 to 300 billion a year amount in terms of, the revenue collections from the customs. Remember, contrary to a lot of what the president says, the folks who pay the tariffs are the importers, the American companies that are importing these these goods, and that's why it shows up in our national accounts. And the stimulus checks to allegedly offset the costs from these tariffs, and there are real costs there. They are juicing inflation, particularly of imported goods, would swamp the amount of revenue, even though that's substantial revenue. This is a very expensive promise. So I doubt it would occur. I also think you have to be concerned about the Federal Reserve. I mean, they're kind of on a knife's edge there in terms of balancing a weakening job market and higher prices. They're looking at a nascent stagflationary environment. I think you'd be fighting the Fed big time if you tried to implement this policy.
Just about a minute left here, Jared. We started by talking about this ADP report, and as we see continued cooling in the job market without the benefit of monthly BLS data, I just wonder where your head is on this. The Fed is kind of flying blind until the government can start churning out monthly job reports again, but this was a trajectory already in place. Where's the job market going to be a couple of months from now, and are you worried about this continued contraction?
I definitely am concerned about it, and I wrote about it this morning on my Substack about precisely this question. The title of my piece was, "Are Layoffs Accelerating?" And I concluded, based on a lot of private sector data, ADP, but one bit of public sector data, which is unemployment insurance claims, they're still coming in, that it does look like layoffs are accelerating, but the trend is quite mild. So maybe flashing yellow, definitely not flashing red, and that's a maybe on the yellow. I do think the unemployment rate is probably ticking up, and I would guess by the end of the year it's a couple of, which is next month actually, it's a couple of tenths higher than it is now.
All right, Jared Bernstein, chair of the White House Economic Council of Advisors under President Joe Biden and senior fellow for economic policy at the Center for American Progress. Thanks so much for joining us here on Bloomberg. Our political panel is on the way next. Stick with us. This is Bloomberg.
7:21 on Wall Street. I'm Alexis Christoforous. White House National Economic Director Kevin Hassett said the record-long government shutdown means that some of the economic data that was supposed to be collected in October may never be recorded, making it difficult to get a comprehensive look at the health of the U.S. economy. Today, we saw another sign of possible weakness in the job market. Payroll firm ADP estimates the private sector lost 11,250 jobs per week in October. On Wall Street, stocks are mixed, with the Dow Industrials flying high, up 538 points. The S&P 500 in the green by 18. The NASDAQ well off its session lows, now down just 53 points. Shares of Paramount Skydance up about 11% after the company raised its target for job cuts and cost-saving measures. Paramount now plans to lay off another 1,600 workers and aims to save at least $3 billion in costs. Shares of Beyond Meat trading down about 7% after the plant-based meat company reported third-quarter results that missed the mark and provided a weak forecast for the fourth quarter. And shares of Sony rallying 4.5%, the company raising its profit outlook and getting a boost from recent hit titles, including the anime movie Demon Slayer. For on-demand news 24 hours a day, subscribe to Bloomberg News Now, wherever you get your podcasts. I'm Alexis Christoforous. That's a Bloomberg Business Flash.
Alexis, thanks so much. As Alexis mentioned, I'm Tyler Kendall here alongside Joe Matthew in Washington, where we are now counting down the hours to 4 p.m. Eastern tomorrow, when the House is set to reconvene and vote on this package that could reopen the government. Now, Joe Matthew, it's not a done deal yet, but it seems like it's headed in the right direction, as we just heard from President Trump moments ago, speaking on ESPN, saying that he thinks the House is going to vote in favor of it.
Well, and that does seem to be the case, although they might have a little bit of whipping to do. There are a few constituencies who might not love this, but Speaker Johnson did say in the last 24 hours that he thinks he's got the votes. There is a path in the House, then it would head for the president's desk. The question is the unwinding of, obviously, trouble at the airports, how to fulfill SNAP benefits, how to get people paid after getting them off the payrolls, furloughed workers back in the office, and it could be weeks, not days, before all of that is done.
Right, and we have to keep in mind, once the House passes it, it then has to go to President Trump's desk, of course, for him to sign it. But we know that the White House is trying to get this done as quickly as possible, as it's really become a political issue. But Joe, of course, we have our eyes set then on the next deadline, maybe the end of the year, for expiring Affordable Care Act premium tax subsidies. And then January 30th, when the stopgap measure ends.
Then the government could potentially close all over again. I'm deeply curious about how SNAP benefits are fulfilled, because we should note yesterday, even as the gears started to turn on reopening the government, the administration went back to the Supreme Court for a second time to ask for cover on not fulfilling SNAP benefits for some 42 million Americans, currently paying about half of those benefits, I think at 60%, urging justices to intervene in a court battle over this, raising a lot of questions about the politics behind this decision. And we're going to get into this with our panel now. Bloomberg Politics contributors Rick Davis and Jeannie Shanzano are with us. Rick is partner at Stone Court Capital, our Republican strategist. Jeannie is Democracy Visiting Fellow at Harvard Kennedy School's Ash Center, our Democratic analyst. What's going on here, Rick? Why would the administration want to be on the record as to pushing back on feeding people who don't have food?
Yeah, I think you have to sort of take a step back and understand what the administration's goal is. They have to use the device, which is, hey, we haven't chosen to fund those SNAP benefits, so we shouldn't be forced to by a federal judge. And at the core of it is the administration is in charge of the administration of the budget, not the courts. And so we can't be told what to do by a federal court. We have the authority to do what we want to do with the federal budget, in consultation and direction by the Congress. And so this is all about presidential power, executive authority. It's got really nothing to do with the SNAP benefits, other than the fact that they are the vehicle by which this court case is getting to the Supreme Court. So what he's hopeful the president's hopeful, is that the court says, no, you're right. The executive branch is the only branch that can determine what to pay. The downside is, politically, it's a horrible thing to fight. I'm like, oh, yeah, we're going to deny you SNAP benefits so that we can make a point about executive authority.
Mm-hmm.
Right, and the administration is also citing the fact that one of the key agencies that this package funds is the USDA. So theoretically, funding for food benefits through the next fiscal year, September 30th, should be resolved soon enough once the government reopens. But Jeannie, much to Rick's point, at this point, is that political damage already done when we've seen food benefits really come to the forefront of this conversation around the government being closed for a record amount of time?
Yeah, the damage is done, but they're making it worse. I mean, they are digging a hole. Let's not forget, all of a sudden, the Trump administration seems terribly concerned about what the courts are saying. But we all remember back a few months when they were taking people off the streets and shipping them to gulags in South America. They didn't seem terribly concerned about what the judges were saying then. So they seem to find religion when it pertains to doing something that they don't want to do. And in this case, what they don't want to do is pay for SNAP benefits. And the reality is today is Veterans Day. The president was just at Arlington Cemetery waxing poetical about veterans. And 1 million of those 42 million people that are being denied SNAP benefits are veterans. 16 million are children. 8 million are elderly Americans. This is what they are fighting against doing. And to their credit, they did tell the court this may be a moot point if we get the shutdown over with. But the reality is politically, this bodes very badly for the administration. And Trump seems way off his game to me politically in the last few weeks, because anytime you're having a conversation about affordability, to your conversation with Jared Bernstein, it is bad for the Trump administration and it is bad for Republicans.
You know, Rick, when I think about all the stuff that we've witnessed here over the past couple of weeks, the snarling of airports, federal workers not getting paid, SNAP benefits not being fulfilled or funded here. We've talked a couple of times to lawmakers since this shutdown and just before it about the Eliminate Shutdowns Act. There was another one called the Prevent Shutdowns Act, and you've heard of these before. Ron Johnson came on to explain his position on this and why he put his name on the bill quite recently. It would be, and any lapse in funding would trigger essentially a short-term continuing resolution. So at least the lights would stay on, people would keep getting paid, people wouldn't be starving, and then lawmakers could hash out a longer-term budget deal. Have we made the case for a law like that here with what we've seen from airport traffic control towers down to soup kitchens in the past couple of weeks?
Yeah, there's no question that government shutdowns hurt, right? And the longer they go, the more they hurt. And that case has been made. But let's not forget, it's Congress's job to pass these budget bills, right? This is not a question of like, gee, we need to have something to automatically go into effect when we don't do our job. Who else gets that? I mean, like, do you guys? You don't show up, automatically the show's going to be canceled today because Joe didn't show up. No, the show must go on. And they need to get that message that they can't pass laws that keep them from having to do their job. I mean, like, somebody should pay a political price for not having gotten this done in Congress. And I'll leave it to the parties to make the case. But the American public will determine who is at fault here, and they are always right because they're the only ones who get to cast a vote.
Well, Jeannie, Joe just outlined one deadline that we're, of course, watching, January 30th. But what about the deadline of the end of the year when the Affordable Care Act premium subsidies expire? Realistically, is there going to be a deal by then to extend this coverage?
I am not banking on it, Tyler. When it comes to Congress, I have a hard time these days saying, oh, yeah, I think we will get there. You know, I think it's possible that we get some kind of deal out of the Senate, maybe, but I don't know where that lands in the House, and I just can't see that working its way through the House. That said, it would be the benefit, obviously, of Americans, but also of Republicans in the Senate and the House who are facing election in 26 to get something done. So maybe that spurs them forward. But at this point, I think we are so closely divided in both the House and the Senate. I think it's going to be very difficult to do. And I would just say on a shutdown bill, the problem with having something like that passed is that you look at this and parties benefit from shutdowns. They do not feel pain. The Democrats, if things continue the way they are, will have benefited from messaging the right way on this shutdown, just like Republicans did in 95 and 96. That's why even if they pass a law, they're probably not going to tie their own hands enough to make sure we're not right back here again. And maybe, Tyler, to your point, even as soon as January 30th, or, although, gosh, I hope not.
We talked to a lot of angry Democrats yesterday, Jeannie, who were not happy with the 8 senators who decided to cross the aisle and vote with Republicans. And I'm wondering what you think happens, what's waiting for those Democrats in the House who are reportedly set to vote yes as well. Cuellar of Texas, Golden of Maine, Gluesenkamp-Perez of Washington, Gonzalez of Texas. Will they all be on an island after this?
They may be on an island, but Golden's not running again. The others are in really moderate, middle-of-the-road districts, and so I don't think their voters will be surprised. But yeah, Democrats are raging angry. They have a right to be angry, but the reality is this was never going to end any other way. But I think the one who really pays the price in the long term here is going to be Chuck Schumer. They are not happy with his ability to message a win.
Rick, I mean this seriously. The House is coming back after more than 50 days out of session. What have lawmakers been doing? Has this been time well spent with constituents? Well, we've seen polling showing that Americans have been pretty uneasy about this government shutdown.
Well, considering the number of invites I've received in my emails and texts, they've been raising a lot of money. There's been a lot of fundraisers, that's for sure. So, yeah, they've made good use of that as far as a political purpose. But I haven't noticed a whole lot of town halls going on during this period of time. Have you? I mean, like, they've been laying low, and I don't blame them. But I would say, look, the happiest guy in the United States Senate for these Democrats to have walked across the aisle and unfrozen the accounts of the government is Chuck Schumer. He was desperate for a deal. He put on a good show, but he is the one guy who's sitting back going, God, thank God they walked the aisle and got rid of this, because it has really been hurting me and I don't know how to handle it.
You know, Rick's not the first one to suggest it, Jeannie. Did these 8 senators save Chuck Schumer in the near term? And do you think he actually runs for re-election after all this?
I'm not sure he can. I'm sitting in New York. He is facing a really tough uphill battle if AOC runs. And yeah, I too have heard that this was sort of a secret or not so secret plot for him to get these 8 to walk the plank for him. I think that's possible. The outcome is just in keeping with the Chuck Schumer that we know, hence the real frustration against Democrats who want to move on beyond what they see as a geriatric Democratic leadership. And unfortunately, Chuck Schumer is the poster child for that now that Joe Biden and Nancy Pelosi are gone.
All right, our political panel today, both Bloomberg Politics contributors, Rick Davis and Jeannie Shanzano. Thank you so much, as always. And Joe, we have a lot to keep our eye on, not just tomorrow, of course, as this 4 p.m. Eastern vote we're expecting gets underway, but then what's going to happen as we head into the holidays and these other deadlines that are looming.
That's for sure. We're going to talk to a lawmaker who's going to be called to vote in the next 24 hours. It looks like Byron Donalds, the Republican from Florida, will be with us next as we consider next steps here. To Tyler's point, they could be voting roughly 24 hours from now. The Rules Committee is going to get the ball rolling tonight as lawmakers trickle back into town. I wouldn't want to be a representative waiting at the airport today, though.
No, and definitely House Speaker Mike Johnson needs all of them to be back here in order to get this vote underway. Stick with us. We'll
7:40 on Wall Street. I'm Alexis Christoforous, and stocks remain mixed as investors are hopeful that an end to the longest government shutdown in U.S. history is near. The Dow Jones Industrial Average rallying 520 points, or more than 1%. The S&P 500 is up 15, and the Nasdaq in the red by about 70 points. Bond market closed today for Veterans Day. Another sign of weakness in the labor market from private payroll provider ADP, which found U.S. companies lost an average of 11,250 jobs per week in October. Nearly 1.1 million job cuts have been announced so far this year. That's according to outplacement firm Challenger Gray and Christmas. It's the most since 2020. In stock news, the AI cloud computing company CoreWeave coming under pressure. Revenue more than doubled last quarter while its net loss narrowed, but CoreWeave flagged a delay by a data center developer, and that stock is now down by double digits. The quantum computing company Rigetti Computing logging a smaller than expected adjusted per share loss. However, quarterly revenue did disappoint at Rigetti. And Gemini Space Station, that's the crypto exchange founded by the Winklevoss twins, that reported a steeper loss than analysts anticipated in its first earnings release since going public. Shares of Gemini Space now down more than 15%. For on-demand news 24 hours a day, subscribe to Bloomberg News Now wherever you get your podcasts. I'm Alexis Christoforous, and that's your Bloomberg Business Flash.
Alexis, thank you. She'll have more on the markets coming up at the top of the hour, 2 p.m. Eastern, as Bloomberg Business Week Daily gets off the ground. And we're all keeping our eyes on Capitol Hill today for good reason. The Senate passed the legislation last evening that would reopen the government. Once the House does the same, the president pulls out the Sharpie, and we're back in business, of course, knowing that it could take some time for airlines to get back together, for airports and air traffic control towers to be fully staffed, SNAP benefits to be funded, and, of course, the hundreds of thousands of furloughed federal workers to get back to work and get a paycheck in the bank account. So, Tyler, what we have here is a Rules Committee hearing. It's going to be an important one. That's set to start a few hours from now. And they'll start hashing out the rules that will bring the bill to the floor. And by 4 p.m., we're told, don't necessarily bet on that, but around 4 p.m., we'll have a vote in the House that could actually end this shutdown.
Right. If we've learned anything, things could change quickly in the House of Representatives. But this is what we're tracking as of now. House Speaker Mike Johnson can only afford to lose 2 Republican votes, but it appears that his hand has been bolstered by the fact that President Trump has thrown his weight behind this deal, saying that he wants to sign it into law. Now, we're going to talk to one of the members who is going to cast his vote when this comes up tomorrow, and that's Congressman Byron Donalds. He's a Republican representing Florida's 19th District. Congressman, thanks so much for joining us here on Bloomberg Television and Radio. I think I probably know the answer, but just to get you on the record and to confirm, how are you going to vote when this package comes up tomorrow?
I'm voting yes tomorrow. It's time for the government to be reopened and end this shutdown created by Chuck Schumer and the Democrats. To be blunt, we're still not even sure what they shut the government down for in the first place, but we're excited to get back to work and get this to the president's desk as quickly as possible.
Congressman, I want to ask you about one of the provisions that we're seeing included, which is a rollback, a reversal of the mass federal firings that started on October 1st, also puts a block on any future firings until January 30th. Do you have any concern with this policy, since we know it's something that this White House had been advocating for?
No, we don't. There's been a lot of work in this regard the entire year. That's number one. Number two, everybody knows at this point that one of the ways we're going to be able to get our spending under control, which is a major concern for the bond markets and our credit rating agencies, is we're going to have to streamline the federal government across the board. Part of that has been giving workers an opportunity to leave the federal workforce. Some of them have been provided bonuses on their way out the door. And so I think this is going to continue. But, you know, we have a temporary measure that we have to get through here, and we're going to do that and get the government reopened.
Congressman, it's good to see you. And you said something in your first answer that was important. What was this all for? Because it seems to me that this could have been something that took place weeks ago, knowing that Democrats were offered an up or down vote on extending Obamacare subsidies. Many told us here on the air that that was simply not good enough, and I know a lot of them still feel that way who are going to vote no, because they wanted an actual deal on paper. John Thune has promised that vote now. Should Speaker Johnson do the same?
No, I think that's something that John Thune and the Senate has to go through. Let's talk real quickly about these Obamacare subsidies that were part of one of the things that Democrats are talking about. Let's first be clear, Democrats are arguing for like 5 different things over the last 40 days, and that's how you know that their negotiations weren't serious. This was much more about politics from the Democratic left and politics from Chuck Schumer trying to save his job as Senate Minority Leader. But to the specific issue about Obamacare subsidies, what the Democrats have been telling the American people consistently is that they need more subsidies to cover up the true cost of health care. And these subsidies are on top of the existing structure of subsidies built into the law of the Affordable Care Act. So in short, more subsidies is not going to fix Obamacare. What it's going to do is mask the true cost and the true damage to families everywhere. I've talked to people where their premiums for a bronze plan are now $2,000 a month. That's rent. That's a mortgage in some parts of the country. The deductible's $12,000 to $14,000 a year. So if you're making $125,000 a year as a family, you don't have $2,000 a month in disposable income to pay premiums, let alone the $14,000 to pay the deductible before you even start accessing the health insurance policy. This is what's wrong with Obamacare. The Democrats want to cover it up using subsidies as opposed to fixing the problem that they created 15 years ago.
So then what is the plan, Congressman? Are we talking about replacing? President Trump has said that he'd be willing to negotiate when it comes to this very issue. So what's feasible? What's going to get through your chamber that would get your vote?
I think what's feasible are some of the reforms that we tried to get through back in 2017. I will tell you, by the way, Democrats refused to lift a finger and work with us to avoid the calamity that we see today. But that's centered around healthcare policies that are patient-centered. It's about healthcare policies that do not have overburdensome requirements on all the things that are covered that really create a bureaucratic bloat that makes the premiums more expensive. It's about making sure there's more catastrophic insurance policies in the marketplace. Maybe you have young workers, they don't need a full gold-plated healthcare policy. What they need is catastrophic healthcare coverage and ability to go get regular visits and checkups. That's a key part of this. There's a study being done. There was one, I think Senator Ron Johnson released these findings actually, and it's demonstrated that employer-provided coverage in most of the country has just marginally risen over inflation. But when you look at health insurance policies in the Obamacare exchanges, they are up 200, 300, 400, in some respects, 500% over inflation. That's crazy. We've created a 2-tier system in healthcare. So I would tell the American people, this is not simply about subsidies for Obamacare. It is about providing real solutions that put patients first, so we have a healthcare system and a healthcare insurance marketplace that people can afford and be able to access healthcare readily in their communities.
Well, I love that we're having this conversation, Congressman, and I wonder your thoughts on what the president said to Laura Ingraham last evening, because he's been on Truth Social about this as well. Give the money directly to people and let them negotiate with health insurers is essentially what he said. The quote was, "The insurance will be better, it'll cost less. They're going to feel like entrepreneurs," he said. They'll actually be able to go out and negotiate their own health insurance. Would that still require a pool of patients, though, Congressman, to create leverage? Or am I calling up United Healthcare and trying to get my own rates at the same time that you are?
Well, I think there's parts of what you're saying are true, some that'll have to be worked on. I think the premise that the president laying out is the correct one. Look at any industry in our economy, the ones where people have direct purchasing power to go to companies and buy the product they're looking for, those prices are actually increasing lower than the rate of inflation. But when you bring in these other issues, these other areas where the government is doing direct subsidies, that's where the prices are completely out of control. And so for me, the situation is clear. The situation is clear. You have to put people at the front of the line. They got to be able to make those purchasing decisions. If it's giving those dollars directly to the individual, that will work. Now, to your question around risk pools, this is essential in all insurance. We could look at setting up geographic risk pools as an idea so that people in that community or in that state can actually be dealing with the insurance companies, but the insurance companies actually have a defined risk pool. This is one of the reasons why large companies have cheaper insurance than when people are just going into the marketplace by themselves, because they're using the risk profile of working for that company to set up the risk pool to what then the actuaries kind of decide how much is the cost to insure each person in that pool. There's ways to do this, but the Obamacare way has been a disaster. It is now proven, and the costs are out of control.
We're talking about next steps here, and I also want to talk about the next steps for fully funding the government, because the stopgap measure goes until January 30th. How are we going to avoid another shutdown? Are we going to be having this conversation again when we know that the Senate has been proposing some spending levels that are higher than many House Republicans want to see?
Well, again, we're going to get back to the negotiating table in short order. I know Speaker Johnson has told the members that we can expect some very long days when we get back to Capitol Hill, and that's fine. That's our job, and we're more than happy to do that. I think it's important for my Senate colleagues, both Republicans and Democrats, to understand one very important thing. We are borrowing a lot of money. The bond market is looking at us to curtail spending, and this is the core position of House Republicans. We can still have a federal government that does its job, but we don't have to be so obscene in how we are spending other people's money. And I think that, if we come back to the situation again in January, I think whether it's healthcare or spending, it's important for myself and my colleagues to communicate clearly to the American people of what's truly at stake. Everybody wants to talk about the economy, affordability. These are major issues for the American people. The core of our affordability problems is massive government overspending. It diminishes the purchasing power of the American dollar. It does not help American families be able to make ends meet. In Washington, for once, we got to do the right thing. Let's cut our spending, get that down, and let's pass bills so we're not doing this brinksmanship, which, by the way, the Democrats are the ones who want to do it. People should know the Democrats, most of them are mad about this deal to reopen the government. They want the government to continue to be shut down. That's not an appropriate way to get the business done for the American people.
Well, we have talked to a number of Democratic lawmakers who were not happy with the 8 who crossed the aisle on this because there wasn't a deal there that they were hoping for, certainly, Congressman. I want to mention to our viewers on Bloomberg TV, if you're watching us on YouTube right now, that the congressman does not have a new job. He's not working at Cantor. He's actually down in Miami right now at an important AI energy infrastructure conference. And I've got to ask you, because we typically get to this because of your committee assignments and your areas of interest, an important bipartisan bill came out of the Senate last evening, the Ag Committee, on a crypto market structure bill. And I'm wondering where this stands in the House. We've talked so much about the Clarity Act and whether there's going to be some reconciliation between these two pieces of legislation or a different path.
I think we're probably going to end up sitting down and coming to an agreement between the two chambers on this. The one thing that's very clear, I'm happy that my Senate colleagues are taking this seriously. AI, quantum computing, the future of energy for our country, these are critical components to our economic future. If we don't actually create the frameworks for this, we fall further behind to China, to Europe, and some of our rivals on the world stage. So this is actually important stuff that we can get done. I'm very happy that AI and quantum is not a partisan issue because it's really about the future of our economy. And so let's see what they have. We'll work together with them and try to get something done that's going to put the American people first and actually be in the best interest of our country.
Could you give us any timeline that we should be watching out for? Any chance that this is going to get done by the end of the year?
Listen, I don't put any timelines on Washington. You've been around long enough, what you do is you go in there, you work hard. You try not to set artificial deadlines. I do believe that you have members of the Senate, members of the House, myself included, who want to see a regulatory framework in AI, in crypto, and in quantum. It is important. We have to be able to get this job done because we have many other public policy issues that we have to address as well. One of them is energy. I'm a major proponent for small modular nuclear reactors to be commercially deployed throughout the United States. Every state needs to double their amount of power on their grid. The United States needs to do that. And this is something where my colleagues on Capitol Hill, this is common sense stuff that actually provides energy at a lower per kilowatt hour than any other generation source. We need to get in the game and get that done as well.
Well, you know, Congressman, few stories are more important to our audience, so let's talk about that. Let's have that conversation when you're back in town with our eyes, of course, on the AI space. Congressman Byron Donalds, I hope you get the flight back to D.C. all right. That's easier said than done. Representing Florida's 19th District, I'm Joe Matthew alongside Tyler Kendall. We'll be back on the late edition of Balance of Power as the Rules Committee gets underway here in the House. Lawmakers are streaming back into town. We expect a vote to reopen the government tomorrow. We'll see you in a couple hours from now on Bloomberg.
This is Bloomberg Business Week Daily, reporting from the magazine that helps global leaders stay ahead, with insight on the people, companies, and trends shaping today's complex economy, plus global business, finance, and tech news as it happens. Bloomberg Business Week Daily with Carol Masser and Tim Stenivek, live on Bloomberg Radio, television, YouTube, and Bloomberg Originals.
And a very good afternoon, everybody. Yes, indeed, we are across Bloomberg platforms. This is Bloomberg Business Week Daily. Carol Masser along with Tim Stenivek. And,
You know, initially it felt like stocks were running out of steam, but here we are, bouncing off our lows, Tim, and near our highs.
Yeah, still in the red on the NASDAQ Composite as we're seeing some selling in tech, a little rotation out of some tech names, but it's barely down. The S&P 500 up 0.3%, the Dow up more than 1 percentage point. Alexis Christoforous is going to be with us in just a moment. She's going to have all of the details.
Reminder, too, the bond market is closed because of Veterans Day. Hey, this hour, what really matters to investors? So we're going to get into the U.S. economy, an upcoming Fed policy. We do have one more meeting of the year in December. This is happening as U.S. Treasury Secretary Scott Bessent appearing earlier and making some comments and kind of deflecting on inflation. So we're going to get into all of that with Renaissance Macro's Neil Dutta. Looking forward to a conversation with him.
Plus, on the tech side and the AI trade, from CoreWeave and Meta to Intel and SoftBank, the onslaught of tech news, all with an AI angle.
So much going on. And we're going to get to the top gainer in the S&P 500. Paramount Skydance on post-merger savings, what may be next in terms of a merger or acquisition, what we all as investors need to know about this company is coming your way in the next 60 minutes. First up, though, let's get an update on that. I don't even know if we can call it rally, Alexis, but we definitely are off our worst levels of the session. Alexis Christoforous, take it away.
Thanks so much, Carol. I think we can definitely call the Dow a rally, up now 488 points as investors rotate some money out of those high-valued tech names and into other parts of the market with, well, more attractive valuations like healthcare stocks. How about that? The S&P 500 up 15 points. We've got the NASDAQ Composite, though, down by 42, but well off its worst levels of the session. And as Carol mentioned, the bond market is closed for Veterans Day. NVIDIA leading AI-related stocks lower after Japan's SoftBank said that it sold its entire stake in NVIDIA for $5.8 billion. SoftBank's quarterly net profit more than doubled, though, because of gains from its investment in the ChatGPT creator OpenAI. Shares of NVIDIA down 2.5%, SoftBank up more than 2.5%. Company executives are sounding remarkably upbeat about the economy this earnings season, even as trade tensions linger and stock valuations look stretched. Mentions of the words economic slowdown and synonyms during earnings calls tracked by Bloomberg are the lowest since 2007. And Walgreens will no longer give many of its retail workers paid vacation time for Thanksgiving, Christmas, and other major holidays. That's as the pharmacy chain looks to cut costs under new ownership. Now, full-time hourly employees of Walgreens have to work on the holidays to get paid. For on-demand news 24 hours a day, subscribe to Bloomberg News Now wherever you get your podcasts. I'm Alexis Christoforous. That's a Bloomberg Business Flash. Back over to Carol and Tim.
That seems kind of lousy. Can I just say that?
It's the...
Oh, I guess I cannot. Some might say it's lousy.
I think... You know, I think back on that news from Alexis, I think back to the way post-COVID, during COVID, employees were in the driver's seat when it came to so much.
And remember, we thought it was going to stay that way.
We did.
So work at home.
No, we didn't. We didn't think. We thought, you know, this stuff goes in cycles, but, you know, now we know who's in the driver's seat.
But CEOs were talking a lot more about flexibility.
They were.
Coming right off the pandemic, but things have... Listen, when you build beautiful offices, just as somebody like JP Morgan, you want people to be in the buildings,
I
right?
like when you ask if you can do things.
I know.
And then they say no. So you take it back.
My whole control room's like, no! All right, let's get to it, folks. A lot coming your way. The U.S. Treasury, we want to remind everybody, kicking off a messaging campaign to showcase the economic benefits of the president's signature legislation. Secretary Scott Bessent announced that last week. And so on that, we heard from him earlier today. The Treasury Secretary deflected concerns about high costs under President Trump, saying the administration had inherited elevated price levels and that its policies would generate real income gains for American workers. He spoke earlier today on Morning Joe on MSNBC.
We inherited an affordability crisis. We have slowed the price increases down, and they are going to continue to slow down, and that real working class wages will go up, and that will address the affordability issue. And, you know, I think this is what Democrats are afraid to do. They've gone to the courts to try to stop President Trump and this great economy. That hasn't worked. They get overruled at SCOTUS. We go to the media, who carries their water. That hasn't worked, so they shut down the government and hurt the economy. Let's keep the economy open, let our policies kick in, and let's see if what I just talked about, let's see if those two lines cross. Costs come down, real wages go up.
And I will say, not necessarily carrying water. We're just reporting out on what we can and what we are seeing. That, of course, was U.S. Treasury Secretary Scott Bessent this morning on Morning Joe on MSNBC. Hey, let's get more on what the Treasury Secretary had to say. Bloomberg News U.S. Treasury reporter Dan Flatley covers him. He is with us from the Bloomberg News Washington, D.C. bureau. Dan, good to have you here with Tim and me. The first line in your story, U.S. Treasury Secretary Scott Bessent deflected concerns about high costs under President Trump, saying the administration had inherited elevated price levels and that its policies would generate real income gains for American workers. We mentioned that earlier as well. Tell us more about what he did say in addressing inflation and how his messaging may be evolving, changing, or being managed.
Yeah, thanks, Carol. It's a great question. So, there's a few different things going on here, right? We had elections last week in New Jersey, in Virginia, in New York City, obviously, and the Democrats did very well in those elections. And I think that has the White House a little bit nervous about what's going to happen with the midterm elections next year. And so what you see now is Secretary Bessent talking about his phrase is extract and educate. So he wants to take some of the provisions from the One Big Beautiful Bill, if you can remember that back to midsummer, and sort of highlight those for people who may not be getting the message. And what this ultimately comes down to is whose economy is this? If you listen to Bessent, he's sort of still saying in a way this is Joe Biden's economy because we've inherited this affordability crisis. Are the voters looking at it as Joe Biden's economy, or are they looking at it as Donald Trump's economy right now? I think we're sort of a little bit betwixt and between, but from some of the data and responses that we're seeing, I think that voters are starting to think of this as Trump's economy, and that may not necessarily be the best thing at this point for the White House because, again, going back to what Bessent said, there's still a lot of things that they want to do that they feel like they can't do or that, they may be losing some support for. So they're really trying to message a little bit more on all of that.
Yeah, I guess the question is, will it work politically? I mean, the data really back up what you're saying, Dan. I mean, if we think about the conversation we had yesterday with Mark Niquette, right at this time on our program, he cited Harris poll data that said half of respondents in an October survey by the Harris poll for Bloomberg News said the economy wasn't working for them, up from 41% in February, and only 1/3 said their finances were better than a year ago. Does messaging actually work with this stuff, or it's numbers based? Like, people go to the grocery store, they pay their rent, they know what they're paying for things. Does messaging even matter?
Yeah, it's a good question, Tim, and it's fair to say that voters know what they're spending at the grocery store. They know what they're spending on travel. They know what they're spending on their mortgages and on rent. So it is hard to move the needle in terms of what's going out from your pocketbook every month. I do think that messaging can help at the margins. There is, of course, the substance, and then you sort of have the style and the messaging layered on top of that. That can make a little bit of a difference. I do think that looking at the One Big Beautiful Bill or looking retrospectively at the tax bill is sort of fraught with peril because the tax bill wasn't particularly popular even when it passed. And now you're asking people to think back to where they were several months ago when, we all, I think, as human nature, want to look forward and think about what's next. And I do think that in the electorate generally, there is a dissatisfaction with the status quo, and we've seen that in successive cycles where power changes back and forth. So I think that the Trump administration does have kind of an uphill battle in front of them in terms of messaging. We'll see whether what Secretary Bessent mentioned, which is bringing real wages up and bringing the cost of living down, if those lines intersect, they may have the numbers on their side, but we haven't quite gotten there yet.
Just 20, 25, 30 seconds here. Dan, what are you going to be watching as he, works on getting the president's and administration's economic message out? Is it going to be more of the same of what we kind of got this morning? I'm just curious.
Yeah, it's interesting. I mean, I do think, he has sort of said, Secretary Bessent has said that he's going to do something basically every other week. But I think even the secretary would say that President Trump is the most effective messenger on his own policies. So I think that, it's going to be interesting to see how those two sort of vie for attention and space in that lane. I do think that Trump will have to talk a little bit more about this if he wants to get his message across.
All right, great stuff as always. Hey, Dan, thank you so much. Bloomberg News U.S. Treasury reporter Dan Flatley. Now, as the U.S. Treasury Secretary looks to highlight the administration policy, whether it's inflation or other aspects of their policies, we continue to live in a world that really lacks U.S. government data. We did get one piece of private data today. ADP research suggested that the labor market slowed in the second half of last month. Traders now, we know, have relied on private data as the government closure, Tim, has delayed the release of official statistics.
Meantime, the government now, and it's well known to the Bloomberg audience, who is with us right now, Neil Dutta, partner and head of economics at Renaissance Macro Research. He joins us from New Jersey. Neil, good to have you back on the program. I want to start exactly there, and with regard to the shutdown, where we are, longest shutdown on record, but also the lack of data. The picture that we're kind of piecing together from various disparate parts show that a labor market is weakening. In your view, how weak is it?
I tend to concern myself more with the direction as opposed to the magnitude, to be honest.
Okay.
But I think we're probably at the Fed's estimate for the unemployment rate for year end already. So a couple of months ahead of schedule. So that's not necessarily a good thing. So my sense is that the speed of the weakness has, maybe picked up a little bit. But I think we're probably at 4.5% already on the unemployment rate.
Okay.
If it were to come out. And, I think, what people need to kind of answer is, why do you think that stops and what gets it to stop? Because I think when you look at it bottoms up, like if you kind of go industry by industry, it's really hard to see where the growth in employment is coming from at the moment.
Well, and on that, I'm thinking about, Neil, great to be talking with you again, the dual mandate, right? And so I'm just wondering if we continue to see weakness, in the labor market. And then we just talked about Treasury Secretary Scott Bessent kind of deflecting when it came to inflation, as he's out and about talking about the administration's policies. I mean, we've heard from Fed Chair Jay Powell about the struggles on both of those mandates. Do you think it's going to be a bit of a squeeze for the Fed, for the U.S. economy, for all of us, in terms of weaker labor market staying that way and inflationary pressures kind of staying that way?
Well, my own view of it is that I don't view the trade-offs as nearly as onerous as the Fed does. I think there's more downside risk to the labor market than there is upside risk to inflation. At the end of the day, inflation is 3% this year. It was 3% last year. The difference between this year and last year is tariffs. So that would tell me what? That underlying inflation is probably slowing. And, the fact that it's really hard to make a case for why tariffs are anything more than a one-off lends support to the idea that the Fed should continue to cut interest rates here. In terms of, and remember, to me, the big story is that employment tends to evolve potentially in nonlinear ways. It kind of, once like a increase in the unemployment rate really gets going, it tends to keep on going. And that's why you have this sort of, it's episodic, right? You see big spikes in the unemployment rate at times, right?
Yeah.
That's not really the case with inflation. And so in other words, inflation tends to move in a more linear way and, particularly outside of commodities. And unemployment, that's not necessarily the case. It tends to be more nonlinear in fashion. And I think that's what, frankly, the Fed and, the markets might be missing is the sort of downside kind of growth tail risks associated with the labor markets.
What if the Supreme Court comes back and says the tariffs are not legal as they're implemented? Does that change your view?
No. I think if you think that the Supreme Court is going to be the institution in Washington, D.C. with the last word on tariffs, I think I'd like to have some of what you're smoking.
Well, is that because you think there are other avenues for the Trump administration to enact these tariffs apart from IEEPA?
Absolutely. The Congress, this is really about Congress, and Congress is frankly a lazy bunch. Okay, and they've delegated a lot of their tariff authority to the White House. And there's a vast legal architecture from which the president can draw from to prosecute a trade war. And, you know, I think immediately he could probably do a temporary 15% baseline tariff, and he can do that for 6 months, and that will, you know, sort of act as a bridge, you know, to get towards national security tariffs. So I don't think we're out of the woods on tariffs because the SCOTUS rules it one way or the other. I mean, I think that's sort of wishful thinking, in my opinion.
Hey, a couple of stories I just want to bring in. One was from last week, Neil, and it was about U.S. consumer sentiment tumbling to near the lowest on record. And part of it was the government shutdown weighing on the economic outlook, but also high prices, souring views about personal finances. There were also concerns about the labor market continuing to weaken in the future. We got that from that report. And then we just had a story that our Alexis Christoforous mentioned about Walgreens no longer giving many of its retail workers paid vacation time for Thanksgiving, Christmas, and other major holidays. The company looking to cut costs under new owners. Like, I just keep thinking about this K-shaped economy, and there's just so many people, and I think about the SNAP benefits. How many people are on food stamps and getting assistance? Like, this economy doesn't feel great, and yet we have records on Wall Street, and we have earnings that seem to be okay, and the AI spend is out there still in a big way, even if there's been some questions over the last week or so. So I don't know, from an economic perspective, are we in a good economy or no?
I mean, I think we're in a deeply imbalanced economy, Carol. Okay. I mean, and it's been that way for a while. Yeah. You know, I recently wrote a piece for your colleague Joe Weisenthal on Odd Lots. You know, just sort of characterizing the economy as really three different things, right? You have the housing market, which I think is in recession, and you have the consumer, which is kind of, let's say, in the middle. And then you have AI, which is, you know, booming. And when I go to client meetings and I give my sort of outlook on the economy, you know, the pushback that I get is kind of what you were describing, right? It's, you know, AI, it's stocks, it's, you know, the high-end consumer. And people talk about that, frankly, as if those are three separate things, but they're really derivatives of the same thing. And I think that's something to keep in mind here. The other thing I would say is that, you know, we talk a lot about the resilient consumer. We hear a lot about, you know, never bet against the U.S. consumer. The truth is the consumer never actually gives you a signal ahead of an economic slump, right? If you go back historically, consumer spending has never, ever declined in the quarters leading up to broader economic downturn.
Interesting.
Sometimes in an economic downturn, consumer spending actually expands, right? Like go back to 2001, right? Like, so that's not unusual either. So if you're waiting on the consumer to give you a tell, you've probably waited too long, right? I mean, consumption has a way of amplifying downturns. But I would just say, you know, what's been interesting to me is just how... Like the labor markets have evolved the way you've expected, right? It's come for the young first, and I think it's going to come for the affluent next.
Interesting stuff. Ouch. Yeah, well, this is something we talked about, the 3 A's in that Trump economy story. Neil Dutta, good to connect again. Come back soon. Partner and head of economics at Renaissance Macro Research. Hey, coming up, our tech roundup from SoftBank, Meta, Intel. It's all about AI.
2:21 on Wall Street. I'm Alexis Christoforous. We've got a tale of two markets today. The Dow is up more than 1%, but the NASDAQ a bit lower as investors move some money out of those high-valued tech names. The Dow Jones Industrial Average up better than 1%, or 510 points. The S&P 500 gaining about 16, but the NASDAQ Composite down 44 points. For the Dow, we have got Merck, Nike, and Amgen leading things higher. Just 4 of the 30 Dow stocks are lower right now, led there by NVIDIA. Shares of Paramount Skydance up about 9% after the company raised its target for job cuts and cost-saving measures. Paramount plans to lay off another 1,600 workers and aims to save at least $3 billion in costs. The entertainment company said it will also hike prices for its Paramount Plus streaming service early next year. Shares of Occidental Petroleum up about 1%. The oil and gas producer posting mixed quarterly results. Earnings topped expectations, but revenue disappointed. And tariffs are forcing some big brands to cut back on their Black Friday deals. Companies from upscale handbag brand Coach to the wellness device maker Therabody, among those pulling back on promotions. They're citing higher costs due to tariffs and inflation. For on-demand news 24 hours a day, subscribe to Bloomberg News Now wherever you get your podcasts. I'm Alexis Christoforous. That's your Bloomberg Business Flash.
All right, got it. Alexis, thanks so much. Hey, time for our tech roundup. Everything from CoreWeave results, AI execs moving around, and SoftBank exiting its entire stake in NVIDIA. All right, first up, let's talk CoreWeave. Shares of the company tumbling after it lowered its annual revenue forecast due to a delay in fulfilling a customer contract. It's a setback for a company that's racing to keep up with the AI boom. Earlier today, CoreWeave's CEO Michael Intrator joined the BTech team on Bloomberg Television, Caroline Hyde and Ed Ludlow, and the CEO talked about broadening their customer base and suppliers.
If you think about the messages that I was trying to communicate during the earnings call yesterday, I talked about the incredible impact of the effort that we've had to diversify our clients. We started the year with 85% of our revenue to a single client, and we are coming out of the year with our backlog which has reached all-time highs, where no specific client is more than 35% of it, and that is down from 50% even last quarter. You're seeing a real focus by our company to diversify on both sides of the ledger. The clients that we are delivering infrastructure to, as well as the suppliers that are delivering us the components that we need to be successful.
That's CoreWeave CEO Michael Intrator with BTech host Caroline Hyde and Ed Ludlow on BTV earlier today. Hey, joining us to talk about CoreWeave and some other things that are going on in the tech space, all with some AI aspects. With us is BTech co-host Caroline Hyde, along with Bloomberg Intelligence Global Head of Technology Research Mandeep Singh, both here in studio. I want to get to the interview in a moment, but I want to bring in you, Mandeep. Step back. What insight did we get on the company's business as a result of this quarterly update?
That data center demand far outstrips supply, and it's not just at the chip level. It's actually at the facility level, because in this case, they were not able to bring a data center online in time to fulfill, a customer order in terms of giving them the GPUs. And so this is way beyond chips at this point of time. I mean, he didn't attribute it to power specifically, but it's more at the facility level than it was at the chip level before.
Caroline, come on in here, because you guys asked the company's CEO, Michael Intrator, who we just heard from, specifically about the delay and the client. And, this company has been not under pressure, but critics have essentially said, and he addressed this, that, there's a small number of clients that pay a lot. Do we know anything about the client or the partner that ordered this, or where the bottleneck is coming from?
He's very loyal, so he wouldn't name the client. Okay. He wouldn't name the data center builder partner that has got them into this mess. But you're right, ever since CoreWeave went public, it's one of the first neoclouds to be in public shareholders' hands. What's a neocloud? It's this new form of accessing compute. And people are still trying to struggle as to what really the underlying assets is that they own, how the business model really works, and what is clear from this its hiccup in its supply chain is that it is dependent on an entire ecosystem of which it can't control. He was very clear about that in the interview, saying, look, usually they have very good partners. They still think that this partner is a good one. They work with them significantly. But there are going to be choke points. There are going to be bottlenecks, whether it's power, whether it's access to just permissions to build, whether it's going to be the cooling systems that they have around, whether it's access to servers, GPUs. In this case, it was sort of the PowerShell situation. It's more the interior of the data center. But I think what he's trying to make clear here is that his business will eventually thrive as it scales out, as it's less dependent on one single data center builder, and as they build out more of their own. He's building out his engineering talent, his labor force, so that he can, in a vertically integrated manner, bring on NVIDIA's relationship that she thinks is really core to the business offering, get the GPUs in place.
Well, the assumption is, right, Mandeep, is that this, we're seeing incredible demand, and whether the power is not there or there's, hiccups in the supply chain and kind of meeting all of that demand, the assumption is that demand, though, is going to stay and continue to grow. But is that still possibly a question in terms of the need, the use of AI, the implementation of AI, and all that it brings with it? Is that demand, can we assume it's going to stay or really just grow at the current levels? Like, do we know that for certain?
I mean, we track the backlog numbers of all the hyperscalers, and CoreWeave actually give out a backlog number which grew 85% quarter over quarter. So, when you look at the aggregate backlog number, we're talking about 1.2 trillion in aggregate backlog for all the hyperscalers, including CoreWeave. And that has grown almost 500 billion this year. So when you see that kind of growth, I mean, companies are committing, whether it's a 5-year contract or a 3-year contract, that backlog is a committed contract. And in the case of CoreWeave, that 55 billion will translate into revenue over the next 5 years. And I'm not even including the OpenAI deal, which I don't think is part of that backlog. So these are committed contracts. And so CoreWeave is at a revenue of $6 billion run rate. You can see from the backlog, even with a 5-year duration, they'll have 11 billion of revenue next year. So you add up 11 billion in revenue for next year. So from that perspective, I mean, the visibility and the line of sight is pretty clear in terms of that translating into revenue. Margins is where the big question is for a company like CoreWeave, because these assets are not 15 to 20-year-old, useful life assets. These are probably 3 to 4 year useful life.
So the rebuild will have to happen.
And then you have to get new NVIDIA GPUs and, the use. I mean, that's the other thing that could have delayed this, because everyone is waiting for the latest Blackwell chips. Nobody wants Hopper. So if you're a CoreWeave building a data center, your customer is asking you a data center with the latest Blackwell chips as opposed to, Hopper. And it just, there wasn't enough time to build a completely new data center with Blackwell chips. So that's why they delayed it by a quarter. Again, it's a hypothesis. We don't know for sure. Right. But that could be one of the reasons as well.
But Caroline, to your point, you went through a whole host of issues that could cause delay in something such as this, including power actually getting hooked up to something. John Gittleson out with a story yesterday about 2 data centers in Santa Clara that have been built and that are just sitting there because there's no power connected to them. It hasn't been hooked up at this point. Is there an opportunity for at least local, state, or the federal government to actually come in from a permitting perspective, from some sort of removal of red tape to actually make this process easier and to remove some of these choke points?
I love that you asked that question, because that's exactly what we asked Michael in Trader, and he was like, I would like significant government support here in terms of permitting, in terms of streamlining, in terms of ensuring that we can get these enormous investments online as quickly as possible. So yes, the government can and should play a role from his perspective. He's not in any way starting to encroach on the whole Sarah Fryer backlash that we got last week with OpenAI, and a worry about, whether or not the government should in some way be talking about the GPU asset deterioration. And that's exactly where Mandeep was just taking us, because these are depreciating assets, and we don't actually know how quickly they depreciate. Chris Bryant out from Bloomberg Opinion writing a beautiful piece today all about saying, and leaning into Michael Barry's piece here, that a lot of these hyperscalers are perhaps being too optimistic as to how long this infrastructure, the GPUs, will actually last. Are A100s still useful? Many would say they're still using them at 100%. But are they really? Are we really going to see 4-year or is it 6-year? We don't really understand. And that's a key question that sort of hangs over everyone's head. But maybe that was where, at the time, the trial balloon went up from OpenAI. Does the government want to back that? No, it doesn't want to back that. Okay, we never said that to begin with. Maybe only if we're going to be chip manufacturing. But I think more broadly, that's a different set of questions than really what the supply chain chokehold is that we're currently facing in the US and whether it slows down. Look what's happening in Europe today. Microsoft scaling out in Portugal in a big way using Nscale, a competitor. We're seeing Nebius rising 300% in terms of revenue. There's a lot of neo clouds people could depend upon, but from Michael and Trader's perspective, none of them can satiate demand. None of them will put together.
I guess what I keep thinking about, and I know it's not apples to apples, but like the great financial crisis where it was like so much money out there, the build on houses, and then we had all these empty houses and developments. Could we see, Mandeep, like this build out of data centers and then ultimately, okay, the demand longer term isn't there and that we have all these empty data centers?
I mean, so far we are not seeing any signs where people have said, oh, we don't want to use more AI compute or anything along those lines. If anything, hyperscalers themselves are the biggest users of compute. When you think of Microsoft, Google, Meta, I mean, yes, their cloud businesses are growing, but they are among the biggest consumers of the AI compute.
Right.
So from that perspective, I don't doubt, that there will be a demand issue, at least in the near term, because they are the ones who have more demand for their own chips.
So, all right, we only have a couple minutes. There's so much going on. We've got AI execs moving around, Meta's chief artificial intelligence leaving to launch his own startup. That's from the FT. Intel's chief technology and AI officer leaving the company to take a role at OpenAI. You've got SoftBank selling its entire stake in NVIDIA. Got about 45 seconds each. You take one story that you think is interesting.
I think the NVIDIA SoftBank one is interesting because I don't think this is the AI bubble popping either. And I think that's what that headline stirred, anxiety. Oh my goodness, they're getting rid of all of their NVIDIA stake. Why? Because it's risen as much as possible.
$5.8 billion.
Which isn't much. It's a $5 trillion company. Should have weighed on the stock that much. Maybe there was a little bit of just reaction to the headline. But ultimately, this is a clever bet by SoftBank. They bought back in 2020. $3 billion became $5.8 billion. They're going to redeploy that money into OpenAI, which is only going to build and buy more NVIDIA GPUs in the longer term. I kind of think it's a good story.
Circular finance is still...
Get on the whiteboard.
It still survives.
But maybe the concern, Mandeep, is that, okay, SoftBank sees the opportunity being greater in these startups than it does in NVIDIA. That's why they're getting out of this investment and putting it somewhere else.
I mean, if anything, our thesis is the concentration is becoming even more kind of peculiar in terms of how these companies are the ones who are dictating whether it's the LLM players or the cloud guys, because with AI, I mean, even like with cloud, you have 3 hyperscalers. With AI, I think the concentration is becoming even more powerful, and that's the one thing.
Powerful good, powerful scary?
Scary, actually. And that's where, you see these departures. Why are these guys leaving for OpenAI? Because that's where everything is happening. And,
it's the nucleus, I feel like. Oh my God, that was so much fun. Come back tomorrow and do the same thing.
Please. Always.
VTech co-host Caroline Hyde, along with Bloomberg Intelligence Global Head of Technology Research Mandeep Singh. Still to come, the #1 gainer in the S&P 500, a name that is in the media a lot. That when we continue.
6:40 on Wall Street. I'm Alexis Christoforous, and it continues to be a split market. The Dow Jones Industrial Average rallying 549 points to 47,920, led higher by Nike and healthcare stocks. In the broader market, the S&P 500 up 18 points, but the Nasdaq Composite in the red by about 39 as investors shy away from some of those high-valued tech names. Speaking of which, we've got shares of AMD slightly lower today. Its CEO, Lisa Su, says annual revenue growth will average more than 35% over the next 3 to 5 years, and that AMD's AI data center revenue will increase by an average of 80%. Su predicts the total AI chip market will reach $1 trillion by 2030. Elsewhere in stock news, shares of Beyond Meat trading down about 7% after the plant-based meat company reported third-quarter results that missed analysts' expectations. It also provided a weak forecast in the fourth quarter. And shares of Gemini space station sinking 15%. This is the crypto exchange founded by the Winklevoss twins. It's reporting a steeper loss than expected in its first earnings release since going public. And shares of Sony rallying today, the company raising its profit outlook and getting a boost from recent hit titles, including the anime movie Demon Slayer. Shares of Sony now up nearly 4.5%. For on-demand news 24 hours a day, subscribe to Bloomberg News Now, wherever you get your podcasts. I'm Alexis Christoforous. That's your Bloomberg Business Flash. Back over to Carol and Tim.
All right, Alexis, thank you so much. Hey, one stock and company that we wanted to highlight, it is the number one gainer in the S&P 500 today. It's up about 9%. We're talking about Paramount Skydance, shares rallying. In fact, they've been up more than 12% at their intraday high today after the newly merged company raised its target for job cuts and cost-saving measures. As you know, the media and entertainment company has also been trying to buy rival Warner Brothers Discovery. It also said in a letter to shareholders, we talked about this a little bit, that it plans an additional 1,600-person workforce reduction and did lay out a specific goal to achieve at least $3 billion, Tim, in cost savings.
With more on the results, the company and its place in the world of media and its future, too. Bloomberg Intelligence senior media analyst Geetha Ranganathan joins us. She's at Bloomberg Intelligence headquarters in Princeton, New Jersey. Geetha, is today's move, before we get to the big picture, is today's move all the result of that at least $3 billion in cost savings? Is that why investors are happy today?
Yeah, absolutely, Tim. So, the $3 billion cost savings target, which was upward guidance revision from the $2 billion, basically caused them to lift their EBITDA target for 2026. I mean, when I say lift, it's much higher than what consensus was expecting. So consensus was expecting around $3.1 billion for 2026. They came in at $3.5 billion. So I think that really gave investors some cause to cheer, and that's driving the stock upwards today.
Well, we should just remind everyone. Carol always points this out, that that includes an additional 1,600-person workforce reduction. So I would imagine there are people within the organization that are worried about not having a job in the near future. Do we know at all where these layoffs will hit?
So these layoffs, actually, the 1,600 are going to be a part of their Latin American operation. So they're going to do some of the divestitures of their LATAM assets in Chile, in Argentina, and a lot of those job cuts are actually associated with that.
All right. So, you know what, Geetha, I keep thinking, is this the media company to watch right now?
It definitely is, Carol. So, a lot of what David Ellison and his team laid out yesterday, I mean, they came across as a really strong team with a very, they have a game plan. They know what they're doing. But at the end of the day, and if you just look at the playbook, right, you guys mentioned the cost synergies, which are a big part of, the forward plan. But if you just kind of think back a few years, this is so reminiscent of exactly what Warner Brothers Discovery did. This was their playbook. They came in with, the merger of Warner Brothers and Discovery. They kind of kept raising their synergy targets. But at the end, what happened was everything fell apart because they couldn't really kind of get to the initial EBITDA target that they had laid out up until this year, of course, when they, kind of came out with their whole plan to separate the company. So one doesn't really know what's going to happen with Paramount Skydance. So yes, things looked pretty promising as laid out by the management team yesterday. They obviously are not afraid to make big, bold bets when it comes to content. We saw them. They're ready to spend about $8 billion on UFC content. They obviously are more than willing to go after Warner Brothers Discovery. But at the end of the day, it's going to come down to, execution. Are they going to actually be able to execute? And even if they do execute, is it going to be enough? Those are really the questions, because I'm not sure. Yes, they might be able to drive up their streaming subscriber base a little bit. They have about 80 million right now. But then when you're competing with Netflix, which has well over 310 million, again, what do? You need something transformative. So you do need that Warner Brothers Discovery acquisition.
Well, I do think about kind of where media companies are going, Geeta. Who would have thought at